Hello friends, so welcome to this CA final SFM Strategic Financial Management revision lecture. Today I would like to help you all in revising the entire subject in a short span, as short as possible. The first chapter that we are going to take up is security valuation. So I'll write down here security valuation. Okay. Now within security valuation there are three parts: bond valuation, equity valuation and money market instruments. First of all, let us do the revision for bond valuation. So I'll write here bond valuation. Okay. Now within bond valuation there are few concepts. Let us touch each one of them. So first concept that we need to study is the basic valuation of bonds. Next concept that we need to study, or I might say revise, is yield to maturity. The next concept we need to revise is calculating actual market price using YTM. Next we need to revise is reinvestment rate assumption. Next we need to understand and revise is dirty and clean price of a bond. Next we need to revise is duration and volatility. Then of course duration of a portfolio is another concept connected to duration and volatility. Next is bond immunization. Next is bond refunding, convertible bond terminology, bond convexity. So in all students there are 11 concepts that we need to study, or I might say revise, in this video, or I might say in this revision series of SFM bond valuation. So let's start one by one. So the first basic concept that we need to revise is basic valuation of bonds. So in bonds there are four types of bonds that we need to learn how to value. One is called as a plain vanilla bond. The next is called as a perpetual bond. The next is called as an annuity bond, and the last one is a zero coupon bond. Now first of all, what is valuation? Valuation refers to how much I am ready to max pay for this instrument today. Theoretical valuation it is also called. It is also called as intrinsic value. So intrinsic value, theoretical value, value is basically what I am ready to max pay today. And mathematically, how is the value calculated? It is nothing but the present value of all future cash inflows. So now if I talk about valuing a plain vanilla bond, what is a plain vanilla bond? It is the normal debenture or normal bond that you know that gives you interest for n years and then gives you a redemption value at the end of nth year. Correct? It will give you interest for n years and then it will give you redemption value at the end of nth year. Students, how do we value such a bond? Very simple. We calculate present value of all future cash flows. Can I say in future cash flows you have got interest for n years and redemption value at the end of nth year? Can I say interest into the annuity factor, because every year interest would be same, plus redemption value into discounting factor, one shot last year, will give you the value of a plain vanilla bond. Now within plain vanilla bond there could come two types of plain vanilla bond. One is an annual bond and one is a semi-annual bond. Annual bond, very simple, you know how to do it. Semi-annual bond means a bond which will pay you interest not at the end of every year but at the end of every 6-month period. So basically if there are 5 years in a bond, we have to consider 10 periods. Also the discounting rate, if our required rate of return at which we discount future cash flows is, let's say, 16%, we will be considering 8% because here we will be doing periodic discounting. So we will take one question each for both of them and then we'll go ahead. So first of all, let's talk about a plain vanilla bond. Okay, a plain vanilla bond question. Let me show one question to you. Okay, so let's take this question number 1. A 1,000 rupee par value bond bearing a coupon rate of 14% matures after 5 years. Okay, so there is a 1,000 rupee par value bond bearing a coupon of 14%, which means, can I say, 140 rupees interest every year for 5 years, and at the end of basically 5th year, you will get your redemption back 1000 rupees. So if your required rate of return is 13%, what is the value of the bond? Very simple. Do you realize it will be 140 rupees interest per annum? So the present value will be 140 into the annuity factor of 13% 5 years plus 1000 rupees at the end of 5th year into discounting factor of 13% 5th year. I'll show you how the solution would look. Okay. I'll take you to the solution. Yeah, this is how it will look. Very simple. Present value of interest plus present value of RV. Correct. 140 into annuity factor plus 1000 into discounting factor will give you the value of the bond. You could alternatively make a table also for this. You could make a table like this: year, cash inflow, discounting factor at the rate 13%, present value. Can I say for 5 years you will be getting 140 rupees interest. At the end of 5th year you will be getting 1000 rupees as a redemption value. Take the annuity factor here, take the discounting factor here, and this is how you get the value of the bond. Simple. Correct. This is an annual bond. Now how do we value a semi-annual bond? I'll take one question for that. For a semi-annual bond, read this question number 3. They are saying if a 100 rupee par value bond carries a coupon rate of 12% and maturity of 8 years, but interest is payable semi-annually, then what is the value of the bond if the required rate of return is 14%? So first of all, how many years? 8 years. But when we are doing the valuation, we will not take 8 years, we will consider 16 periods, because in each year there are 2 interest payments that we will be receiving. So therefore, when we do the calculation, I hope you know value of bond, value of equity, value of a company, value of anything is present value of all future cash flows. So it is PV of future CI, correct? But now generally what columns do we make? We make year, cash inflow, discounting factor at the rate some percent, present value, correct? In year we would have written 1, 2, 8 and 8, and the required rate of return is 14%, we would have written this year. But now since it is semi-annual, we will not be considering 8 years, we will be considering 16 periods. Everybody clear? We will be considering 16 periods, and also my required rate of return, which is annually 14%, but because we are doing semi-annually, this will become 7%. Okay, it's half basically. Now as far as the coupons are concerned, 100 rupee par value, 12% coupon rate means 12 rupees per annum, which means 6 rupees per period. Everybody clear? 6 rupees per period. So basically for 16 periods you will be getting 6 rupees per period. At the end of 16th period you will be getting 100 rupees redemption value. Take the calcium, normally calculate this: 1 divided by 1.07. Press equal to 16 times, press GT, get the annuity factor, and the 16th period discounting factor, that will give you value of the bond. That's it. Everyone clear? So with that we complete the discussion to a plain vanilla bond, annual as well as semi-annual. Next students, I would like to take you to, okay, so we are done with basically and plain vanilla bond annual, plain vanilla bond semi-annual. Now I will teach you annuity bond. Now what is annuity bond? Annuity bond is such a bond which is redeemed in installments, which means such a bond is not going to only give you interest for n years and RV one shot at the end of nth year. It will keep giving you interest plus some principal repayment at the end of every year, which means the principal is amortized over the life, and that is how you get your money back. That's why it is called as an annuity bond. So how do we find the value of an annuity bond? Very simple. End of the day, the value is present value of future cash flows. So whatever future cash flows you will get, take the present value, game over. I'll show it to you how. So for an annuity bond, let us take a question here. Okay, so yeah, see this question number 4. A PSU is proposing to sell or issue 8-year bond of 1000 at 10% coupon rate. The bond will be amortized equally over its life. Equally over its life means 1000 rupees won't be given to you one shot at the end of 8th year. It will become 1000 divided by 8. Every year 125 rupees you will get back. Everyone clear? Every year 125 rupees principal you will get back. Accordingly, can I say the interest every year will keep changing. So if an investor has a minimum required return of 8%, what is the bond's present value? So students, how to find this? Very simple. Take future cash flows and discount them, but you will require a table here. I'll tell you what kind of table you will require. See, it will be year 1, 2, 3, 4, 5, 6, 7, 8. then you will have the principal repaid. This is one cash inflow you're getting. Apart from that, can I say interest is another cash inflow you will getting, and then total cash inflow you will get. This total cash inflow you will discount at the rate 8%, correct? Discount at the rate 8% and you will get present value. Now principal, as you know, every year 125, 125, 125 you will keep getting. As far as interest is concerned, 1000 into 10%. First year you will get 100 rupees interest. But can I say, since at the end of first year 125 rupees principal has been repaid, do you realize 125 rupees into 10%, that is 12.5 rupees interest every year will get reduced, because every year principal is getting reduced by 125, right? If principal gets reduced by 125 every year, then corresponding the interest will keep getting reduced by 10%, that is 12.5. So basically this is 87.5, this is 75, 62.5 and so on. You add this becomes 225, and then this becomes 212.5, correct? And this is 200 and so on. You keep getting the cash inflows, discount them normally at the rate 8% and you will get the value of the bond. This is how you do the calculation. Of course, whatever value you get, this is what you are saying. You are saying this is what I am ready to max pay. They are saying if the bond is asking you to actually pay 1100, should you buy it? Okay, if this particular value is, let's say, 1070, that means you are ready to max pay 1070. They are asking you to pay 1100. We will not pay for it. Simple. Or of course, if the valuation comes to something like 1170, for example, so of course this is an undervalued bond, we will buy it. Everyone clear? So this is how we value an annuity bond. Okay, valuation of an annuity bond. Next is valuation of a perpetual bond. Now simplest of all, students, please understand, perpetual bond means a bond which will pay you interest for perpetuity. There is no redemption here, only interest at the end of every year, fixed interest for perpetuity. How do I calculate value of this particular bond? Very simple. It will be the present value of all future cash flows. But then, sir, future cash flows, if it is eternal, how will we find present value? For that, there is a simple formula. Most of you might be knowing it. That value of a perpetual bond is simply take interest per annum and divide it by the required rate of return. That's it. This small looking formula will capture the present value of all future interest. In fact, in CA Foundation, you must have studied present value of perpetual annuity is cash flow by I. Same formula this is, of course, right? But this is of course having a great derivation behind it, but we are skipping all that right now. So interest upon R, I'll show you one small question. Okay, so here we have got question 5. So they are saying if a bond pays 90 rupees interest annually into perpetuity, every year if it pays 90, what is the value if the current yield is 10%? Very simple, it is interest upon R, that is 900. Similarly, if the yield changes to 8%, 12%, keep changing the rate, we'll keep getting new and new values. Everyone following? So with that, we complete the valuation of a perpetuity bond. Very simple. Next, students, valuation of a convertible bond will keep on hold. It will come in some time. Right now we'll keep it on hold. Now we will go to valuation of a zero coupon bond. Now students, do you realize valuation of a zero coupon bond you need not study separately if you have understood valuation of a normal plain vanilla bond. In a plain vanilla bond, you know it is present value of interest plus present value of RV. In a zero coupon bond, zero coupon means what? Zero coupon means, do you realize, it does not have any coupon, no interest, only RV is there. Such bonds are issued at a discount and redeemed at par. So for you, the only future cash inflow you will be getting is the redemption value, and hence do you realize in such a valuation the interest portion will be removed. The only thing left will be this much. That's it. Present value of the redemption value is the value of the bond. That's it, right? So with that, students, we complete the discussion to this particular point, that is basic valuation of bonds. So can I say out of your 11 concepts, right, out of 11 concepts, one is done, one broad concept is done. Next, students, we move on to the second point, that is called as yield to maturity. Now students, what is the definition of yield to maturity? Yield to maturity is the rate of return that an investor will earn if he or she buys a bond today at its current market price and holds it till maturity. Okay, YTM is what you will earn if you purchase the bond today at its current market price and hold it till maturity. That is called as yield to maturity. Is of course a per annum percentage rate of return. To calculate this, there are two methods. One method is the shortcut YTM formula, which is recommended. But YTM shortcut formula, it is recommended only if it is a normal plain vanilla bond. Otherwise, you can also calculate the same using IRR trial and error method. Okay, IRR trial and error method. So of course, if a particular bond is having some complications, some interest rates are changing, some redemption is happening in between, or it's not a plain vanilla bond, then of course, please take help of IRR trial and error method. Okay, so we'll take up a question to understand YTM. Okay, so let's now take question 9. If the price per bond is 90, okay, if the price per bond is 90, which means today the bond's price is trading at 90, the bond has a par value of 100, that is face value, and a coupon rate of 14% and a maturity of 6 years, calculate YTM. So students, first of all, I will tell you the YTM formula. So the YTM formula which you are 100% allowed to use in the exam, if it's a plain vanilla bond, is the interest plus redemption value minus market value upon number of years, the whole upon redemption value plus market value upon 2 into 100. Yes, this is the KD formula of inter-CA. In inter-CA, this formula was KD because it was cost of debt from company's point of view. But this is same YTM formula from debenture holders point of view. See, what is YTM, what is IRR, what is actual rate of return earned by the investor is considered as the cost for the company, right? This is the YTM formula. So now let's put numbers. Interest is how much? Interest here is 100 into 14%, that is 14, plus redemption value, I guess they have not given, so we will consider redemption at par, that is 100. So 100 minus market value is 90, so minus 90, the whole divided by how many years? 6 years, so divided by 6, the whole upon 100 plus 90 divided by 2 into 100. So if we solve this, this is 14 plus, so now this is 100 minus 90 divided by 6, this comes to 1.67, and this is 95 into 100. So this will be 14 plus 1.67 divided by 95 into 100, and this comes to 16.49%. So this is how you calculate the YTM using the YTM formula. You can now also use a trial and error method. Okay, YTM trial and error, basically the IRR method also can be used. So now that we have got the YTM as 16.49, I want you to know this is an approximate answer but allowed in the exam. Okay, so what we will do is IRR. Now IRR is what? IRR is that discounting rate at which NPV is 0. Everybody remembers. So to start the trials, let us start at 16% and see where we land. Okay, so I'll show you method 2 now, that is IRR trial and error method. So here I'll write year, cash flow, discounting factor at the rate 16%, present value. In year, I'll start with year 0. How many years are there? Total 6 years. So I'll write 1 to 6 and 6. So see, in NPV, what do? We first of all write the initial investment that you as an investor has to do for the bond, that is the current market price. Then can I say for 6 years you will be getting 14 rupees as the coupon and then 100 rupees as the redemption. So this is your cash outflow, these are your cash inflows. We calculate the present value. Can I say we will get the net present value at the rate 16%, PV of CI minus PV of CO net off. Okay, so the discounting factor here is 1. Now I do 1 divided by 1.16 equal to M plus 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 equal to M plus, and I'll just do it once more. 1 divided by 1.16, 1, 2, 3, 4, 5, 6. So the sixth year is 0.4104 and the annuity factor is 3.6847. Now students, let's calculate the NPV. I'll do 90 into 1 M minus 14 into 3.6847 M plus 100 into 0.4104 M plus MRC. We get NPV as 2.63. So it is very close to 0. So what we will do is to bring it down to 0, let us jump one more, let's go to 17. So I'll do discounting factor at the rate 17%. This is of course 1. Let's do it again. 1 divided by 1.17. I hope you all remember how to do IRR, trial and error method, right? So 1, 2, 3, 4, 5, 6. So the sixth year is 0.3898 and the annuity factor is 3.5892. So I'll take the calci and I'll do 14 multiplied by 3.5892. I'll press M plus 100 into 0.3898 M plus and of course 90 M minus MRC. We get NPV at the rate 17% as negative 0.77. Once we have these two numbers, you have to simply interpolate. Can I say YTM or IRR will be 16% plus X? I will just do the calculation here. 16% you have got 2.63 NPV, 17% you have got negative 0.77 NPV. Can I say at YTM the NPV has to be 0? Can I say rate we increased by 1%, the NPV fell from 2.63 to negative 0.77, correct? And that is a total fall of 2.63 plus 0.77. It's a total fall of 3.4. I wanted it to fall from 2.63 to only 0, which means for a 2.63 fall, I should have increased the rate by how much? So 2.63 into 1 divided by 3.4, that gives you 0.77. That I should have increased above 16% and therefore your YTM comes to 16.77%. This is how you calculate yield to maturity, that is YTM. Yes, using shortcut method. Shortcut is allowed for plain vanilla bond, and this is the trial and error method, right? Now students, there is one more small concept here called as current yield. So if the question asks you current yield, simply take the first expected interest, only one first expected interest upon current market price into 100. That's it. Okay, which means if in this question they would have asked you current yield, then can I say your first expected interest from today would have been 100 into 14%, that is 14, and current market price is 90. It's simple, 14 by 90 into 100. So that would have come to 14 divided by 90 into 100, that is 15.56%. Everyone clear? That is the current yield. So current yield done, yield to maturity done. With that students, we finished the discussion to yield to maturity as well as current yield. Okay, so these two are done. Now there is one small concept here, that is YTM with tax. Okay, YTM with tax. So what to do if tax rate is also given and YTM is also asked? So for that I will take you to a question and explain it to you through there. So let us take up question number 12. There is a 9% 5-year bond issue in the market. Issue price is 90, redemption price is 105. Now can I say this is clearly a bond having a face value of 100. It is not given, but we will assume it to be 100. For an investor with a marginal tax rate of 30% and capital gain tax of 10%, what is the post-tax YTM? Now students, for some time now, let us not read this. Let's assume that is not given. If this was not given, how would you have calculated YTM? Okay, how would you have done it? Normal formula, right? YTM is equal to interest plus RV minus MV upon N, the whole upon RV plus MV upon 2 into 100. This is how we would have done it. Now the interest is how much? Can I say 100 into 9%, that is 9. Redemption value given to you is 105. Market price or issue price given to you is 90. So 105 minus 90 divided by number of years, I guess is 5, right? 5-year bond. The whole upon 105 plus 90 upon 2, correct, into 100. This is what we would have done. But now since there is tax, can I say as an investor, your returns, your actual IRR would be net of tax, right? Net of whatever tax you have to pay. So this rate that we have been calculating, can I say is pre-tax in one sense. It is ignoring tax. But if tax is taken into consideration, your overall YTM will reduce by the tax amount. So now how do we do that? So first of all, they are saying that your tax rate is 30%. Okay. If our tax rate is 30%, that means, do you realize that the interest that we will be earning from the bond, we will have to pay tax on it, and therefore we will be earning a net of tax or post-tax interest, which means this 9 that we have written here, instead of 9, we have to write 9 into 1 minus 0.3. Point number 1 clear. Second point, they are saying our capital gain tax is 10%. Now, if capital gain tax is 10%, do you realize that here the 105 rupees that we got as redemption, we might actually not get that entire 105 rupees as cash home, because do you realize 105 is of course the redemption that we are getting, but from this 105 we will also have to pay a little bit of tax. Why sir? Why tax we will have to pay? We will have to pay tax because, do you understand that there is a 15 rupees capital gain that you have earned? 90 rupees is what you had invested, 105 is what you will get back as redemption. So 15 rupees is the capital gain that you will get. On this capital gain of 15 rupees, 10% tax you will have to pay. So I'll just multiply the 10% tax. Basically 105 rupees, yes, redemption value I will get, but that same year on 15 rupees 10%, 1.5 rupees tax I have to pay to the government. So can I say the net of tax redemption value that I will be getting is only 103.5, which is what we will write here, 103.5. That's how you calculate and you get the YTM post tax, right? So students, with that we complete the discussion to the second out of 11 concepts, that is yield to maturity. Everything that was needed to be discussed conceptually is done. Okay. Next students, we move on to the third concept, that is calculating actual market price using YTM. Here nothing to solve as such. There are of course many practice questions, many questions which are there in your books also, wherever you all have studied your SFM from. But I would like to tell you that one simple thing you should know: if the future cash flows are discounted at the required rate of return, I'll again repeat, if future cash flows are discounted at the required rate of return, the present value that you get is the theoretical or intrinsic value of the bond, which is what you are ready to max pay for the bond, which is what we did in this first module, the first concept, right? But students, I would like to tell you that if the same future cash flows are discounted not at the required return, but if they are discounted at the YTM, yield to maturity, actual return, IRR, if at that rate you are discounting the future cash flow, if your discounting rate is same as IRR, then students, the present value of future cash inflows that you will get is not the theoretical value of the bond, it is the actual current market price of the bond. Which means if you want to find the actual current market price of the bond, take the future cash flows of the bond and discount them at the rate YTM, the present value is the actual current market price of the bond. That is this concept number 3. Next students, we move on to concept number 4, that is reinvestment rate assumption. Now what is reinvestment rate assumption saying? Reinvestment rate assumption is saying that if you want to generate YTM, see students, now for example here we got YTM, I'll take the normal question here, this one, we got the YTM as 16.77%, right? Now what is 16.77%? 16.77% is the actual rate of return that an investor will earn if he or she buys this bond at 90 rupees and then holds it till maturity. But then reinvestment rate assumption says that, dear investor, if you actually want to realize this 16.77%, then there is a reinvestment rate assumption which states that whichever cash flows you will be getting in between this 14, everything that you will be getting, no, you will not be sitting on those cash flows as and when you get it. You will have to keep reinvesting the cash flows, and that too exactly at 16.77% outside in the world somewhere. If you fail to do this reinvestment, then the actual yield that you will eventually get would either be less or more than 16.77 depending on how you are reinvesting. If you are reinvesting at a rate less than 16.77% outside, your eventual yield that you will actually realize, your realized yield will be less than 16.77%. If you are able to reinvest at a rate more than 16.77%, your realized yield will be more than 16.77%. If you are able to reinvest exactly at 16.77%, only then your realized yield will be 16.77%. That is the assumption, which means here the YTM, the bond is saying you buy this bond today and hold till maturity, you will get 16.77% as the YTM. But then we realize that, hey, if we really want a 16.77 YTM, then we cannot just buy the bond and sit like this only. Whatever cash flows we will get, we will have to keep reinvesting the cash flows exactly at the rate 16.77%. So we'll take an example to understand how that works. So it is very, very similar to modified IRR concept of inter-CA. So that same bond we will take again. Okay, same numbers we will take on which we had calculated the YTM, this one. So of course the par value is 100, coupon rate 14% for 6 years. So first of all, I will teach you how to reinvest the cash flows. Okay, whenever you get the money, how to reinvest. So there are 1, 2, 3, 4, 5 and 6 years in which you will be getting the cash flows. What all cash flows you will be getting? Can I say you will be getting 14 rupees every year for the next I might say 5 years, and 114 at the end of 6th year, because 14 plus the principal repayment. Now I want you to reinvest it and get a lump sum at the end of 6th year. Reinvest means whatever money you would get, put it outside, put it in some bank, put it in some investment and keep accumulating it, and let's see how much lump sum you are able to accumulate at the end of 6th year. So for that we don't need to now calculate discounting factor, we need compounding factor. We don't need present value, we need future value. So I'll write compounding factor at the rate 16.77%, right? That was the rate. 16.77% was the YTM. So let us discount them at the rate 16.77%. Okay, so the rule is that if you want to actually generate YTM, you have to first of all reinvest all cash flows at the rate YTM. Okay, so now for that what we will have to do, compounding factor, how to calculate. First of all, do you realize the first 14 that you will get at the end of year 1, you will reinvest that till end of year 6. Can I say that is only for a period of 5 years. This will basically be 1.1677 raised to 5. Then the next cash flow, can I say you will reinvest for a period of 4 years, that is end of year 2 till end of year 6. So 1.1677 raised to 4. This will be 1.1677 raised to 3, 1.1677 raised to 2. This is 1.1677 raised to 1. And this is 1.1677 raised to 0. Basically the last year cash flow you cannot reinvest because it is anyways at the end of 6th year. So the compounding factors are 1.1677, I'll take the calci, 1.1677, okay, now raised to 2 will be 1.3635, raised to 3 will be 1.5922, raised to 4 will be 1.8592, and raised to 5 will be 2.1710. Now students, let's get the future value. Okay, so 14 multiplied by 2.1710 m plus. So basically the 14 that you get at the end of year 1, if you reinvest at the rate 16.77% for 5 years, it will grow till the end of year 6 as 30.394. Then students, 14 into 1.8592 m plus, the next 14 will grow to 26.029 by the end of 6th year. Then the next 14 will grow to 14 into 1.5922 m plus, that is 22.29. Then 14 into 1.3635 m plus, that is 19.09. Then 14 into 1.1677 m plus, that is 16.35. And then of course 114 into 1 is 114. And now if I do MRC, we realize it totals to 228.15, which means this total that you have, all these cash flows you kept getting from the bond, you kept reinvesting them outside, and can I say it accumulated to a lump sum of 228.15. Now that you know how much money you have at the end of year 6, let us calculate how much actual rate of return compounded annually, CAGR as they say, compounded annual growth rate you earned. For that, students, we will have to do step 2, that is future value is equal to present value into 1 plus r raised to n. Do you realize you have invested 90 rupees? Apart from that, you did nothing. You invested 90 in the bond. At the end of 6th year, do you realize it grew to a future value of 228.15, of course in a span of 6 years. So then if your 90 in 6 years grew to a lump sum of 228, that means how much compounded growth rate you must have earned, that is called as your realized yield. Okay, so students, can I say 1 plus r will be equal to, or I might straight away do here, r is equal to 228.15 upon 90, the whole power 1 by 6 minus 1. So students, how to calculate this? So I'll take 228.15 divided by 90, and that comes to 2.535. Power 1 by 6 means 6th root, okay, and minus 1. So how do I calculate 6th root? 2.535 I'll take on calci. I'll press the root sign 12 times. I hope you know all this. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 minus 1 divided by 6 plus 1, and then into equal to 12 times. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. And this, students, comes to 1.1677 minus 1, that is 0.1677. That is, congratulations, exactly the YTM that we had got earlier. So the point I want to explain to you in this particular module, right, or this particular point of reinvestment rate assumption, is that if you are wanting to actually realize the YTM given by the bond, you will have to keep reinvesting the cash flows at the rate YTM. Now questions could come where they could give you some random reinvestment rate, and they will say, okay, if this is the reinvestment rate, what is your realized yield? How much are you actually realizing? Then okay, whatever reinvestment rate they give, reinvest the cash flows, get the future lump sum cash flow, and then FV equal to PV into 1 plus r raised to n you do, and find the r. That is how you solve these type of questions. Okay, so with that we complete the 4th concept out of 11 concepts. Okay, next we go on to point number 5. Students, point number 5 is dirty and clean price of a bond. Here I would just like to tell you that, see, dirty and clean price means, let's say that, okay, there is a company that is paying interest annually. Okay, a company is paying interest annually. Now let's say there is a person who bought this bond at the issue only, first year only bought that bond. The bond is going to have a life of, let's say, 10 years. Okay, now let's say he stays for the first year, earns the interest, stays for the second year, earns the interest, stays for the third year, earns the interest. Now in the 4th year, in 8 months, let's say he is in need of his money back. Can he ask redemption from that particular bond immediately? No, he can't ask for redemption, because the company will say that, hey, there are still so many years left. So if you still want your money back, can I say the only option you have is to sell the bond, right? You'll have to sell the bond in the secondary market. Some other investor will enter the bond. So now let's say you sell it and someone else enters and buys the bond from you. That someone else who buys the bond from you, can I say buys the bond from you in the 8th month of the 4th year, correct? Can I say he or she stays in that bond for 4 months only, and can I say gets full interest at the end of 4th month? Now can I say that full interest, that for that full annum, full period interest that you are getting, full year interest that you are getting, that other person, can I say it appears as if there is some kind of injustice happening here, because the first person who was there in the bond for 8 months should have got 8 months interest, and the new person coming in should have got only 4 months interest. But what happened? The person who stayed for 8 months did not get any interest, and the person who came only for 4 months got the full 12-month interest. So how is this injustice solved? The injustice is solved as follows. When the first person sells the bond to the second person at the end of 8th month, students, the bond is sold at a cum interest price, cum interest price, cumulative of the 8-month interest, okay, which means the price at which the first person will sell the bond to the second person will be a price which not only includes the bond's basic value, it will also be including the accrued interest for 8 months. By that, what will happen? The new person who is coming in is paying two things, is paying not only for the bond, is also paying for accrued interest for 8 months, and then waits for 4 months and gets 12-month interest. Can I say by this all parties are satisfied? The first party is also getting its 8-month interest back. Second party is paying 8-month interest but getting 12-month interest from the company. Basically net earning only 4 months, which he or she actually deserved. So students, that price at which the first investor sold the bond to the second investor is called as the dirty price of the bond. Dirty price is basically the bond's basic value plus the accrued interest. Accrued interest is also there, embedded in the price. That price is called as dirty price of the bond. From that dirty price, if we remove the accrued interest part, then that bond's basic value which is left, that is called as the clean price of the bond. That's the definition and the concept of dirty and clean price. Next, students, we move on to a concept called as duration and volatility of a bond. So now in duration and volatility, students, we have to understand how to solve it. In short, I'll tell you, duration is basically weighted average payback period of the bond, and volatility measures how much percentage the bond price will change for a 1% change in YTM. Everything we'll discuss through one question. We'll understand it and then we'll go ahead, okay? So what I will do is, I will take up a question, let's say question 29, okay? Now what are they saying? Face value of the bond is 1000, coupon rate is 16%, years to maturity is 6, redemption value 1000, yield to maturity 17%, okay? Now they are saying what is the current market price. As we had discussed, since YTM is given to you, simply take the future cash flows, discount them at the rate 17% YTM, present value that you will be getting is the current market price. So first of all, let's knock that off. So what I will do is, I'll take a fresh page here, okay, and then in that I'll write year cash inflow, discounting factor at the rate 17%, present value. In year, future cash flows, we have to discount at the rate 17%, right? How many years are there? 6 years are there. So I'll write 1, 2, 3, 4, 5 and 6. Cash flow, students, tell me 1000 rupees into 16%, that is, can I say 160 rupees per annum? So 160, 160, 160, 160, 160 and 1160 considering last year redemption. Some of you might think, sir, why are you not doing 1-6 and 6? Because we have to calculate the duration, right? So when duration calculation is there, that clubbing you cannot do, okay? You'll understand. So, or I'm pretty sure you remember, you're just revising now, okay? So 1 divided by 1.17, this is 0.8, okay, 855. Students, you can take 3 decimals also, you can take 4 decimals also. Institute generally takes 3 decimals. I'll tell it to you. I generally take 4, but ICAI generally takes 3. So 3 and 4 both are right. Sometimes they take 4 also, but 3 is what they generally do. In CA final module, if you see, most of the questions they have solved using 3 decimals. Okay, great. So 0.855, you have got next 0.731, then you have got 0.624, next is 0.534, next you have got 0.456 and you have got 0.390. okay, now let me take the calci. 160 into 0.855 m plus, this is 136.8, 0.731 m plus, this is 116.96, 0.624 m plus, this is 99.84, 0.534 M plus, this is 85.44, 0.456 M plus, this is 72.96, and then you have got 1160 into 0.390 M plus, this is 452.4, and when you do MRC you get 964.4. This is the current market price. This is not theoretical value, this is actual market price because you have done the discounting at the rate YTM, right? Okay, now that you have this, next they are asking you to find duration. Now how to find duration? There are two methods of finding duration. I will first tell you the first method, then of course the second method. Okay, so first method is where duration is equal to summation of year into PV upon summation of PV. Now, can I say you already have the PV summation as 964.4? So I'll write here 964.4. Summation of year into PV. Now can I say I need another column called as year into PV. Now let's do it. 1 into 136.8 M plus 2 into 116.96 M plus 3 into 99.84 M plus 4 into 85.44 M plus 5 into 72.96. Okay, I'll do it again. 5 into 72.96 M plus and 6 into 452.4 M plus MRC, you get 4091.2, and therefore if you write here 4091.2, so 4091.2 divided by 964.4, you will get a duration of 4.24, and always write years. Okay, 4.24 years. This is how you calculate duration. Now students, there is one more method of calculating duration which institute generally follows. So in that, what do they do? So I'll just mark this column. This is what they don't do. Okay, this is one column they don't do. Okay, instead of that they make two more columns. They calculate weights and then they do year into weights. Okay, I'll tell you how to do it. Now weights means whose weights? The present value column, we have to calculate weights there. So that is 136.8 divided by 964.4, or I might first of all do 1 divided by 964.4, okay, into 136.8. So here the weight is 0.142, then 116.96, here the weight is 0.121, 99.84, the weight is 0.104, 85.44, the weight is 0.089, 72.96, the weight is 0.076, 452.4, the weight is 0.469. Students, let me just take the total of all these weights. I hope it comes to 0. I hope it comes to 1. Okay, so it is 0.142 plus 0.121 plus 0.104 plus 0.089 plus 0.076 plus 0.469. Yes, it is 1.001, around 1 only. Okay, now what we will do, we'll do year into weights. Okay, so let's do it. 1 into 0.142 M plus, 2 into 0.121 M plus, 3 into 0.104 M plus, 4 into 0.089 M plus, 5 into 0.076 M plus, 6 into 0.469 M plus, MRC. Students, they get 4.24. Okay, how much did we get earlier? Yeah, 4.24 years. Same answer we will get, 4.24 years. Everyone clear? So basically either you can do it in this fashion or you can do it directly using this formula. It is the same. That is how you calculate duration. Next students, we have to calculate volatility of the bond. Now volatility, the formula I give you first. The formula of volatility is what? it is duration divided by 1 plus YTM. Please note, volatility is also referred to as modified duration. Okay, volatility is also referred to as modified duration. So volatility is equal to duration upon 1 plus YTM. Your duration is 4.24 years. Your YTM, as you know, your YTM was 17%, so this will become 1.17. So 4.24 divided by 1.17, this comes to 3.62. Point number 1, volatility should always be expressed as percentage. Duration will be years or periods as the question is, but the volatility will be a percentage. Everybody clear till here? The volatility will be a percentage. Now students, please understand what is the meaning of volatility. Students, the meaning of volatility is that, see, right now at 17% YTM, the price of the bond is 964.4, correct? Can I say if YTM increases, price of the bond will fall. If YTM decreases, price of the bond will rise. So volatility is telling you that if YTM changes by 1% from 17, right now it is 17. From 17, if it changes by 1%, then the bond's price will approximately fluctuate in the opposite direction by 3.62%. You understood? That means if YTM goes up by 1%, bond price will drop by approximately 3.62%. If YTM drops by 1%, bond price will approximately rise by 3.62%. That is the meaning of volatility. So they are asking you, calculate the expected price if there is an increase in the YTM by 75 basis points. So basically, if YTM increases by 0.75%, can I say current market price will drop by 3.62 into 0.75, because 3.62 is the drop for 1% change in YTM, right? It's a 0.75. So this is 3.62 into 0.75. Approximately it will drop by 2.715% from 964. So the revised market price would be 964.4 minus 2.715%, and whatever answer that is the answer to this particular question, the last point, right? So with that, students, we complete the discussion to, okay, we complete the discussion to the fourth, or I might say, sorry, the sixth point out of 11 points, that is duration and volatility. Next, we have got duration of a portfolio. Students, duration of a portfolio refers to, see, please understand that every bond has a duration. Like here we had 4.24 years, some bond might have 5.3 years, some bond might have 1.9 years. Every bond has different durations. So if I create a portfolio of these bonds, then what will be the duration of that portfolio? That is this duration of portfolio. Simple. Students, how to calculate? Weighted average. So you will have the total amount invested in each bond. Based on your investment in each bond, can I say you can calculate the weights? Then these weights you multiply by the respective duration of each bond, you get the weighted average duration. That is the duration of the portfolio. So duration of portfolio is nothing but weighted average duration of the portfolio. That's it. Okay. Next we go on to a concept called as bond immunization. Okay. So first of all, bond immunization. Students, bond immunization, that is the 8th concept in this chapter. Immunization here means, see, what happens is that sometimes a particular person might be having a fixed liability at the end of, let's say, 5 years. Okay, a fixed liability at the end of 5 years, correct? Now to match that liability, today this person invests in a bond. Okay, now when he invests in the bond, there are two types of risks that this person will experience. First risk the person will experience is the changes in YTM, and because of that the changes in the reinvestment rate. What happens is, see, I need, let's say, 1 lakh rupees after 5 years. So for that, today only I invested in the bond. Now from the bond I'll keep getting coupons. These coupons which I will be getting, I'll keep reinvesting somewhere, right? Now where I will be reinvesting, if that rate fluctuates up and down, can I say it is possible that I might not exactly meet my target of 1 lakh? Correct? Second problem I have is, what if the bond in which I have invested is having a life let's say more than 5 years, let's say it is having a life of 7 years, then can I say at the end of 5th year I will have to sell off the bond, right? Because redemption I will not get, I'll have to sell off the bond. Now when I sell the bond, what if the YTM has gone up? Because the YTM goes up, the market price of the bond falls. Can I say again I might not be able to meet my target of 1 lakh rupees at the end of 5th year. So students, these risks are there for a particular investor who has invested in a bond to meet a particular liability at the end of particular year. So students, two risks what you saw, one is the reinvestment rate risk, second is the change in the bond prices due to change in YTM risk. These two risks, how to eliminate, that is called as bond immunization. And to immunize, the secret is that you should ensure that the duration of the liability is same as the duration of the asset. Now what happens is, you want to pay off the liability in, let's say, 5 years. 5 years is the duration of the liability. One should ensure that the duration of the assets or the bond in which you are investing is also 5. I never said life of the bond should be 5. I said the duration of the bond should be 5. If the duration of the bond is also 5 years, then students, whatever YTM changes, you will be immunized, you will be vaccinated, doesn't matter. Let the duration, let the YTM go up, let the YTM go down, you will exactly meet your target. But for that, the secret is you have to match the duration of the bond with the duration of the liability. If you do that, your bond will be immunized, right? So for that, students, we have a question. We will pick up, let's say we will pick up question number 36. Okay, this is a very famous exam question. In this I will teach you how to create a bond portfolio so that it matches the duration of the liability. Okay, so what are they saying? Mr. A will need 1 lakh after 2 years. Oh, so his liability is after 2 years. So can I say, to match this, the duration of your bond portfolio should also be 2 years, right? For which he wants to make one-time necessary investment now. He has a choice of 2 types of bonds. The details are as follows. So all these details are given. Students, this current yield here actually they are referring to is YTM. Okay. Advise Mr. A whether he should invest all his money in one type of bond or should he buy both the bonds, and if so, in what quantity. Assume there will be no call risk or default risk. The first question they are asking is, should we invest in one of these two or we need to invest in both? So first of all, students, we will have to calculate the duration of both the bonds. Now if the duration of any of these bonds is exactly 2 years, then can I say we can simply invest in that bond only and game will be over. But if the duration of both of these bonds are not 2 years, then we will have to do some kind of portfolio management here to get that 2 years as the duration of the asset. So let's start. Now let us calculate duration first of all. So I'll write here calculation of duration. Okay. Now for duration of bond X. Okay. So I'll write here bond X. What columns do we make? Year, cash inflow, discounting factor at the rate YTM, that is 10%, present value, and then remember year into present value. There is only 1 year here. 1000 into 7%, so 70 rupees coupon plus the 1000 rupees redemption. Everybody clear? 1070 is what you will get at the end of first year, and then of course that's it. So I will now just take 10%. 1 year is 0.909, so 1070 into 0.909 will give you 972.63, that is 972.73, doesn't matter, 972.73, total is also 972.73. year into PV if you do, you will get 972.73 only. And basically if you see that the duration of bond X will be 972.73 upon 972.73, which is equal to 1 year. So here the duration of bond X is same as its life, that is 1 year. Let's now go to bond Y. Now for bond Y, how many years it is? 4 years. Okay, so here we will have to do some calculations now properly. Year, cash inflow, discounting factor at the rate 10%, present value, year into present value, 1, 2, 3, 4. Coupon will be, can I say, 80 rupees. So this is 80, 80, 80, 1080, 0.909, 0.826. 0.751, 0.683. Let us calculate the present value. 80 into 0.909, that is 72.72, 0.826, that is 66.08, 0.751, that is 60.08, and then 1080 into 0.683, that is 737.64, and this comes to 936.52 exact. Okay, so I'll take here 936.52. This is the current market price. Now year into PV, 1 into 72.72 M plus, 2 into 66.08 M plus, 3 into 60.08 M plus, and 4 into 737.64 M plus, and MRC, this comes to 3335.68. Can I say duration of bond Y will be 3335.68 divided by 936.52, correct? And this, if I do 936.52, if I do you therefore realize that I will get a duration of 3.56 years? Oh, so the first question is answered. Since none of these two bonds are having a duration of exactly 2 years, do you realize that you cannot invest in any one of these two bonds, because the duration of the bond has to match the duration of the liability. Duration of liability is 2 years. Can I say duration of the bond should also be 2 years? So for that, what to do? Simple. We will have to invest in both bonds, create a portfolio of X and Y in such a way that the duration of the portfolio is 2 years. Okay, duration of portfolio is 2 years, so you will be immunized. Now students, let's follow some steps for that. First step, students, is to calculate investment to be done today. Okay, calculation of investment to be done today. And investment to be done today is nothing but the present value of the liability. Students, the liability is 1 lakh after 2 years, so the present value will be 1 lakh into discounting factor of 10% 2 years. So this is 1 lakh into 0.826, correct? And that of course comes to 82,600. So 82,600 rupees is what you will have to invest today. The first step that you need to calculate is how much I need to invest today. See, then I will be able to bifurcate in bond X and bond Y, etc. First question is to know how much I will be required to invest today. It is nothing but present value of the future liability, that is 82,600. Step number 2. Step number 2, students, is to calculate duration of both bonds, which we have already calculated. Duration of bond X is 1 year, duration of bond Y is 3.56 years. So I'll write here 3.56 years. Till here clear? Point number 3, students, is to calculate the weights. Weights means in what weights I should be investing in a portfolio. I need to know in what weights I should be investing in X and Y. Can I say duration of a portfolio will be weight of X into duration of X plus weight of Y into duration of Y. Everyone clear? So students, this here will be, this what I want is 2. Everybody clear? I want the duration of portfolio to be 2. This will be weight of X into 1 plus, instead of weight of Y, I will write 1 minus weight of X into 3.56. So let's solve this. 2 is equal to weight of X plus 3.56 minus 3.56 WX. Everybody clear till here? So now this will be minus 1.56 is equal to, okay, so this will be minus 2.56 WX, and if you solve this, you will get WX as 1.56 divided by 2.56, which is equal to 0.609, and therefore WY will be 1 minus 0.609, that is 0.391, which means now you know that whatever you want to invest, 60.9 should go in X and 39.1% should go in Y. So next I'll write point number 4, that, okay, first of all I'll write what is the current market price of X and Y. Can I say current market price of X and Y? They have only given, we have also calculated 972.73, okay, and 936.52. Now why do I need this? I'll tell you. See, what is your total investment? Total investment to be done was 82,600, correct? So I'll write here 82,600. This, can I say, has to be bifurcated in X and Y in the ratio of 0.609 and 391. So 0.609 and 0.391. So 82,600, okay, 82,600 into 0.609, 50,303 I should invest in X, and 32,297 I should invest in Y. Can I say, if I divide this by the current market price 972.73 and 936.52, can I say I will be able to get the number of bonds that I need to invest? Because I now know 50,000 I want to put in X. One bond is costing 9 or is having a price of 972. So 5303 divided by 972.73, students, 51.7 rounded off to 52 bonds I need to buy of X, and there 32,297 divided by 936.52, 34.48 rounded off to 34 bonds I need to buy of Y. Students, that is what they're asking you. Okay, you should buy both bonds. If so, in what quantity? The quantity is 52 bonds of X and 34 bonds of Y. If you do this, then students, even if there are changes in the YTM, your portfolio will be immunized. Everybody clear? So that is how you calculate bond immunization steps. Okay, next, students, we move on to the next concept, that is of bond refunding. Now here in bond refunding, I would like to tell everyone that, see, first of all, what is the concept? It is same as replacement decision, right? Replacement decision of capital budgeting. Now what are you replacing in a bond here? Okay, let me tell you. In a bond, what you are replacing is, what happens is, let's say you as a company, you are a company here, okay, you have issued, let's say, a 15-year bond, and when you issued, the yields were very high, and therefore let's say you have given a coupon of 12% to your investors for 15 years. Now the life is going on, you are paying 12% coupon. Let's say after 5 years, the yields in the market have dropped from 12 to, let's say, 8%. Which means today if you now issue a new bond, you have to pay only a coupon of 8%. But you cannot do that because you already have an existing bond which you are paying 12%. Now can I say you will slightly feel the heat here because, oh no, I issued at a wrong time when the yield was high, 12% I am paying. Today if I would have issued a new bond, I would have had to pay only 8%. So now you think of issuing new bond, take the proceeds of the new bond and refund or replace the old bond. Basically, you will be now issuing a cheaper bond with a lower interest rate. You will take the money, you will take the proceeds of that new issue and use that proceeds to refund the old bond. Okay, refund the old bond, which is right, which for which you have to pay 12% interest rate. So that for the remaining 10 years at least you can pay only 8% interest rate. But to do all these things, there are a lot of complications, a lot of costs involved. So the whole question is the saving in interest, right, worth it for all the costs that you have to incur for doing this big replacement? That is this concept of bond refunding. Now students, different faculties teach it in different fashions. ICAI has its own method of solving. So here I would like to take a back seat and allow you to read this particular bond refunding from whichever faculty or whichever notes you have read it from, because stick to that only, otherwise this is very confusing if you switch the method at this point, and hence I will keep quiet here. So but in bond refunding, of course, it's a very complicated concept. It's a complicated, not concept, complicated method of solving. If you have grip on replacement decision of capital budgeting, this will become very simple for you. So that much as far as bond refunding is concerned. Then students, we have got some terminologies called as convertible bond terminologies. Let me take you through each one of them. What are these convertible bond terminologies? There are small concepts. Okay, and in each of these concepts there are some formulas that you need to know. The questions can come for 6 marks, 4 marks or even 8 marks. Okay, so I will just take you through all of those concepts quickly. Okay, so yes, so here you can see these many concepts that you need to study. Okay, First, what is a now? You remember I had told you about convertible bond sometime back at the start of the video. We have come back here now. So convertible bond. What is a convertible bond? Convertible bond, students, is a bond which gives the investor an option to convert. Okay, it gives the investor an option to convert its bond to equity shares. Okay, bond to equity shares. Now some convertible bonds give an option to the investor to convert the bonds to equity shares. Some bonds compulsory convert themselves into equity on a particular date. Now students, how do you value a convertible bond? Students, a convertible bond is to be valued like a plain vanilla bond only. Plain vanilla bond means present value of interest plus present value of RV. So that's it. But instead of RV, we will take conversion value. Conversion value means what? It is basically, you will not be getting the redemption in cash, right? You will be getting the redemption in shares. So whatever will be the market value of shares on that date, in which at the time when you're converting, that will be considered as the redemption value. So number of equity shares that you will be getting per bond multiplied by the market price per share of the bond will give you the conversion value that you take instead of the final redemption value, and you get the valuation of the bond. So generally in plain vanilla bond, how do you value? You do interest into PVAF plus RV into DF. Now we'll do interest into PF plus conversion value into discounting factor, where conversion value is nothing but number of equity shares multiplied by the current or the market price of the bond. Then number of equity shares means each bond will be converted into 10 shares, 20 shares, whatever, those many shares, right? Now students, these are these few terminologies. Here I would like you to take a screenshot if you want and just go through all of these, because these small 2, 4, 4, 6, 6 mark or 8 mark questions come through this. So just know, have a grip on all these formulas, and then we'll go ahead. Please take a screenshot. Okay, so these were different terminologies that you need to know. Please go through all of them. Please learn the formulas. Please buy at the formulas, I might say, right? If questions come from these, it's very simple for you to calculate them, right? Okay. Then now this is the big one, bond convexity. Students, bond convexity is a concept which was first time asked in November 2020 paper. It came in one of the MTPs also. Students, ICAI has kept bond convexity, small paragraph in ICAI module. There is a formula also. Students, to understand this, one needs to go through a lot of calculations and understanding the formula. It came for 2 marks. Basically it was a 5-pointer question in which one small point was bond convexity. Total marks were 8. So I presume that one bond convexity must be for 2 marks. Students, to understand this, what I have done is I have already issued one detailed video on bond convexity, okay, on YouTube. If you simply search on YouTube bond convexity JK Shah classes, you will find my video there. You can go through the video to understand and get a grip on what bond convexity is all about. Otherwise, you can just skip to the end of the video, take the formula and go ahead. That is as far as bond convexity is concerned. Otherwise, there is nothing else to revise as such here. It's a formula one needs to take, right? So with that, students, we come to an end to bond valuation part of security valuation. Now we'll move on to equity valuation part. Okay, so let us now go to the equity valuation part. Now students, as far as equity valuation is concerned, I'll first of all show you the list of concepts that we will be covering. So in equity valuation, what we need to study is, see, first of all, just as we have valued bonds, we are supposed to value equity also. Same theme will continue, that value of equity is equal to present value of all future cash flows. In that you have to study Gordon's model, single growth. We have to study Gordon's model, multi-step growth. Study means basically revise, correct? H model is no longer there in your syllabus, so we ignore. Free cash for equity, yes, we have to study FCFE. Walter's model we have to study, still not very important because in inter-C it's already done. Just the formula we'll see and we'll go ahead. Share repurchase and buyback, no such special concept as such, just basic understanding. Valuation of rights is important. So I might just tell you that we will revise Gordon's model single growth, that is one thing. Gordon's model multi-step growth second, then free cash for equity third, and we will do valuation of rights, that is fourth. These 4 points will do. Otherwise everything else is just very simple or straightforward. Okay, let's start. Gordon's model single step. So students, even Walter will do 5. Okay, so first of all, Gordon's single step growth model, what is the formula? Value of equity is equal to D1 upon KE minus G. I think many times you must have done that. D1 stands for expected dividend per share at end of year 1. K is required rate of return. Growth rate. G is the growth rate in dividends and earnings expected for future. If you put numbers, you'll get the value of equity. This is what you're ready to max pay today. That's it, right? Students, next, as far as Gordon's multi-step is concerned, for that we'll pick up a question. Let us pick up a question. Let's pick up, let's say, question number 10. Okay. So what are they saying? MNP has declared and paid dividend of 4 per share. Can I say 4 rupees will therefore become your D0, correct? Dividend which is already paid. It is expected to grow at the rate 20% for the next 2 years and 10% thereafter. Now can you see here, it is not a single growth model, there is a multi-step growth model. For first 2 years it will grow at the rate 20% and then it will grow at the rate 10% thereafter for eternity. Required rate of return to the equity shareholders is 15%. Compute the current price at which the equity shares should sell, basically theoretical price you find, and then they have given to you the discounting factors. Now students, please understand how to solve. Can I say value of equity just as value of bond, just as value of any company, any investment, value of equity is equal to present value of all future cash inflows. Now as far as future cash inflows are concerned, I would have loved to put everything in this one small formula, because I hope you remember this formula captures the present value of all future cash flows starting from D1, D2, D3 till D eternity. But I cannot use that formula because one of the conditions for this formula is that the growth rate should be constant. But now since growth rate is not constant, we will have to make a table. So table is very simple. Year cash inflow discounting factor at the rate 15% and present value. Now can I say for the first 2 years the growth rate is going to be 20%. Last year 4 rupees was paid, so plus 20%. Can I say first year we are expecting 4.8 plus 20%. Next year we are expecting 5.76. Now from third year onwards it is going to grow at a constant rate of 10%. Can I say now we can use the Gordon's formula to find the present value of D3 to D eternity. Generally we would have used Gordon's formula to find the present value of D1 to D eternity, but because growth rate was not constant for the first 2 years, third year onwards it is becoming constant. Hence students, do you realize that 3 to eternity we can club in Gordon's formula as P2. So here we write 2 again. So third to eternity will be calculated present value at end of year 2. I'll put a star. I'll write P2 is equal to D3 upon KE minus G, right? And D3 will be what? 5.76, that is D2 plus 10%. Okay, the whole upon 15% minus 10%. So this is 5.76 plus 10% divided by 5%, and that will give you 126.72. We put 126.72 here. Now this 126.72, can I say, is the present value of 3 to eternity, but as on end of year 2 we need to find total present value as of today. So discounting factors are given to you of year 1 and year 2. I hope you realize 2. Both of these are year 2, okay? Put the numbers and get the answer. That is how you find value of equity in a multi-step growth model, okay? So that done. So concept 1, single growth you know, multi-step growth model you know, and then next students will go for free cash for equity. Now students, first of all I'll give you the concept of what FCF is, and then we'll pick up one question for the same. Free cash for equity basically is a model used to value equity shares using Gordon's model only, But in Gordon's model, what is the model assuming? The model is assuming that the company will pay dividends, right? D1, D2, D3, etc. But how do I value the equity of a company which is not expected to pay dividends? Then students, for a non-dividend paying company, we will have to take help of something called as deemed dividends. You understanding? And deemed dividend means if the company would have paid, how much it would have paid, that is called as deemed dividends. And that deemed dividend is basically calculated as FCFE, that is free cash for equity. Okay, free cash for equity means for equity, what is the free cash available in the company? That will be considered as the dividend and we will do the valuation of the equity share. So for that, students, there is a format that you need to follow to find the free cash for equity. I'll take you to question 23 here. Okay, very famously asked question. Lot of times that it is asked. Let's understand it. Okay. So I'll just write here. Okay, so they are asking calculate the value of the share from the following information. So first of all, they have told you that equity capital of the company is 1300 crores and par value of the share is 40. So do you therefore realize that by this we can easily find number of equity shares? Okay, so I'll write here, number of equity shares will be 1300 crores divided by 40. I take the calci, 1300 divided by 40, 32.5 crore shares are there in the company. Now, why did we do this? Now, let's understand. Students, can you see that the company is planning a capital expenditure of 47 per share? Okay, so can I say capital expenditure will be 32.5 crore into 47. So 32.5 into 47, 1527.5 crore is the capital expenditure that the company is planning. Now the company already has a depreciation fund available of 39 rupees. So I'll just subtract that depreciation of 39 per share. So 32.5 crore into 39. So 32.5 into 39, okay, will give you 1267.5 crore. What is the meaning of depreciation fund available? Students, do you realize that when the company must have calculated this profit of 290, it must have deducted depreciation. Now depreciation, do you realize, is a non-cash expense, which means in expense it is shown as an expense, but in reality cash did not go out. That fund is still there with the company, right? That fund I will subtract from this 1527. So 1527.5 minus 1267.5. Can I say therefore, students, that the company net requires 260 crores for capital expenditure? Everybody clear to here? Actually it requires 1527, but because depreciation, that money is still there with us, net we require only 260 crore. Apart from investment in fixed assets, capital expenditure, we also require to invest in working capital 3.45. So I'll write here working capital investment 32.5 crore into 3.45. So 32.5 into 3.45, if we do, we get 112.125 crores, and if I add 260 to it, I will get 372.125 crore. Now what is 372.125 crore? This is the total investment budget of the company which it needs to invest. Can I say the company basically needs 372.125 crore rupees to satisfy all these requirements of capital expenditures and working capital expenditures. Now from where to get 372.125 crore? For that they are saying that the debt ratio of the company is 27%, means this 372.125 crore that we need to finance, 27% of it we will finance by raising debt. So students, do you realize that debt financing at the rate 27%, if I do, that means 100.47375 crore I will raise through debt, which means students, do you understand that net 271.65 crore we need to raise through equity? So can I say equity funds required is 271.65. So we'll go through this again. We need to do capital expenditure of 1527. We already have 1267. So net capital expenditure we need to do is 260 plus 112 we need for working capital. Total investment we need to do 372. Out of this we will fund this investment 27%. 100 crore will raise through debt. Remaining 271 will raise through equity. So equity funds required is 271. But then I realize I don't need to raise through equity because I already have profits. These profits belong to equity share. These are reserves, right? We already have profits of this particular year, fresh profits of 290 crores. So do you realize if the net profit available with us is 290 crore, we need not raise any fresh equity shares because equity's contribution, can I say, will come through these profits only, which means, do you realize if I subtract 290 from here, I net get 18.35 crore as that profit of equity shareholders which is left, and there is no further use of it because out of 290 crore, yes, there was a 271 crore rupees use which we needed to do for the investment, but this 18.35 crore balance profit, can I say, is of no use for the company actually, and therefore this will be called as the free cash available for equity. Everybody clear? This is your FCFE and I will consider this to be FCFE 0. 0 means basically end of year 0. Students, do you therefore realize that FCFE 0 per share, okay, per share will be 18.35 crore divided by 32.5 crore per share, 18.35, okay, I'll do 18.35 divided by 32.5 and this comes to 0.56. Can I say FCFE 1, that is at the end of year 1, expected will be, since the growth rate is 8%, do you realize it will be 0.56 plus 8%. So I'll do 0.56 plus 8% and this comes to 0.60. So end of the day, what we need to do, value of equity is equal to, generally what we do, D1 upon KE minus G we do. Here instead of D1, because the company is not giving dividends, we will consider the free cash for equity as the dividends, and that, students, we got as 0.60 because literally you saw just now out of the profits 18.35 crore is actually free cash for equity. It could have been distributed as dividends. They are not distributing is a different thing, but if they would have distributed, how much they would have distributed, that is called as free cash for equity, that is FCFE. Everybody clear till here? And I add growth rate to it, I get the FCFE 1 divided by KE minus G, and for KE, students, they have given to you the beta, the IRF, the market return. This is CAPM formula. Use the CAPM formula, get the KE, put the KE here and get the value of equity. Students, that is how you solve free cash for equity questions. Okay, so with that, students, we complete the discussion to FCFE. Walter's model, I'll show the formula here only, nothing great. Can I say value of equity is equal to dividend per share plus earnings per share minus dividend per share into return on equity upon KE, the whole upon KE. They will give you all the numbers, put the numbers here and get the answer, right? That is Walter's model. Share repurchase and buyback, no concept as such, simple 2-3 questions are there which you can revise on your own. We will now go for valuation of rights. Students, valuation of rights and right alone. Now what does that mean? Students, sometimes a company needs to issue shares for raising new funds. Now when it is issuing shares for raising new funds, it could decide to give priority to its existing shareholders only, and therefore it will come out with a rights issue where it gives the existing shareholders rights to issue and subscribe for the rights share issue. Such shares are called as rights shares. Now all the existing shareholders need not subscribe to the rights issue. They can choose not to subscribe also. In case they decide not to subscribe, then they can decide to sell their right alone to an outside shareholder, because an outside shareholder would be wanting to take this right. The existing shareholder could sell the right to the outside shareholder. Now at what price they should sell the rights, that is also this concept all about. So we'll take up one question and through that we will understand it. Okay, so we'll take up question number 32. Okay, yeah, so question 32. What are they saying? AMCO Limited, okay, AMCO Limited has issued 75,000 equity shares of 10 each. Current market price of the share is 36. Company has a plan to make a right issue of one new share at a price of 24 for every 4 shares held, which means 1:4 is the rights issue. For every 4 shares that you will hold, you will get 1 right share. So they are asking you what is the theoretical post rights or ex rights price and what is the theoretical value of the right alone. These two are the most important questions in this module. Of course, there is one more question that they can ask you, is to show the impact on shareholders' wealth. I will do that part also in this question only. I'll embed it here only so that you get revision of that also. So students, now how to calculate X rights or post rights price per share? Very simple. See, I'll write here. X rights price per share is equal to, now see, imagine you are a shareholder owning 4 shares, okay? Can I say you had 4 shares worth rupees 36, the market price per share was 36. Now can I say apart from this you will now get 1 share, and do you realize the 1 share is having a price of 24, the issue price is 24. So do you realize this is your total wealth now? You have 4 shares of 36 and 1 share of 24, and this entire thing I hope you realize will now be divided amongst 5 shares. This was there for you in inter-C accounting also. So if you solve this, this is 4 into 36 m plus 1 into 24 m plus MRC divided by 5, and this comes to 33.6. I'll do the calculation again. 4 into 36, 24, and this divided by 5, yeah, 33.6. So the X rights price, students, comes to 33.6. Second, students, the calculation of value of a right alone. Value of a right alone, I'll straight away give you the formula. The value of the right alone is X rights price minus issue price into number of right shares per right. Okay. Now what does this mean? What is the X rights price? 33.6. What is the issue price? 24. And in one right, how many right shares are there? Can I say one right share is only there? Because see, when will you get one right? If you hold 4 shares, you will get one right to buy one right share. Everybody clear? The rights issue could have been 3:4 also. So if the rights issue is 3:4, that means if you have 4 shares, you get one right to buy 3 right shares, correct? But here you're getting one right to buy only one right share, so this will be into 1. So students, this is 33.6 minus 24, and the value of a right alone comes to 9.6, which means if you are planning to sell your rights, sell it at a price of rupees 9.6. Now students, that is as far as these 2 points are concerned. This question is done. Now I want to just explain to you how the rights issue impact the wealth of a shareholder. So I'll write here impact on wealth of a shareholder, let's say who owns 1000 shares. Okay, currently this shareholder is owning 1000 shares. So I'll first of all say wealth before rights issue. Okay, what is the wealth of the shareholder before rights issue? I'll write particulars, calculation and amount. Students, can I say this only wealth is the value of these existing shares? Whatever shares he has, the value of that is the wealth of the shareholder. 1000 shares this guy or this girl has, and has how many? What is the price of that share? 36, right? The value, the price currently is 36. So I'll multiply by 36 and this comes to 36,000. 36,000 is the wealth of the shareholder before the rights issue. Point number B, what is the wealth after rights issue? In that we will see, students, 3 cases. Okay, we will see 3 cases. If he or she does nothing, okay, if they do nothing about it, then what will be the value? I'll write particulars, calculation, amount. Value of equity share, value of the existing shares, I might say. Can I say if he or she does nothing, they will continue to hold the 1000 shares, but these 1000 shares will now be having a price of 33.6x rights. So I'll multiply by 33.6. Can I say 33,600 rupees will be the value? Do you realize that 2,400 rupees will be the loss that you will suffer if you do nothing after the rights issue, correct? Point number 2. If he or she sells the rights, which means you're still not subscribing to it, but you're doing one thing, good thing, Your rights you are selling to somebody else. Everyone clear? So in that case, what will happen? I'll do particulars, calculation and amount. Do you realize your value of existing shares will of course drop to 33,600? That is going to happen. But apart from that, can I say you will receive cash? Cash received on sale of rights, correct? Cash received on sale of rights. Now how many rights you will have? Can I say for 4 shares you will get 1 right. So for 1000 shares you will get 250 rights. Everybody clear? So 1000 divided by 4, basically 250 rights you will get. Each right I am asking you to sell at what price? Each right I am asking you to sell at 9.6. So I'll multiply by 9.6. Okay, in fact I can do this calculation in the calculation column only. So 1000 divided by 4 into 9.6 if I do, can I say the cash that I will receive on sale of rights is 2400. Can you see my wealth jumps back to the pre-rights case scenario only, and therefore the wealth of the shareholder is not impacted by the rights issue even if it doesn't exercise the rights. He or she, if they don't exercise the rights, it is okay. Just sell the rights, but your wealth will go back to what your wealth was before the rights issue. Everybody clear? The last case, what if he or she exercises the rights? Okay. So I'll write here, if he or she exercises the rights. Okay. What if he or she exercises the rights? In that, students will make 3 columns: particulars, calculation and amount. Now in particulars, students, we will write first of all what are the value of existing shares. You know the value of existing shares are 33,600, correct? But now can I say there will be value of right shares also, new shares also that this person will be getting. How many new shares? 250 rights he had to buy 1 share in every right. 1:4, na? So basically 250 shares he will get extra. These 250 shares that he will get extra, of course, will be having a price of 33.6 only X rights. So 250 into 33.6, 8,400 will be the value of these new right shares which will add on to his portfolio or her portfolio. But these shares do not come free of cost, right? They have to pay some cash for these right shares. So for these 250 shares, how much cash they have to pay? 24 per share, right? So 24 per share cash they have to pay. So 250 into 24, 6,000 rupees, correct? 6,000 rupees is the cash that you will have to pay for purchasing these right shares. So let us check total overall wealth: 33,600 plus 8,400 minus 6,000. It again comes back to 36. So even if you exercise the rights, your wealth will not get impacted. So basically there are 2 cases in which your wealth won't get impacted. First case, if you sell the rights. Second case, if you exercise the rights. Third, if you do nothing, then there will be a loss. Everyone clear? So with that, students, we complete the discussion to valuation of rights and rights alone, right? And with that we complete the discussion to equity valuation part of security valuation. Everybody clear? Now there is only one thing left, that is money market. Money market, students, small 4-mark questions are there. 2-line questions are there. I would request all of you to kindly revise it on your own. Kindly read those questions of how they are. Money market, very simple instruments are there. So please go through that, revise it. And I think with that we complete the discussion and the revision part of security valuation. The next chapter that we are going to pick up is corporate valuation. Okay. Now students, it's a continuation only of what we did just now: bond valuation, equity valuation. Now we are going to value the company as a whole. In this chapter, you are basically going to be a big acquiring company who will be valuing a small target company. Okay. So a big company trying to acquire a small company is trying to give a value to that small company. That is this chapter of corporate valuation. Now students, in this chapter, what all concepts we will be covering? We'll first of all be covering the general items of what all valuation models we have. Then students, Gordon's 2-step model you already know, multi-step model you know. Fair value of business we will cover. Chop shop method we will cover, that is the 3rd thing. Corporate restructuring 4th. And most important, free cash for the firm. This is what we will be covering. Next students, EVA, again very important concept, economic value added we will be covering. And last we will cover a concept called as enterprise value. So students, these are the different concepts that we will be covering in this revision session. So first of all, general, items, please note there are these different models of valuing a company, and on the basis of these models different questions are formed. So first model is discounted cash flow model. Students, discount cash flow model, you know DCF technique. They will give you future cash flows of the company. They will give you required rate of return. Calculate the present value of all these future cash flows. The present value of these future cash flows will be the value of the company. Game over. Next is net asset value method. Net asset value is book value of assets minus book value of liabilities, will give you the book value of equity. That is the value of the company you need to pay for taking over ownership. Net realizable value is, instead of taking book value of assets, you take the realizable value of assets minus liabilities, will give you the NRV. Fourth is market capitalization method. Very simple. Market capitalized value means what? Means current actual market price of the company. That is, this can be done only in case of a public limited company. It will be number of equity shares multiplied by market price per share. Simple. Whatever is the market price per share, you multiply by total number of equity shares, you get the total market value of the company. Earnings capitalization model is same as dividend discount model or discounted cash flow model. Students, in discounted cash flow model, we find the present value of future cash flows. In earnings capitalization model, we find the present value of future earnings. Now, there is a difference between earnings and cash flows, just as there is a difference between net profit and cash flow. Generally, for valuation, we take future cash flows and we find the present value, but you can also take future net profits and earnings and discount them and find the value of the company. That is basically earnings capitalization model. Fair value, now only I will tell you. Students, fair value means what? They will ask you to value the company as per any of these above two models. So they will say, okay, value this company on the basis of discounted cash flow, value this company on the basis of NAV. Can I say that same companies, two different values you will get, one on the basis of DCF technique, one on the basis of NAV technique. Fair value is basically to take an average of these two values. Game over. Take an average of these two values. They will tell you, if they just tell you fair value, to do a normal simple average. They could ask you to do a weighted average also. They will give you the weights also. Okay, that is as far as fair value is concerned. Chop shop model I will explain to you in some time. So with that, students, we understood general questions, we understood fair value of business. Now I will take you to chop shop method, for which I will need you to come with me to a question. Let us go to question 21. Okay, so in question number 21, where are we? Yeah. So let's start. So they are saying A Limited wants to value T Limited in accordance with chop shop method. T Limited is carrying out three streams of business, namely telecom, real estate and toys. The market capitalization of equity shares of T Limited is 15,200 crores. Other financial details are as follows. So students, what is happening? They are saying that there is this company, it has three different businesses: telecom, real estate and toys. So chop shop means what? Chop shop means you chop the business into its three businesses, right? So telecom you take separate, real estate you take separate, toys you take separate, value each individual business separately, and then add the three to find the value of the entire company. Simple. Now how to do that? Let's understand for telecom. For telecom, what they are saying? They are saying that the turnover of telecom is 5,000 crores, and they are saying the market value to turnover is 1.65 as a ratio of the industry. So in the industry, the ratio of market value to sales is 1.65. Do you realize, if our sales is 5,000 crores, our value according to this indicator should be 5,000 crore into 65, because outside the ratio is 1.65. Basically 1.65 is to 1. So do you therefore realize that in the industry outside, if the sale is 1 rupee, the value comes to on an average 1.65. So if in our company our sale is 5,000, our value will be 5,000 into 1.65. Everybody clear? So what happens is, I'll show you the solution here. Okay, so can you see valuation of telecom business based on turnover will be 5,000 into 1.65, that is 8250 crore. Like that you could have another parameter, that is assets. Now we have an asset of 1250 crore and the industry multiple is 3. So based on assets our valuation should be 1250 into 3, that is 3750, and based on profits it should be 1000 into 12, that is 12,000 crore. So basically based on industry standards, telecom business, if I want to value based on turnover, its value should be 8250, based on assets it should be 3750, based on net profits it should be 12,000 crore. So then one value, if I want what to do, simple, take a simple average of these three values and we get the valuation of telecom as around 8,000 crores average. Same students you do for real estate only, same kind of calculations you do, you get average of 6033.33 crore. Same you do for toys, you get a valuation of 2366.67. So the valuation of T Limited as a whole will be the combined valuation of 1, 2 and 3, and therefore a combined valuation, children, gives you a value of 16,400 crores. That is how you do chop shop method. Okay, so with that we complete the revision of chop shop method here. That is done, right? Next, students, next is corporate restructuring. Please note, corporate restructuring is very similar to internal reconstruction that you did in Inter-CA. Of course, we are not going to be doing the accounting part of it, but just the technical balance sheet restructuring. For that, we have got one question, that is question 23. Yeah, this is that question. Let us read this question. I will show you the solution also. Okay. Now, what are they saying? See, they are saying following is the balance sheet of this company. Now you see the balance sheet, if you see the liability sides, there is a debenture interest accrued. Bad sign. Debenture interest should have been paid, but it is accrued. Of course, there is a loan from the bank. There are creditors. All these people need to be paid. Debentures are of course also there. And on the asset side, can you see there are fictitious assets, preliminary expense not written off, initial cost of issue of debentures, P&L debit balance. So basically the company's performance is not good and has suffered sizable losses during the last few years. The company can be nursed back to health with proper financial restructuring. As such, the following scheme is to be prepared. So all this they have given to you of what all you could do to save the company. Show the impact of financial reconstruction on the company and prepare a fresh balance sheet after reconstruction. So first of all, students, let's see what all they are saying. First, equity shares are to be reduced to 2 rupees per share. So right now it is 10, it will be reduced to 2. Can I say there is a reduction in equity shares worth rupees 400 lakhs. That is a benefit of the restructuring. Everybody clear? Liability reduction is a benefit. Next, students, they are saying preference shares are to be reduced to equal number of shares of 5 rupees each. Right now preference shares are 10 rupees each. We are going to reduce it to half. Can I say reduction in preference shares will also be there? It will be 50 lakh rupees. Next, students, they are saying debenture holders have agreed to forego the accrued interest due to them, which means they are saying, okay, now forget this 12. So okay, that is another benefit for us. Waiver of debt interest 12 lakhs. Next, students, they are saying, of course, the interest rate on debentures will be reduced to 10%, but that will not affect the balance sheet values. Moving on, the trade creditors will forego 20% of the amount due to them. Students, so out of this 300, they are saying 20% we are letting go. So can I say there is a waiver of trade creditors of 60. Next, students, what are they saying? The company will issue 50 lakh shares of 2 each, fully paid on application. The entire amount is fully subscribed by promoters. So basically, more cash will be pumped in the company by issuing new shares and the promoters will buy them. Of course, when we will be making the final balance sheet, this will be a part of the final balance sheet. Next, land and building is to be revalued at 350 lakhs. Okay, so right now it is 150. Can I say there is another benefit of appreciation of land and building of 200. So with that, students, we are able to understand total benefit is of 722 lakhs. Next, students, let's see where all this 722 will be used. Plant and machinery to be taken at 150. Now can you see plant machinery is 200. We are devaluing it to 150. Can I say out of the 722 benefit that was there in the balance sheet restructuring, do you realize there is a revaluation of plant and machinery? 50 lakh will go here. Next, students, what are they saying? they are saying a provision of 5 lakh is to be made for bad and doubtful debt, which means can I say that the sundry debtors of 50 will have to be devalued by 5. That will result in provision for bad and doubtful debt 5. That will again eat into whatever benefit we had got till now. And also all these 3 items which are there, the fictitious assets, can I say, should immediately be written off. So we will write off those 3. So the total uses for which the benefits will be used is 557, and total benefits we had was 722. From that 557 was used, can I say 165, the balance will be considered as capital reserve, and then on the basis of that a new balance sheet is being made. I hope you realize equity shares were reduced to 2 rupees, new shares were issued, preference shares were also reduced. This is the preference dividend rate. Capital reserve just now got born. Debentures are same, rate has gone down. The debenture accrued gone. Creditors, I hope you realize have been reduced because they said okay, no problem, 20% to take away, or basically they said okay, we forego it. Loan from bank is still there. Land and building revalued, plant and machinery revalued, furniture fixture as it is, inventory as it is, sundry debtors 5 lakh rupees reduced due to provision, and then balance is cash bank, that is 150. Institute took it as a balancing figure. We can of course prove also how this 150 is left at the end, but no need to do that. So students, with that we complete the discussion to the company's corporate restructuring, right? That is done. Then we come to one of the most important points of this chapter called as free cash for firm. I'll just keep it on hold for a minute. I will first of all take you to economic value added. Just understand, many small questions are there on economic value added. One should have full grip on it. EVA, simple formula is there. The formula of EVA is net operating profits after tax minus capital charge. Okay, net operating profit after tax minus capital charge, where net operating profit after tax is EBIT into 1 minus T, and capital charge is total invested capital multiplied by weighted average cost of capital. So what is EVA basically? See, this is, can I say, the profit, post-tax profit that the company is earning, and this is basically what your investors want. Can I say, investors have given to you invested capital, they gave to you. On that, their required rate of return is weighted average cost of capital. So can I say this particular bracket is what you have to give to your investors. This particular area is what you earned in the company. Can I say NOPAT minus capital charge, if it is positive, can I say it is economic value added for the company is performing well. So that is the concept of EVA. Students, that is EVA. Now last concept that I would want to revise in this particular revision section is enterprise value. It's a new concept embedded in ICI study module. Just know that enterprise value of a company is market cap of a company, that is nothing but number of equity shares into market price per share. So market cap of equity shares plus the book value of debt minus cash and cash equivalents in the company. So students, if they tell you find out the enterprise value of the company, students, 3 things one should know. One is find the market value of the equity shares. In that you add the value of the existing debt in the company, and from that you subtract whatever cash and cash equivalents are there in the company's asset side. You will get the enterprise value. Remember this formula before going in the exam. They will give you questions, just put numbers and get the answer. This is enterprise value. Okay, so now I would urge everyone to read enterprise value notes in the ICI study module. There are 2 illustrations also there. You can read them also, very important. Okay, so now the last point which is left in this chapter is free cash for firm. So we had studied earlier free cash for equity. Free cash for firm is also like free cash for equity only, but now it is free cash for equity and debt both combined. Okay, equity and debt both combined. What is the free cash? So now that is why it is called as free cash for firm. How to calculate? Very simple. Students, can I say we have sales, correct? We have sales. From sales all operating costs are subtracted, correct? What we get is net operating profit or EBIT. Now generally we subtract interest, but don't subtract interest because we want to calculate what is the free cash available for debenture holders also. If you subtract interest, then what is left at the end, do you realize, will be free cash available for equity only. We want free cash available for equity and debt both, so don't subtract interest, straight away subtract tax. Okay, so once you subtract tax, you will get here NOPAT. Okay, this is NOPAT. Now NOPAT, students, is also basically EBIT 1 minus T. This is the net profit after tax. You can consider it as NPAT also. Okay, now students, now that you have NOPAT, do you understand in these operating costs there must be an depreciation included? That depreciation, students, do you realize we will have to add back to find the cash flow after tax? Everybody clear? We need to add back the depreciation, otherwise this is only net profit or earnings. To find cash flow, free cash, depreciation, which is a part of expenses earlier, needs to be added back. You have been doing this since inter-CA capital budgeting also. So once you add back the depreciation, can I say you will find the cash profits after tax. But these cash profits after tax cannot be considered as free cash, because from this there would be some investment in capital expenditure, there would be some investment in working capital. So subtract the investment in fixed assets or capital expenditure, subtract the investment in working capital or current assets, and what you are left with now is free cash for firm. All the commitments reduced, all the reduced in the sense subtracted, all the expenses subtracted, what is left now is free cash for firm, because can I say from this we will be paying interest and we will be paying equity, their dividends. This is the profit, can I say, which is yet, from this interest is yet to be deducted, right? We have not yet deducted interest, and therefore we understand that this is the free cash available both for equity as well as debt, which is called as free cash for firm. Such a free cash for firm, do you realize, if it is discounted at the rate KO, not KE, such a free cash, see FCF if you remember, value of equity was FCFE 1 upon KE minus G. But if I want to find value of the overall firm, overall company including debt, then future cash flows I will not take only equities cash flows, I will take free cash for firm divided by overall required rate of return minus G. Everybody clear? So in equity valuation, free cash for equity was discounted at the rate KE to find value of equity, right? FCFE was discounted at the rate KE to find value of equity. In corporate valuation, FCFF is discounted at the rate KO to find value of overall firm. And from this value of overall firm, if you subtract the value of debt, you will get value of equity. That's how you do it. Okay, so that is as far as free cash for firm is concerned. Okay students, so with that we complete the discussion for free cash for firm. Now on this we will solve one question so that you can get an idea of how it is solved. So I'll take up question 24 from my notes. Okay, question number 24. Okay, so students, let us do this question. In that you will get grip on how to do FCFF. Of course there are many more questions. I'll tell you total of 4 questions are there in ICA on FCFF. 4 to, I might say 5 questions. Please solve all of them. Okay, all right. Following informations are available in respect of XYZ, which is expected to grow at a higher rate for 4 years, after which growth rate will stabilize. So they are saying that this company is there for first 4 years, it is going to grow at a high rate, and then from 5th to eternity it is going to grow at a stable rate. The moment you see this, what should ring in your head? That there is that multi-step growth model of Gordon that we will be doing 1, 2, 3, 4, 4. That much we will have to do. Now students, here first of all, for calculating these valuations we need the discounting rate. So before going into FCFF calculations, we'll first of all set the discounting rates. So for high growth period they have given this information, and for stable growth means 5 to eternity, they have given to you this information. We'll first of all finish the calculation of discounting rate and then go ahead. So what I will do is, here I'll just write calculation of KO. I hope you remember we are valuing the firm as an entirety. We will not be discounting at the rate KE, we will be discounting at the rate KO, WACC. Everyone ready? So for that, I will first of all do for the high growth period, okay, high growth period, that is basically years 1 to 4. Now in that, let's see what all information is given. IRF is given, beta is given, market risk premium. Market risk premium means RM minus IRF is given. I guess we can easily find KE. I'll do it on Calci only. So basically 6 into 1.15 plus 10. I'll do it again. 6 into 1.15 plus 10, we get KE of 16.9%. So I'll write here KE is equal to 16.9%. For KD, they have given to you the interest rate. Pre-tax cost of debt is given. You have to simply multiply by 1 minus tax rate of 30%. So 13, okay, minus 30% will give you 9.1 as KD, correct? And for KO, they have given to you debt equity ratio as 1:1. That means 0.5 is the weight. So weight of equity is 0.5, weight of debt is 0.5. Let us calculate KO. KO, can I say, will be 16.9 into 0.5 M plus 9.1. I'll do it again. 16.9 into 0.5 M plus 9.1 into 0.5 M plus MRC. We get overall cost of capital for the first 4 years as 13%. Next, students, I will go for the stable growth period, which is 5 to eternity. Okay, 5 to eternity. Now for this, let's first of all calculate KE. Now KE, do you realize, will be 5 into 1 plus 9, that is 14%. KD will be 12.86 minus 30%, that is 9%. As far as weights are concerned, the debt equity is 2:3, which means, do you realize that the weight of debt is 0.4 and the weight of equity is 0.6. Now students, let's calculate the KO here. This will be 14 into 0.6 M plus 9 into 0.4 M plus MRC. We get the KO as 12. So now that our discounting factors are ready, let us go and calculate the FCFF. Please understand, our final valuation will look like how? Year 1, 2, 3, 4, 4. We will have to put the cash flows in 1, 2, 3, 4, and then 5 to eternity we will be clubbing in P4. And that's how we'll do the valuations. But to get these cash flows, we have to first of all calculate the FCFFs, right? We'll have to first of all do the hard work to find FCFFs. Once the FCFF is ready, then we can put it in that valuation present value discounting factor table and find the value of the firm. So students, the next step is now to calculate FCFF. So I'll write here calculation of free cash for firm. So we are now going to be calculating free cash for firm. See how I'm doing it. I'll write particulars. I'll write here 1, 2, 3, 4 and 5. Fifth year is the last I want, because from here it will grow at a constant rate, right? So first of all, let's talk about sales. Everyone remembers the format, I had shown you some time back. Sales. Now as far as sales are concerned, last year, year 0, base year, sales or revenue was 2000 and it is expected to grow at the rate 20% for the first 4 years, correct? 20% for the first 4 years. So I will take my calculator. 2000 plus 20%. This is 2400 for first year, plus 20%. This is 2880 for second year, plus 20%. This is 3456 for third year, plus 20%, this is 4147.2 for the fourth year, and from fifth year onwards, or basically after fourth year, it is going to grow at a stable growth of 10%. So plus 10%, this is 4561.92. This is all rupees in crores, okay? Then from sales we subtract operating costs and we reach EBIT, but in this question directly they have given to you EBIT of last year is 300. So I'll straight away write EBIT. Last year it was 300 and that EBIT is again going to grow at that same rate of 20% for 4 years and 10% from fifth year onwards. So 300 I will take on Calci plus 20%. This is 360. Plus 20%, this is 432, plus 20%, this is 518.4, plus 20%, this is 622.08, plus 10%, this is 684.288. So this is the EBIT for these 5 years. From EBIT, should I subtract interest? No, straight away subtract tax. Okay, so minus tax at the rate 30%. Can I say will give you net profit or net operating profit after tax. So students, I'll straight away take NPAT as 70% of EBIT to save time. So 0.7 into 360, this is 252. 432, this is 302.4, 518.4, this is 362.88, 622.08, this is 435.456, 684.288, this is 479.0016. So you got the NPAT here. Now that you got NPAT, in that students, we will add the depreciation. Now as far as depreciation is concerned, last year it was 200 and here they are saying growth in depreciation will be 20%. Okay, so 200 crore last year, for first 4 years it will grow at the rate 20%. So students, last year 200, right? So 200, right? So I'll just take the calci, 200 plus 20%, this is 240. Plus 20%, this is 288, plus 20%, this is 345.6, plus 20%, this is 414.72. You got the depreciation here. For 5th year onwards, they have said something, we'll talk about it in some time. Next students, we have to subtract the investment in fixed assets, that is capital expenditure. Last year the investment in fixed assets was 280 crore, correct? 280 crore. This 280 crore, can I say, will grow again at the rate 20% for 4 years. So I'll take 280 on calci plus 20%. This is 336 plus 20%. This is 403.2 plus 20%. This is 483.84 plus 20%. This is 580.608. And now for the 5th year, you know what they are saying? They are saying that capital expenditure is offset by depreciation, meaning whatever depreciation must be here is same as the capital expenditure that we will be showing, and it will get offset against each other. If it will get offset against each other, do you realize there is no point in writing those numbers? They have not even given those numbers to you. They are that irrelevant. Forget it. Everybody clear? Because they are going to cancel off each other. Then students, what is left is investment in working capital. Now please pay attention. Investment in working capital, students, do you understand that in this particular question they are saying working capital is 25% of revenue? Now do you understand that last year my sales were 2000 crore and working capital must be 25% of it. So 2000 into 25%, 500 crore must be the working capital. Now in first year, the sales are expected to grow to 2400. Everybody clear? So 2400 into 25%. Do you realize that in first year, the working capital that we will be requiring in the company is 600 crore. But out of 600, do you realize 500 crore working capital is already running in the company, which means you need an additional investment of only 100 crore. Everybody clear? Because last year anyways 500 crore we have invested. See children, please understand, if you wanted to continue sales of 2000 crore only in till eternity, then you need not invest any further money in working capital. The 500 crore which is already there in working capital, that is 2000 crore into 25%. Last year already 500 crore you had. That working capital was enough to sustain your 2000 crore rupee sales. But because you want to increase the sales, then slight increase in investment in working capital, change in working capital will be required. Students, your sales are increasing by how much? 2400 minus 2000, 400 rupees, 400 crore rupees of sales are increasing. 400 into 25% also you will get 100 as the working capital required. So students, you need 100 crore rupee investment in working capital for first year. Second year, 2880 is the sale minus 2400, your net increase in sale is 480 into 25%. Can I say 120 will be the requirement in working capital. Next year, 3456 minus 2880 into 25%, 144 will be the requirement in working capital. Next year, 4147.2 2, correct, 4147.2 minus 3456 into 25%, 172.8 is the investment required in working capital, and last is 4561.92 minus 4147.2 into 25%, 103, okay, 103.68, correct, that is the investment in working capital. So students, with that we will finally be able to find our FCFF, okay, FCFF. Let's start. So 252 plus 240 minus 336 minus 100, you get FCFF of year 1 as 56. Next is 302.4 plus 288 minus 403.2 minus 120, you get 67.2 as the FCFF for year 2, and so on. So students, what I will do is I will straight away take you to the solution now. In the solution, can you see here, we have already done all this hard work. First year 56 rupees is what ICAI got, we are also getting. Second year 67.2, we are also getting. Like that students, every year FCFF you will get. Once you get the FCFF, you simply need to calculate the present value of FCFF. For that we are making this table year 1, 2, 3, 4, 4. For the first 4 years, these are the FCFFs taken from here. And then students, do you realize year 5 to eternity will be clubbed in P4. Can I say cash flow of year 5, 375 we already have, upon KO minus G. Now KO 12%, I hope you remember we had already calculated this 12% for 5 to eternity, right? Stable growth period. WACC we already have as 12%. We get the P4 as 18,766, and then students, we will be discounting them at the rate 13%, because for the first 4 years the discounting rate, the high growth period discounting rate, WACC 13% we already have. We discount it and we find the value of the firm. This is value of firm, not value of equity. This is value of firm. From this, if we subtract the value of debt, which is not given to you, but if they give you, subtract the value of debt, you will find value of equity, right? So with that students, we complete the discussion to FCFF also, right? And with that we complete the discussion to this chapter, the revision of this chapter of corporate valuation. Okay students, so the next chapter that we are going to take now is mergers and acquisitions. So I'll write here mergers and acquisitions. Okay, ready? So now in this chapter, let us see what all concepts we need to cover. The first concept that we need to cover is the calculation of share exchange ratio, how to calculate it. Bootstrapping effect is not a concept as such, it's just a small question, we can ignore that. Yes, we need to learn the calculation, or basically revise the calculation of impact on shareholders' wealth. Yes, we need to know the calculation of cost of merger. One question on impact on growth rate change. Demerger question is very simple, you need not do the revision here. Banking merger, one question we will have to do, and maximum and minimum share exchange ratio question also we need to do. Okay, so we will do all these concepts as far as mergers are concerned. Let's start with the first, calculation of share exchange ratio. So students, here I would like to first of all give you an example, and through that example I want you to first of all get this concept clear, because a lot of students make a lot of mistakes here. So please focus. There are two companies, acquiring company and target company. Number of equity shares of acquiring company are, let's say, 10 lakh, and that of target company are 5 lakh. Okay. Then students, let's say market price per share of acquiring company is 500 and market price per share of target company is, let's say, 200. Okay. Now students, if the question tells you that A will acquire T, the purchase consideration is to be paid in shares. Of course, A Limited will issue shares to the shareholders of target company, and the share exchange ratio is to be based on market price per share. They say SER is to be based on MPS. Now what does it mean? SER based on MPS means it is on the basis of these numbers that the share exchange ratio will be decided. So always remember the formula, SER based on any variable. Now in this question it is market price per share, tomorrow it could be earnings per share. The formula will be the variable of target company upon the variable of the acquiring company. Okay, T by A. So here the target company's variable market price per share is 200, acquiring company's market price per share is 500. So 200 divided by 500, this is 0.4:1. Now what is the meaning of 0.4:1? It means that for every one share held by target company shareholders, they are entitled to 0.4 shares of the acquiring company, which means total shares to be issued, okay, total shares to be issued will be, now do you realize they have got 5 lakh shares with them? So for every one, if we are going to issue 0.4, then do you realize that for 5 lakh we will be issuing a total of 2 lakh shares. Everybody clear till here? So that is how we calculate share exchange ratio based on a variable. Tomorrow if they say SCR is based on EPS, then what will be the formula? It will be EPS of T upon EPS of A. That's it. Now students, there could be another type of question where they say that A is going to acquire T and A will issue, okay, A will issue 2 lakh shares to acquire T, and T has already 5 lakh shares outstanding. Okay. Now students, if the question tells you like this, that there is a target company, 5 lakh shares are outstanding, acquiring company will take over target company by issuing only 2 lakh shares, what is the share exchange ratio? Students, in such a scenario where you're calculating share exchange ratio where already the shares are decided, there the share exchange ratio will be number of equity shares issued by A upon number of equity shares outstanding of T. Basically it will be 2 lakh divided by 5 lakh, and of course the ratio is same only, that is 0.4:1. So how many shares A is issuing and how many shares T had, that ratio basically is again coming back to 0.4:1. I hope you realize both examples are same only, but why I made you go through this example is because if they would have told you to create share exchange ratio first, then students, that creation is always based on some variable, then the formula is variable of T upon variable of A. But if the shares are already decided how many shares are to be given and then they tell you okay, not find the ratio, here you are not creating a ratio, you are simply calculating the ratio, then it will be shares issued by A upon shares outstanding of T, that is 0.4:1. Everybody clear? So that is as far as calculation of share exchange ratio is concerned. We could do one question here. Okay, so for example, let's take this question. What are they saying? X Limited wants to take over Y Limited and the financial details of both are as follows. So X is the acquiring company, Y is the target company. They are saying what should be the share exchange ratio to be offered to the shareholders of Y Limited if it is based on net asset value per share, earnings per share and market price per share. So we'll do each one of them. So the first one which they are asking you to do is on the basis of, based on NAV per share. Students, can I say the share exchange ratio based on NAV per share will be NAV per share of target upon NAV per share of acquiring T by A. So what is the NAV per share of target? Can I say the NAV per share of target would be 50,000, 2,000 and 4,000. This is basically the net assets. You could also do like this, 61,000 assets minus 5,000 liability. I hope you realize 56,000 is the net assets. So 56,000 and divided by how many shares does T, that is target company, that is Y Limited, have? 50,000 divided by 10, there are 5,000 shares here. And similarly NAV per share of acquiring would be 1 lakh plus 38,000, that is 1,38,000, correct? 1,38,000 divided by 1 lakh divided by 10, that is 10,000 shares. If you solve this, this is basically 56,000 divided by 5,000, this is 11.2 and divided by of course 13.8. So if I divide by 13.8, we get the share exchange ratio as 0.81:1. That means for every one share of target, acquiring will issue 0.81 of its own shares. Then students, we have the share exchange ratio based on EPS, share exchange ratio based on EPS will be, can I say EPS of target upon EPS of acquiring. EPS of target would be 15,000 profit divided by 5,000 shares. So 15,000 divided by 5,000, and EPS of acquiring would be 24,000 divided by 10,000. So 24,000 divided by 10,000. So this is 3 upon 2.4. So 3 divided by 2.4, if we do 3 divided by 2.4, we get 1.25:1. And similarly, we have got the last one, that is based on MPS. Okay, based on MPS. So here I'll do based on MPS. The formula will be MPS of target upon MPS of acquiring, and that is of course 27 upon 24. That is how you're supposed to calculate the share exchange ratio. Everybody clear? They are asking what should be preferred from the point of view of acquiring company. Of course, in whichever option lowest number of shares are to be issued, that will be the best option, right? So with that, students, we complete the discussion to how to calculate share exchange ratio. Then students, I would now like to calculate for you impact on shareholders' wealth. For that, we would pick up a question. Let's now take up question number 15. Okay, yes. So let us start understanding this question. They are saying company X is contemplating the purchase of company Y. Company X is basically the acquiring company. Company Y is the target. See, what is the meaning of impact on shareholders' wealth? You'll understand now in this question. X has 3 lakh shares, market price 30, while Y has 2 lakh shares, market price 20. The EPS are 4 and 2.25 of both companies. Management of both companies are discussing 2 alternative proposals for share exchange. So there are 2 share exchange ratios given. I will solve with the help of one. Okay, now let's take this one. Simple share exchange ratio 0.5:1. And the first one of course is in proportion to the EPS, means the first one is SER based on EPS, that is EPS of target upon EPS of acquiring. Second one is straightforward 0.5:1. So they are asking you calculate the earnings per share after merger and show the impact on EPS for the shareholders of the 2 companies. So basically we have to first of all find the post merger EPS. Secondly, we also have to find the impact of EPS or impact on EPS of the merger. So first of all, let us understand the post merger EPS. So students, how to calculate post merger EPS? Very simple. Post merger EPS, that is what they are asking you, will of course be post merger earnings, correct? Post merger earnings upon post merger number of equity shares, correct? Post merger earnings upon post merger number of equity shares. Now how do I find post merger earnings? Can I say post merger earnings will be a summation of pre merger earnings of acquiring and target? Can I say the acquiring company's pre merger earnings would be 3 lakh shares into 4, correct? Earnings per share is 4. So 3 lakh into 4 is the pre-merger earnings of acquiring company, and target company's pre-merger earnings are 2 lakh into 2.25. 2 lakh into 2.25 is the pre-merger earnings of target. When I add both, I get the post-merger earning of this acquiring company, right? The whole divided by post-merger number of equity shares. Can I say acquiring companies 3 lakh shares will continue as it is only, plus they will be issuing new shares, right, for takeover of target company. How many shares they will be issuing? The share exchange ratio is 0.5:1. So can I say they have got 2 lakh shares outstanding? I hope you are understanding. They are having 2 lakh shares outstanding. If we issue 0.5 for every 1 share, I hope you realize total 1 lakh additional shares we will be issuing. So let's solve this. This is 3 lakh into 4 M plus. This is 2 lakh into 2.25 M plus MRC. Post merger earnings are 16 lakh 50,000, and this, can I say, will be divided amongst 4 lakh shares. So if I divide this amongst 4 lakh shares, I get post merger EPS as 4.125. So now that we have got the post merger EPS and we have understood how to calculate it, now I will show you the impact of this EPS. Now what is the impact? Let me explain. So I'll write here impact on EPS for both companies. So I'll write here particulars. I'll write here acquiring company, I'll write here target. I should actually write X and Y, but it's okay. A and T I'll write. Okay, next. Now students, tell me. First of all, I'll write post-merger EPS. Can I say for a shareholder, post-merger EPS minus the pre-merger EPS, do you realize will give the gain or the loss for the shareholder? Everybody clear? Post-merger EPS minus pre-merger EPS will give you the gain or the loss. Now talking about acquiring company, can I say acquiring company's pre-merger EPS was 4 and post-merger EPS can I say is 4.125, which means for the acquiring company there is a 0.125 rupees gain. For the target company's pre-merger EPS was 2.25. Now what is target company's post-merger EPS? Now please understand from a shareholder's point of view. A shareholder who was owning one share of target company, can I say was earning 2.25 rupees EPS. Now that shareholder gets transferred to new company, that is acquiring company, and now they will get acquiring company's EPS, but the problem is they will not be able to get the entire 4.125 because the share exchange ratio is not 1:1, right? Share exchange ratio is 0.5:1, which means if you had one share in target, you will have only half share in the acquiring company post merger, which means the earnings per share that you will be getting is 4.125 into the share exchange ratio. So when I do that, I get 2.0625. I'll do it again, 4.125 into 0.5 and we get 2.0625, which means students, do you realize that there is a loss of 0.1875 for the target company shareholder as far as earnings per share is concerned? Students, this is how we calculate the impact on EPS. I would like to now do one more question for you, in which students we calculate the impact not only on EPS, but we will calculate the impact on MPS also. Generally, questions can come on either one of the two or both. In this question, let us see what is to be done. Through this, you will get a lot of grip on impact on EPS as well as MPS. Let's start. You have been provided the following financial data for two companies, Krishna and Ram. Earnings after tax is given. Divide by number of equity shares, we get earnings per share. Multiply by the PE ratio, we get market price per share. I hope you understood this particular statement. Company Ram is acquiring the company Krishna, exchanging its shares on 1-to-1 basis, and the share exchange ratio is based on the market price of the shares of the two companies. Basically, SER is based on MPS. So students, if SER is based on MPS, you tell me how do I calculate SER based on MPS? Do you realize it will be MPS of target upon MPS of acquiring? Krishna's MPS is 35, Ram's MPS is also 35. I hope you realize that the share exchange ratio here is 1:1. Now that you have understood the share exchange ratio, let's see what all they are asking. First point, they are asking you the EPS subsequent to the merger. What is this? This is post-merger EPS. I hope you understood. They are asking you post-merger EPS. I hope you remember how to calculate post-merger EPS. Post-merger EPS will be post-merger earnings, correct, divided by post-merger number of equity shares. Now, how do I calculate post-merger earnings? Do you realize post-merger earnings would be, I am sorry, they're given to you, correct? They have given it to you. Generally, what do? We do number of equity shares into earnings per share, but they have directly given to you the post-merger earnings. Straight away take it. Do you realize acquiring companies pre-merger earnings and target companies pre-merger earnings? I simply add, I'll get the post-merger earnings for the acquiring company, that is 10 lakh plus 7 lakh. Do you realize 17 lakh is the post-merger earnings? Post-merger number of equity shares, do you realize pre-merger number of equity shares of acquiring company 4 lakh will continue, plus for target companies 2 lakh shares, we are going to be issuing 1:1, that is 2 lakh shares itself. So now the post-merger EPS will be 17 lakh divided by 6 lakh and we get the post-merger EPS as 2.83. Now that we have got the post-merger EPS, what is the second thing they are asking? They are asking what is the change in EPS for the shareholders of both companies. This is basically the impact on EPS for both the shareholders. Let us do the calculations. So I'll write here particulars. Acquiring company, target company. Do you realize post-merger EPS minus pre-merger EPS will give you the gain or the loss. Now, as far as acquiring and target companies are concerned, acquiring companies EPS pre-merger is 2.5, target company 3.5. So I'll write here 2.5 and I'll write here 3.5. And now post-merger EPS we just now got is 2.83. And do you realize here also I'll write 2.83 only, because students, the share exchange ratio is 1:1. Everybody clear? Share exchange ratio is 1:1. So that means for if you are holding one share in target company, in the acquiring company also you will be holding one share only, and therefore your post-merger EPS will be 2.83 itself. So this therefore shows a gain of 0.33 for acquiring company, that is Ram, and there is a loss of target company, that is Krishna. 2.83 minus 3.5, there is a 0.67 rupees loss for the shareholders of target company. Everyone clear? So this was a repeat telecast of last question itself. Now something new. They are asking you to determine the market value of the post-merger firm. Students, what do they mean? Market value of post firm means post-merger market cap. They are asking market capitalized value. Now you know that the market value of a company would be post-merger number of equity shares into post-merger market price per share. Correct? Number of equity shares into market price per share will give you the market capitalized value. So post-merger market cap will be post-merger number of shares into post-merger market price per share. Post-merger number of equity shares we know is 6 lakhs, correct? It is 6 lakhs. So I'll write here 6 lakh shares, and I have to simply multiply by the post-merger MPS. Now the question is, how do I know what is the post-merger MPS? Because these were the pre-merger market prices per share. Post-merger market price, how to find? For that they are saying P ratio is likely to remain same. Okay, so if the P ratio is likely to remain same, do you realize the post-merger MPS will be the post-merger EPS of 2.83 multiplied by the P ratio of the acquiring company, that is 14. You know that EPS into P is MPS. So post-merger EPS into post-merger P will give you post-merger MPS. And post-merger P, they are saying acquiring companies P will continue to remain same. Of course, acquiring companies P will continue to remain same, not target company. Target company is not there only now in the picture, right? So students, this is 2.83 into 14, that is 39.62. So 6 lakh rupees into 39.62. 39.62 is the post-merger MPS. So therefore 6 lakh into 39.62, if we do, we get 2 crore 37 lakh 72,000 as the value of, or the market value of the acquiring company post-merger. And now they are saying ascertain the profits accruing to shareholders of both the firms. Now students, when they use the word ascertain the profits, ascertain the gain loss, that means they are asking you impact on shareholders' wealth. But in impact, as I told you, there are two impacts that we can show. One is impact on EPS and other is impact on MPS. As a rule, you remember, whenever they ask you normal profits, profits or loss, gain, loss, etc., always show the impact on MPS and not EPS. Okay. Anyways, we have already shown the impact on EPS, but even if this point was not given in the question and they straight away ask you to find the profit or loss for shareholders, show the impact on market price per share. Everyone clear? So therefore, I will now show you the impact on market price per share. Particulars, acquiring company, target company. Can I say post-merger market price per share minus pre-merger market price per share? Can I say will give you gain loss on a per share basis? We know that both shares had a 35 rupees market price per share earlier. Pre-merger, post-merger it is 39.62. So do you realize 39.62? Here also I'll write 39.62 because do you realize the share exchange ratio is 1:1, which means there is a per share 4.62 rupees gain for both the shareholders of basically both the companies. Correct? This I can simply multiply by number of equity shares. In acquiring company, can I say there are 4 lakh shares, in target company 2 lakh shares. So 4 lakh and 2 lakh, can I say that will give you the total gain to all shareholders. So this will be total total gain, that is basically 4.62 into 4 lakh, and that is 18,48,000, and this is 9,24,000. Correct? This is how you show the total gain or loss for the shareholders, by showing the impact on MPS first and then multiplying by the number of equity shares pre-merger of both the companies. Done. So with that we complete the discussion to impact on shareholders' wealth. Correct? This is done. Next, students, we will go on to the concept of cost of merger. So the next concept now is cost of merger. Now students, it's a slightly deep concept, please understand. Cost of merger is basically a cost that the acquiring company is incurring for taking over target company, and what is cost of merger for the acquiring company becomes the premium of merger for the target company's shareholders. So in short, if I say that if target company's value is 10 rupees, but the acquiring company is paying, let's say, 12 rupees to acquire target company, we will say cost of merger for the acquiring company is 2 rupees, because 10 rupees worth asset you are buying, but you are paying 12 rupees. So cost of merger will be 2 for the acquiring company. That same 2 rupees will become premium of the merger for the target company shareholders, right? Now students, cost of merger, there are two formulas, because it depends on what the purchase consideration is. So if the purchase consideration is in cash, okay, if purchase consideration is in cash, then cost of merger will be cash paid minus pre-merger market cap of T. Simple. Cash paid, of course, by A to shareholders of T. Acquiring company will pay cash to shareholders of T for taking over target company. So if purchase consideration is in cash, simple, cash paid is what the acquiring company is paying, and pre-merger market cap of T is what the acquiring company is taking over. So the difference between both, can I say, will be the cost of merger to the acquiring company. Now second case is slightly tricky, is that if, okay, if the purchase consideration is in shares. So what if the purchase consideration is in shares? Then students, the cost of merger would be, now please pay attention, number of equity shares issued by A to shareholders of T multiplied by post-merger market price per share, the whole minus pre-merger market cap of T. I am pretty sure you understand this minus pre-merger market cap of T. But to acquire this, what is the acquiring company paying? Can I say it is issuing shares? So the value of the shares that the acquiring company is issuing is what the acquiring company in one sense is paying, minus the pre-merger market cap of T. Now students, in this just one point you should understand is that post-merger market price per share, how to calculate? Okay, post-merger market price per share, how to calculate? Students, there are two methods of calculating post-merger MPS. Either you can do post-merger EPS into the PE of acquiring company. We have done one such question some time back. Or you could do post-merger market cap upon post-merger number of equity shares. Like that also you can do post-merger market cap upon post-merger number of equity shares, where generally the post-merger market cap will be sum of pre-merger market caps of A and T. Correct? So you take the pre-merger market cap of A, you take the pre-merger market cap of T, add both and understand this to be post-merger market cap of A and divide by post-merger number of equity shares, you'll get post-merger market price per share, or as we did some time back, post-merger EPS into the PE ratio. Now students, generally they will give you in writing clearly which assumption is to be taken. If nothing is given, you please go for this particular assumption. Okay. Also students, if the question is about impact on growth rate, which is the next concept that we will be picking up, in that students compulsory you have to do this method. So we will see now, we'll see one question on this, we'll see one question on this. Actually we have already seen a question on this, but we will now use that in cost of merger also. So let us do one question here. So let me take question number 22. So I'll take question number 22. Let's start reading this. They're saying ABC is taking over XYZ. The shareholders of XYZ would receive 0.8 for every one share. So the share exchange ratio is 0.8:1. Merger is not expected to generate any synergy benefits. The relevant data for the two companies are as follows. So students, they have given to you all this data. Profits divided by number of shares will give EPS. EPS into P ratio will give you market price per share. Next, they are saying for the combined entity, which means post merger, you are required to calculate. So students, first of all, they are asking you to calculate number of shares. Now only I will tell you, can I say acquiring companies number of shares already are 12 crore. So those 12 crore will continue. Plus for target company, we will be issuing 3 into 0.8:1, correct? For every one share, we are issuing 0.8 shares. So for 3 crore shares, we will be issuing 2.4. So can I say number of shares will be 14.4 crores after the merger? Everybody clear? Next, they are asking you to find EPS. Now students, they are asking you to find the post-merger EPS. You know post-merger EPS will be post-merger profits. Can I say post-merger profits will be summation of pre-merger profits, that is 70 crore divided by post-merger number of equity shares. So post-merger earnings divided by post-merger number of equity shares, we get the post-merger EPS as 4.86. Point number C, they are asking you to find the post-merger PE. Now since nothing is given, we will assume that the pre-merger PE of the acquiring company will continue to remain same post-merger also. So 6.21 will continue to remain 6.21, which means, do you realize I am going for this assumption, this route to calculate the market price per share, the PE route. Next students, they're asking you to find the market price per share. I hope you realize post-merger EPS into the PE ratio. So 4.86 into 6.21, 4.86 into 6.21, 30.18. okay, 30.18 will be the post-merger market price per share. Point number E, they are asking you to find total market cap. Total market cap, I hope you realize, will be total number of shares post-merger into market price per share. 14.4 crores is the total number of equity shares post-merger multiplied by post-merger market price per share. So 14.4 into 30.18, 434.59, okay, 592 is basically the post-merger market cap. And last is what they're asking, premium paid. Can I say nothing but cost of merger? Now how do I find cost of merger, students? This is the formula of cost of merger if you are issuing shares. So can I say cost of merger will be number of shares issued. Can I say 2.4 crore shares we are issuing, number of shares issued into the post-merger market price per share. So basically this much value of shares we are offering to the target company shareholders minus to take them over, we are taking over a company worth how much? Can I say we are taking over a company worth 20 rupees is the market price per share and 3 crore shares are there. So basically 60 crore rupees is the market cap of target company. So and 60 crore of course is the pre-merger market cap of the target company. So 2.4 into 30.18, we have offered shares worth 72.43 crore and we are taking over company worth 60 crores. Can I say 12.43 crore is the cost of merger that we are paying or the premium that these people are enjoying. So this what you saw just now is the calculation of cost of merger where I took this route, the EPS into PE route. We could have alternatively done the market cap route also, which I would like to do it for you. So if I go for the market cap route, of course all these numbers will change. Okay, the point A and point B won't get affected, number of shares and EPS will remain same. Now I would like to first of all do point number E, total market cap. Students, total market cap route means we are going to assume that the post-merger market cap will be a summation of pre-merger market caps of A and T. As you know, the pre-merger market cap of T is 60 crores, correct? And the pre-merger market cap of A is 12 into 30. Correct, 12 into 30, which is equal to 360 crores. That means 420 crores is the post-merger market cap. This is an assumption. We are now not going the P remaining same assumption. We are going through market cap remaining same assumption. In a sense, both market cap summation becomes post-merger market cap. Now that you have total market cap post-merger, this post-merger market cap, if I divide by number of equity shares, 420 divided by 14.4, I will get the post-merger market price per share. And this post-merger market price per share, if I divide by EPS, 29.17, if I divide by 4.86, I will get 6 as the P ratio for this company. And now if I want to find the premium paid, the MPS now has changed to 29.17. So do you realize everything remains same, only this becomes 29.17 and you recalculate it. Everyone clear? So with that we complete the discussion to cost of merger. Okay, cost of merger or premium of merger. Now we will go on to a question to show the impact of growth rate change. Now what do you mean by impact of growth rate change? Now what happens is sometimes an acquiring company takes over target company, and because the target company is now going to be functioning under new management of acquiring company, the target company could experience an accelerated growth rate as compared to its independent growth rate. Independently at what rate they were growing, now they would grow at a faster rate. And if that happens, then the value of target company within acquiring company's management will swell up over and above its current valuation, and that will have an impact on the post-merger MPS. See, right now what do we assume? That acquiring company is running on its own, target company is running on its own, both have their own market values, the summation of both values is the value of the post-merger firm. But now we realize that acquiring company is running on its own, we understand, but target company, which is right now having a particular value based on a particular growth rate, this value will now swell up because under acquiring company's management, the growth rate of target company will accelerate, thereby improving its valuation. So students, let us see how to do that. There is one question that I would like to take, and let's say we take question number 28. So I'll take you to question 28, and through that I will explain 28 or 29. Let's see which one we are taking. So here I would like to actually take 29. Okay, let's do 29 here. So see what they are saying. As finance director of BM Limited, you are analyzing the planned acquisition of WA Limited. Following data is available to you. So they are saying there is a company BM, which is the acquiring company, and a WA Limited, which is the target company. All this info is given to you. Your estimate indicates that steady growth of earnings and dividends to the tune of 6% per year. However, under new management, the growth rate is likely to go up to 8%. Whose growth rate will go from 6 to 8? Target company. Okay, so they are asking you point number 1, what is the cost of acquisition? Cost of acquisition means cost of merger if 50 rupees is paid per share. Students, this is COM in case the PC is paid in cash. I hope you understood what I'm saying. Here the PC is paid in cash, the PC is not paid in shares. So you know that if the PC is paid in cash, then the cost of merger will be cash paid minus the market cap of T. Cash paid is 50 into how many shares? Can I say 12 lakh shares, right? Each share will get 50. So 12 lakh into 50 is the cash that the acquiring company is paying, and we are taking over a company worth 12 lakh, can I say, into 40. The market cap is 12 lakh into 40. Basically 12 lakh into 10, 120 lakh is the cost of merger for this particular question. Point number 2, they are saying what is the cost of merger again if the share exchange ratio. So basically now they are saying, okay, if PC is not paid in cash, let's say the PC is paid in shares, then what will be the cost of merger? And for that they have given to you the share exchange ratio as 1:3. Okay, so you all know that cost of merger will be number of equity shares issued by acquiring company into post-merger MPS, the whole minus pre-merger market cap of target company. Now we all know that the pre-merger market cap of target company is what? 12 lakh into 40, that is 480 lakhs, correct? That is clear. 480 lakhs is the market cap of the target company that you are taking over. Now how many shares are we issuing? 1:3. For every 3 held in the target company, acquiring company will be issuing 1 share. Now students, in target company there are 12 lakh shares, which means, can I say 12 lakh divided by 3, 4 lakh shares will be issued by the acquiring company. So I'll write here 4 lakh into. Now the whole question is what should be taken as the post merger MPS. I told you last time, whenever this growth rate change kind of question comes, always and always follow this particular model for finding the post merger MPS, not the PE model. Okay, so how do we do that? Let's understand. So I'll write here calculation of post merger MPS. Now students, talking about the target company, okay, talking about Target Limited. Students, in Target Limited, if you can see carefully, there is a D1 of 1.6 currently, correct? D1 is 1.6. Then they have given to you P0 as 40, P0 as 40, and its current growth rate, students, do you realize, is 6%. The current growth rate is 6%. So if I calculate KE, K is D1 upon P0 into 100 plus G, which is 1.6 upon 40 into 100 plus 6%. I'll take the calci, 1.6 divided by 40 into 100 plus 6, and therefore the K here comes to 10%. Currently the K is 10% and currently the price is 40. But under new management, can I say the growth rate is going to change from 6% to 8%. I hope you remember, it is going to change from 6% to 8%. If that happens, can I say value of equity will experience a change. D1 upon KE minus G, this valuation model I hope you know. D1 continues to remain 1.6, KE continues to remain 10%. Growth rate, which was 6%, will now become 8% under new management. If that happens, the price will be 1.6 divided by 2%, and that comes to rupees 80. So yes, currently the price is 40, but under new management, do you realize the value of the target company share will jump from, it will double, it will jump from 40 to 80. Now, why did I do this calculation? I will tell you. Students, we generally write what? Post merger market price per share will be post merger market cap upon post merger number of equity shares. Students, post merger number of equity shares, I am pretty sure you know that 20 lakh shares already are outstanding in the acquiring company, and for target companies 12 lakh shares, can I say we are issuing 4 lakh additional shares. So do you realize 20 lakh plus 4 lakh, 24 lakh are the post merger number of equity shares. Now if I take the total post merger market cap and I divide it by 24 lakhs, can I say I'll get the market price per share. How do I find post merger market cap? Post merger market cap is a summation of the pre merger market caps. Students, summation of pre merger market caps means, do you realize 20 lakh into 180? So I'll write here 20 lakh into 180 plus, and this is 12 lakh into 40, correct? 12 lakh into 40. Now this is where there is a change. Okay, students, this entire calculation that you are doing will be right for point number 4 if the expected growth rate continues to be 6%. Then that same calculation what I am telling you, you go ahead and solve the COM. Nothing great. But if the growth rate is expected not to remain 6% and change to 8%, then the change that we need to do is we should understand that the target company, which is right now valued at 40, because of change in growth rate, it will be valued not at 40 but at 80. Everybody clear? It is worth 80 now, and therefore that will have an impact on the post merger MPS. So students, this is 20 lakh into 180 M plus 12 lakh into 80 M plus MRC divided by 24, and that will give you 190 as the post merger market price per share. We put this 190 into the cost of merger calculation and we get the cost of merger. Everyone clear? So this is how you calculate cost of merger if shares are issued and there is a growth rate change. Remaining 2 points, students, are very straightforward and simple, nothing great. This point number 2 is what I wanted you all to revise. Okay, so with that we complete the discussion to impact of growth rate change. Now students, we will go to banking merger. Students, a unique type of question comes on banking merger that you need to understand, and students, for that we will take up question number 31. Okay, we will take up question number 31. I'll just take you there to question number 31, right? And now what I will do is, this entire question, I have already recorded a video on this. I will share that. I will basically attach that video here. Go through that entire question. There is a big chance that such a question will come. Generally people keep this question as option because I don't understand only what is given there. But if you see the video properly, you will understand what is to be done, and if such a question comes in the exam, you will be getting 8 marks more than the others. Okay, so students, please watch this video now, and then we'll come back and do that last minimum and maximum share exchange ratio question. Okay, watch it. Hello friends, so welcome to one last module, that is banking merger, in this chapter of mergers and acquisitions. Students, this concept, okay, is being asked in the practice manual. It was also asked in the latest paper. I remember last it was asked in May 2018 in the old syllabus. But children, this question does generally come in the examination, and students tend to skip it. They look at the PM, they see the question, they see the solution, and they say, no, we don't want to do this. It is too much. All these complicated terms are there, and they skip it and they don't do it. And when it comes in the exam, they have no idea what to do. So children, it is extremely important therefore for us to do this question, this concept. Children, on the basis of this concept of banking merger, ICAI has placed 2 questions. Okay, both questions are exactly similar. Just the numbers are different, the names are different. So as usual, as you know me, what we'll be doing is, we will be studying in depth one question, and then the second question, children, I will be giving it to you as a test. Of course, solution will be given to you. You have to just tally your answers with mine. Yes. So children, with that in mind, that you have to solve one question on banking merger on your own, I am now starting question 31, and you please be extremely attentive. As usual, children, now I request everyone to first of all pause the video and read the question carefully. Start. Okay students, I hope you all read the question. Let us now try to understand this. See what they are saying. Don't panic, okay? Very simple it is. Yes, I know the terminologies are very cringy, but don't worry, we'll be able to knock it off. Bank R was established in 2005 and is doing banking in India. There is a bank R doing banking in India. The bank is facing a do or die situation. There are problems of gross NPA, non-performing assets at 40%. Now children, what does that mean? See students, very simple it is. Okay, this is the bank. Okay, this is the bank. Can I say for the bank, these are the deposits which come inside the bank, which becomes liabilities for the bank. Yes, the customers are all depositing in the bank. This bank therefore gives loans and advances to other customers. Everybody following? And these become the asset of the bank. Everybody following? Now children, these liabilities, see, for an individual like me, for example, I am depositing in the bank. For me, that bank deposit is an asset. But for the bank, it becomes a liability because it has to pay me back. Also, it has to pay me interest, etc. On the other hand, bank is advancing or giving loans to people. The people who are taking these loans, for them, these become liabilities. But for the bank, these loans given become assets. And from these assets, the bank is supposed to receive interest, that is returns. Everybody following till here? Now children, what happens is, let's say there is a person named MAL, okay, Mal. There is a person named Mal. Now this bank has, let's say, given a loan of 100 crores to this person named Mal. Now Mal is a person who is very, very malicious, okay? He doesn't take all his life very seriously, and he is just spending money here and there, a spendthrift, okay? Now this guy is supposed to repay money to the bank 100 crores, but he repays, let's say, only 40 crores, and 60 crores are still left to be paid. But this Mr. Mal or Mrs. Mal, whatever, doesn't repay this 60 crores, yes, and defaults. So there is a default not only in the principal of 60 crores but also the interest element on 60 crores. Children, can I say for this bank, this Mal was an asset, correct? From that asset, they were supposed to receive returns. Now can I say they have got back their money of 40 crores and also received the interest on 40 crores, but there is a default on 60 crores. Such an asset on which there is a default, based on certain guidelines of the banking companies and the act relevant for that, children, do you realize these will be called as non-performing assets? Okay, non-performing performing assets for the bank, because for the bank this 60 crores is not performing. They are not getting their returns back. Everybody following till here? So children, let's say the bank has total given, let's say 1000 crores, total given 1000 crores assets. In a sense, the loans and advances given are 1000 crores, of which children 60 crores are non-performing assets. So what do we say? We say that 6%, 6% children is the gross NPA, non-performing asset percentage. Yes, this is a very simplified version I have given you. Of course, there are some technicalities to it, but I am not concerned in SFM for teaching you all that. I'm just giving you a broad guideline that 6% of our total assets are gross NPA. Everybody following? There is something called as net NPA also. Ignore that. As of now, what we are reading, only that much I'm teaching you. I am not a banking teacher here. I am SFM mergers teacher here, and that too for one question I'm explaining whatever is required. Everybody following, and I hope you accept that also. So gross NPA percentage, I hope you understood. So they are saying their gross NPA percentage is 40%, yes, which means 40% of their loans and advances given are non-performing. That's why they're saying, right, do or die situation. Then they say that CAR ratio is at 4%. Now children, what happens is that this bank must be giving loans and advances to various types of people. Let's say there are people like Mal, there are very powerful people like AMB, then there is very safe, government, and all these different people are there. Can I say the bank must be giving loans and advances to everybody, and everyone's risk quotient is different, right? He has a very high risk quotient, considerably less risk quotient, risk-free quotient, and so on. So based on the risk and the weights given to them, the weights are given on the basis of risk, their total is calculated as risk-adjusted weighted assets. So that is what they are calling it here. They're saying capital risk weight asset ratio. So students, they are saying that they have given weights of different risk base to all of them, and they have calculated a total. We are not supposed to know how it is calculated. To hell with it. I am just telling you that on the total risk weighted assets, what the bank is supposed to do is, let's say the total of everything multiplied by their weights comes to, let's say, 10,000 crores. It comes to 10,000 crores. So now what the bank is supposed to do, the bank is supposed to keep capital, aside. In a sense, tomorrow if there is any default, see children, do you realize this is the bank and they have given the loans to these people? Do you realize bank has also taken deposits from people? Now on the basis of their performance, the bank will be able to give back to those who have deposited in the bank. If the assets don't perform, how can the bank satisfy liabilities? Everybody following? So children, what happens is this bank now has taken money from people and has given money to these people. Now do you realize the money which is given to these people, there are different risk categories. On the basis of that, it calculates a total asset value which is based on the actual value multiplied by their weights, which are given in the ratio of their risk. Now children, how that is given, I am not going into that. What I am trying to say is this bank, once it calculates, the risk adjusted weighted assets value is 10,000 crores, it therefore has to keep some capital aside as a safety, yes, as a cushion, that tomorrow if these people do not perform, then the people who have given deposits to the bank should not suffer, and therefore the bank, after giving loans to these people, has to keep a certain percentage of amount separately, so that tomorrow if these people default, bank is completely not dependent on them. Everybody following? See, of course, majorly it is dependent on them, but still for some safety cushion the bank has to keep some amount aside. Children, on this 10,000 crore, let's say the bank has a capital of, let's say, 1,000 crore, we say that the ratio that the bank has kept is 10%. It is called as capital adequacy ratio. Can you see? Adequacy means adequate capital is kept. Everybody following? Adequate capital is kept in times of emergency. Yes, in times of emergency means tomorrow if these people do not default, the bank has a 10% adequacy ratio. Everybody following? Of course 90% it is dependent on them, but 10% we have kept ourselves safe, and this bank, children, here is saying that it has a capital adequacy ratio of only 4%. Everybody following? It has a capital adequacy ratio of only 4%. So therefore children, it is saying it has got NPA of 40%. 40% of its assets are non-performing, and on the other hand, on the basis of the risk adjusted assets given, it only has kept a cushion of 4%. So can I say this bank is basically screwed? Yes. the net worth of the bank is not good. Wow. So they are saying all those of who you didn't understand anything of this first part, just understand the net worth is not good. Okay, the bank is in not a good shape. Shares are not traded regularly. Last week it was traded at rupees 8 per share. All sad stories are being said here. RBI audit suggested that bank has either to liquidate or merge with another stronger bank. Yes. So Bank P is a professionally managed bank with low gross NPA of 5%. Okay, low gross NPA of 5% means what? Can I say this Bank P is so nice that its non-performing assets are only 5% compared to 40 here. Everybody following? And it has a net NPA of 0%. Children, what net NPA means, I know of course, but I'm not going to tell it to you here because it is of no use for this question, so completely ignore it, okay? This line, even if you don't take into consideration, it is completely okay. And CAR at 16%. Now children, can I say what does this mean? This means that the bank has a cushion of 16% as compared to a cushion of only 4 in the weak bank. Yes, its share is quoted in the market at 120 per share. The board of directors of Bank P has submitted a proposal to RBI to take over that weak bank R on the basis of share exchange ratio. Then children, balance sheet is given to you. They are saying it was decided. Now children, mergers is starting. It was decided to issue shares at book value of Bank P, the stronger company, to the shareholders of Bank R. All assets and liabilities are to be taken over at book value. For the swap ratio, share exchange ratio, yes, rates assigned to different parameters are as follows. So children, they have given to you the weights, which means they are saying calculate SCR based on this, calculate SCR based on this, calculate SCR based on this, calculate SCR based on this. The weights are given, calculate the weighted average SCR, and then go ahead with life. Students, if you remember, one question was, they're efficient and healthy limited. Yes, in that I had taught you how to calculate weighted average SCR. Yes, they're saying point number A, what is the swap ratio based on the above weights? Can we start? Let's start. So students, here I am just telling you, okay, please pay attention here. This is question number 31. Okay, question number 31. I'll write down here again. Question 31. Point number 1, calculation. Okay, calculation of share exchange ratio. Now children, we know that the share exchange ratio is financial variable of the target company upon financial variable of the acquiring company. Correct? Children, as far as the financial variables are concerned, they have given to you 4 variables. Students, I would like to go bottom up because there is some reason here. I want to explain certain things later on. So first of all, let us focus on the book value. Children, the book value, children, book value per share. Now students, if you see, as far as the weaker bank is concerned, the number of shares are how many, students? Can I say 140 divided by 10, that is 14 lakh shares. And as far as the stronger company is concerned, it is 500 divided by 10, that is 50 lakh shares. Correct? Children, the book value per share will be 210. Can you see this? 210 are the total equity shareholders funds divided by 14. So on the calci, 210 divided by 14, if I do, 15 rupees is the book value per share of the weaker company. And as far as the stronger company is concerned, it is 6,000, correct? 500 plus 5,500 divided by 50. So children, 6,000 divided by 50, if I do, I get 120 as the book value per share for the stronger company. Can I say the share exchange ratio based on the book value per share will be book value per share of target upon book value per share of acquiring, 15 upon 120. I'm very sure you understand. Yes, so I'll write down here. Yes, based on book value per share, it will be book value per share of target upon book value per share of acquiring. Everybody following till here? And now children, can I say it will be 15 upon 120. So I write down here 15 upon 120 on the calcis. 15 divided by 120, if I do, I get 0.125 is to 1. Yes, 0.125 is to 1. What is the meaning of this? The meaning is for every 1 share of target company, the acquiring company will issue only 0.125 of its share. Now why is the acquiring company giving only 0.125? Of course, because the ratio is such, right? The target company's book value per share is only 15, whereas the acquiring company's book value per share is 120. Therefore, of course, the acquiring company will be paying less number of shares for each share of the target company. Yes, children, next it is based on market price per share. So children, can I say based on MPS, the ratio will be MPS of target upon MPS of acquiring. Children, the market price per share of target given in the question is 8 and the market price of acquiring given in the question is 128, correct? So children, can I say 8 upon 128 will happen here? I'll write down 8 divided by 128 on the calci. 8 divided by 128, if we do, we get 0.0625 is to 1. Again, per share of target, acquiring will issue only 0.0625 of its share if the share exchange ratio is based on the market prices per share. Next children, on the basis of capital adequacy ratio. So children, I'll write down here capital adequacy ratio. Can I say the formula will be CAR of target upon CAR of acquiring. Children, CAR of target here given in the question, yes, if you remember, the CAR was 4% only and the CAR of the acquiring, children, can I say is 16%. So can I say 4 upon 16 I will do. I'll write down here 4 divided by 16 on the calci. 4 divided by 16 comes to 0.25 is to 1. So on the basis of CAR, can I say for every 1 share of target, the acquiring saying will pay only 0.25 of our share. And the last, children, the last one is on the basis of gross NPA. So children, now you have to be very attentive. On the basis of gross NPA, if I do, you know, you will say it is NPA or gross NPA of target upon gross NPA of acquiring. Children, the gross NPA of target is, can you remember this, 40% here, and the gross NPA of the acquiring is only 5%, correct? So can I say it is 40 upon 5, correct? Target upon acquiring, I will write down here 40 upon 5, which comes to, of course, 8 is to 1, correct? 8 is to 1. Which means for every 1 share of target, the acquiring company is saying we will pay 8 shares, we'll issue 8 shares. Now children, tell me, do you have the basic intelligence to understand that there is something wrong here, correct? What is wrong here? The wrong thing happening here is that we are saying, you know what, we means here the acquiring company here, as the acquiring company, we're telling target company, you are so bad, your gross NPA is 40% and my gross NPA is only 5%. Oh, therefore for your share I will issue 8 shares. Does this make sense? No, it doesn't make sense. Children, this is wrong here. It is wrong here. Children, this formula becomes wrong here because the gross NPA, yes, in one sense is not an asset indicator, it is a weakness indicator. Everybody following? It is a weakness indicator of both the companies and therefore the ratio, children, has to reverse. See here, the CAR ratio was the asset indicator, right? It was the strength indicator that yes, for me, the acquiring company will say my strength is 16% cushion, your strength is only 4% cushion, and therefore this is the ratio. For your one, I'll pay only 0.25. But here, children, do you realize this is not the strength indicator, this is the weakness indicator, and since it is a weakness indicator, do you realize the ratio has to reverse? Yes, you cannot say that, you know what, your weakness is 40, my weakness is only 5, okay, so I'll give 8 for 1. No, that is wrong, right? It should be 1 for 8. Everybody following? And therefore the ratio will change. It will be the gross NPA for acquiring upon the gross NPA for target. Children, it will be 5 upon 40, that is 1 by 8. 5 divided by 40, if I do, it comes to 0.125 is to 1. Yes, 0.125 is to 1. Everybody following? Yes, students, so with that we completed the 4 share exchange ratios based on the 4 financial variables. Now let us calculate the weighted average share exchange ratio. Children, now tell me what are the weights given. First of all, the weight given for gross NPA is 30%. So students, what I will do is, it will be 0.125 ratio on the basis of gross NPA into 0.3 plus, correct? The weighted average we are calculating. For CAR, children, it is 20%. The SCR based on CAR was 0.25, so I will do plus 0.25 into 0.2, correct? That is the weight. plus students, the next ratio is on the basis of MPS, and the weight given to you is 40%. On the basis of MPS, the share exchange ratio was 0.0625, so I'll write down plus 0.0625 into zero point 0.4 and plus the last one, children, the last one is on the basis of book value per share, that is 0.125, so I'll write down plus 0.125 into the last weight given, of course, is 10%. Yes, so I'll write down into 0.1, correct, into 0.1. So children, now on the calces we will do 0.125 into 0.3 m plus, then it is 0.25 into 0.2 m plus, then it is 0.0625 into 0.4 m plus, and then it is 0.125 into 0.1 m plus MRC. This comes to 0.125 is to 1. This becomes the weighted average share exchange ratio, which means for every one share of target company, the acquiring company will be paying 0.125 of its own shares, and that is the answer to point number A. Everybody following till here? Let us now go to point number B. In point B, what they are saying, how many shares are to be issued? Very simple question, children. Do you realize the ratio is 0.125 to 1? They have got 14 lakh shares. So number of shares to be issued will be 14 lakh into 0.125. On the calci, 14 lakh into 0.125. The total number of shares to be issued are 1.75 lakh. Yes, 1.75 lakh shares to be issued. And that is your answer for point number B. Everybody following? Let us now go to point number C. In point number C, children, they are saying prepare balance sheet after the merger. Children, this is like amalgamation of companies. Okay, they're saying prepare balance sheet post amalgamation. Children, one thing I want to tell you, very simple. They are saying transfer everything at book value. Yes, transfer everything at book value, but there is one small thing you should know. Children, do you realize that the total book value of equity of the target company is 210 lakhs, correct? So can I say that book value of equity shares of target company is 210 lakhs, correct? But we are issuing shares, we are issuing how many shares? Only 1.75 lakh shares of 10 each, which means, can I say we are issuing shares worth 17.5 lakhs only? Everybody following? 1.75 lakh shares of P are issued for takeover of the entire 210 lakh. Of course, we are issuing less because the company is very bad, and the ratios, as you saw, the share exchange ratio was, weighted average was, for every one we are offering only 0.125. So of course, for 210 lakh worth of equity, we are offering only 1.75 lakh shares of 10 each, that is 17.5 lakh rupees. So children, can I say that equity issued, okay, the value is 17.5 lakh only. Therefore, children, can I say that 210 minus 17.5, 192.5 lakh, can I say will be the capital reserve? Everybody following? 192.5 lakh will be the capital reserve. Everybody following till here? Children, with that, let us now proceed ahead. So let's now, children, make the balance sheet post merger. So I'm writing down here the balance sheet. Yes. Now, students, as far as balance sheet is concerned, do you realize you have to just add the numbers here? Yes. So can I say as far as the assets are concerned, children, let's look at the assets. Can I say cash in hand will be 2,900. So I'll write down here cash. Okay, cash is 2,900. Next, students, we're taking everything at book value, right? So next is balance with other banks, 2,000. So I'll write down here balance with other banks, 2,000. The next, students, is investments will be 16,100. I hope you're understanding. Yes, investments will be 16,100. Yes, the next, children, will be, yes, advances. Advances, children, can you see, will be 30,500. We're adding both, right? 30,500 will be the advances. I'm writing here advances 30,500. And children, the last is other assets. Can I say will be 2,100. So I'm writing down here other assets 2,100. Everybody clear? Now children, let's go to the liability side. As far as liability is concerned, can I say equity share capital? Okay, equity share capital, children, I'm very sure you understand, will be what? It will be 500. Yes, 500 lakh is the existing equity capital of the stronger company. it is further issuing 1.75 lakh shares of 10 each, which means, do you realize 17.5 will be added? I hope you're understanding. Yes, so 500 lakh plus 17.5 lakh will be 517.5 lakh. I'll write down here 517.5 lakh. Everybody following? The next will be, of course, the reserves. Children, as far as reserves are concerned, do you realize all this is gone? The only reserve now left is 5,500. So I'll write down here 5,500 lakh. Next, children, next will be total of deposits. Can I say 44,000? So I'll write down here deposits 44,000 lakh. Next, children, yes, the next one will be other liabilities. Children, other liabilities, if you take total 2,500, yes, 2,500 plus 890, children, will give us 3,390 lakh as the other liabilities. So I'll write down here other liabilities 3,390 lakh. Now, children, tell me what is missing. Of course, capital reserve. I'll write down here capital reserve. Capital reserve, children, we got is 192.5 lakh. So I'll write down here 192.5 lakh. Let us now take the totals. Can we start? So, students, it is 517.5 plus 5,500 plus 192.5 plus 44,000 plus 3,390. This comes to 53,600. On the asset side, 2,900 plus 2,000 plus 16,100 plus 30,500 plus 2,100, that is also 53,600. Yes, students, so with that we have completed the balance sheet. Our balance sheet has tallied, the post-merger balance sheet has tallied, and with that we complete point number C. Let us now go to point number D. Calculate CAR and gross NPA percentage of Bank P after merger. Children, one by one, okay, please pay attention. First of all, CAR, okay. Now, children, as far as CAR is concerned, do you remember it was the cushion that we were talking about? So the CAR for the weak company was 4% and for the strong company was 16%. So please pay attention now here. See, for the weak company, the CAR was only 4%, correct? Which means, children, do you realize that the capital cushion it had kept upon the risk-weighted assets into 100 must have been 4%, correct? The risk-weighted assets, the cushion kept, the capital was only 4%. Now, students, we do not have how the risk-weighted assets were calculated, nor do we have the amount, correct? But we have the capital with us, correct? If you see the balance sheet, yes, if you see the balance sheet earlier, the capital of the weak company was 210 lakhs. Children, therefore, we know that the cushion was 210 lakh. We know the cushion percentage was 4%. Can we find the risk-weighted assets? Students, please trust me to understand everything. How the risk-weighted assets were calculated, we are not going into that. We are just calculating a balancing figure. That's it. So now, students, focus on this. Can I say that 210 lakh upon risk-weighted assets is equal to 0.04? Everybody following? So can I say 210 lakh divided by 0.04 will be risk-weighted assets? So on the calci, 210 divided by 0.04 will give us 5,250. Yes, 5,250 lakhs were my risk-weighted assets. What they are, to hell with it. How they are calculated, to hell with it. We only found it as a balancing figure. Everybody following? So children, can I say that pre-merger, okay, pre-merger, as far as the weak company is concerned, that is R, the capital, okay, the capital was 210 lakhs, correct? So I'll write down here, capital was 210 lakhs. The risk-weighted assets, children, was 5,250 lakhs. Everybody following? And therefore the percentage ratio came to 4%. Can we similarly find the pre-merger RWA for the strong company P? Yes. So for P, children, we know that the capital adequacy ratio was 16%. So children, can I say the cushion was 16%? The capital, that is the cushion percentage we know is 16%. The capital, children, was 6,000 here. Can you see this? 6,000 lakh was the capital. So children, do you realize if 6,000 lakh was the capital, can we find the risk weighted assets? Yes, as the balancing figure. So I'll do it here only. Can I say 6,000 lakh upon risk weighted assets into 100 was 16%? percent. So children, can I say that 6000 lakh upon RWA is equal to 0.16? Can I say RWA is equal to 6000 lakh upon 0.16? On the calci, 6000 divided by 0.16 will give us 37,500 lakh, correct? 37,500 lakh as the RWA for the strong company. So 37,500 I will put it here. 37,500 lakh I'll put it here. Now children, do you realize for the merged company, how do I solve this? Come on, think and tell me, for the merged company, how do I solve this? I have to simply take the totals. Everybody following, I have to simply take the totals and then calculate the ratio again for the merged company. Can we start? So children, as far as total capital is concerned, can I say it is 6,210 lakh. As far as RWA is concerned, it is 37,500 plus 5250, that is 42,750, and therefore the revised CAR ratio for the merged company will be 6,210 lakh upon 42,750 lakh into 100 on the calci. 6210 divided by 42,750 percentage, if I do, it comes to 14.53%. Yes, 14.53% therefore becomes the revised CAR percentage. Everybody following? Yes children, basic mathematics these are, need not go into much details here. Yes, so we got the CAR. Now we have to calculate the gross NPA percentage. Very simple students, please pay attention. So gross NPA percentage. Now children, let us try to understand how to calculate. Same we'll do. We have to calculate the pre-data first and then merge and calculate the post. Can we start? Okay. Now students, for the pre-data, for the weak company first, that is R, do you realize this R bank has a gross NPA pre-merger of 40%, which means of all the advances it has given, correct? R has given advances of 3,500, 40% is NPA, which means children, do you realize 3,500 lakh into 40%, if I do 3,500 into 40%, this comes to 1,400 lakh. This must be the NPA, can I say, in rupees. As far as a strong company is concerned, the total advances given by the strong company children are 27,000 lakh, but their NPA is only 5%. So can I say 27,000 multiplied by 5%? Can we start? So children, 27,000 lakh, okay, 27,000 lakh into 5%. If we do 27,000 into 5%, this comes to 1350 lakh. Children, can I say therefore post merger? Yes, post merger total advances we know are 30,500 lakh, and the total NPA now will be 1,350 plus 1,400, that is 2,750 lakh. Can I say therefore the percentage, the NPA percentage will be 2,750 lakh divided by 30,500 lakh into 100. So if I divide this by 30,500, percentage comes to 9.02%. Yes, so 9.02% therefore now is the post merger NPA percentage. Yes, post merger NPA percentage. It was only 5% for the strong company, but because taking this weak company, it has gone up from 5 to 9.02. Everybody following? Children, with that we complete this huge question, this dangerous looking question. Yes, this threatening question, question number 31 on the basis of banking merger. I hope you all understood this question. Yes, I have tried my best to explain to you without taking you much into the banking details. It is not our zone to go there. We only needed to know what is happening in this question. I showed you what is happening. I am very sure you're confident. More confidence you'll get when you do the next question, which is also very similar, just numbers have changed. Yes, so I hope that you get the right answer in the next video also. I'll now flash the solution of this question on the screen, so you can pause the video and copy down the notes. Okay students, so I hope you all saw the video to this particular question. With that we complete the discussion to this particular area called as banking merger. Now we go to maximum and minimum SCR. Last concept of this chapter. Students, in maximum and minimum SCR, what we have to calculate? We have to calculate how much maximum share exchange ratio acquiring company should be willing to offer, and contrary, from target company's point of view, how much minimum SCR they want. So students, to calculate that, there is only one thing: non-dilution of pre-merger market cap. I'll again repeat, non-dilution of pre-merger market cap, which means acquiring company will say, I am willing to offer how many ever shares, I have no problem, but my pre-merger market cap for existing shareholders should not get diluted. Same thing target company is saying. Target company is saying minimum I want these many shares so that my existing market cap doesn't get diluted. So accordingly, students, they set the share exchange ratio maximum and minimum limit. So for example, acquiring company has 600 crore rupees market cap. Target company has 200 crore rupee market cap. Acquiring company is going to take over target. Now students, it might happen that acquiring company issues too many shares to the target company, thereby diluting the existing shareholders market cap, which is what they don't want. They are saying our existing 600 crore market cap of existing shareholders should not dilute. Let the new people come in, but existing shareholders should not suffer. So they will accordingly set the share exchange ratio, and target company is saying share exchange ratio, whatever you want to give us, to give minimum 200 crore rupees worth of shares we want. So that is what they are saying. They don't want their market cap to get diluted. There is one nice question which is there on this particular concept, which we will revise right now. I'll take question 33. Yeah, this particular question, it has come in a recent RTP also. I will now share my video on this particular question right now. You watch it, and students, once that video is done, then we are done with the revision of mergers and acquisitions. Okay, so please now watch this video. Hi friends, welcome to this video where we will be discussing one question based on this concept of maximum and minimum share exchange ratio. I request everyone to first of all pause the video and read the question carefully. Start. Okay students, I hope you all have read the question. Let us now try to understand this. They are saying C Limited and D Limited are contemplating a merger deal in which C Limited will acquire D Limited, which means, children, can I say C Limited is the acquiring company and D Limited is the target company. The relevant information about the firms are given as follows. So all this information is given to you. Let's go ahead. Point number 1. What is the maximum share exchange ratio? Maximum share exchange ratio acceptable to the shareholders of the acquiring company if the P ratio of the combined firm is 7. Okay, so they are saying that what will be the maximum share exchange ratio that is acceptable to the acquiring company if the P of the combined firm, children, combined firm means post-merger firm, right, is 7. So if this is the scenario, then what is the maximum exchange ratio for the acquiring company to offer to the shareholders of the target company? As I told you, children, since they have not mentioned any specific criteria, we should understand that the silent criteria here is that the shareholders of the acquiring company, they should not dilute their pre-merger market cap. Whatever market cap they were owning pre-merger should continue post-merger also. Let us now see mathematically how that functions. So I will write down here, okay, point number 1. Okay, point number 1. Okay, I'll write down here question and then point number 1. Are you ready? Let's start. I'll write down calculation of maximum SER, share exchange ratio, that C Limited, that is the acquiring company, would offer. Okay, calculation of maximum SER that C Limited would offer. Now children, for this I would make 3 columns. One is particulars, then we have got calculation, and then we have got amount. Okay, particulars, calculation and amount. Are you ready? Let's start. First of all, just be with me. One small points we will take up, and then at the end everything will make sense. Don't worry, okay? So please be with me. First of all, I just want to calculate post-merger earnings of acquiring company, that is C Limited. So I'll write down here post-merger earnings, okay? Post-merger earnings. Now children, can I say the post-merger earnings will be nothing but the sum of the pre-merger earnings, that is, can I say 96 million plus 30 million. Everybody clear? 96 million plus 30 million. This will give you your post-merger earnings. So now let's do the 96 plus 30, 126 million. I'll write down here 96 million plus 30 million, that is rupees 126 million, correct? Rupees 126 million will be the total earnings post-merger. Now, according to the question, can I say the post-merger P ratio is 7, correct? Post-merger P ratio is 7, so I'll write down here post-merger PE ratio given to us is 7 times. So students, do you understand this 126 million total post-merger earnings? If I multiply by 7, I will get the post-merger market cap. Everybody clear? I will get the post-merger market cap. Children, EPS into PE gives market price per share. So total earnings into PE will give total market cap. Everybody clear? So I will now get post-merger market cap. Okay, post-merger market cap. Can I say that will be rupees 126 million into 7. 126 into 7. This comes to rupees 882 million. Everybody clear? Rupees 882 million. So now we understand that if A, that is the C Limited, acquires T, that is D Limited, do you realize the post-merger market cap of this company will be 882. Now comes the most important point. What are the shareholders, the existing pre-merger shareholders of the acquiring company C Limited saying? What are they saying? They are saying that, see, our pre-merger market cap of C Limited, okay, pre-merger market cap of C Limited was, children, if you see here, the pre-merger market cap of C Limited was 96 million were their earnings and 8 was the P ratio. So children, can I say 96 into 8 will give you the pre-merger market cap of C Limited? I'll write down here rupees 96 million into 8. Or I can also say that the number of equity shares in this company were 20 million and the market price per share was 38.4. So 20 into 38.4 will also give you the market cap. So I'll write down or 20 million shares into rupees 38.4, okay, into rupees 38.4. Let's take the calci. 96 into 8 if we do, we get rupees 768 million, which could have alternatively be calculated as 20 into 38.4, that is 768 million. Everybody clear till here? So what are the shareholders of the acquiring company saying? They are saying that, see, we will take over this D Limited, no problem, but the condition is that our pre-merger market cap of 768 million should not get diluted. We should continue to hold 768 million. Now children, we know that post-merger the market cap is 882 million. They are saying from this 882 we want 768, which means, children, do you realize the balance market cap left for D Limited, that is the target company, would be rupees 882 million minus rupees 768 million. Everybody clear? 882 million minus rupees 768 million. I'll take the calci. 882 minus 768. What is left is 114 million. Everybody clear? What is left is 114 million. So one thing we realized, that when the acquiring company is taking over the target company, the acquiring company is saying that the post-merger market cap of the acquiring company will be 882. From that, 768 should belong to our existing shareholders. 114 we are willing to pay or willing to share or willing to give for the shareholders of the target company. Everybody clear? So now the question arises that if you want to share 114 million out of 882 for delimited shareholders, then what should be the share exchange ratio? Okay, what should be the share exchange ratio? So children, this is slightly tricky calculation. It's mathematics at the end of the day, but please be with me. So I will write down now here, calculation of number of equity shares to be issued by C Limited to shareholders, okay, to shareholders of D Limited. Everybody clear? Because once we understand how many shares we are offering, only then we'll be able to find out the share exchange ratio. Everyone clear? Great. So calculation of number of equity shares that C Limited has to offer, correct, to the shareholders of D Limited. Let number of equity shares be X, which means let the number of equity shares which are issued by C Limited to the shareholders of D Limited be X. Till your story is clear? Great. Now children, can I say that for D Limited, if you think from their perspective, the market cap that they will be owning, okay, market cap that they will be owning in the post-merger firm divided by post-merger market price per share will give you the number of equity shares that has to be issued to them. Everybody are able to understand? So children, the post-merger market cap, right, the entire market cap that the shareholders of D Limited will be now owning after merger divided by the post-merger market price per share will of course give you the number of equity shares that have to be issued to the shareholders of D Limited. Everyone clear till here? So just to make things more clear, I will also write down here post-merger market cap. Okay, post-merger market cap. Everyone following? Great. Now we know one thing, that the post-merger market cap that the acquiring company is willing to offer to the shareholders of the target company is rupees 114 million. Everyone clear? 114 million is the max that we are ready to share. So children, do you realize this is 114 million? Everyone clear? 114 million, the whole divided by post merger market price per share will give you the number of equity shares that need to be offered to the shareholders of D Limited, which we have taken as X. Everybody clear? Which we have taken as X. Now children, how to go ahead from here? Very simple. This post-merger MPS, okay, post-merger MPS is nothing but post-merger EPS into the PE ratio. Everybody clear? Post-merger MPS is nothing but post-merger EPS into PE, and I'm taking this PE route because the PE ratio is very specifically mentioned in the question to be 7 post-merger, right? They have very clearly told you that the PE ratio is going to be 7. So of course I will take the PE route to calculate the post-merger MPS. So can I therefore say that 114 million divided by post-merger EPS into the PE ratio will give X, and can I say post-merger EPS into PE is nothing but the post-merger MPS. Everyone clear till here? Now children, as you know that the post-merger PE ratio given to us by the question is 7 times, correct? The post-merger PE ratio is 7. So now children, how to proceed ahead? How to find out post-merger EPS? Children, can I say post-merger EPS is nothing but post-merger earnings divided by post-merger number of equity shares. So I will write this down here. 114 million divided by post-merger earnings, okay, divided by post-merger earnings, the whole divided by post-merger number of equity shares, correct? This into 7 should give X. Everyone clear? This into 7 should give X. Now 114 million divided by, now children, post-merger earnings. post-merger earnings already we had calculated as 126 million. Everyone clear? 126 million. So students, therefore, do you realize that this is 126 million divided by post-merger number of equity shares into 7 should give X. Everyone clear? Into 7 should give X. Now, how do I find the post-merger number of equity shares? Very simple. Children, do you realize the acquiring company already has 20 million shares outstanding, right? The acquiring company already has 20 million shares outstanding. Plus, it is going to issue X shares. Everyone clear? Additionally, it is going to issue X shares to take over the target company. So, do you realize the total number of equity shares outstanding in the acquiring company C Limited post-merger will be its pre-merger number of equity shares, that is 20 million, plus the new shares that will be offered to the shareholders of Target Limited. Everybody clear? That is 20 million plus X. Everyone clear? Now we have to simply solve this equation to find out X. I'll just once more go through the entire thing. Children, what is 114 million? 114 million is the maximum market cap that the acquiring company is willing to share with the shareholders of the target company. Till here clear? That divided by post-merger market price per share will give the number of equity shares that are to be issued, or rather the number of equity shares that the acquiring company is willing to max issue to the shareholders of Target Limited. Everybody clear till here? And now children, in the denominator here, the post-merger market price per share is nothing but the post-merger earnings per share into P ratio. P ratio was given to you in the question. Post-merger earnings per share is nothing but post-merger earnings divided by post-merger number of equity shares. Post-merger number of equity shares is nothing but the pre-merger number of equity shares of the acquiring company plus the new shares that should be offered to the shareholders of Target Limited, which we have taken as X. Everyone clear? So I'll now just remove these markings and let's now mathematically solve this. Are you ready? Let's start. So now I would first of all like to do 126 million into 7. Right? In the denominator, 126 million into 7, that gives me 882 million. So I'll write down, therefore 114 million divided by 126 into 7 is 882 million divided by 20 million plus X, correct, will be equal to X. Everybody clear? Will be equal to X. Now children, this 20 million plus X, let us take it to the numerator. I hope that much maths you know. Okay, so 114 million into 20 million plus X, the whole divided by 882 million should give X, correct? So now children, 114 into 20, this comes to 2280 million plus 114 million X is equal to 882 goes to the RHS, 882 million X. Now children, this 114, let us put it to the RHS. So children, 882 minus 114 gives you 768. So therefore 2280 million is equal to 768 million X. Therefore X will be 2280 million divided by 768 million. Everybody clear? So children, if we do the calculation, 2280 divided by 768, this comes to 2.96875, which we can round off to 2.97 million. Okay, I'll write down here, which is equal to 2.97 million. Now what is 2.97 million? Children, I hope you realize X is the number of equity shares that the shareholders of T will max receive from A, considering A does not want to dilute its market cap. So I'll write down, therefore A means here acquiring company is C Limited. Therefore C Limited will issue 2.97 million shares to shareholders of D Limited. Everybody clear? So therefore the share exchange ratio will be 2.97 million divided by, children, D Limited, there are 14 million shares, correct? In D Limited pre-merger there are 14 million shares. So to these 14 million shares, 2.97 shares will be offered, and that gives a share exchange ratio of 2.97 divided by 14, that is 0.212 is to 1. Everybody clear? 0.212 is to 1 becomes the max share exchange ratio that the acquiring company is willing to offer to the target company. Till here clear? So with that, children, we complete the discussion to point number 1. Now let us go to point number 2. Children, in point number 2, what they are saying, what is the minimum share exchange ratio acceptable to the shareholders of D Limited if the P ratio turns out to be 9? So the shareholders of D Limited are now saying that we want minimum this much share exchange ratio. But children, of course, the P ratio is changing now. According to them, the P ratio will be 9 in the post-merger firm. So students, let us understand this point number 2. Calculation of minimum share exchange ratio acceptable to shareholders of D Limited, that is the target company. Everyone clear till here? Now children, as I told you in the introduction, when nothing is mentioned, the criteria is market cap, correct? What is the pre-merger market cap of D Limited? What is the pre-merger market cap of D Limited? The pre-merger market cap of D Limited is 30 million earnings multiplied by P ratio of 7. Okay, so I'll write down here rupees 30 million into 7. Children, or you can alternatively also calculate it as 14 million shares multiplied by rupees 15 per share. So I'll write down here 14 million shares into rupees 15. So whether I do 30 into 7 or I do 14 into 15, it is 210 million. So basically the shareholders of the target company will say that the share of market cap that A, you should be offering to us, A, that is the acquiring company, C Limited, you should be offering to us minimum 210 million. Everyone clear? So the market cap that the shareholders of D Limited would be wanting is 210 million. Everyone clear? And children, I hope you understand that 210 million divided by post merger market price per share will give the number of equity shares that these people want. Everybody clear? Market cap divided by market price per share will give the number of equity shares. Children, as you know, 210 million divided by, now post merger market price per share is nothing but post merger EPS into the PE ratio. Everybody clear? Into the PE ratio. This PE ratio they are saying will now be 9, and therefore I will take 9 here. Everybody clear? I will take 9 here. Now children, post merger EPS. How to find post merger EPS? Post merger EPS is nothing but post merger earnings divided by number of equity shares. Children, post merger earnings we already had calculated. The post merger earnings, children, were 126 million, correct? 126 million. So I'll write down here 126 million divided by, as we had already discussed, 20 million shares already outstanding plus new shares to be issued, X. Everybody clear? Let us quickly solve this, children. So this is 210 million divided by 126 into 9 will give 1134 million divided by 20 million plus X. The whole is equal to X. Now children, this 20 million plus X, we will take it upstairs. So 210 into 20 million plus X, okay, will be equal to, now children, this 1134 which is there in the denominator, I'll push it to the RHS. So this will become 1134 million X. Everyone clear till here? This is of course 210 million. Let's now continue ahead, children. 210 into 20 will give 4,200 million plus 210 million X will give 1134 million X. This 210 I'll put on the RHS. So 1134 minus 210. 924. So can I say 4200 million is equal to 924 million X, and therefore X is equal to 4200 million divided by 924 million. Children, 4200 divided by 924, this comes to 4.5454. I'm rounding it off to 4.55 million, which means the shareholders of target company are saying that we minimum want 4.55 million for our 14 million shares. Everybody clear? For our 14 million shares. So children, do you therefore realize that the share exchange ratio that they are demanding is 4.55 million divided by 14 million. So 4.55 divided by 14, this comes to 0.325:1 is what they are asking. Everybody clear? This is the minimum share exchange ratio that they need. So with that, children, we complete the discussion to this question. The first question on this concept of maximum and minimum share exchange ratio. Okay, students, I hope you all watched the video for this particular question. With that, students, we are done with the revision of mergers and acquisitions. So till now, which all chapters we have done? We have completed equity valuation. In fact, before that, bond valuation we did, equity valuation, corporate valuation, mergers and acquisitions. So 4 big chapters we are done. Now students, let us go to the next chapter for the revision of SFM. Okay students, so now the next chapter that we will be taking up is portfolio management, a very big chapter, portfolio management. Okay, so let us begin the discussion to this chapter. Students, there are many concepts here. Okay, we will be discussing as many as possible. Yeah, around 21 you should take. So let's see what all we can do. So introduction, of course, done. In introduction, I would just tell you that in this chapter there are 2 broad aspects which are being covered. One is the calculation of KE. Okay, so in equity valuation we do valuation of equity shares, right? Theoretical valuation, how much we are ready to max pay for the share today. Now in that, to do the valuation, we need to discount future cash flows, and we do discounting of future cash flows at the rate KE. Students, in this chapter, we will be focusing a lot on how is the KE calculated. And of course, the second part of this chapter is revolving around portfolio tools, techniques, how to create, how to avoid pitfalls, etc. All that is there in this particular chapter. Portfolio means basically bringing together of more than one securities in a portfolio, right? So now let's start. So in this, the first concept I want to teach you is risk and return of a single security. Okay, risk and return of a single security. I'm using the word teach, basically revise. Okay, so risk and return of a single security. In that, students, there are 2 types. First is if the data is historical past data. Second is if the data is probable future data. Okay, so basically there are 2 types of data sets that could be given to you. Either they can tell you, okay, there is this share, and in this share, if you see in the last 5 years, in the last 4 years, the share has given this return. Okay, now you calculate the expected return of the share and calculate the risk in the share. So if that data is there, historical past data is there, then students, the expected return, which is nothing but X bar, is calculated as summation X by N, and the risk, which is sigma, is calculated as summation X minus X bar the whole square upon N the whole under root. These are the 2 formulas which we are using to calculate expected return and risk in case the data given to you is historical past. What if the data given to you is probable future? So probable future means they will say forget the past, let me give you coming year data only. They will say, okay, in this coming year, If market condition is good, then the share will give this much return. If the market condition is bad, then the share will give this much return. If the market condition is normal, the share will give this much return. So probability and futuristic data if they are giving you, then students, the expected return, okay, the expected return calculation, again x bar will be summation px, where p stands for probabilities, and the risk, that is sigma x, will be summation p x minus x bar the whole square, the whole under root. Okay, so these are the two formulas for probable future data. Now students, what we will do is, we will just pick up one example for each of these two to understand historical as well as probable future, and then we'll go ahead. So for historical past, let me give you one example. Let's say, let's take up question number 1. Okay, we'll do only security X for this. Okay, so what are they saying? Following is the return of two securities for the past 5 years. Calculate the expected return and risk. So let's talk about security X. So these are all percentages of security X in the last 5 years. How to calculate expected return? Now expected means what? Basically in the last 5 all this happened. Now in this coming year, okay, in the coming year, correct, that is year 6 I might say, but year 6 in a sense it is year 1 for you. In this coming year, how much is the share expected to give? So students, for that what we need to do is, we consider this as X and we use the formula of x bar and sigma x. So I'll just show it to you. I'll just write here calculation of expected return, that is x bar, and risk, that is sigma x. Okay, how many columns to make? Only 3. Year, x, x minus x bar the whole square for sigma. Okay, so how many years are there? 5. So year 1 2 3 4 5. Then 6.6 5.6, so I'll write here 6.6 5.6 minus 9 12.6, so minus 9 12.6 and 14. Okay, and 14. Now students, these are the past 5 year data. Now how much are we expecting in this coming year? Can I say x bar will be summation x by n, basically a simple average of this. So we'll take the calculators and we will now do a simple average. So this will be basically 6.6 plus 5.6 plus minus 9 plus 12.6 plus 14 divided by 5, and you get an expected return of 5.96. Basically you are expecting this share to give 5.96 in the coming year, but there is a deviation also possible from this 5.96. You are not completely sure about it. That deviation, students, is called as risk, which is calculated as sigma, which is summation x minus x bar the whole square upon n, the whole under root. So let us now do calculation of sigma x minus x bar. So 6.6 minus 5.96 into equal to m plus 5.6 minus 5.96 into equal to m plus 9 plus 5.96 minus plus, right, into equal to m plus 12.6 minus 5.96 into equal to m plus, and then 14 minus 5.96 into equal to m plus. MRC if we do, we get 333.072. that is the summation of x minus x bar the whole square. So the sigma, can I say, will be 333.072 divided by 5 the whole under root. I'll divide by 5 and I'll press the root and I will get 8.16%. Basically this share is expected to give 5.96% in this coming year, but it can deviate by 8.16% up or down in this coming year. That is the risk element. That's how you calculate the expected return and risk for a share using historical past data. Now I will give you a question for probable future data. So you see this, they are saying following information is available in respect of returns of security X under different economic conditions. So what they are saying, if the condition is good, then the share will give 20% return, and there is a 10% probability that the condition will be good in the coming year. Then if condition is average, then the share is expected to give 16% return in the coming year. There is a 40% chance that the economic condition would be average in the coming year, and so on. Okay, they are saying find the expected return and the risk. So now when probabilities are given, means it is probable future data given to you. So in that, how do we calculate? So I'll write here again, calculation of expected return and risk. Again, x bar and sigma x we have to calculate, but now the columns should be slightly different. It will be P, it will be X, it will be Px, it will be Px minus x bar the whole square. So first of all, I'll write down the probabilities 1, 4, 3 and 2. So 0.1, 0.4, 0.3, 0.2. Then as far as x is concerned, 20, 16, 10 and 3. So 20, 16, 10 and 3. Now students, for calculating the average expected return, that is x bar, do you understand that you cannot now do simple average here? You'll have to do weighted average. X bar will be summation Px. Weighted average means basically probabilities are the weights. You multiply the x by the weights and get the summation Px. So students will now do, okay, 20 into 0.1 m plus, 16 into 0.4 m plus, 10 into 0.3 m plus, 3 into 0.2 m plus and MRC, and this comes to an x bar of 12%. So basically you are expecting this share to give you an weighted average return of 12% in the coming year, but yes, it can deviate, so we need to find the risk also. Now the calculation of risk is summation P x minus x bar the whole square, the whole under root. So basically we have to simply get the total of this column and then press the root sign. So this is x minus x bar the whole square into P. So let us do it. 20 minus 12, correct? X minus x bar for the first case. 20 minus 12 into equal to into 0.1 m plus. 16 minus 12 into equal to into 0.4 m plus. 10 minus 12 into equal to into 0.3 m plus, and then 3 minus 12 into equal to into 0.2 m plus, and then we do MRC, we get 30.2, and straight away we need to calculate the root of this, and we get 5.495 or basically 5.50% as the sigma. This is how you calculate the sigma and expected return, that is x bar, for a data based on probable future. Okay, so that is as far as this concept is concerned. Now there is one more small area which I need to revise for all of you within this. So see, we are done with historical data, we are done with probable data. There is one concept called as observed return of a share. So first of all, let me tell you what is the background of this. Students, now for example, we did this question. Now in this question, we learned how to calculate the x bar and sigma using all this data, but then a question could arise that how did this data got calculated, right? How did someone calculate that security X gave 6.6% in 5 years ago, 5.6% 4 years ago? How did they calculate? What formula was used to find the return of a share? Students, that is called as observed return of a share, and observed return of a share is denoted as capital K, and the formula is, so if you are wanting to find the K for year 1, then the formula will be price at the end of year 1 minus price at the end of year 0 plus dividend at end of year 1 upon price at end of year 0 into 100. Basically the share starts at P0, P1 minus P0 is like the capital gain, and plus D1. So there are two kinds of income you are deriving from a share. One is capital gain and other is dividends. Upon P0 into 100 is basically the return of a share from year 1. Similarly, if you want to find return for year 2, it will be price at end of year 2 minus price at end of year 1 plus dividend at end of year 2 upon price at end of year 1 into 100, and so on. That's how you use the formula. I'll do one question for you to get a grip on how that is calculated. So we will now pick up question number 6. Okay, this question I will take. So what are they saying? ABC had the following dividend per share and market price per share for the period 2000 to 2005. So students, in the last 5 years, 6 years, all this data is given. They are asking you to calculate annual rate of return for the last 5 years. So now For the last 5 years means for 2001, 2, 3, 4 and 5. Now how do I find the rate of return? See, the question 1 which we did there, already the percentage rates of returns were given to you. We could easily find X bar and sigma X. But here can you see they have given to you dividends and share prices. We have to first of all use this data to convert it into the K, that is the percentage returns, and then we will be able to find out X bar, sigma, whatever they want. Okay. So let me show it to you how to do it. So here I'll write calculation. Okay, then I will write K, which we call as X. So first of all, let us talk about year 2001. Can I say for year 2001 the return will be, see this is P1, correct? This is end of year 1, this is P0 and this is D1. You understanding? So can I say for 2001 the share started at a price of 31.25 and ended at 20.75. So there is a negative capital gain here. So loss basically. So 20.75 minus 31.25. So I'll write here 20.75 minus 31.25. We got a dividend of 1.53. The whole upon 31.25 into 100. So if I take the calci, 20.75 minus 31.25 plus 1.53 divided by 31.25 into 100, and that comes to a negative 28.7% return for year 1. Okay, negative 28.7% return for year 1. Next we will do 2002. For 2002, can I say the year started with P1 of 20.75 and ended with a P2 of 30.88 and a D2 of 1.53 again. So can I say for year 2 the return will be 30.88 minus 20.75, 30.88 minus 20.75 plus the D2, that is 1.53 upon 20.75 into 100, right? We are starting the year with 20.75, that is P1. So this is basically P2 minus P1 plus D2, the whole upon P1 into 100. So 30.88 minus 20.75 plus 1.53 divided by 20.75 into 100, and that comes to 56.19%. Like that, students will get all the percentage returns correct for each of the last 5 years. Once you have the X, then can I say we can easily find X bar, we can easily find sigma X. Everybody clear? So that's how you do the calculation of observed return of a share. So with that, students, we complete the discussion to this part or this module, that is return and risk of a single security. Now students, will move on to risk and return of a 2 security portfolio. So if you are now constructing a 2 security portfolio, means in one portfolio there are 2 shares, not 2 shares of same company, but one share each of 2 different companies, or how many were shares but 2 different companies into one portfolio. Then how to calculate the expected return of that portfolio and how to calculate the risk of that portfolio. So let us understand. So return of portfolio, okay, return of portfolio is denoted as RP, and risk of portfolio is denoted as sigma P. Okay, return of portfolio is RP and risk of portfolio is sigma P. Students, simple formulas are there. Return of portfolio is nothing but weighted average return, that is WXRX plus WYRY, where WX, WY will be the weights in which you have invested in X and Y, and RX and RY will be individual security returns that we studied in the previous concept. Individual security return and risk we found, right? I taught you X bar, I taught you how to calculate X, that is RX, that is K. So everything I have taught to you. So you have to basically first of all find the individual security returns of X and Y, that is X bar and Y bar, and that is denoted here as RX and RY, and also get the weights of X and Y and simply calculate the return of the portfolio as a weighted average. Now as far as risk of portfolio is concerned, it's a slightly big formula. It is WX square sigma X square plus WY square sigma Y square plus 2 WX WY sigma X sigma Y RXY, the whole under root, where of course WX sigma X, all these you know, WX and WY are the weights of X and Y, sigma X sigma Y will be the risks of X and Y, and Rxy at the end denotes correlation coefficient between X and Y. So students, in this also I would like to put one condition that if Rxy is equal to +1, okay, see please note correlation coefficient ranges between -1 and +1. It cannot be anything else. It can be -1, it can be +1, it can be 0, it can be plus 0.3, it can be -0.4, it can be anything between -1 and +1, but nothing beyond those boundaries. So if Rxy is +1, we say it is perfect positive. If Rxy is -1, we say it is perfect negative. So if Rxy is +1, then sigma p formula boils down to Wx sigma x plus Wy sigma y. That's it. And if Rxy is -1, then sigma p is equal to Wx sigma x minus Wy sigma y. That's it. Everyone clear? So basically there are three formulas I gave you for sigma p. This is the general formula, correct? This is the generic formula. But if Rxy is +1, no need to make such a big formula straight away. Use the shortcut formula I gave you. Also if Rxy is perfect negative -1, then also you can use that shortcut formula with a negative sign in the middle. Otherwise if Rxy is anything but -1 and +1, then the big formula you will have to use. So we'll just take up one small example to get a grip on return and risk of a two security portfolio. Okay, and for that we will pick up, let's say, a question number 8. Okay, so what are they saying? Mr. X is holding two securities X and Y in portfolio. Understood the language? In one portfolio, in one basket, we are holding two securities X and Y. With the details given below, calculate the portfolio return and risk. So students, X and Y proportion means basically weights are given, standard deviation means basically sigma is given, returns are of course the returns of X and Y. So if I can just mark it for you, these numbers here are Wx, Wy, this is sigma X, sigma Y, this is Rx and Ry, and here this is correlation Rxy. So let us put the numbers now and get the Rp and sigma p. Okay, what is the formula of Rp? Wx into Rx plus Wy into Ry. The weights of X and Y are 0.6 and 0.4. So 0.6 into something plus 0.4 into something. Rx and Ry are 20 and 25. So I'll write here 20 and 25. Let us take the calci and solve this. 0.6 into 20 m plus 0.4 into 25 m plus MRC, we get the expected return of the portfolio as 22%. For finding sigma, what is the formula? Now first of all, see, the correlation is neither +1 nor -1, which means, can I say, we will have to use the big formula. So I'll write here Wx square sigma x square plus Wy square sigma y square plus 2 Wx Wy sigma x sigma y Rxy, the whole under root. So students, here weights are 0.6, 0.4. So what I will do is 0.6 square into something plus 0.4 square into something plus 2 into 0.6 into 0.4 into something into correlation 0.5, the whole under root, and the sigmas given to you are 10 and 16. So I'll write here 10 square, 16 square, 10 and 16. Now how to do it on calci? One shot. 0.6 into equal to into 10 into 10 m plus 0.4 into equal to into 16 into 16 m plus 2 into 0.6 into 0.4 into 10 into 16 into 0.5 m plus MRC root, and you will get the answer as 10.74% of sigma p. This is how you calculate return of a portfolio and risk of a portfolio. Now within this there are certain mathematical things that I need to share with you. So see, we have understood the return of a two security portfolio, we have understood the risk of a two security portfolio. Now this one point is left, that is calculation of covariance and correlation calculation. So here in the example that we did, can I say correlation coefficient of 0.5 was directly given to you, but there could be scenarios where they would ask us to calculate the covariance and correlation, basically calculate the correlation coefficient, and to calculate correlation coefficient we need to calculate covariance also. So we will do one example to understand that. So please now focus on this, on how to calculate correlation coefficient. So correlation coefficient RXY, correlation is always between two securities. The formula is covariance XY upon sigma x into sigma y. Okay, covariance xy upon sigma x into sigma y, and you know how to calculate sigma x, you know how to calculate sigma y. Covariance xy, we need to know, is summation x minus x bar into y minus y bar upon n in case it is historical past data, or summation p x minus x bar y minus y bar, correct, in case it is a probable future data. So students, we will now invest some time to get all these formulas under grip by using some examples. So now what we will do is we'll go to question number 10. Okay, before I go there, yeah, so we will now do question number 10 here. Yeah, can you see the historical rates of return of two securities? So historical means past. Okay, over the past 10 years are given. Calculate the covariance and the correlation coefficient. This is an exam question. Okay, so see, they have given to you x and y. All this data is given to you. We have to calculate the covariance and correlation coefficient. So let us do it. So I'll write here year 1. How many years are there? There are 10 years. Okay, so 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Then x. So what all information is there? Let's pick it up. 12%, 8%, 7%. So 12, 8 and 7. 14, 16, 15. 14, 16, 15. 18, 20, 16. 18, 20, 16. And then 22. Okay, 22. And then as far as y is concerned, we have 20, 22, 24. 20, 22, 24. Then we have got 18, 15, 20, 18, 15, 20, and 24, 25, 22, 24, 25, 22, and then at the end we have got 20. Okay, so now how to calculate covariance and correlation coefficient? First of all, I will require the x bar and the y bar before we do anything. So for x bar, it will be 12 plus 8 plus 7 plus 14 plus 16 plus 15 plus 18 plus 20 plus 16 plus 22 divided by 10, and that is basically 14.8%. For y bar, it will be 20 plus 22 plus 24 plus 18 plus 15 plus 20 plus 24 plus 25 plus 22 plus 20 divided by 10, and that comes to 21%. Now that you have x bar and y bar, let us now calculate correlation coefficient, covariance, everything will do. So you tell me, what is correlation coefficient formula? Covariance xy upon sigma x into sigma y. Now for that, can I say we will require covariance xy? Covariance xy is summation x minus x bar y minus y bar upon n. How to calculate sigma x? Can I say sigma x is summation x minus x bar the whole square upon n the whole under root. And how to calculate sigma y? Summation y minus y bar the whole square upon n the whole under root. So we'll have to first of all figure out these terms, and then we can go ahead for correlation coefficient. So first of all, covariance. Now covariance, do you realize, summation of x minus x bar into y minus y bar. So I'll make a column here, x minus x bar, name it as 1, y minus y bar, name it as 2, and then 1 into 2. You're understanding? For x minus x bar into y minus y bar. So let us start. So now this is 12. Okay, 12 minus 14.8. Can I say is negative 2.8? 8 minus 14.8 is negative 6.8. Then we have got 7 minus 14.8 is negative 7.8. 14 minus 14.8 is negative 0.8. 16 minus 14.8 is 1.2. 15 minus 14.8 is 0.2. 18 minus 14.8 is 3.2. 20 minus 14.2 is 5.2, 16 minus 14.8 is 1.2, 22 minus 14.8 is 7.2. Correct? Let's now go to y minus y bar. So 20 minus 21 minus 1, 22 minus 21 plus 1, 24 minus 21 plus 3, 18 minus 21 minus 3, 15 minus 21 negative 6, 20 minus 21 1, 24 minus 21 3, 25 minus 21 will be 4, 22 minus 21 is 1 and 20 minus 21 is negative 1. Okay, now we will do 1 into 2. So students, this will be 2.8 into 1 and I'll do m plus because minus minus will be plus, right? Then 6.8 into 1 m minus, correct? Then 7.8 into 3 m minus, then 0.8 into 3 m plus, then 1.2 into 6 m minus, then 0.2 into 1 m plus, 3.2 into 3 m plus, 5.2 into 4 m plus, 1.2 into 1 m plus, and 7.2 into 1 m minus. MRC, it comes to negative 7.6. Now negative 7.6, do you realize I will write here negative 7.6 and divided by 10 if we do, you will get negative 0.76 as the covariance between x and y. Now let's go for sigma x. How to calculate sigma x? Now students, sigma x, for that do you realize we will have to do 1 square. 1 square means x minus x bar the whole square, okay? So this is 2.8 into equal to m plus. This is 6.8 into equal to m plus. Then 7.8 into equal to m plus. 0.8 into equal to m plus. 1.2 into equal to m plus. 0.2 into equal to m plus. 3.2 into equal to m plus, 5.2 into equal to m plus, 1.2 into equal to m plus, 7.2 into equal to m plus, MRC, and this comes to 207.6. So can I say the sigma x will be 207.6 divided by 10, the whole under root. So if I divide by 10 and I press the root, this comes to 4.56. Okay, sigma x is 4.56. Now let's go to sigma y. Now as far as sigma y is concerned, I will need a column 2 square, it is y minus y bar the whole square. So this is 1 into equal to m plus, again 1 into equal to m plus, then 3 into equal to m plus, 3 into equal to m plus, 6 into equal to m plus, 1 into equal to m plus, 3 into equal to m plus, 4 into equal to m plus, 1 into equal to m plus, 1 into equal to m plus, MRC, and this comes to 84, and this will be under root 84 by 10. So if I divide this by 10 and press the root, this comes to 2.90. Students, now that we have all these numbers, let us calculate correlation coefficient. This is negative 0.76 divided by 4.56 into 2.9. So on the calci, 0.76 divided by 4.56 divided by 2.9, and students, this will come to 0.06 as the correlation coefficient. Yes students, so with that we get the answer, correlation coefficient we are done. So this is how we calculate correlation using historical past data. Like that students, you can calculate using probable future data also. In probable future data, I'll just simply tell you that, okay, I'll give you an example. Let's say there is P 0.2, 0.5, 0.3. Okay, X is let's say 10, 15, 19. Y is let's say 20, 25, and let's say 29. Okay, these are X and Y. Now if I want to calculate correlation coefficient and covariance for that, and of course sigma, etc. Everything we need. We'll first of all have to calculate x bar and y bar. For x bar and y bar, I hope you realize we'll have to do px and py. Okay, not simple average, but we'll have to do weighted average, right? So this is 10 into 0.2 m plus, 15 into 0.5 m plus, 19 into 0.3 m plus MRC. This will come to 15.2 as the x bar, and then this is 20 into 0.2 m plus, 25 into 0.5 m plus, 29 into 0.3 m plus MRC. Y bar comes to 25.2. Now students, we need correlation coefficient. Correlation coefficient is what? Covariance xy upon sigma x into sigma y. Everybody knows this. Now covariance xy formula slightly changes. It is summation p x minus x bar y minus y bar. Okay, not divided by n. Now we are not doing simple average, we are doing weighted average here. Then sigma x formula will also change. Summation p x minus x bar the whole square the whole under root, and sigma y formula will also change. Summation p y minus y bar the whole square under root. So let's now go for covariance first. X minus x bar 1, y minus y bar 2, and then we will do 1 into 2, but then we'll multiply by p also. P into 1 into 2. That is how the column is made. Okay, p into 1 into 2. So first of all, x minus x bar. So 10 minus 15.2, negative 5.2. 15 minus 15.2, negative 0.2. 19 minus 15.2, 3.8. Correct? 3.8. Next students, y minus y bar. 20 minus 25.2. This is again negative 5.2. 25 minus 25.2. This is negative 0.2. 29 minus 25.2, and this is also 3.8. So students, here if you see the calculations which have happened, yeah, because there was very similar kind of data on x and y, that is why x minus x bar, y minus y bar is looking same, but it is a coincidence. Okay, I hope you are not going to think that all questions like this only it will be there. Here 5.2 means here also 5.2, nothing like that. Okay, so now we will do p into 1 into 2. Okay, so let's do it. 0.2 into 5.2 into 5.2 m plus minus minus plus. Okay, 0.5 into 0.2 into 0.2 again m plus, and 0.3 into 3.8 into 3.8, and that is again m plus. Correct? And students, if I do MRC here, it comes to 9.76. So 9.76 is your covariance. Now let us calculate sigma. Students, sigma, for that can I say we will require x minus x bar the whole square into p. So that is p into 1 square. Okay, p into 1 square. So 5.2 into equal to into 0.2 m plus, 0.2 into equal to into 0.5 m plus, and 3.8 into equal to into 0.3 m plus, and we do MRC, we get 9.76, and I hope you realize we'll do 9.76 root, we will get 3.12 as the sigma x. And I'm pretty sure because of the data here, when I do p into y minus y bar the whole square, same data is there like x, and this also will come to 9.76 only. So this is under root 9.76, this is also 3.12. So when I calculate correlation coefficient, this will be 9.76 divided by 3.12 into 3.12. 3.12 into 3.12 is 9.76. Here the correlation coefficient came to +1. Great, no problem. Everyone clear? At least you understood what table to make when the data is probable future. Okay, so with that we complete the discussion to risk and return of a 2 security portfolio. Okay, risk and return of a 2 security portfolio, and in that I taught you correlation coefficient calculation also. One thing that I need you to understand is, in the previous part I taught you the formula of sigma p, right? Sigma p formula, you remember, it was wx square sigma x square plus wy square sigma y square plus 2wx wy sigma x sigma y r xy the whole under root. This is what is the formula I taught you. Now I also taught you r xy is covariance xy upon sigma x into sigma y, correct? Now this formula I can write like this, right? R xy into sigma x into sigma y is equal to covariance xy, correct? R xy into sigma x into sigma y is covariance xy. Can you see this part here is nothing but r xy into sigma x into sigma y. So students, instead of writing this, the formula can also be written like this. Everybody clear? Instead of r xy into sigma x into sigma y, you can write directly covariance xy also. So sometimes ICI uses this formula. Please note it is the same formula that uses r xy, correct? Same thing it is. Done. So with that we complete the discussion to risk and return of a 2 security portfolio. Now students, we will move on to, I'll come to minimum variance portfolio in a minute. I'll quickly complete risk and return of a 3 security portfolio. So 3 security portfolio means students, return of a portfolio will now include X, Y as well as Z. So it will be like this: WX RX plus WY RY plus WZ RZ is the return of the portfolio. RP is return of the portfolio is this. Risk of a portfolio, students, will be slightly complicated. It is now A plus B plus C the whole square, the whole under root. See, I'll tell you what it means. It is WX square sigma X square plus WY square sigma Y square plus WZ square sigma Z square. This is like A square plus B square plus C square plus 2AB. 2WX WY sigma X sigma Y R XY plus 2BC. 2WY WZ sigma Y sigma Z R YZ plus 2AC. 2WX WZ sigma X sigma Z R XZ the whole under root. So these are the formulas for RP and sigma P for a 3 security portfolio. It mostly doesn't come in the exam, but if you just study the formula, it is very simple. It is like A square plus B square plus C square plus 2AB plus 2BC Y and Z plus 2AC X and Z, right? So that's as far as risk and return of a 3 security portfolio is concerned. Now students, we will go to minimum variance portfolio. Okay students, so now for minimum variance portfolio, what exactly is minimum variance portfolio? Here we have to learn what should be the weights of X and Y so that the overall risk of the portfolio is lowest, okay? Because the risk of the portfolio also depends on weights. So what should be the weights so that overall risk is lowest? Minimum variance. So for that there are 2 formulas you need to know, okay? So if the correlation coefficient between X and Y, the 2 securities which are coming in the portfolio, is -1, then the weight of X should be sigma Y upon sigma X plus sigma Y. Of course, weight of Y should be 1 minus WX, correct? And if RXY is not equal to -1, okay, if RXY not equal to -1, then the weight of X should be sigma Y square minus covariance XY the whole upon sigma X square plus sigma Y square minus 2 covariance XY, and WY should be 1 minus WX. Everybody clear? So one thing you should note, that if WX you are finding, the numerator will be sigma Y. If WX you are finding, numerator will be sigma Y. So just remember, because tomorrow there could be M and N or A and B. So be very careful with which sigmas you are taking for which weights, okay? So what is, again let me tell you what is special about these 2 formulas. Basically we are trying to say that if RXY is -1, then one should invest in X and Y in these weights. By this, the overall risk of the portfolio will be lowest. If RXY not equal to -1, then we should be investing in these weights. Everyone clear? So that is as far as minimum variance portfolio is concerned. Now students, we will go on to a concept called as Markowitz efficiency frontier. It is also called as the theory of dominance. It is very simple. Let me explain it to you. Okay, so now Markowitz efficiency frontier. What is this? Students, Markowitz efficiency frontier is a theory basically which is trying to tell you that between two investments or two securities or two portfolios, let's say there are two investments X and Y, X will dominate Y. Okay, X will dominate Y, or basically X will be considered efficient, Y will be considered inefficient in the following three cases. Case number one, if X is going to give higher return than Y at same risk. Okay, if X will give higher return than Y at same risk as Y, then can I say X dominates Y. Case 2, if X will give same return as Y but with lower risk, then also X will dominate Y. And case 3, if X will give higher return than Y but lower risk than Y also, then also can I say X will dominate Y. So X will dominate Y in three cases. Case number 1, if it gives higher return at same risk, or it gives same return at lower risk, or it gives higher return at lower risk. If X gives higher return but at higher risk, then none of the two will dominate each other, both will be considered efficient. Okay, that is Markowitz efficiency frontier. Capital allocation line, students, in capital allocation line, basically here we will be creating a portfolio of a share and a risk-free asset, that is a bond. Now till now can I say we were creating portfolios of X and Y, two shares, but now a share and a bond, a risk-free asset. Then very simple, students, the return of such a portfolio will be weight of the risk-free asset into return of risk-free asset plus weight of X into return of X. Everybody clear? And of course normal calculation, that is RP calculation, weighted average calculation. Okay, and as far as sigma P is concerned, very simple, weight of X into sigma of X, that's it. Because students, do you realize that the risk-free asset does not have risk, correct? So Wx into sigma X, that's it. So that is as far as capital allocation line is concerned. Capital market line, students, capital market line is a formula of calculating KE, where KE is equal to IRF plus RM minus IRF into sigma X upon sigma M. Okay, so basically here we are saying that okay, we are calculating the required rate of return from a share. Let's say the name of the share is X. So the KE of X will be IRF plus RM minus IRF into sigma of X upon sigma of M, right? And then we have capital asset pricing model, which says KE of X should be equal to IRF plus RM minus IRF into beta of X upon beta of M. And since beta of the market is always 1, right, we basically just write beta here, right? So what is beta? Beta is an indicator of the degree of reaction of a security's change to a change in market. Okay, so if market changes by 10% and as a reaction the security reacts by 20%, we say that the beta of X is 2 times, right? Beta is basically an indicator of risk. So these are the two formulas of calculating KE, one as per capital market line, one as per CAPM. Then students, as far as beta is concerned, there are 3 formulas to calculate beta. So I'll just write here 3 formulas to calculate beta. The first formula is beta is equal to change in X upon change in market, change in the percentage return of share X upon change in percentage return of market. But students, avoid this formula. In fact, I will say use only if RXM is plus 1. Okay, that means if the correlation coefficient between X and M is plus 1, only then use this formula. Otherwise, students, the most important formula is beta is equal to covariance XM upon sigma M square. Okay, covariance XM upon sigma M square. There is one more formula. The second formula, if you open up now, you get the third formula, that is RXM, correlation coefficient, into sigma X upon sigma M. Okay, RXM into sigma X upon sigma M. So this is basically the formula for calculating beta, the 3 formulas. This is the most important one. So let us do one example for this. So what I will do is I'll write here 1, 2, 3 X and M, 10, 20, 30, 10, 30, 50. Can you see as market is changing by 10, the security is reacting by 20. Okay, as market is changing by 10, security is reacting by 20, which means obviously the beta here is 2 times, but we will solve that using the formula given. So beta's formula is what? Beta is equal to covariance xm upon sigma m square, correct? Covariance xm, how will you find? Summation x minus x bar into m minus m bar upon n, and sigma m square, how will you find? Summation m minus m bar the whole square by n. The under root will not do because we need sigma m square here. Okay, so let's see what all columns will require, but before that we'll just write down the x bar. X bar is 30 and m bar is 20. Now for a covariance, can I say we'll require x minus x bar, that is 1, m minus m bar, that is 2, and then 1 into 2. So 10 minus 30 minus 20 dash, this is 20, 10 minus 20 minus 10 dash 10, this is 200 dash 200, and this will come to 400. So can I say covariance xm is 400 divided by 3. As far as sigma m square is concerned, we will have to do column 2 square, m minus m bar the whole square, that is 100 dash 100 and of course 200. So sigma m square will be 200 divided by 3. So can I say the beta will be 400 divided by 3 covariance, 200 divided by 3 sigma m square, the beta is 2 times. This is how you calculate the beta. 3 formulas, but the second one is the most important. CAPM formula to calculate KE, I just now showed it to you. KE is equal to IRF plus RM minus IRF into beta. That's it. Okay. Next, students, we come to CAPM and Gordon. Again, very simple. I'll tell you there are only 2 steps to be followed here. First, they will give you data to calculate KE as per CAPM. Okay, they will give you IRF, they will give you RM, they will give you beta. Okay, so you find KE using CAPM, and once you have KE, then you go back to equity valuation Gordon's formula and find the value of the equity using Gordon's formula, where the KE that you use is calculated using the CAPM calculation. You just did nothing great here, very simple. First calculate KE using CAPM, then take that KE, put it in Gordon's formula and find the value of equity. One thing about CAPM I would want to tell you, please note this is market return, correct? But RM minus IRF, this is market risk premium. So if the question tells you market return, it is RM. But if the question tells you market risk premium, then it is not RM, it is RM minus IRF. And RM minus IRF into beta, the whole thing is called as normal risk premium. You're understanding? So normal risk premium is RM minus IRF into beta. Market risk premium is RM minus IRF. Market return is RM. Okay, so these points you should know. Otherwise nothing great in CAPM and Gordon. Moving on, security market line. Again, very simple. Students, do you realize that X bar, okay, X bar is the expected return from the share. What the share is expected to give you is X bar. Can I say, students, CAPM KE is your minimum required rate of return from the share, correct? Minimum required rate of return from the share. So what is this model saying? It is saying that if X bar is greater than CAPM KE, okay, if X bar is greater than CAPM KE, one should accept the share. Very simple, because if X bar is what you are expecting the share to give you, CAPM KE is what you are wanting, minimum required rate of return. Can I say if X bar is greater than CAPM KE, then of course one should accept the share. That is what this particular theory is all about, security market line. Okay, next, students, we have excess return to risk ratio. We'll keep it on a pause. We'll come to it in some time. Next, we have Jensen's alpha. Now, Jensen's alpha and security market line are quite simple. I'll tell you what is Jensen's alpha. Jensen's alpha is saying the formula is X bar minus CAPM KE. Now, X bar minus CAPM KE, Jensen's alpha says that if Jensen's alpha is positive, one should accept the share. Now, I hope you realize this is stupidity in one sense, because do you realize that when will Jensen's alpha be positive? It will be positive only when X bar is greater than CAPM KE, same as security market line. Same thing. Security market line is saying if X bar is greater than CAPM KE, accept the share. Jensen's alpha is saying if X bar minus CAPM KE is positive, accept the share. It is the same thing. Okay. Moving on, students, portfolio beta. Now, do you realize that, see, let's say you have a portfolio of X and Y. Do you realize X will have its own beta, Y will have its own beta. Do you realize now we need to calculate the beta of the portfolio? Now let's say beta of X is 2. Let's say beta of Y is 3. What does that mean? That means X reacts 2 times to a change in market. Y reacts 3 times to a change in market. The question is, how much is your portfolio going to react to a change in market? That is portfolio beta. Simple, calculate the weighted average of these two betas. So can I say beta of the portfolio will be weight of X into beta of X plus weight of Y into beta of Y. Weights will be known to you from the question, betas will be calculated. Just put it in this particular equation and get the beta of the portfolio. That is portfolio beta. Now students, we come to a concept called as characteristic market line. Now students, this particular area is very deep. Lot of explanations are there in this. So this particular area, characteristic market line, I will just simply tell you in this revision as to what is to be done, okay, how it is to be calculated in the exam. That's it, and we'll go ahead without going into the logic part of it, because the logic can take another 3-4 hours for me to explain. But since it's a revision or last minute revision, I'll just tell you what is to be done from characteristic market line point of view. So students, what happens is, X is equal to beta m plus alpha. Now this is an equation of a line called as characteristic market line. X and m are the returns of share and market. Beta you know, and alpha you calculate as a balancing figure here. So I will tell you, I am going to right now put these two in some different ink only to make you realize that beta and alpha here in this linear equation, okay, are constants, and X and M are variables, which means the line that we eventually, or the equation that our final goal is, we want to calculate is X is equal to, okay, something like 2m plus phi. We have to get it till here and stop. Okay, that is the answer of characteristic market line. X equal to 2m plus phi. Now how to get till here, that I will explain to you through a question. We will take up a question, from that I will explain to you. So students, let me now take you to question number 70 in my notes. Okay, let us take this question and let's try understanding it. Okay, so they are saying the rates of return on the security of company X and market for 10 periods are given below. So they have given to you all of this. This is security X, this is the market. They are asking you what is the beta of security X. So what we will do is, before going to the characteristic line equation, we'll first of all calculate beta and keep, and then I will tell you what to do next. So for beta, let us start. So I'll just write here, okay, first point, calculation of beta. Now you tell me what is the formula of beta. Can I say beta is equal to covariance xm upon sigma m square? For that you will require covariance xm, which will be summation x minus x bar m minus m bar upon n, correct? And you will also require sigma m square, which will be summation m minus m bar the whole square upon n, correct? Now what columns will we need to make here? X, m, x minus x bar 1, m minus m bar 2, and then we will do 1 into 2 for covariance, and we'll do 2 square for sigma m square. Okay, now let's see how many years are there. There are 10 years. Okay, so let's do it. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So now we will take the numbers. So X is 20, 22, 25. So I'll write here 20, 22, 25. Next is 21, 18 minus 5. So 21, 18 minus 5. Next is 17, 19 minus 7. 17, 19 minus 7. And last is 20. Okay, as far as M is concerned, 22, 20, 18. So 22, 20, 18. 16, 28. So 16, 28 minus 6, 5, 6, minus 6, 5, 6 and 11. Okay. So now that the numbers you have, we will now first of all calculate x bar and m bar. Okay. So let me take the calculator. 20 plus 22 plus 25 plus 21 plus 18 minus 5 plus 17 plus 19 minus 7 plus 20 divided by 10, x bar comes to 15. As far as m bar is concerned, 22 plus 20 plus 18 plus 16 plus 20 plus 8 minus 6 plus 5 plus 6 plus 11 divided by 10. This is 12. So 15%, 12% we got. Now students, for beta we need covariance, right? So we'll now do x minus x bar. So this is 5. Okay, this is 7, this is 10, this is 6, this is 3, this is minus 20, this is 2, this is 4, this is minus 12 and 5. Okay, and now we will be having, this one is not minus 12, this one will be minus 22. Okay, and 5. Done. And now m minus m bar, this will be 10, 8, 6, 4, 8, minus 4, okay, and then minus 18, minus 7, minus 6 and minus 1. Now let's do 1 into 2. So 5 into 10 m plus, 7 into 8 m plus, 10 into 6 m plus, 6 into 4 m plus, 3 into 8 m plus, 20 into 4 m minus, 2 into 18 m minus, 4 into 7 m minus, 22 into 6 m plus, 5 into 1 m minus. So when I press MRC, I get 357. Now let us do m minus m bar the whole square, but before that we'll just calculate covariance. So this will be 357 divided by 10, that is 35.7. Now for sigma m square, m minus m bar the whole square. So this is 10 into equal to m plus, 8 into equal to m plus, 6 into equal to m plus, 4 into equal to m plus, 8 into equal to m plus, 4 into equal to m plus, 18 into equal to m plus, 7 into equal to m plus, 6 into equal to m plus, 1 into equal to m plus, and you do MRC, you get 706. Okay, 706. So this will be 706 by 10. Your beta will be basically 357 by 10 upon 706 by 10. Basically 357 divided by 706, you get 0.51 times as the beta. Now that you have the beta, now let's see what next they're asking. What is the characteristic line? So for the characteristic line, basically, do you realize that we need to create somehow this equation? Now for this equation, can I say right now we already have the beta, right? Beta is already ready. The only thing we need to find is alpha. Our job is done. Okay. So I'll write here point number 2, characteristic line equation. Okay. Now in that, the first step that you need to do is calculate beta. Beta is already done, 0.51 times beta is ready. Now students, the second step that you have to do is to calculate alpha. You have to first of all write the equation. X is equal to beta m plus alpha. X is equal to 0.5 m plus alpha, or I might say 0.51 m plus alpha. And then you should substitute x and m with x bar and m bar and find alpha as the balancing figure. That's it. Nothing great. So for example here, x bar is how much? 15, m bar is 12. So 15 is equal to 0.51 into 12 plus alpha. If you solve this, you'll get alpha. So this is 0.51 into 12 and then minus 15. If I do, I will of course get alpha as 8.88. Correct? We'll do it again. 15 m plus, then 0.51 into 12 m minus MRC. Yes, alpha is 8.88. And then your step 3 is to just write the equation as x is equal to 0.51 m plus 8.88. This is your final answer. Everyone clear? This is how you're supposed to express it. So that is basically the explanation to characteristic market line. Okay, where did it go? Characteristic market line. So characteristic market line, this that you calculated, tell me what are the 3 steps. Step 1 is finding beta. How to find beta? Normal covariance xm upon sigma m square calculation you do. Step 2 is to calculate alpha. How to calculate alpha? Put that equation x equal to beta m plus alpha. beta you have. Instead of x and m, you put x bar, m bar. Find alpha as balancing figure. And then step 3, create the equation. X is equal to beta m plus alpha, where you just put beta and alpha and keep. Everyone ready? So with that we complete this point of characteristic market line. Now students, we will go on to the calculation of systematic risk and unsystematic risk. I'll just again tell you what is to be done. Please understand that total risk is equal to systematic risk plus unsystematic risk. Okay, total risk is equal to systematic risk plus unsystematic risk. Systematic risk is basically the risk caused to a share due to market influence, market factors, market movements, and unsystematic risk is the risk caused in the share due to company's own performance. Now total risk of a share is denoted as the variance of the share, that is sigma x square. Systematic risk is calculated as beta square, or I might say beta x square, because beta of the security x square into the variance of market, and unsystematic risk is calculated as sigma ex square. So students, here what they will ask you calculate total risk and bifurcate it between systematic risk and unsystematic risk. For total risk, calculate sigma x square. For systematic risk, do beta x square into sigma m square, and for unsystematic risk, find it as a balancing figure. Simple. That's how you're supposed to do this systematic and unsystematic risk. So let us see if we have a question. That same question 70, there was a last point there. We'll take it up now. Question number 70. Yeah. So they are asking calculate total risk and bifurcate it into systematic and unsystematic risk. So let us do it now. For total risk, do you realize we need sigma x square? Sigma x square is summation x minus x bar the whole square divided by n. Now do you realize the same question I'm continuing? For sigma x square, I need summation of x minus x bar the whole square. So basically I need summation of 1 square, x minus x bar the whole square. So let us do it students. 5 into equal to m plus, 7 into equal to m plus, 10 into equal to m plus, 6 into equal to m plus, 3 into equal to m plus, 20 into equal to m plus, 2 into equal to m plus, 4 into equal to m plus, 22 into equal to m plus, 5 into equal to m plus, and we do MRC, we get 1148, and therefore can I say the total risk is 1148 divided by 10, that is 114.8, that is sigma x square. Now how do I bifurcate it? Systematic risk, unsystematic risk. Systematic risk is calculated as beta x square into sigma m square. Can I say beta we already have 0.51 square, and sigma m square, do you realize, is 706 divided by 10, right? Sigma m square, that is 70.6. So I'll write here 70.6. So on the calculator, 0.51 square into 70.6, if we do, this comes to 18.36, and then unsystematic risk, which is denoted as sigma ex square, is found as a balancing figure 114.8 minus 18.36, 96.44% is unsystematic risk. That's it. Okay, one more thing you should know, that there is one more formula to calculate systematic risk. Just take it in case you require, use it, otherwise go for this only. That is Rxm square, correlation coefficient, into sigma x square. Okay, Rxm square into sigma x square. Students, this formula will also give you exactly same answer as this only. Okay, so this is as far as the systematic and unsystematic risk calculations are concerned. So in this, tell me what kind of question will come. They will ask you to, okay, in this they will ask you to calculate total risk of the share and bifurcate it between systematic and unsystematic. For total risk of the share, what to do? Take sigma x square, that's it. Okay, take sigma x square, and then to bifurcate into systematic and unsystematic, calculate the systematic risk as beta x square into sigma m square, or r square into sigma x square, and then unsystematic risk, students, will be a balancing figure, that is sigma ex square. That is as far as SR and USR is concerned. Then students, portfolio risk using William Sharp. Now the original portfolio risk formula that we know, sigma p is equal to wx square sigma x square plus wy square sigma y square plus 2 wx wy sigma x sigma y rxy the whole under root. This formula you know. But if they ask you to calculate the portfolio risk as per William Sharpe, then students the formula slightly changes. Sigma p is equal to wx beta x plus wy beta y plus dot 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 wn beta n. How many ever securities are there? The whole raised to 2 into sigma m square plus wx square sigma ex square unsystematic risk plus wy square sigma ey square plus dot 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 wn square sigma en square. So basically wx beta x weight of x into beta of x plus weight of y into beta of y, like that, the whole raised to 2 into sigma m square plus weight wx square into sigma ex square means weight square into unsystematic risk sigma ex square, as you know this point. Correct? You just put the numbers there and get the portfolio risk as per William Sharpe. This is the formula of sigma p as per William Sharpe. Then students, Sharpe's optimum portfolio model. Now this particular point, for this we need to go through question 77. It's a slightly terrible kind of calculation, lot of mathematics are there. So what I will do is, I will right now pull out my video explaining this question. I want you to watch that video right now. Understand Sharpe's optimum portfolio, because right now there is no point in going to logic etc. Just see the steps of what is to be done and we go ahead. Okay, so that is Sharpe's optimum portfolio model. Students, before I show you the video, the last concept in this particular chapter, or I might say not last but second last, is arbitrage pricing theory, where they say Ke is equal to lambda 0 plus beta 1 lambda 1 plus beta 2 lambda 2 plus dot 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 beta n lambda n. So where lambda 0 is like IRF. Now in normal William Sharpe, that is CAPM model, there was only one beta, but here there will be multiple betas. So the moment you see multiple betas for the same company, know it is APT or multi-factor model, that is arbitrage pricing theory. So, and this lambdas are basically the risk premiums. So everything will be given to you, just put numbers in this and get the answer. Lambda 1, lambda 2, everything will be given to you. They might call it as risk premium. So take that risk premium, lambda 1, lambda 2, lambda 3, etc. and complete the question. So for example, I'll just give you one. Let me see which question we can take. Here we can take question number, maybe, yeah, we can take 81. Now in 81, what happens is actual value minus expected value is the premium, which we call as lambda. Okay, and then betas are given. So students, once you have each of these lambdas and risk-free interest rate, that is lambda 0. So can I say the KE of this particular company as per APT will be lambda 0 plus beta into lambda plus beta 2 into lambda 2 plus beta 3 into lambda 3 plus beta 4 into lambda 4 plus beta 5 into lambda 5. That is how you calculate KE as per APT. Okay. Next students, in this segment of portfolio management, I would now like to simply tell you that everything, main points are all clear. There is just one portfolio ranking which I need to check with you. Portfolio ranking means basically there are three ranking tools. Okay, first tool is the Sharpe's index. Okay, now what is Sharpe's index? It is Rx minus IRF, okay, Rx minus risk-free return upon sigma x. So what to do? They will give you, let's say, A, B, C, D, E, F, 4, 5, 6 portfolios they will give, for example. What you should do? You should calculate the Sharpe's index for each one of them. Return minus risk-free return. Return means return of the portfolio minus risk-free return upon the sigma of the portfolio or sigma of the share. Calculate Sharpe's index for each one of them, and then highest to lowest you should rank them. That is Sharpe's index. They can ask you to rank based on trainer's index also, and trainer's index formula is Rx minus IRF upon beta. Correct? So instead of sigma, take beta, recalculate trainer's index, recalculate the weight, the ranks, and then ranking basically based on trainer's index will slightly differ from that of Sharpe's index, because both are using different denominators for the risk. One is using sigma, one is using beta. And then the third indicator or the third ranking tool is Jensen's alpha, that is Rx minus CAPMK, which we have already discussed. Calculate Jensen's alpha for all of the portfolios and rank highest to lowest. Also, this trainer's index is also called as excess return to risk ratio, which I had shown you some time back. I told you we'll talk about it later. This is nothing but excess return to risk ratio. Can you see Rx minus IRF is what the share or the portfolio is giving you over and above IRF, excess return to risk. Beta is an indicator of risk. So trainer's index is also called as excess return to risk ratio. So these are the portfolio ranking tools. So students, here I would just like to tell you that now I want you to see the video of Sharpe's optimum portfolio model. Before you go ahead, yes, there are these two concepts of exponential moving averages and efficient market hypothesis. For this, I would like to tell you that I have already shot videos and put it on YouTube of JK Shah classes YouTube channel itself. Students, there is a chapter called as security analysis, not portfolio management, security analysis. In that, students, there is one concept called as exponential moving averages. Then we have got efficient market hypothesis, that is the runs test, and we have again got efficient market hypothesis auto correlation test. So students, what you should do is, if you want to go through all this also, just go to YouTube and search. There are 3 different videos for each one of them, okay, basically one for each. So just search exponential moving averages JK Shah classes, okay, you will find my video. Go through this for this particular concept. Efficient market hypothesis JK Shah classes, you will find it. Auto correlation test JK Shah classes, you will find it. These 3 videos are there on YouTube already. You can watch it at maybe a 1.5x speed and do the revision of these 3 concepts. Very important. If it comes in exam, then you will be lucky that you know exactly how to solve. Many people don't know how to solve this, okay. Now as far as the last concept is concerned, Sharpe's optimum portfolio model, this particular question, very old question of ICI, it is still there in the module, a typical way of solving it. So I'll give you that video now, just watch it, and with that we are done with portfolio management, and then we'll start a new chapter, that is mutual funds. So first of all, complete this. Thank you. So now let's do one question on this Sharpe's optimum portfolio model. In the last video, I showed you the steps. I hope you have copied the steps in your notebook. Now we will apply those steps in this particular question, that is question 77. Students, question 77, I have picked up from the old practice manual. It had come in the May 2010 paper for 10 marks, okay. So let's start. Question 77. Ramesh wants to invest in stock market. He has got the following information about individual securities. So there are these securities A, B, C, D, E and F. These are the returns expected, these are the betas, and these are the unsystematic risks, that is sigma EX square, okay, in the variance form. The market index variance is 10%. Students, what is this? This is sigma M square. And the risk-free rate of return is 7%. What is this? This is IRF. What should be the optimum portfolio assuming no short sales? Can we start? So students, what was step 1? Step 1, if you have the notes with you, was to calculate excess return to risk ratio for each of these securities and then to rank the portfolios based on ERR. So what I propose is, let us do steps 1 and 2, that is calculation of ERR and ranking them in one table only, and then the remaining steps we will proceed afterwards, okay. So let's start. I'll give heading steps 1 and 2. Calculation of ERR and ranking the projects, okay. Now if you remember the ERR formula, if you remember, was Rx minus IRF divided by beta, yes. So now let's see what all columns we can make. First column obviously will be the security column. Next column I will make is calculation of ERR. Okay, calculation of ERR. With the calculation of ERR, we will then be able to get the ERR, and after we get the ERR, we can rank them. Okay, so students, securities A, B, C, D, E and F. Okay, A, B, C, D and F. So let's start, students, for security A. So Rx minus IRF divided by beta, that is 15 minus 7 divided by 1.5. Are you understanding? Return of A is 15, IRF is 7, beta of A is 1.5. So the ERR for A will be 15 minus 7 divided by 1.5. So I'll write down here 15 minus 7 divided by 1.5. Let's go for security B. 12 minus 7 divided by 2. So let's write down 12 minus 7 divided by 2. Then for security C, 10 minus 7 divided by 2.5. So it is 10 minus 7 divided by 2.5. For security D, it will be 9 minus 7 divided by 1. 9 minus 7 divided by 1, I'll write down here 9 minus 7 divided by 1. Then we go for security E. Student, security E will be 8 minus 7 divided by 1.2. Okay, 8 minus 7 divided by 1.2. So I'll write down here 8 minus 7 divided by 1.2. And the last one, students, security F will be 14 minus 7 divided by 1.5. Okay, 14 minus 7 divided by 1.5. So I'll write down here 14 minus 7 divided by 1.5. So with this, all the numbers we have put, now we can easily take the calculators and calculate the ERR. Okay, so let's start, students. 15 minus 7 divided by 1.5 will give us ERR as 5.33:1. Next is 12 minus 7 divided by 2 will give us 2.5:1. Next one, students, 10 minus 7 divided by 2.5 will give us 1.2:1. Next one is, of course, 9 minus 7 divided by 1 is 2:1. The next one, students, is 8 minus 7 divided by 1.2. That will give us 0.83:1. And the last one is 14 minus 7 divided by 1.5. That will give us 4.67:1. Students, now if I rank the securities, let's see who is rank 1. Yes, portfolio A is rank 1, portfolio F is rank 2, portfolio B will be rank 3, portfolio D will be rank 4, portfolio C will be rank 5, and portfolio E will be rank 6. Correct? 1, 3, 5, 4, 6, 2. I hope you all got these numbers correctly. Okay, so steps 1 and 2 of ERR and ranking is now done. And now we will have to rearrange these securities based on these ranks from top to bottom. Okay, so let us rearrange them, students. So I'll write down here security. Who was rank 1, students? Rank 1 was A. Rank 2 was F. So I'll write down here A, then F, then who is 3 and 4? B and D. Okay, so let us write down B and D. And who was 5 and 6? C and E. Okay, so I'll write down here C and E. Done? Now, students, let's proceed ahead with the next and further steps. Students, now we will have to first of all calculate the cutoff points. Students, what formula I gave you for the calculating the cutoff points? I said C is equal to sigma m square into cumulative A, okay, into cumulative A divided by 1 plus sigma m square into cumulative B, correct? Where if you check your notes, A is equal to Rx minus IRF into beta divided by sigma Ex square, and B is equal to beta x square divided by sigma Ex square. Okay, so now let's start putting these numbers. First of all, let's knock off A and then cumulate the A. So I'll write down here, okay, the first thing I'll write down here is Rx minus IRF into beta divided by sigma Ex square, and this, students, is your A, correct? And therefore my next column will be cumulative A. I hope you are following the maths here. Let's now put numbers for security A. Rx minus IRF, students, Rx minus IRF here, okay, will be 15 minus 7 into beta, that is 1.5. So 15 minus 7 into 1.5, I'll write down here 15 minus 7 into 1.5, and students, sigma Ex square is 40, so I'll divide it by 40. Don't square the 40, correct? Because that unsystematic risk sigma Ex is already in squared form. It is already in variance form. Okay, that's it. So 40. The next one for security F. A is done. Now look at security F. Do you realize it will be 14 minus 7 into 1.5? I'll write down here 14 minus 7 into 1.5. Yes, the whole divided by 30. The whole divided by 30. The next, students, is B. For B, it will be 12 minus 7 into 2. Okay, I'll write down here 12 minus 7 into 2, the whole divided by 20, correct? The whole divided by 20. Next is portfolio security D. Okay, next is security D. It will be 9 minus 7 into 1. Okay, I'll write down here 9 minus 7 into 1 divided by, if you see, the sigma Ex square here is 10. So let me put 10 here. Next comes security C. Students, security C is 10 minus 7 into 2.5. So we'll write down here 10 minus 7 into 2.5, the whole divided by, what is the unsystematic risk of security C? 30. So we will divide it by 30. Yes, and now the last one, students, is security E. That is nothing but 8 minus 7 into 1.2. 8 minus 7 into 1.2 divided by, tell me what is the sigma Ex square here? That is 20. So I'll divide it by 20. With this we have put all numbers here. Okay, so students, let's start. Let's take the calci. 15 minus 7 into 1.5 divided by 40 will give me 0.3. Yes. Next will be 14 minus 7 into 1.5 divided by 30 will give me 0.35. Next, students, is 12 minus 7 into 2 divided by 20 will give me 0.5. Okay, will give me 0.5. Next is 9 minus 7 into 1 divided by 10 will give me 0.2. The next, students, is 10 minus 7 into 2.5 divided by 30 will give me 0.25. The next, students, last one, 8 minus 7 into 1.2 divided by 20 will give me 0.06. So with this we have got Rx minus IRF into beta divided by sigma Ex square, which I am naming as A, and let's now start accumulating the same. Okay, students, so of course if I accumulate, this is 0.3, then let's take 0.3 plus 0.35, correct, accumulating. So if I do that, I will get 0.65 plus 0.5, I will get 1.15 plus 0.2, I will get 1.35 plus 0.25, okay, we will get 1.6, and plus 0.06 will give me 1.66. Yes, so 1.66 we have got. Now we have accumulated A. Now students, let's attack the B. Students, what is the formula of B? It is beta x square upon sigma Ex square. That is the B calculation. So I'll be able to now get B, and then I will cumulate B. Okay, once I get B, we will cumulate the B. Yes. Let's start, students, for security A now. Security A, do you understand the beta square by sigma EX square will be 1.5 square by 40, correct? So I'll write down here 1.5 square by 40. Now for security F, students, for security F, it will be 1.5 square by 30. So I'll write down here 1.5 square by 30. Next, students, for security B now, it will be 2 square by 20. So I'll write down here 2 square by 20. Next, for security D, it will be 1 square by 10. So I'll write down here 1 square by 10. For security C, students, it will be 2.5 square by 30. So let's write down 2.5 square by 30. And now the last one, security E, it will be 1.2 square by 20. So 1.2 square by 20. And with this, our numbers are put. Let's now calculate the B. Can we start? Alright, 1.5 into equal to, we are doing for security A, right? 1.5 into equal to divided by 40 will give us 0.05625. So I'll write down here now, okay, 0.05625. Yes. Next one, 1.5 into equal to divided by 30 will give us 0.075. The next one, students, is 2 square, that is 2 into equal to divided by 20 will give 0.2. Yes. The next one, 1 square divided by 10, that is 0.1. The next one, students, will be 2.5 into equal to divided by 30 will give us 0.208, and the last one, 1.2 into equal to divided by 20 will give me 0.072. Yes, so with these, students, we have got the B numbers with us. Alright, now let's start accumulating the same. Okay, so now to accumulate, okay, let's take the calces. Alright, 0.05625, okay, 0.05625 I will write down here as it is, 0.05625. Then plus 0.075, we will get 0.13125, plus 0.2 will give me 0.33125. Next, plus 0.1 will give me 0.43125. The next is plus 0.208 will give me 0.63925, and the last one is plus 0.072 will give me 0.71125. Yes, so students, with this we have completed the accumulation of B also. Let's now go ahead and calculate the cutoff points. Okay, students, let's start. I have rounded off the accumulation of B here. Okay, now cutoff point, students. For the calculation of cutoff points, this is the formula. Okay, this is the formula. Students, in this, can I say sigma m square given to you as 10%, correct? Sigma m square market variance is given to you as 10%. Let us now calculate the cutoff points, that is C, for each of those items in our question. So students, I'm writing down here now, calculation of cut-off points. Okay, calculation of cut-off points. Students, for that, the securities arranged are A, then F, next ones are B, D, C and E. So we'll write down here B, D, C and E. Let's now calculate the cutoff points for each of these securities. Okay, students, do you understand that this is the formula, and in that formula sigma m square, that is 10, will be common throughout. So let's create the structure of the formula and then complete it. So it is sigma m square into accumulation A divided by 1 plus sigma m square into accumulation B. So students, do you understand that sigma m square, okay, that is 10 into accumulation A divided by 1 plus 10 into accumulation B, that will remain constant for all. So let's write it and keep. Okay, students, let's now pick up the numbers. Let's start. So we now need cumulation A and cumulation B for security A. So students, for security A, if you see, cumulation A is 0.3, cumulation B is 0.056. So we'll write down here 0.3, 0.056. Let's now see for F. Students, for F, A is 0.65, cumulation A is 0.65. So 0.65 and 0.131. So I'll write down now here 0.65 and 0.131. Next one, students, will be 1.15, 0.331. So I'll write down here 1.15, 0.331, correct? Next one, 1.35, 0.431. 1.35, 0.431. So 1.35, 0.431. The next one's 1.6, 0.639. 1.6, 0.639. 1.6, 0.639. And the last one is 1.66, 0.711. 1.66, 0.711. 1.66, 0.711. Okay, so now let's take the calces and solve this ahead. Okay, so which is equal to, students, 10 into 0.3 will give 3 divided by, students, 10 into 0.056 plus 1 will give me 1.56 in the denominator. Let's do for the next one. 10 into 0.65 will give 6.5. Now students, in the denominator, 10 into 0.131 will give you 1.31. 1.31 plus 1 will be 2.31. Next students, 10 into 1.15 will be 11.5 divided by 10 into 0.331 is 3.31 plus 1 will be 4.31. Next is 10 into 1.35, that is 13.5 divided by 10 into 0.431, that is 4.31 plus 1, that is 5.31. Next students is 10 into 1.6, that is 16 divided by 10 into 0.639 will be 6.39 plus 1, that is 7.39, and the last students will be 10 into 1.66, that is 16.6 divided by 10 into 0.711. So we'll divide this by 10 into 0.711 means 7.11, correct, plus 1, that is 8.11. 8.11. Can we start now? Students, let us now calculate the final answers now. Okay. All right. So 3 divided by 1.56 will be 1.92. So I'll write down here 1.92. Next is 6.5 divided by 2.31, that is 2.81. I'll write down here 2.81. Next students is 11.5 divided by 4.31, that is 2.67. 2.67. Next students is 13.5, okay, 13.5 divided by 5.31, okay, which is equal to 2.54. Next one is 16 divided by 7.39, that is 2.17, and the last ones are 16.6 divided by 8.11, that is 2.05. 2.05. Students, with this now we have completed our calculation of cutoff points. Now students, let's understand the next step. This is it. That next step is the most important. Students, can you see that when your portfolio consists of security A only, your cutoff point is 1.92. Students, do you realize that this 2.81 is not of F alone, but it is cumulation of A and F, correct? So basically in A, if I add F, my cutoff point goes to 2.81, correct? This 2.81, students, look at it as some points given for adding security F to security A in our portfolio. Students, if I now add security B to F and A, can you see my cutoff point now decreases to 2.67, which means according to this William Sharpe's model, if you add security B to your portfolio, the points allotted to your portfolio now starts decreasing to 2.67. If I add D also in it, my points decrease further to 2.54. If I add C in it, my points allotted decrease further to 2.17. If I add E in it, my points crash down to 2.05, which means, students, according to this model, my portfolio should consist only of securities A and F. A and F. Why? Because till I have A and F, my points allotted to my portfolio have increased, but the moment I start adding B, D, C, etc., my points have started crashing. I would not want my points to crash. I would want my portfolio to be the best. Now these points are like some values given to your portfolio. Students, if I have A and F, my value of the portfolio is 2.81 points, but the moment I add B, D, C and E, the value of my portfolio starts decreasing. Therefore, my C, students, actual cutoff point is 2.81, and I will therefore stop at A and F. B, D, C and E will be rejected. B, D, C and E will be rejected. In fact, I can also tell you like this, that yes, we had rearranged these terms by ranking them according to their excess return to risk ratio. Remember that? So basically, A was the best security as per the ERR, E was the worst security as per ERR, and all in between, according to William Sharpe, you have to take A, also add F, no problem, your points are increasing, but beyond F, don't take any more securities. Therefore, I will write here, okay, therefore, securities A and F will be selected, okay, in our portfolio. This becomes my portfolio according to William Sharpe. Now the last step, students, is to calculate the Z value and then accordingly calculate the weights. Can we start doing it? Students, what is the cutoff point now? 2.81. Remember here, 2.81 is your relevant C. Now students, for the purpose of calculating weights, what formula of Z I have given you? Z is equal to beta divided by sigma EX square, the whole into RX minus IRF divided by beta minus the cutoff point. I hope you are mathematically that much aware that this beta and beta you cannot cancel, okay? There is this bracket where minus C is also there. Can we start? So students, Z for A will be, what is the beta of A? Students, beta of A is 1.5. And what is the sigma EX square of A? 40. So do you realize it will be 1.5 divided by 40? I'll write down here 1.5 divided by 40, the whole into RX minus IRF. Students, 15 minus 7. So I'll write down here 15 minus 7 divided by beta. Beta is 1.5 minus the cutoff point 2.81. Remember, don't take the cutoff point as 1.92 just because you're doing for A. No, this is all gone now. The only relevant cutoff point is 2.81. Okay. So students, let's now go ahead. Yes. So let's put the numbers now on your calcs. 1.5 divided by 40 will give me 0.0375. 0.0375 into 15 minus 7 divided by 1.5 minus 2.81. So that comes to 2.52333, etc. And if I multiply this big number by 0.0375, what I get of ZA is 0.095. Okay, ZA comes to 0.095. Similarly, let us do for ZF, correct? ZF, students, beta upon sigma EX square, that is 1.5 divided by 30. Let us write down here 1.5 divided by 30, the whole into RX minus IRF, 14 minus 7. So I'll write down here 14 minus 7 divided by beta minus cutoff point 2.81. So students, if I take the calci, 1.5 divided by 30, Okay, 1.5 divided by 30 will give 0.05. In the bracket will be 14 minus 7 divided by 1.5 minus 2.81, that is 1.85666 and so on. If I multiply that number by 0.05, what I get is 0.093, 0.093, 0.095. Let us now calculate the weights. Okay, the formula I gave you was in your notes. Wx is equal to z of x divided by z of x plus z of y plus dot 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 z of n. Correct? That is the formula I've given to you in the notes. Students, here we don't have n securities, only two securities are there, that is A and F. So students, WA will be equal to ZA upon ZA plus ZF, and of course WF will be equal to, we can either do it as ZF upon ZA plus ZF, or since considering the fact that only two securities are there, WF can be easily 1 minus WA. Can we put the numbers now? What was ZA, students? 0.095. So I'll write down here 0.095 divided by 0.095 ZA plus ZF is 0.093 plus 0.093. Okay, so let's write it down again. 0.095 divided by, so 0.095 plus 0.093 will give 0.188. So 0.095 divided by 0.188, if we do, we will get 0.505. I'll round it off to 0.51, and therefore my weight of A has come to 0.51. My weight of F will be 1 minus 0.51, that is 0.49. Therefore, for my optimum portfolio, the weights of A, I should be investing my money 51% in A, that is 0.51 is the weight of A, and the balance 49% in F, that is weight of F 0.49. With this, we are able to now create our optimum portfolio according to William Sharp. A and F in the weights of 0.51 and 0.49. Students, I hope you understood how to solve this question. Don't worry, if at all Sharp's optimum portfolio model will come, this is the type of question that will come. You have to just by heart those steps. I showed you in this particular video how to apply those steps. Cutoff point, first of all ERR, then ranking according to ERR, then according to the ranked portfolio sequentially calculating the cutoff points. Once the cutoff points are ready, calculating the relevant C cutoff point for the entire portfolio, where the increasing of C stops. That becomes your relevant cutoff point for this particular question or the question you will be solving, and then only those securities which are lying till the cutoff point will be selected. Here it was A and F. Then we calculate the Z and the weights in which we are supposed to allocate our funds within those securities to create the optimum portfolio according to William Sharp. So with this, students, we complete question 77. I hope you understood the steps. I will now flash the solution in front of your screens. You can copy the solution in your notebook. With this, end question 77. Okay friends, so now that you are done with portfolio management, I hope you saw the entire video on Sharp's optimum portfolio construction model. Now students, will start new chapter, that is mutual funds. Students, this could be the smallest chapter as far as revision is concerned, nothing great. Of course, sums are there, it comes in every exam, you should have grip over the sums, but I'll just revise the concepts for you. The first concept which is there in mutual funds is calculation of returns of mutual funds. Now in portfolio, you remember I told you observed return of a share is P1 minus P0 plus D1 upon P0 into 100, correct? This is how you calculate return of a share. Similarly, students, you can calculate return from a mutual fund. Now just as shares have share prices, mutual funds don't have shares, they have mutual fund units, and the mutual fund units prices are called as NAVs, and therefore the K for a mutual fund will be NAV1 minus NAV0 plus D1 upon NAV0 into 100. That's it. Based on this formula, majority questions are there in ICEI module. Okay, so this is as far as K1 is concerned, calculation of returns from mutual funds. Then students, calculation of NAV. Now what is NAV? Students, see, mutual fund is an intermediary between the investor and the investment. So mutual fund basically takes money from the investor and invests it in shares, bonds, gold, real estate, etc. So students, whatever is the market value of the assets that the mutual fund owns or holds, I might say, whatever is the market value of the assets that the mutual fund holds, do you realize that divided by the number of units which are issued to the unit holders will become the market price per unit, and that is called as NAV. So students, therefore, do you realize that net asset value is equal to market value of assets held by the mutual fund divided by number of units. So can I say as market value changes, in fact I would like to say if market value increases, NAV of the units held by the investors will automatically increase, and of course decrease also in case there is a decrease in the value of assets. Also, if there are any liabilities of the mutual fund, then those liabilities also should be subtracted to find the net market value of assets, and that divided by number of units will give you the net assets value. So students, on this there is one very famous question which is there. In fact, there are few questions which are very similar, and so what we will do is one such question we will pick up and we will try to calculate the NAV for the same. So I'll just get you that question. Okay, now let us see this question number 18. So what I will do is I'll just give you my video on this particular question. Watch it, see how NAV is calculated, and once that is done, the calculation of NAV, nothing great is there in that. Now before we go into that video, just let me tell you what else is there. Yeah, there is one concept called as mutual fund performance evaluation. This is same as portfolio ranking. Okay, portfolio ranking in portfolio management, those three tools were there. Those three tools are there here also to rank mutual funds: Sharpe's index, Trainer's index, and Jensen's alpha. Portfolio rebalancing is very simple, nothing great to be done here. Dividend equalization is something that you need to revise. Students, this is one concept that troubles students. So what I will do is, I will now give you my two videos. One is for the calculation of NAV and one is for the calculation of dividend equalization. Once you are done with these two, I guess that's it as far as mutual funds chapter is concerned. Please do revise all the questions of mutual fund whichever are there in your respective notes, because mutual funds chapter is very simple, but it comes in exam every time. It does come 8 marks question minimum they ask. So please have grip over all of this. Conceptually there is nothing great in this chapter. I told you there are 3-4 concepts only, that's it, but the sums you need to practice on your own, right? So now these two questions, one on calculation of NAV and one on dividend equalization, I will share with you right now. Watch it, and once that is done, then students, the revision for mutual funds chapter we will consider to be completed, and then we'll go to the next chapter, that is Forex. Okay, thank you. Now please watch these videos. Let us now do question 18, our first question in this module. Students, I request everyone to please pause the video and read the question carefully. Okay students, so I hope you all read the question, and look at this, so many places it has appeared. So let's start. Very important question, question number 18. So I'll read the question now. Based on the following data, estimate the NAV on per unit basis of a regular income scheme of a mutual fund on 31st of March 2015. Okay, so they are saying that this regular mutual fund has all these assets and liabilities, listed equity shares at cost, cash in hand as on 1/4/2014. Remember, we are looking for NAV on 31/3/2015. Bonds and debentures at cost. Of these, bonds not listed and not quoted, that means the other bonds must be listed and quoted. Other fixed interest securities at cost, dividends accrued, amount payable on shares, expenditure accrued. They are saying the current realizable value of fixed income securities of face value 100 is 96.5. Number of units 10 rupees face value each, 2,75,000. Okay, that is number of units. I'm just reading the question. I'll explain each point. Don't worry. All the listed equity shares were purchased at a time when the market portfolio index was 12,500. On NAV date, the market portfolio index is at 19,975. There has been a diminution of 15% in unlisted bonds and debentures. Okay, valuation. Listed bonds and debentures carry a market value of 7.5 lakhs as on the NAV date. Operating expenses paid during the year amounted to 2.24 lakh. So students, all this data is given. What we have to do is you have to keep picking up the assets and liabilities, start pasting them in that table, calculating NAV, and at the end, whatever net assets you got, divide by number of units, you will get your NAV. Can we start? So I'll straight away write down now here, question 18, calculation of NAV. Okay, I'll write down particulars, calculation and amount. Let's start. So if it's an asset, we will add it. If it's a liability, we'll keep subtracting it. Ready? So net assets, let's start. The first asset that this mutual fund holds are listed equity shares at cost 40 lakh. Okay, I'll write down here listed equity shares. Now my question to you is, can I write 40 lakhs in the amount here? I can't. Why? Because I have to take the market value, correct? And that too market value as on which date? As on the closing NAV date, that is 31/3/2015. Everybody following? As on this date, whatever is the market value. See, the market value must be 40 lakhs when I did purchase it, okay? But students, when I purchased it, it becomes cost for me. When I calculate the NAV, NAV will happen at market values. And if I'm calculating NAV on 31/3/2015, I will take the market value then, right? So right now, I don't know the value of it. Yes, of course, I know in a sense, we have read the question. But till now, till here, the only thing we know is that listed equity shares will form part of my NAV calculations. Those are my assets as a mutual fund. But the value, the market value, we will see later. Next, cash in hand as on 1/4/14 is 5 lakhs. Can I say, children, if I'm calculating for 31/3/2015, cash as on 1/4/2015 will be the opening balance of cash, correct? So I'll write down here cash. Now what is the value of cash given opening to you? 5 lakhs. So I'll write down here in calculation, I'll write down 5 lakhs. Let's see if there is something happening with the cash in this year. If nothing is happening, straight away 5 lakhs will take as closing. If something is happening, which will happen, we will adjust it, okay? Next, students, let's go ahead. Bonds and debentures at cost. Students, bonds and debentures are given to you at cost, and they are saying of these, bonds not listed and not quoted are this. Students, that means in these bonds and debentures there are two parts: listed bonds and debentures, unlisted bonds and debentures. We will write both down. I'll write down here listed bonds and debentures, unlisted and unquoted bonds and debentures. Everybody following? Let's now read ahead. Other fixed interest securities at cost. Students, right now I'm only putting the values, but these are, I'm very sure you understand, the cost values for us. Yes, we need the market values. If nothing is given about the market value, we will assume the cost price to be the market price. Right now we'll just put down the particulars. So other fixed income securities, I will write down here, other fixed income securities are also what this particular mutual fund is holding, okay? So next, they are saying dividends accrued, which means dividends are receivable for the mutual fund. So therefore, this will obviously go in assets. I'll write down here dividends accrued, okay? Dividends accrued. But students, do you realize that dividends accrued, this 1.95 value as it is will come, correct? There is no market value, book value of this. 1.95 is the receivable. So straight away 1.95 lakhs will write down there. So here I'll write my first amount, 1.95 lakhs. Everybody clear? Let's now go ahead. They are saying amount payable on shares, 13.54 lakhs. It's a liability for me. 13.54 lakhs as it is I will take as my liability, correct? So I'll write down here less amount payable, okay, on shares. What is the value of amount payable on shares? 13.54 lakhs. So I'll write down here 13.54 lakhs. Everybody clear? Let's now go ahead. Next is students expenditure accrued. Accrued means again it's a liability for you. 1.76 lakhs payable. So I'll write down here less. Yes, I'm very sure you're understanding. Expenditure accrued. The value is obviously we saw just now 1.76 lakhs. Everybody following? So we have now right now the dividend accrued amount, the amount payable on shares amount, expenditure accrued amount. Students, we have all this data. Now the assets data we need. If nothing is given about it, straight away book values only will take, assuming everything is at par, market value, book value is same. But if something is given, which obviously is given, you also seen it, correct? We will now take the market values according to the data given. Let's start. So they're talking first of all of current realizable value, means today's market value of fixed income securities. Today if I sell it off, what I will be getting, face value of 100, the market value is 96.5. Everybody following? So they are saying that for every 100 rupees face value security, the market value is 96.5. Students, when we purchased it, these particular other fixed income securities, can I say 9.75 is the cost price, which I'll assume that I purchased it at par. So 9.75 therefore students becomes the face value. So I am basically holding other fixed income securities of face value 9.75 lakhs. If the face value is 100, the current market value is 96.5. If it is 9.75 lakhs, then how much? Basic cross multiplication we have to do, students. Yes, other fixed income securities, do you realize 9.75 lakhs is the total face value of the other fixed income securities I own? Divide by 100 if I do, I will get the number of fixed income securities I own, and multiplied by what is the realizable value? 96.5. If I multiply by 96.5, let's see how much I get. So 9.75 divided by 100 into 96.5 if we do, we get 9.40875 lakhs. Okay, 9.40875 lakhs. Yes, so with that we completed the other fixed income securities value. Let's now read ahead what all is given to us. Now they are saying number of units are 2,75,000. So whenever I get my final net assets value, I will divide by 2,75,000. I will get the NAV, correct? Let's now read ahead. All the listed equity shares were purchased at a time when the market portfolio index was 12,500 points. As on NAV date, the market portfolio index is now 19,975 points. So what are they saying? They are saying that when you purchased these listed equity shares, when you put 40 lakh in the shares, at that time the index was at 12,500. Today, as on basically the NAV closing date, the index has gone to 19,975. So how much must be the today's market value of your listed shares? Today's means as on 31st of March 2015 closing NAV date. Students, basic cross multiplication. If when it was 12,500 points, the value of the shares was 40 lakhs. So now if it has gone to 19,975 points, the value must have gone to how much? Basic cross multiplication. Can I start? So students, what I will do, 40 lakhs. Okay, 40 lakhs is the value of my investment in the shares when the index was 12,500 points. So divide by 12,500 into, students, now the index has gone up to how much, children? The index has gone up to 19,975 points. So I'll multiply by 19,975. Okay, let's see the value. 40 lakhs divided by 12,500 into 19,975 if we do, it is 63.92 lakhs. Everybody following? So students, with that we have finished the listed equity shares valuation also. Let's now read ahead. They are saying there has been a diminution of 15% in unlisted bonds. Students, they have given to us the unlisted bonds. You can see this, of these bonds not listed and not quoted. The value given to us, children, is 2.5 lakhs. They are saying this 2.5 lakhs is your cost, correct? Because the bonds and debentures at cost, and of these not quoted, not listed also is at cost only 2.5 lakhs. They are saying this 2.5 lakhs, you have been experiencing a diminution of 15% in the unlisted bonds and debentures. So what I will do, I will take that 2.5 lakhs and I will subtract 15% from it, correct? That will give me my final realizable value on due date, that is on the date on which the NAV is to be calculated. So unlisted bond, students, 2.5 lakhs minus 15%. 2.5 minus 15% will give us 2.125 lakhs. Okay, 2.125 lakhs. Everybody following? So students, with that we get the value of the unlisted bonds and debentures also. Let's now read ahead. They are saying listed bonds and debentures. Straight away they have given to us the market value is 7.5 lakhs. Nothing to think about here, students. Straight away take the market value as 7.5 lakhs of the listed bonds and debentures. Yes, so I'll write down here listed bonds and debentures. Straight away 7.5 lakhs is the market value. Everybody following? Let's now read ahead. They are saying operating expenses paid, not accrued, already paid during the year amounted to 2.24 lakhs. What do you think you'll do with this? Yes, you are right. We already have the opening cash balance, right? From the opening cash balance, we will subtract 2.24 lakhs. We will get our closing cash balance. So students, let's quickly complete this. Cash we have 5 lakhs. From that 2.24 lakhs. What is 2.24 lakhs? I'll show you again. It is the operating expenses already paid during the year. Everybody clear with this? Operating expenses paid during the year 2.24 lakhs must obviously be out of the opening cash balance of 5 lakhs, correct? So what we will be doing is we'll straight away take the opening cash of 5 lakhs. From that 2.24 lakhs will subtract. Yes, so 5 minus 2.24 will give 2.76 lakhs. So 2.76 lakhs becomes the closing cash. So I'll write down here 2.76 lakhs. Everybody following? With that, we have taken all the assets liabilities at its correct values in the calculations. Let us now find the net assets value. Okay, so my net assets will come to 63.92 plus 2.76 plus 7.5 plus 2.125 plus 9.40875 plus 1.95 lakhs minus 13.54 minus 1.76 will come to 72.36375 lakhs. Okay, my net assets value comes to 72 lakhs 36,375. What to do with this, children? I'll obviously divide by the number of units, correct? Number of units given to in the question are 2,75,000. So I'll divide it by 2.75 lakhs. I will get my NAV. Can we start? So my NAV will be 72.36375 divided by 2.75, which is equal to 26.31. Everybody clear? 26.31 therefore becomes my NAV for this question. Okay friends, I hope you understood this question. Question number 18. I hope you understood this question. So let us now do question number 28. I request everyone to please pause the video and read the question carefully. Start. Okay students, I hope you all read the question. See, I've picked it up from the old PM, but see, it is there in the RTP November 18, RTP May 19, and in November 15 they had asked it for 8 marks. Very important, right? So let's start, and I'm very sure as you read it, you must have seen something different and peculiar. It is not like the normal questions you have been reading till now, okay? So students, question number 28, let me start explaining. On 1st April, an open-ended scheme of mutual fund had 300 lakh units outstanding with an NAV of 18.75. Note the date, end of April, it issued 6 lakh units at opening NAV plus a 2% load adjusted for dividend equalization. At the end of May, 3 lakh units were repurchased at opening NAV less 2% exit load adjusted for dividend equalization. At the end of June, 70% of its available income was distributed. In respect of April to June quarter, the following additional information is available. They are saying in that quarter, the portfolio value appreciated by 425.47 lakh. The income of April, students, is 22.95. This is the income of the mutual fund, okay? Income for May is given, income for June is given. You are required to calculate. Point number 1, income available for distribution. Point number 2, issue price at the end of April. Point number 3, repurchase price at the end of May. And point number 4, NAV as on the end of June. Can we start? Students, very simple question, but you need to know how to do it. If it comes in the exam, as it is, it will come in the exam. You should know how to solve it. That is my goal. Yes? So let's start understanding it. Students, what they are saying, the opening NAV is how much? 18.75. Now at the end of April, it issued 6 lakh more units. Yes, it issued 6 lakh more units at whatever the opening NAV is plus a 2% entry load. I am very sure you remember what is entry load. I taught you in the introduction, right? So the opening NAV plus a 2% entry load is the rate at which this new issue of 6 lakh units happened at the end of April. Apart from the opening NAV and the entry load, we are also going to adjust it for the dividend equalization. Yes, students, let us now understand what is this concept of dividend equalization. Can we start? So please pay extreme attention. Students, what are they saying? In April, how much income the mutual fund is going to earn? 22.95 rupees, right? So let's start the understanding. I'll take you straight to the ICAI practice manual solution. Ready? So students, yes, this is the ICAI question 37 from the practice manual. So let us now try to understand it, okay? Students, first things first, what are we going to learn now? The process of dividend equalization. Can we start? So see what they're doing. Students, as far as the April month is concerned, as I told you, the income from April month is how much? 22.95. So that is what they are taking here. See, please pay attention. They are saying income from April is 22.95. Okay. So when income from April is 22.95, okay, do you realize that the total units outstanding are only 300? Where is 300 given? See, I'll show it to you here. 300 units here, 300 lakh units, correct? Now 22.95, if the total income is being earned in April, that divided by 300 units means a per unit income of how much? 22.95 divided by 300 will give you 0.0765. Till your story is clear. Alright. Now tell me, students, how many new units are being issued at the end of April? 6 lakh units. So when these 6 lakh units enter into your fund, they will have to pay not only the opening NAV, not only the entry load, but also the dividend equalization, which means that proportionate existing dividend rate they'll also have to pay. Students, do you realize already I have 300 units and per unit 0.0765 is the income accumulated. So when these people walk in, add dividend equalization collected on issue. When these people walk in, 6 lakh new units are issued, they will have to pay us, apart from opening NAV, apart from entry load, they will have to pay us 0.0765 additional money. That means this money extra I will get as the income from these people. Everybody clear? And therefore, do you realize 306 lakh units will now be outstanding at the end of April, and the total income which will be available with us will be not only what we originally received, but also that we recovered from these people, recovered in a sense which we charged from these people. So the total income available with us is 23.4090, thereby ensuring that the per unit income continues to be 0.0765. Everybody clear? Your goal therefore is to ensure that whenever some new people walk in or you give back the units, the per unit has to remain same, considering the income that you originally hold. Everybody clear? Let's now move ahead. Students, April is done. Let's now move to May. They are saying in the month of May, children, 34.425 income the mutual fund will be earning. So let's now go to May. They are saying add income from May, 34.4250. Obviously, if I divide it by 306 existing units, the per unit comes to 0.1125. This is irrelevant data as of now because we need to see the totals, okay? So total income already I had 23.4090 plus additional income of 34.4250 gives my total income accumulated at the end of month May as 57.8340. This when I divide by 306 units, do you realize my effective per unit accumulated income is 0.1890, correct? Now children, in the end of month May, what is happening? 3 lakh units were repurchased, bought back, which means the money was given back to them, correct? So when these 3 lakh units were repurchased from the unit holders and money was given to them, we will give them money how much? Can I say we will be giving them opening NAV first of all? Opening NAV is available, correct? From that 2% exit load will subtract. Obviously, everyone understands this. But apart from that, that NAV calculation we'll see later. We are right now focusing on the dividend equalization. Do you realize that we will be giving them their share? of the dividend equalization. Everybody following? Which means when 3 lakh units are repurchased, when we give them back their money, we will give them back not only their NAVs adjusted for the load, but also the dividend equalization, correct? Which means when these 3 lakh units are repurchased, we will be giving them their share of 0.1890 rupees per unit back, which is why we say less dividend equalization paid on repurchase. This much amount, students, my income will now reduce. Everybody clear? Yes. So 0.1890 is the accumulated income per unit, correct? And if we are repurchasing 3 lakh units, on 3 lakh we'll have to give back their income. That comes to 0.1890 per unit. Total comes to 0.5670. So 57.8340 minus 0.5670 will give us 57.2670 as the net income at the end of May. And obviously, students, I hope you understand that the outstanding units thereafter will be 303, right? 306 minus 3, and the per unit will not get affected. Everybody clear? Let's now see what happens in June. Students, in the month of June, they are saying the income will be 45.45 rupees. 45.45 lakh rupees. That also will now get accumulated in your existing income. So I add 45.5 to this income from June. This is an irrelevant data. This is nothing but 45.5 divided by 303 outstanding. So the total income accumulated now will be 57 point something upon 45 point something. That is 102.7170 divided amongst 303 units. Can I say the per unit income dividend equalization rate is 0.3390. 102.7170 divided by 303 will give you that amount. Everybody following? Now in the month of June, children, there isn't any new issue. There isn't any repurchase, but something else only is happening. I'll tell you what is happening. They are saying in the month of June, at the end of June, 70% of available income was distributed. So if we are going to distribute 70% of our available income, then students, 102.7170 is our available income post the income of June. From this, 70% will be distributed. That is 71.9019. Students, this is an irrelevant data. Don't look at it right now. Yes, that is nothing but 71.9019 divided by 303. Doesn't make any difference. But the point is, at the end of June now, the balance income, 102 point something minus 71 point something, the balance accumulated income will be 30.8151 divided by 303 existing units. The dividend equalization rate for anything further happening after June, in July, which is not forming part of our question, just saying the equalization rate will be 0.1017 rupees per unit. Everybody followed this dividend equalization process. Let's now go on and calculate the NAVs of the individual month ends. So with that, we have completed what, students? Income available for distribution is over. Now one by one, let us knock off these 3 points. So first point, issue price at the end of April. Children, issue price at the end of April will be how much? Do you realize the issue price at the end of April for these 6 lakh units additional that are being issued, yes, will be nothing but opening NAV plus a 2% load that will be charging as entry load, plus we will be also asking from them, recovering from them the dividend equalization, the amount of which we have already calculated, correct? So let's calculate the NAV as on month end of April, at which we will be issuing the new 6 lakh units. Ready? So students, remember 2% load and the opening NAV of 18.75. So calculation of issue price at end of April, opening NAV 18.75, add entry load 2% of 18.75, add the dividend equalization paid by them. That means we will be recovering from them at the time of issue 0.0765 per unit. I'll show it to you where we have done it. Students, here it is. Yes. See, please focus. Can you see that when the 6 lakh units were issued, we recovered from them at the rate 0.0765 rupees per unit, correct? So per unit that will get added to their issue price, correct? And therefore the final issue price at the end of April will be 19.2015. Everybody clear? Opening plus entry load plus the dividend equalization rate. Final issue price is 19.2015, correct? With that we complete your issue price at end of April. Let us now calculate the repurchase price at the end of May. Students, repurchase price at the end of May, how will we calculate? They are saying that at the end of May, when you repurchase, it will be at the rate opening NAV 18.75 less 2% exit load. Obviously, why less? Because students, if for you it is a sale value, correct? And for you the load has to be paid to me. Do you realize the load will be net off from your sale value, and therefore the net income will be given to you, correct? So for me, when I give you your money back, I will give you opening NAV, but I will deduct that exit load, and then the net I will give it to you. Adjusted for dividend equalization means here, students, in that net NAV that I will be giving to you, I will also add your share of dividend equalization, and I will give the money back to you on the repurchase. What is that repurchase price is what they are asking at the end of May. Children, at the end of May, as you saw, it is nothing but the opening NAV less 2% exit load, and I will add your share of income 0.1890. So 18,750 minus 0.375, 2% of it, plus 0.1890. The net final repurchase price for me will be 18.564 as a mutual fund. Students, from where I got this 0.1890 that I'm adding to your income when I repurchase, this 0.1890, if you remember, yes, this thing here, add less dividend equalization paid on repurchase. Yes, you can see this data here, 0.1890 from my reserves it is getting reduced, which means for you it is an income, correct? So students, when I say less, it is not less for the unit holder. For you it is add. For me, from my treasury it is reducing, but for you it is an income, correct? So 0.1890 per unit is what I'll be adding on to your repurchase price. Everybody following? It is a repurchase price for me, but for you the redemption price. Everybody clear? So students, with that we understand the issue price at the end of May will be 18.564 rupees per unit. Everybody clear? Then they're talking of the last thing, that is the NAV as on 30th June. Students, they are not saying issue price or repurchase price, because at the end of June nothing is happening. So straight away they're asking you NAV only. What do you think will be the NAV at the end of June, students? Very, very simple. It is nothing but the total assets we hold divided by the number of units. Now students, as far as the assets we hold, they are saying that our portfolio has appreciated by 425.47 lakh rupees from the initial. Initial means nothing but 300 lakh into 18.75 was my initial portfolio value. In that there has been an appreciation of 425.47. Everybody clear? And apart from that, that final net income is also available, right? After the distribution 70%, net income is also available. That also we will add, and we'll find the final NAV. Everybody clear? Of course, when I'll be dividing by the number of units, it won't be 300 lakh units now, because you have also raised additional 6 lakhs and you have repurchased 3 lakhs. So basically 303 lakh will be left at the end. Ready? So let's start. Let's see the final calculation. And also obviously, as you will be raising the new funds, 6 lakh units when you will be raising, new fund will come into our bank account, correct? New fund will therefore increase the NAV. When you are repurchasing the units, fund will go out from your bank account. There will be a reduction in the NAV. So basically what all is happening, children? There is an opening balance of 300 lakh into 18.75, correct? Apart from that, there is a new issue of 6 lakh. Apart from that, there is a subtraction, reduction of repurchase of 3 lakh units that will get reduced. Apart from that, there is an appreciation of 425.47 lakh in your portfolio. Apart from that, there is a final net income that is available at the end after the distribution of 70%. Everybody clear? Students, will take everything into consideration and then divide by the final units available. We will get the final closing NAV. Everybody following? So students, let's now see the calculation of the closing NAV on June. Opening NAV, I hope you understand, 18.75 rupees per unit into 300. This is the value. Portfolio appreciation they have given to you separately as 425.47. Issue of fresh units 6 into 19.205. From where you got 19.205? Can you see this? New units, correct? At the end of April, the issue price was 19.205 per unit. 6 lakh units we have issued at the rate 19.2015. So this is the additional money that you will receive. Yes, apart from that, the income that we have received So now let us go on to point number 4. They are asking you NAV as on 30th June. See students, they are not asking you issue price or repurchase price. No, they are only asking you NAV because at the end of June you are neither issuing units nor are you repurchasing any units, correct? Straight away final closing NAV as on 30th June. So to explain this, let me first remove all the markings from upstairs. Okay, I will remove everything. And now let me explain. Students, they're asking you NAV as on 30th June. Students, what all has happened from April? Please pay attention. Can I say you already had 300 into 18.75 opening fund value, correct? In that, can I say 6 lakh units were issued new and fresh, and the issue price at the end of April is already calculated by us. So 6 lakhs into issue price is the new fund coming into your company, correct? And in that issue price at the end of April, all the dividend equalization, load, etc., everything is taken into picture, right? Then at the end of May, 3 lakh units are being repurchased. So if you are repurchasing, some of your fund will now deplete, correct? It will go down. And at what rate it will go down? That rate, that repurchase rate is also calculated by us at the end of May. That is also available. And then students, do you realize that you're going to distribute 70% of the available income? That also therefore will reduce your final NAV. Apart from this, correct students, they are saying that our portfolio is going to appreciate by 425.47. This will add on to your NAV. And these three incomes, obviously from these incomes only you are distributing 70%, right? So first we'll obviously add these incomes and then the 70% will get distributed, reduced from your portfolio, correct? So I'll again repeat, understand the chronology. First of all, students, do you realize that your original mutual fund has a value of 300 lakhs into 18.75, correct? In that you will be earning income of April, correct? After income of April, you will be issuing new units at some rate which have already calculated at the end of April. That will also add to your fund value. Then in May, students, you will be earning more income that will add to your fund value, but you are repurchasing some units that will reduce your fund value. Then students, in June, what will happen? In June, you will be earning some income. That income will add to your fund value. And then in June, you are distributing 70% of your total income available for distribution. That will reduce your fund value. And apart from all this, 425.47 is the portfolio appreciation also. That means the portfolio will appreciate by this much value. That will also add to the value of NAV. And finally, students, whatever final net assets we will get, we will divide it by what? We will divide by the closing number of units, which I'm very sure you understand. See, 300 opening units you had, 6 units you issued extra, and 3 units you repurchased. Net closing will be 303 lakh units, at which we'll calculate the NAV per unit. Everybody clear? Let's now quickly complete this, students. See, closing NAV on June, I hope you understand. Opening you have 18.75 rupees into 300 lakh units. This is the value of the opening. Portfolio value appreciation is given to us, correct? Apart from that, there is an issue of fresh units, 6 lakh units at 19.2015. I'll show it to you where it is. You remember end of April, 19.2015 is the issue price. So at this issue price, we are issuing new 6 lakh units. So this additional fund comes into our company. Then total income received of the 3 months given to us in the question. This also adds to the fund. Total fund value gross less units repurchased. 3 lakh units you are repurchasing at 18.564 per unit. 18.564, I hope you remember. End of May, 18.564 is the repurchase price. So 3 lakh units you are repurchasing at that price. So this much fund goes out of our company. Reduction in our fund. Income we are distributing 71.9019. Students, that also we have calculated earlier. I'll show it to you. Yes, you can see here. Total income that you are distributing is 71.9019. That is nothing but 70% of the available income. I hope you remember that. So that also will reduce your fund value, correct? And therefore the total reduction in the fund value will be 127.5939 from this 6268.504. The net value will be 6140.9101. Divided by closing units. I hope you understand this calculation. 300 original opening plus 6 new issued minus 3 repurchased, 303 lakh units. My closing NAV therefore will be 6140.9101 divided by 303 lakhs will give us 20.2670 rupees. Everybody clear? So with this students, we finished the dividend equalization process also. I hope you understood. I was very hell-bent on teaching you this because students, you should know what it is. Because if in case this comes as it is in the exam, which as it is only it will come hopefully, do you realize you should know how to solve this? Hence I took you through this. Now you are ready. I will now flash the solution of this question on your screens. You can pause the video and copy down the solution. And as you're copying down, please understand it once more properly, logic by logic, so that whenever it comes in the exam, you can easily knock it off. 8 marks are going nowhere. Let us check how many marks it has come. Students, I'll show it to you here. I have written it down here. Yes, it is a 8 marks question. Yes. Okay, students. So I hope you all saw those 2 videos on mutual funds. Now we will continue to our next chapter, that is Forex. A huge chapter. Foreign exchange exposure and risk management is the full name. So in this, what we are going to do, I'll tell you what the theme of the whole chapter is. Let's say you are an Indian exporter and you have sold goods to an American customer. Okay, you are an Indian exporter and you have sold goods to an American customer worth $1 lakh, but it is payable in 3 months. So today, let's say $1 is equal to rupees 80, which means today your consignment is worth rupees 80 lakhs. But since you will be receiving that $1 lakh after 3 months, today you will not be knowing, right, that at what rate those dollars will get converted to rupees. Because after 3 months, what exchange rate would be there between dollar and rupee? Who knows? So students, this uncertainty of future is called as currency risk. And in this chapter, we are going to study tools to hedge the currency risk. Hedge means basically to remove the uncertainty, to create certainty. How to create certainty? For that, this chapter provides, broadly speaking, 2 tools. One is forward cover and the second is money market hedging. Okay. Of course, there are couple tools more. One is currency future, the other is currency options. But that one should study only once you are done with derivatives chapter. Because once derivatives, futures and options, you know what it is, then you can easily tackle currency futures and options also. So students, in this chapter, forward covers and money market hedging, these 2 tools are there. But to get to that, we need to first of all have a grip on few basic items like bid rate, ask rate, cross currency rates, indirect quotes, etc. And once those are done, then we can easily go ahead with forward covers and money market hedging also. So now for the basics, the first basic that I want you to understand is bid, ask and spread. So let's say a quote given to you is like this: $1 is equal to rupees 80. This is called as the bid rate of dollar, and $1 equal to rupees 82 is called as the ask rate of dollar. Now what is the difference between these two? Students, bid rate is the rate at which bank or the foreign exchange dealer buys the product, that is dollar, and ask rate, okay, ask rate of dollar is the rate at which the bank or the foreign exchange dealer sells dollar. Okay, so students, if you go to the bank today and say, bank, I want to buy dollars, can I say bank will sell dollar to you, and bank will sell dollar to you at rupees 82? But if you as a customer want to sell dollar to the bank, can I say bank will buy dollar from you at the bid rate of dollar? Everybody clear? So that is as far as bid rate, ask rate is concerned. Spread is basically the difference between these two. 82 minus 80, the spread here is rupees 2. So of course, as far as bid rate, ask rate identification, what it means, etc. is concerned, many different faculties teach it in many different ways. So I would always urge students to continue and stick to however you have been taught, because unnecessary last minute one should not get confused, because my pattern of teaching this particular chapter or this particular area could be very different from others. Of course, the answers of all of us will be same only, the final answers, but how we approach it could be different, and hence stick to your original notes whatever you have, and I will of course give you my end of explanation, but as a priority, please stick to the notes, please stick to the explanations that you have already been following. because right now at the last minute one should not change the way one understands a particular chapter. Okay, so now that is bid rate, ask rate and spread. So on this, if you want to do one question, okay, we could do this question number 5. Okay, see what they are saying. You propose visiting London. London, can I say the currency there is pound, you are Indian, so your currency is rupee. You go to your local bank, exchange rate quoted by the bank is buying rate 72.7, selling rate 73.25. What does this mean? Buying rate, selling rate, whenever they use these terms, it is always and always from the bank's point of view, which means this is the buying rate of the bank and this is the selling rate of the bank, which means bank buys 1 pound at rupees 72.7, bank sells 1 pound at rupees 73.25, which means the quote here is 1 pound is equal to rupees 72.7 dash 73.25 rupees, which means here the bid rate, can I say, is 1 pound equal to rupees 72.7, ask rate is 1 pound equal to rupees 73.25, and the spread is of course the difference between 73.25 and 72.7. Now very interesting, how much would you pay for purchasing 250 pounds? Students, if you want to buy from the bank 250 pounds, how much do you want to, or how much you will have to pay? Students, do you realize if you want to buy pounds from the bank, bank will sell pounds to you and bank will sell pounds to you at the ask rate of pounds. Ask rate of pound, can I say 73.25, which means 1 pound is equal to rupees 73.25. This is the rate at which bank will sell pounds to you. Can I say that means if you want to buy 250 pounds, bank will sell 250 pounds to you at 250 into 73.25. Now you took that 250 pounds, you went to London, and on your return from London, you still have a balance of 23 pounds with you. How many rupees would you receive if the bank in India now quotes this? Now do you realize by the time you came back, few days have passed and therefore the rates have undergone a fluctuation. Right now the rate is now 73.65, 73.92. So what I will do is I'll just write down the revised rates here. Okay, this is basically now 73.65 and 73.92. In your pocket you have got 23 pounds. Can I say you want to now convert these pounds to rupees? So you go to the bank and say, bank, I want to sell pounds to you, please give me rupees. The question is, how many rupees will you get? Do you realize when you sell pounds to the bank, bank will buy pounds from you. Bank will buy pounds from you at the bid rate of pounds, that is 73.65, and therefore the total rupees that you will be getting would be 23 pounds into 73.65. These many rupees you will be getting. That is as far as bid rate, ask rate and spread is concerned. Moving on to the next concept is indirect quote for bid ask. So I'll tell you what this means. Now students, if $1 is equal to rupees 80-82, then using this, if I want to find 1 rupee is equal to dollar, how much? How to do? Can I say we will have to find the reciprocal, correct? Calculate the reciprocal. But when you're doing reciprocal, one needs to cross it. I'll tell you how. It will be 1 by 82 dash 1 by 80. Not 1 by 80 dash 1 by 82. It will be 1 by 82 dash 1 by 80. Okay, which means you can also put it in 4 decimals. 1 divided by 82, if you do, this will be 1 rupee is equal to $0.0122, and then 1 divided by 80, this is 0.0125. What does this mean? That means bank buys 1 rupee. See, this is bid rate of rupee, this is ask rate of rupee. Bank buys 1 rupee at $0.0122. Bank sells 1 rupee at $0.0125. Students, always remember, spread has to be positive. Okay, spread has to be positive means ask rate has to be more than the bid rate. Everybody clear? Bank will always be in profit. So now on basis of this, let us see if we have a question here for practicing this. So here we will take, let's say, question number 7. Okay, very interesting question. Question number 7. What are they saying? Consider the following: rupee per Singapore dollar direct quote of ICICI Mumbai 33.5, 33.75. So I'll write here 1 Singapore dollar is equal to rupees 33.5 dash 33.75. Done. Now point number A. What is the cost of buying Singapore dollar 7,500? Okay, now students, you want to buy Singapore dollars. Can I say bank will sell Singapore dollars? Bank will sell Singapore dollar at the ask rate of Singapore dollar, that is 33.75. So students, if you want to buy Singapore dollar 7,500, you need to pay 7,500 into 33.75. These many rupees you will have to pay. Everybody clear till here? Great. Next students, they are asking how much would you receive by selling Singapore dollar 12,000. So if you go to the bank and say, bank, I want to sell Singapore dollar to you, can I say bank will buy Singapore dollar from you at the bid rate of Singapore dollar, that is 33.5. So therefore, if you go and sell 12,000 Singapore dollars, you will receive 12,000 into 33.5, these many rupees. Next students, they are saying, okay, if you want to buy rupees, oh, you want to buy rupees, that means now you will require the quote of rupees, correct? So the quote of rupees will be 1 rupee is equal to Singapore dollar 1 upon 33.75 dash 1 upon 33.5. If we open this up, 1 rupee is equal to Singapore dollar 1 divided by 33.75. This is 0.0296, and 1 divided by 33.5, this is 0.0299. So students, tell me, you want to buy rupees, bank will sell rupees, bank will sell rupees at the ask rate of rupee, that is 0.0299. So if you go to buy 1 lakh rupees, bank will sell 1 lakh rupees to you at 0.0299, and these many SGDs you will have to pay for buying rupees. And if you want to sell rupees, how many Singapore dollar will you get? If you sell rupees, can I say bank will buy rupees from you at the bid rate of rupee, and therefore this is the applicable rate. So basically 50,000 into 0.0296, correct? These many Singapore dollars you will get if you sell 50,000 rupees to the bank. So that is as far as IDQ, indirect quotes for bid rate and ask rate, is concerned. Now moving on, students, we come to a concept called as cross currency rates. Now in cross currency rates, what happens? Let's say they tell you $1 is equal to rupees 60, and they tell you $1 is equal to Singapore dollar, let's say 20. Okay, $1 is equal to rupees 60 and $1 is equal to Singapore dollar 20, and they will ask you, okay, so 1 Singapore dollar is equal to rupees how much? Okay, so basically what is happening is you do not have a direct relation here between Singapore dollar and rupee, but you have a common currency between both of them, that is dollar, and through the common currency dollar, can I say we can find the relationship between Singapore dollar and rupee. How to do it? Very simple. Do you realize we are looking for rupee per Singapore dollar, correct? Rupee per Singapore dollar. The equation is, it is rupee per dollar into dollar by Singapore dollar, correct? Again, I'll just tell you that this is how I teach it. Please stick to however you have been taught, stick to that only. I'm just revising things for you here. So rupee by dollar here, do you realize is $1 is equal to rupees 60, and dollar by Singapore dollar, do you realize is 1 by 20, because this 20 is Singapore dollar per dollar. I need dollar per Singapore dollar, that is 1 by 20. If you solve this, you will get 3. Basically 1 Singapore dollar will be equal to rupees 3. That is how you calculate. Also students, one should know that if they tell you that $1 is equal to 60-63 and this is 20-25, and now they are asking you 1 Singapore dollar equal to rupees how much? So do you realize that here also you will require 2, right? Bid rate and ask rate. So what you should understand is, when you are searching for bid rate, okay, when you are searching for bid rate, then yes, one should take the bid rates only, where here the bid rate would be 1 by 25. Okay, 1 Singapore dollar will be equal to $1 by 25, because if you take a reciprocal here, then I hope you realize you'll have to do the cross there. So point being, please understand that if you are calculating bid rate in the cross currency, then please note that whatever products you are taking in the RHS, take the bid rates only. And if you are calculating ask rate, then one should do everything on the basis of ask rates. So this is how you calculate cross currency rates. So for example, okay, for example, let me take one example for you here. Let's say we calculate, okay, this one. 1 euro is equal to dollar 1.33, 1.36. So I'll write here 1 euro is equal to dollar 1.33, 1.36, and then 1 pound is equal to dollar, 1 pound is equal to dollar 1.43, 1.46. So 1.43, 1.46. Now what are they asking? They are asking both bid and ask euro rates for pound. So basically they are asking 1 pound is equal to euro how much? Everyone clear? So now let us do for the bid rate first. So for the bid rate, I'll say euro per pound is equal to euro per dollar into dollar per pound. Now everything I need to do on bid rate. So this euro per dollar means $1 equal to how much euros, correct? Euro per dollar is $1 equal to how much euros? Students, $1 equal to how much euros? This is the relationship. $1 equal to how much euro if I need bid rate? Do you realize it will be 1 upon 1.36? Do you understand? Reciprocal, right? IDQ, indirect quote you will have to calculate, and therefore I'll write here 1 upon 1.36. And then here dollar per pound means 1 pound equal to how much dollars? That is this. And here the bid rate is straight away available here as 1.43. So here I will do 1.43 divided by 1.36, and that will come to 1.0515. That is the bid rate that we got here, 1.0515. Now students, for the ask rate. Now for ask rate, how to calculate? First let's go back to this. $1 equal to euro how much? $1 equal to euro how much? Ask rate, can I say, is 1 upon 1.33, 1 upon 1.33, and then 1 pound equal to dollar how much? 1 pound equal to dollar how much? Ask rate is straight away 1.46. So we do 1.46 divided by 1.33, and that will come to 1.0977, and that is how you calculate the cross currency rates in case there is bid rate and ask rate. Okay, so with that we complete the discussion to cross currency rates also, right? Next students, we need to understand is forward contracts. Okay students, so now what are forward contracts? Forward contracts are your first hedging tool. Now hedging tool, I hope you remember I gave you an example. Okay, so that example was where you sold goods to an American customer worth $1 lakh. Okay, now this happened, let's say, on 1st of January, and on 1st of January the exchange rate between dollar and rupee was, let's say, $1 is equal to rupees 80. That was the spot rate. It's called as spot rate. The spot rate on 1st Jan was $1 equal to rupees 80. But students, the money you will receive is after 3 months. So after 3 months, when you actually receive $1 lakh, what the spot rate of dollar would be, can I say, that is unknown to us on 1st of January. And hence that causes risk to us because there is uncertainty. See, there is certainty as far as receipt of $1 lakh is concerned. We know for sure that $1 lakh we will get. But there is uncertainty as to how much rupees we will get. So students, the bank comes out with this scheme or this contract, I might say, which says that okay, on 1st of January itself, you enter into a 3-month forward contract with the bank, and the rate is also told to you on 1st of January only. Let's say the rate given to you is $1 is equal to rupees 81. Such a rate is called as a 3-month forward rate. This 3-month forward rate is quoted to you today itself, and if you enter into a 3-month forward contract with the bank today only at rupees 81 per dollar, then students, on due date, that is on 1/4, when you actually receive your $1 lakh from your American customer, you can take those dollars and go to the bank and sell those dollars to the bank. Irrespective of this rate, you will be able to sell dollar at the already pre-decided forward rate, that is 81. So whatever the spot rate, let it be whatever on 1st of April, doesn't matter, since you have already entered into a forward contract with the bank on 1/1, then on 1/4 when you actually go to convert your dollars to rupees, the rate that you will be getting is actually the forward rate at which you had entered into the forward contract. Can I say this creates certainty to you from 1st of Jan itself. Now you know, irrespective of where the exchange rates would go, do you realize you know that you will be getting 81 rupees per dollar. That is your hedging tool, your certainty creation tool, or I might say risk hedging tool, forward cover. Everybody clear? So that is as far as forward cover is concerned. There would be many questions on forward cover. Please practice them. Okay. Next we have got something called as appreciation and depreciation of currency. Very simple. See, let's say $1 is equal to rupees 80 is today's spot rate, and $1 is equal to rupees 83 is a 3-month forward rate quoted by the bank. Students, I hope you realize both of these rates will be quoted on the same day, right? Let's say for example, today only the bank is saying that $1 equal to rupees 80 is the spot rate, which means today if you want to buy or sell dollar, the rate is rupees 80. Right now I'm not going to bit rate, ask rate. For today's transaction it is 80. But today we are also telling you 3-month forward rate is rupees 83, which means today if you want to enter into a contract with me for a 3-month forward, which means you will come to me and sell or buy dollars after 3 months, then today only we can decide the rate as rupees 83. Now students, looking at the spot rate and the forward rate quoted by the bank today, can I say we realize that the dollar is expected to appreciate. Today it is rupees 80, it is expected to appreciate to 83. How much is the percentage appreciation? Very simple. So percentage appreciation in the product, or basically in the currency, is the forward rate minus the spot rate upon spot rate into 12 by m into 100. So students, do you realize forward rate is 83, spot rate is 80, spot rate 80 into 12 by 3 into 100. So what does this mean? On 80 rupees, 3 rupees is the appreciation. So 3 by 80 into 100 is the percentage appreciation. But this percentage appreciation, can I say, is happening over 3 months only. So effective annualized percentage appreciation is how much? So for 12 months it is how much? For that we are doing a cross multiplication into 12 by 3. That will give you the percentage appreciation in dollar. Of course students, if this is, let's say, 73, then do you realize that instead of 83 we will get 73, and here we will get negative answer. Negative answer means basically there is no appreciation in dollar, there is a depreciation in dollar. Everybody clear? That is the concept of appreciation and depreciation of currency. Next students is the concept of swap points. So let me explain to you what swap points are. Now if the question tells you that spot rate is $1 is equal to rupees 80.3450-3570, okay, this is the rate given to you, spot rate. Then they tell you 3-month swap points, okay, 3-month swap points are 10-20, okay, 3-month swap points are 10-20. So then how much will be the 3-month forward rate is asking. What will be the 3-month forward rate? So you say spot rate is given, swap points are given. How do we find forward rate with it? Very simple. First of all, ask yourself, the swap points, can you see, are in the ascending order. Ascending means 10, 20. The ask rate swap point is more than the bid rate swap point. In such a case students, one should add these numbers to the spot rate to find the forward rate, which means if instead of 10-20, if it would have been 20-10, then you would have subtracted, because do you realize here it is going in descending order. The bid rate swap point is more than the ask rate. So here now, since it is in ascending order, students, we have to add. But now how to add? $1 is equal to rupees. Now students, I hope you realize that when I wrote 3570 here, this is basically 80.3570. That much you all understand, right? Now students, do not directly add 10 and 20 like this, 90.3450 and 100.3570. No, this is wrong. This is not how you are supposed to do it. Please note that these numbers are to be added to the last digits, which means this 10 will be added to this 50. this 20 will be added to this 70, and therefore the rate will be 80.3460 dash 80.3590. Everybody clear? That is how you're supposed to do it, which means if, let's say for example, here instead of 1020, what if it was 3-5? Then 3-5 means, do you realize this will be 3453? Just add to the last number, and then this will be 3575. Everybody clear? So that's how you are supposed to deal with swap points. That is as far as swap points are concerned. Next, students, we will talk about a concept called as exchange margins. Now, what are exchange margins? Please understand. See, there is bank A, there is bank B, and then there are all these customers. Okay. Now, students, let's say that the question tells you that $1 is equal to rupees 80-82 is an interbank rate. Okay, $1 equal to rupees 80-82 is an interbank rate. What is the meaning of interbank rate? Means this is the rate at which bank to bank transactions will happen, which means if bank A goes to bank B, then bank B will quote $1 equal to rupees 80-82. But if an ordinary customer goes to the bank, then for that customer interbank rates are not quoted. Something called as merchant rates are quoted. Now, how to calculate merchant rates? See, they will tell you in the question that exchange margins, okay, exchange margins are, let's say 0.1% for bid rate and 0.2% for ask rate. What does that mean? Students, this means that the exchange margins, once you apply on the interbank rate, you will be able to find the merchant rates. So these rates are between banks. These rates are not available for customers. For customers, what will happen? These exchange margins will be applied on the interbank rates, and then new merchant rates are created, and those merchant rates are quoted to the customers. Now please note, bid rate is there, always subtract from the interbank rate, and ask rate is there, always add to the interbank rate, which means your merchant rate now will be $1 is equal to rupees 80 minus 0.1% dash 82 plus 0.2%. Everyone clear? So here I will take 80 minus 0.1%, and that is 79.92, and 82 plus 0.2%, that is 82.16. So students, this becomes your merchant rate, which means when banks will quote to the customers, it will be at these rates. Okay. Now students, moving on to the next point in this chapter are some special cases. Now what do you mean by special cases? Students, there are three broadly speaking special cases. One is cancellation. Okay, cancellation of forward contract. The next is execution of forward contract, and the last is extension. Okay, extension of forward contract. Now students, within that, students, there is cancellation before the due date, there is cancellation on the due date, there is cancellation after the due date, execution before the due date, execution on the due date, execution after due date, extension before due date, extension on due date, extension after due date. Now students, first of all, I'll give you a broad idea of what this is. Now let's talk about this case. This means that let's say you entered into a 3-month forward contract with the bank, but in 2 months only you go to the bank and say, bank, I want to cancel the forward contract. What is this? On due date means you actually go on the due date and say, bank, I want to cancel the forward contract. And what is after? After means you can go after due date also. The bank will give you 3 days grace period. You can go to the bank and say, bank, I want to cancel the forward contract. Similarly, in execution also there are 3 cases. You can either go on the due date and execute, which is a normal case, or you could go before due date and execute. You could go after due date and ask for execution. Extension means what? Extension means you took a 3-month forward contract, but then you realize, no, I want 1 month extension more. Like that, you can go to the bank and ask for extension either before, on or after the due date. Now students, regarding these 9 cases, in fact I would say there are 18 cases, because 9 cases from importer's point of view and 9 cases from exporter's point of view. Students, that would be outside the purview of this revision, because then it will take too much time. I would request all of you to kindly refer to the notes that you must have been given by your respective faculties for these special cases, because unnecessarily there will be lot of discussion. It will waste your time right now. Just go through those notes of extension, execution and cancellation of forward contract. Even the study module has each of these cases properly defined, properly with lot of examples and illustrations they have given. I would request you to kindly read them immediately. Okay, so that is as far as these special cases are concerned. Now students, we move on to the second hedging tool, that is money market hedging. To understand money market hedging, students, we will have to go through 2 examples. One is for exporter and one is for importer. Let us understand how to do these two. I will pull out my videos on exporter and importer money market hedging. I will share it with you. Kindly go through those and then only we will go ahead. Okay, please now watch money market hedging, both for exporter as well as importer point of view. How can you hedge? Hedging means what? Hedging means creating certainty. One tool you saw already of hedging, that is forward cover. Enter into a forward cover today only with the bank and create certainty for yourself as to how much you will be getting in future or how much you have to pay in future as far as home currency is concerned. Because if you don't hedge, can I say, uncertainty looms large over your head. But if you hedge, can I say, you get certainty. So forward cover was one hedging tool. Money market hedging is another hedging tool. Students, for that I will just give you 2 questions. Just go through them. You will understand how the money market hedging is done. And after that, students, I guess the chapter is more or less over. Small points only are left. We'll cover that after you see this video. Please watch this video now. Students, this question 64 I've picked up from the old practice manual of CA Institute. It had come in November 2008 paper for 6 marks. It is also there in the new study material of this chapter of Forex. Students, I request everyone to pause the video here and read the question once. Start. Okay students, I hope you all have read this question. Very simple question. Tell me students, this is money market hedging from whose point of view? Exporter's point of view. Can we start? An Indian exporting firm, Rohit and Brothers, want to cover itself against a likely depreciation of pound sterling. The following data is given. Receivables of Rohit and Brothers are 5 lakh pounds. 5 lakh pounds are receivable and they are fearing depreciation of pound, which means they are fearing tomorrow they will get less rupees. The spot rate is 1 pound equal to rupees 56. Payment date is 3 months. 3 months interest rate, India 12%, UK 5% per annum. Students, here in this question the borrowing and deposit rates are not different, one rate for both. What should the exporter do? Can we start? You know the steps? Correct. Let's start. So question 64, tell me today what all steps will you do? Step 1. Yes, it was identify. What to identify? Whether we have a foreign currency receivable or payable. Tell me, here you are an exporter. You have a foreign currency receivable or foreign currency payable? Obviously students, we have a foreign currency receivable. So I'll write down here, we have a foreign currency receivable of pound. How many pounds receivable, students? We have 5 lakh pound receivable in how many months? 3 months time. So I'll write down here, receivable of pound 5 lakh in 3 months time. Okay, in 3 months time. Ready? Next, step 2. Step 2. Students, since we have a foreign currency receivable, to hedge, what will we do? Create a foreign currency payable. So I'll write down here, to hedge, create, okay, a foreign currency payable. Create a foreign currency payable of exactly 5 lakh pounds payable in 3 months time. Of 5 lakh pounds in 3 months time. Okay students, tell me what will be step 3. Students, step 3, very simple. If you want to create a foreign currency payable of 5 lakh pounds in 3 months time, what you have to do, you will have to go today and borrow the present value of 5 lakhs so that the maturity value of that loan is exactly 5 lakhs in 3 months time, payable 5 lakh in 3 months time. Yes, so I'll write down here, borrow present value of pound 5 lakh in UK today. So what is the interest rate given to us, students? 5% per annum is the interest rate for pounds. Students, for a period of 3 months, the effective interest rate will be 5% into 3 by 12. If we take the calci, 5 into 3 divided by 12, we will get 1.25%. Yes, so on 1.25%, students will have to discount this and check how much to borrow. So that is 5 lakh divided by 1.0125. Yes, let's take the calci. 5 lakh divided by 1.0125, that will give me a pound borrowing today of 4,93,827. So this much if we borrow today in UK, it will grow to a maturity value of 5 lakh pound in 3 months time. Okay, now step 4. Students, come on, what is step 4? Step 4, very simple. These pounds you borrowed, right? Bring it home and convert at spot to rupees. So I'll write down here, convert pound to rupee at today's spot rate. Convert pound to rupees at today's spot rate. Students, today's spot rate is 1 pound equal to rupees 56. Bid and ask separately is not given. No problem. So 1 pound equal to rupees 56. I'll write down here, 1 pound equal to rupees 56. Students, how many pounds we have to convert here? Yes, we have to convert pound 493,827. So therefore, if we sell 493,827 pounds today and convert to rupees at today's spot, we will be able to receive how many rupees today? 493,827 into 56. We will be able to receive rupees 276,54312. That is nothing but 2 crore 76 lakhs 54,312. Students, this rupees when you will receive today. So what will you do today only? Step 5. I am very sure you know what to do. Invest rupee in India. Students, in India for how many months? For 3 months. Students, tell me, if you invest in India for 3 months, the relevant rate is 12% per annum. That is nothing but 3% for 3 months, correct? 12% is for 12 months, so 3% for 3 months. So therefore, this rupee I will invest at the rate 12% per annum for 3 months. So on due date, this will grow to how much, students? This will grow to rupees 2 crore 76 54,312 plus 3%. It will grow to rupees, let's take the calci, I add 3% to this, it will give me rupees 2 crore 84 lakh 83,941. This is the rupees that you will get at the end of third month when you invest this 2 crore 76 54,312 in India today at the rate 12% per annum for 3 months. Students, therefore on due date, now what is left? On due date, I hope you understand, you will get your 5 lakh pound from your export sales. You will take that 5 lakh pound that you have received from your customer here and you will use it to knock off your pound loan. You will use it to knock off your pound loan, which must have obviously grown to 5 lakh pounds at the end of third month. So pound and pound is nullified for you. You know today only that after 3 months you are going to get 2 crore 84 lakh 83,941, correct? And therefore with that, students, we end question 64, in which we have told what the exporter should do. All steps are written. I will flash the solution on our screens. You can copy it in your notebooks. So I hope you understood this question. So let us now do one more question on money market hedging, that is question 66. Students, I would request everyone to please pause the video and read this question carefully. Start. Okay students, so I hope you all read the question. Let us now start understanding it. Very simple this is. The CFO of this company has been studying the exchange rates and interest rates relevant to India and USA. This company has purchased materials from an American company at a cost of $5.05 million, payable in US dollars in 3 months time. So first of all, I'll write down here we are Indian importer. Do you understand this? We are Indian importer. We have purchased goods. So the dollar payable is how much, students? Dollar payable is 5.05 million. That is nothing but 50,50,000. So I'll write down here $50,50,000 in 3 months time. Story clear till here? Great. In order to maintain profit margins, the CFO wishes to adopt, if possible, a risk-free strategy that will ensure the cost of goods sold does not exceed 21 crore rupees. So he's saying that we want to ensure a hedging strategy so that tomorrow, after 3 months, when I have to purchase these dollars to pay my supplier, the total rupee outflow for the same should not exceed 21 crores. If it is possible, I would like to go for such a hedging tool. Then they say in the question, they are saying exchange rate, bid rate and ask rate. $1 equal to rupees how much? Spot is given, 1 month forward is given, 3 months forward is given, and then the interest rates available are given. In India, the deposit borrowing, in USA, the deposit borrowing. 1 month period, 3 month period. What is the meaning of this 5%, students? If someone wants to invest in India, deposit in India for 1 month, the relevant rate will be 5% into 1 by 12. If someone wants to deposit in USA for 3 months, the relevant rate will be 4% into 3 by 12. If someone wants to borrow in USA for 1 month, the relevant rate will be 8% into 1 by 12 and so on. I hope you understand how to read these rates. Okay, let's go ahead now. Calculate whether it is possible for SKMC to achieve a cost directly associated with this transaction of no more than 21 crore. So basically they are saying check whether any hedging tool ensures that your rupee outflow is below rupees 21 crore by means of forward market hedge. I am very sure you know this. Money market hedge, this also you know, or leading students I will teach you, don't worry, which is available at 3%. What is this? I will tell you. Okay, don't worry. Transaction costs may be ignored. We anyways ignore, correct? Let us start. So tell me, students, what is happening in this question? We are Indian importers. We have purchased goods worth $50,50,000, which we have to pay in 3 months time. We want to therefore hedge this future purchase of dollar. For hedging, there are 3 options available: forward market, money market or leading. Students, whichever option ends up in lowest rupee outflow, I'll go for that. But if the lowest rupee outflow is also about 21 crore, then all the 3 hedging tools will be rejected because we want to ensure that our rupee outflow doesn't exceed 21 crore. So can we start evaluating the 3 options? So first of all, students, I will knock off the forward market because that is something we have done so many questions on, correct? Forward market, let's start. So I'll write down now here evaluation of hedging tools. Okay, evaluation of hedging tools. First is the forward cover. Students, we want to buy how many dollars? We want to buy $50,50,000 3 months time. Students, if you see the rates available today, the 3 month forward, right? 1 month forward is of no use because we have to pay the money in 3 months time. So 3 months forward, students, tell me, you will go for bid rate or ask rate? Obviously ask rate because we want to buy dollars 3 months forward. We are an importer here, right? Bank will therefore sell dollar. Bank will sell dollar at the ask rate of dollar in terms of rupees. 3 month forward, that is $1 equal to rupees 42.5, correct? So I'll write down here 3 month forward rate is $1 equal to rupees 42.5. Therefore, for purchase of $50,50,000, the total rupee outflow will be, let's take the calci, 50,50,000 into 42.5. If we do, we get rupees 21 crore 46 lakh 25,000, and the forward cover stands rejected because the rupee outflow is crossing 21 crores. I hope you understood. Great. Point number 2. Forward cover is out of the race now. Let us check what happens in the money market hedging. Can we start, students? These rates are available to us. Can we start? Alright. So in MMH, tell me what is step 1? Identify. Students, what to identify? We have a foreign currency payable, right? We have a foreign currency payable of $50.5 lakh in 3 months time. So therefore students, tell me, step 2 will be what? Step 2 obviously will be to create what, students? Create a foreign currency receivable. Okay, create a foreign currency receivable of 50.5 lakh dollars in 3 months time. Okay, create a foreign currency receivable of 50.5 lakh dollars in 3 months time. So to get a foreign currency receivable of this amount today, I'll have to obviously invest in dollars, right? So step 3 will be invest present value of 50.5 lakh dollars in USA today. Now students, which rate will be relevant in USA? Deposit rate for 3 months. I hope you understand, we are depositing in USA for 3 months. Therefore the relevant rate will be the deposit rate of USA, that is 4% per annum for a 3-month scale, correct? So therefore the rate will be 4% into 3 by 12. I hope you understood. 4% into 3 by 12. 4 into 3 divided by 12, if we do, we get 1%, which means for a 3-month period, the effective deposit rate in USA is 1%. If we want 50.5 lakh dollars after 3 months time, today we will have to invest 50 lakh 50,000 divided by 1.01, correct? So that will give me dollars. Let's take the calci. 50 lakh 50,000 divided by 1.01 will give me dollar 50 lakh. So 50 lakh dollar is what I have to invest in USA today, so that it will grow to 50.5 lakhs in 3 months time. Now tell me students, step 4, what will I do? Students, we will need these dollars today. So let us calculate how much rupees, home currency, is required for purchasing these dollars. So I will write convert dollar to rupee. Actually, you're converting your existing rupee to dollar, but because the amount right now we have in dollars, I want to know the equivalent rupees at today's spot. So students, the spot rate given to you is $1 equal to rupees. Yes, the spot rate given to you is $1 equal to rupees 40.35, 40.65. So I'll write down here 40.35, 40.65. Yes. Now students, now that we have the spot rate, tell me what you want to do. You want to convert dollar to rupees, but basically you want to buy these dollars, right? Convert dollar to rupees, students, obviously that is a mathematical language I'm using here. In reality, you are converting the rupee to dollar, correct? Because you will be having rupees, you want to buy dollars. Students, to buy 50 lakh dollars, you will buy dollar spot, bank will sell dollar spot. The relevant rate will be ask rate of dollar in terms of rupees, that is $1 equal to rupees 40.65. Yes, $1 equal to rupees 40.65. So therefore students, for purchase of 50 lakh dollars today, we will have to pay the ask rate of dollar today spot. Let's see how much rupees is required today. So it is 50 lakh into 40.65. We will get rupees 20 crore 32 lakh 50,000. What is this amount, students? This is the amount in rupees you will require today to purchase 50 lakh dollar today, so that today you can take that 50 lakh dollars and deposit in USA at the rate 1% for a 3-month effective period, so that it can grow to 50 lakh 50,000 dollar receivable in 3 months time, so that I can take that and knock off my 50.5 lakh dollars payable in 3 months time. But students, as you all have seen, these rupees that are required to purchase the 50 lakh dollars, I'm going to assume that I don't have, and I'll borrow it today. So students, if I'm borrowing it today, my next step, that is step number 5, my step 5 will be borrow. Okay, rupees this. We have to borrow these rupees in India. Yes, and what will be the rate, students, here? The rate obviously will be 3 months India borrowing rate, that is 13%, correct? So I'll write down here at the rate 13% into 3 by 12. If we take the calci, 13 into 3 divided by 12 will give me 3.25% effective interest rate for a 3-month period. Students, therefore, if these rupees are borrowed at this rate, it will grow to some rupee at the end of 3rd month. So therefore, students, what will be the maturity value of that loan? The maturity value of that loan will be 20 crore 32 lakh 50,000 plus 3.25%, that will grow to rupees 20 crore 98 lakh 55,625. This is your final rupee outflow at the end of 3rd month. And obviously the dollar receivable and payable will get set off against each other. Yes, you had invested present value of $50,000, which must have grown to $50.5 lakh dollars at the end of third month. This receivable of 50.5 lakh, I will knock off my payable of 50.5 lakh dollars. Yes, and with that my dollar tension, stress, exchange rate fluctuation risk is all gone. End of the day, today only I know that my rupee outflow is going to be 20 crore 98 lakh 55,625, and yes, this is below 21 crore. So between the forward cover and money market hedging, obviously money market hedging is the better option. Yes, but there is another option here, that is the third option, that is leading. Okay, now what is going to happen in leading? Students, leading means what? I'll tell you. See, what will happen is I have to pay $50,50,000 to the US supplier after 3 months. Okay, I'll write down here, dollar payable after 3 months will be $50,50,000. Okay, $50,50,000. Payable after how many months? After 3 months. Students, these dollars, if I tell my US supplier, why you are waiting for 3 months? I will pay today only. You want the money today? Take it today. So the American becomes happy. He says, you will pay today. I'll say, of course, but discount you have to give. You have to give me discount because I was supposed to pay 50.5 lakhs after 3 months, dollars. I am ready to pay today, so give me discount. That American becomes happy and says, no problem. Take a discount of 3%. Take a discount of 3%, which means leading means paying early. Lagging means paying late. Leading means paying early, means paying today only. So therefore, do you realize that under leading, the dollar payable today, okay, will be straight away $50,50,000 minus 3%. 50,50,000 minus 3%. If we do, the dollar payable will be 48,98,500. Students, therefore, to pay off my American supplier, these many dollars will be required today. Today, students, how many rupees will be required for purchasing these dollars? $1 equal to rupees, obviously the ask rate, right? Ask rate of rupees, because you will buy dollars, bank will sell dollars. Ask rate of dollar will be relevant at today's spot, and that, students, if you remember, was nothing but 40.65. Yes, rupees 40.65 per dollar is the ask rate. So therefore, for purchasing these many dollars, $1 equal to rupees 40.65 is the ask rate. Here also you can see in the question this rate here, 40.65 rupees per dollar. Therefore, total payment today in rupees for purchasing these dollars will be 48,98,500 into 40.65. If we do, so 48,98,500 into 40.65. If we do, we will get rupees 19 crore 91 lakh 24,025. Students, what are these rupees standing for? These are the rupees you will need today to purchase $48,98,500 today, so that you can pay off a supplier today only at a 3% discount. But now I will assume that these rupees I don't have today, and therefore I will borrow this for a period of 3 months. I will borrow this for a period of 3 months, so that therefore the rupee outflow after 3 months I will achieve in this particular case, and then I can compare with the money market hedging, because in money market hedging, see, forward cover is anyways out of the race. It is now money market hedging versus leading. Both rupee outflow you have to compare after 3 months, right? In the money market hedging, already the rupee outflow is after 3 months. In leading, this rupee outflow is happening today. To convert it to after 3 months rupee outflow, what will I do? I will borrow. Similar borrowing you did in money market also, right? Where we assume that we borrow that rupee requirement today for a period of 3 months. So here obviously when we borrow, the relevant rate will be Indian borrowing rate 3 months, that is nothing but 13%. Same rate, correct? Indian borrowing rate 3 months is 13% per annum, which is nothing but, if you remember, 3.25% effective for 3 months. So therefore, if I borrow this amount at 3.25%, I add 3.25% to this, okay, will give me a total maturity value of rupees 20 crore 55 lakh 95,556. Okay, 20, 55, 95, 556 is your total rupee outflow at the end of third month, and you know this today only, so there is complete certainty. Now tell me, between money market and leading, which one is cheaper? Students, money market hedging will end up at 20.98 crores, but as far as leading is concerned, it is 20.55 crores only. Therefore, we will go for the leading option, since it is not only below 21 crores but also the cheapest amongst the three. Yes, so students, with this we complete your question number 66. I hope you understood this question. Okay students, so I hope you all saw money market hedging both from exporter as well as importer. One question I gave you for exporter, one for importer. Now students, one concept which is there here is interest rate parity theorem. It is called as IRPT. So in this, what happens is, they will give you the interest rates of home and foreign. They will give you the spot rate, and using this you have to find the forward rate according to IRPT. So let's say that the risk-free interest rate in India is 10%. Let's say the risk-free interest rate in foreign USA is 6%. And let's say the spot rate is $1 is equal to rupees 80. Okay, $1 equal to rupees 80. So then the question is, what is the theoretical 1 year forward rate? Okay, what is the theoretical 1 year forward rate? So students, in this there is a simple formula: 1 plus RH upon 1 plus RF is equal to F by S. Faculty to faculty, these formulas change in style, but end of the day it is the same formula only. So here, can I say home interest rate is 10%, foreign interest rate is 6%, spot rate is 80. So if today the spot rate is 80, the interest rate in India and USA is 10% and 6%, then theoretically what should be the 1 year forward rate? The 1 year forward rate should be 1.1 into 80 divided by 1.06, correct? If you solve this, this is 1.1 into 80 divided by 1.06. This will come to 83.0189. So students, do you realize $1 equal to rupees 83.1 or 0189 is the theoretical forward rate as per interest rate parity theorem. Similarly students, instead of interest rate, they can also give you purchasing power parity theorem. That depends not on interest rate, but that depends on the inflation rate. So students, the formula is same, just that instead of interest rates one should take inflation rates, and that gives you purchasing power parity theorem. Everything else remains same. So this is as far as IRPT and PPPT is concerned. One thing is there, please remember that in IRPT, not in PPPT, but in IRPT, now let's say according to IRPT the forward rate came to 83.0189. Now students, what if, okay, what if the actual forward rate, okay, actual forward rate is $1 equal to rupees 85. See, this forward rate was a theoretical forward rate, but in reality the actual forward rate could differ from the theoretical forward rate as per IRPT. Students, in such a case what to do? Then do you realize if the actual forward rate is different from the theoretical forward rate, then there is an arbitrage opportunity to generate risk-free profit. Yes, questions do come on calculation of arbitrage profit. Arbitrage gain will happen only in what case? Only in case that your actual forward rate quoted by the bank is not matching with the theoretical forward rate as per IRPT. And students, for that, let us see if we have a question here. Okay, let us check, for example, question number maybe 82 is there, 83 is also there. Yeah, 84. So this is a very famous examination question, question number 84. So what I will do is I'll just give you the solution, the video of this particular question. Go through this, see how I'm calculating arbitrage under IRPT, and once that is done students, then in this particular chapter only one concept more is left, that is nostro-vostro question. So students, nostro-vostro question. Now what is nostro? What happens is, if let's say there is SBI, okay, that is State Bank of India, it wants to open $1 account with an American bank. because what will happen is there will be so many Indian customers who would come and give checks in dollars to SBI. Now SBI doesn't have the right to clear checks in dollars, they can clear checks only in rupee denominations. But if checks come in dollar, then what can SBI do? Can I say SBI will have to open one account in, let's say, Bank of America, dollar account, and all the checks that they are receiving in dollars from Indian customers, they can deposit and clear it in Bank of America. Such an account is called as Nostro by SBI. That same account is called as Vostro by Bank of America. Similarly, students, there could be many American citizens or people in America who would come with rupee checks and give to Bank of America, but Bank of America cannot clear rupee checks. So similarly, Bank of America will have to open a rupee account with SBI. Such a rupee account will be called as Nostro by Bank of America. It will be called as Vostro by SBI. Students, as far as Nostro Vostro is concerned, there is a typical question that ICAI asks. I will show that question to you. You can see this question number 88. This question, students, ICAI asks. I would want you to go through the two solutions now, one for this and one for question number 84. 84th question is for arbitrage under IRPT, how to solve, and 88th is on Nostro and Vostro. Students, in this 88th kind of question, there are two accounts that you need to create, or two statements. One is called as cash position and one is called as exchange position. Students, cash position is basically your bank passbook. Okay, bank passbook means debit and credit position. So whenever the money goes out of that particular bank, the bank account will be debited. Whenever the money comes in the bank account will be credited. That is cash position. But exchange position, students, exchange position is on an accrual basis, I might say, meaning basically that one does not record in an exchange position only when the money is credited or debited, but even if you agree to pay or receive money in that exchange position, we will be recording it. For example, today I enter into a contract, let's say a forward contract. Okay, I enter into a forward contract to buy dollars. So students, do you realize, just as in cash position there is debit credit, in exchange position there is buy and sell. So if I enter into a forward contract to buy dollars, let's say 3 months forward, since today only I have agreed to buy dollars, in the exchange position, in the buy, I will record it. But it will not come in the credit position, or it will not get credited in my passbook or in the cash position, because this money will come to me after 3 months, right? So after 3 months, when the dollar actually comes to me, do you realize that will be then recorded in the credit position, correct, in the passbook, that is the cash position. So please understand that when you agree to buy or sell, correct, it is at that time that you record in the exchange position, and when the cash is actually realized, either inflow or outflow, it is then that you record in the cash position, right? So exchange position is where you put the buy or sell entry immediately when you agree. Like for example, you received a check of worth $1 lakh. You have not yet cleared it or deposited it, you have received it. Students, the moment you received it, you will show it in the exchange position, but when the check gets cleared, you will show it in the cash position. Everybody clear? So on that, there is this question which comes in the exam. I will give you a detailed video on this. Please watch it. And I guess with that, we are done with the revision of the chapter of Forex. So there are two videos that I want you to watch. One is on arbitrage under IRPT and one is this Nostro account calculation. And once that is done, then we go to the next chapter, that is derivatives. Thank you so much. Please watch the video. Let us now start question 84. Look at this. It is there in the old PM. May 2006 it came for 8 marks. November 2010 it came for 8 marks. May 16 it came for 8 marks. New May 18 it came for 8 marks. Students, very famous question this is. I request everyone to pause the video and read the question carefully. Start. Okay students, I hope you all read this question. Let us now try solving it. Given the following information, exchange rates, spot Canadian dollar 0.665 per DM. That means 1 DM is equal to Canadian dollar 0.665, correct? Students, that means Canadian dollar is in the price. This must be the direct quote for Canada, and therefore Canada becomes home for IRPT. Yes, Canadian dollar 0.670 per DM 3 months forward, that is 1 DM is equal to Canadian dollar 0.670. This becomes your 3-month forward. Okay. Interest rates. Students, DM interest rate is 7% per annum. Do you realize Canadian dollar 9% per annum? This becomes your RH, and therefore this becomes your RF. What operations would be carried out to take the possible arbitrage gains? What operations would be carried out to take the possible arbitrage gains? Students, tell me what you will do. Your first step, students, is to find out the theoretical forward rate. Then compare that theoretical forward rate with the actual forward rate. If it is different, then we understand that there is an arbitrage opportunity. To understand what should be the strategy, borrow in Canada and invest in DM, or borrow in DM and invest in Canada. For that, students, we'll have to calculate. Remember the procedure I told you to identify the strategy is to, come on, tell me, is to calculate the theoretical RHS, and that theoretical RH I'll compare with the actual RH and then take a call where to borrow and where to invest. Yes. So students, let's start question number 84. First step is calculation of theoretical forward rate. Okay, calculation of theoretical forward rate. Students, we're talking of a 3-month forward rate. So I'll write down here 3 months. Tell me what is spot rate. Spot rate is 1 DM equal to Canadian dollar 0.665. So I'll write down here 1 DM equal to Canadian dollar 0.665, and of course the 3 months forward rate will be 1 DM equal to Canadian dollar given to you 0.670. 0.670. This is the actual forward rate. I have to compare this with the theoretical forward rate. Students, RH how much? RH is 9% per annum. How did you define that this is RH for you? Students, do you understand that since, I'm again repeating, Canadian dollar is in the price, therefore this is a direct quote for Canada, therefore Canadian dollar interest rate will be called as RH. Till here everything is understood. So RH is 9%, RF therefore is 7% per annum. 9% into 3 by 12, correct? 9% into 3 by 12. 9 into 3 divided by 12 will give me 2.25%. Yes, 2.25%. And your RF, students, will be, RF, if you remember, is 7% per annum. So it will be 7% into 3 by 12. If you take the calci, 7 into 3 divided by 12 will give me 1.75%. Yes, 1.75% becomes your RF. Students, can we find the theoretical forward rate? What is the formula? 1 plus RH upon 1 plus RF is equal to F upon S0, correct? Let's take the numbers now. RH, students, tell me RH is how much? 2.25%. So I'll write down 1.0225 upon RF is 1.75%. So 1.0175, I hope you understand, is equal to F upon S0. Students, your spot here is 0.665. So I'll write down here 0.665. Let us calculate the 3-month theoretical forward rate. My 3-month theoretical forward rate will be, okay, 1 DM equal to Canadian dollar, 1 DM equal to Canadian dollar. Let's take the calci. 1.0225 divided by 1.0175 into 0.665 will give me 0.668, correct? 0.668, but the actual forward rate is 0.670. Since the theoretical and actual differ slightly, there is an arbitrage opportunity, correct? Now to identify the arbitrage opportunity, what steps did I tell you? First of all, calculate the theoretical RH that would justify the actual forward. Yes, so 1 plus RH upon 1 plus RF is equal to F by S0. What are we calculating? Calculation of theoretical RH that would justify the actual forward. Students, your actual forward given to you is 0.670 and the spot is 0.665. So I'll write down here in forward, I'll write down 0.670 by 0.665. Students, I hope you have seen the video where in that theory video of covered interest arbitrage, everything I have explained in detail. Okay, so your 1 plus RH upon, students, your RF I'll take actual only. Your RF will be 1.75%, which means I will take it as 1.0175. Are you understanding? Therefore, 1 plus RH is equal to 0.67 divided by 0.665 into 1.0175, correct? That will give me 1.02515. Therefore, RH is equal to 0.02515. That is, students, it is nothing but 2.515%. Students, 2.515%, I hope you understand, is the theoretical RH for a 3-month period. Therefore, for a 12-month period, it will be how much? It is 2.515 into 12 divided by 3, which will give me 10.06%, okay? 10.06% per annum. So what is 10.06% per annum, students? To justify this actual forward of 0.670, your RH should be equal to 10.06% per annum. But in reality, your RH is 9% per annum, which means your actual RH is cheaper than what it should have been. Your actual RH is cheaper than what it should have been. Therefore, since, I'll write down here, since actual RH is less than theoretical RH, which means actual RH is less than what the RH should have been for justifying the forward rate of 0.670, tell me our strategy for arbitrage. Tell me, at RH you want to borrow or you want to invest? Of course we want to borrow because RH is available cheaper. So for arbitrage, our strategy will be borrow at home. Okay, borrow at home. That is Canadian dollars you borrow and invest in foreign. That is invest in DM, correct? Borrow in Canadian dollars, invest in DM. Students, to start, let us say we play with 1000 Canadian dollars, okay? So your step 1 obviously will be to borrow Canadian dollars, then you convert Canadian dollars to DM at spot, take that DM in step 3 and invest in DM for a period of 3 months. Then take a forward cover today only to convert the maturity value of the DM investment back to Canadian dollars. These all steps you will do today. Then on due date, what you will do, students? On due date, step number 5, you will realize the DM investment maturity value. Step 6, convert that DM to Canadian dollars under the forward cover you've already taken. Then in step 7, repay the Canadian dollar loan, which must have grown to something by then, and then compare step 6 and step 7, where you get Canadian dollars from the forward cover versus the Canadian dollar you have to pay to repay the borrowing. You will get the arbitrage gain. That is what they've asked in this question. They're asking you what operations would be carried out to take out the possible arbitrage gains. Students, the steps of arbitrage, I am giving it to you as a test now. I would request everyone to immediately pause the video now and start doing the test. Start by borrowing 1000 Canadian dollars and reach at the end. You will have a Canadian dollar surplus at the end, a gain, an arbitrage gain. Calculate that gain and only then play the video. Start. Okay students, I hope your answers are ready with you. I will now flash the solution of the entire question. You can copy down the initial part of the notes and then check your answers with mine for the arbitrage strategy. Yes. So let us now start question number 88. Students, this question I've picked up from the old PM. It came in November 2005 for 7 marks. New November 18 paper, it came for 8 marks. Students, I would request everyone to please pause the video and read the question carefully. Start. Okay students, I hope you all read the question. Let me explain this to you. Students, this is a typical Nostro account question that will come in the exam. In the next video, I have kept one more question, again from the ICI material, but very similar. That will be a test. So you have to be very attentive when I am solving question number 88. Can we start? Okay. You as a dealer in foreign exchange have the following position in Swiss francs on 31st October 2009. So you basically have a Swiss franc Nostro account somewhere in some bank of Switzerland. Let us see what is happening. They are saying balance in the Nostro account credit is 1 lakh. Children, tell me, this is Nostro account balance. This is a balance of exchange position or cash position? Obviously cash position, because cash position is the normal account, correct? So what I will do is, question 88, I have drawn here the exchange position, particulars buy and sell, and then I have also drawn the cash position, particulars debit and credit. Students, opening balance, okay, opening balance is how many Swiss francs? 1 lakh Swiss francs. So I'll write down here only 1 lakh Swiss francs. Everybody following? And I hope you understand how bank accounts operate, right? This is a credit balance, right? Students, why is it a credit balance? Students, basic 11th standard understanding that you understand that your account is like a personal account to the bank in which your account is. Let's say there is some Bank of Switzerland. In that this Nostro account is there. Students, if your 1 lakh is there in that bank account, then for Bank of Switzerland, you are a creditor, right? For Bank of Switzerland, they have to give you your 1 lakh rupees back. Therefore, bank accounts have credit balances. I hope you understand, okay? So let us go ahead. So now they are saying point number 2. Opening position overbought 50,000. What does this mean? They are saying that closing of last year, today becomes opening. They are saying as of last date, last year, we have agreed to buy more than what we agreed to sell by 50,000. Okay, so overbought position means what? In the exchange position, we have bought more than we sold. In a sense, we agreed to buy more than we agreed to sell. Therefore, students, 50,000 overbought opening. I will write down here opening overbought. Okay, 50,000 Swiss francs. Everybody following? Let's now go ahead. They are saying purchased a bill on Zurich 80,000. That means, so they are saying that we as a bank purchased a bill on Zurich. Students, bill in a sense, see it as a check. We received a check of how much? 80,000, but we have not yet presented for payment. So will this 80,000 get cleared in my cash position as of now? No. But will I show it in my exchange position? Yes. In buy or sell? Obviously buy, because we are getting Swiss francs here. Everybody following? So I'll write down in the exchange position, bill on Zurich, right? Purchased a bill on Zurich 80,000. So I'll write here purchased a bill on Zurich 80,000 will go in. Buy, it will not impact my cash position as of now. Everybody following? Let us go ahead. They're saying sold forward TT 60,000. What does that mean? That means I as a bank entered into a forward contract to sell 60,000 Swiss francs. Tell me, will it impact my cash balance today? No. Cash position will not get impacted. Will it impact my exchange position today? Of course, yes. I have agreed to sell today, correct? How much have I agreed to sell today? 60,000 Swiss francs. It will go in my sell position here. I'll write down sold forward TT 60,000 sell. Everybody there? Okay. Next, they are saying forward purchase contract cancelled 30,000. Now this is tricky. Students, forward purchase contract cancelled means what? It means that I had entered into a purchase, a forward purchase contract someday in past. So in the past, I had agreed to purchase Swiss franc in future, but today that forward contract I am cancelling. That forward purchase contract I am cancelling. Students, tell me one thing. In the past, when I must have entered into a forward purchase contract, where I must have put that entry in? Cash position or exchange position? Obviously only in exchange position, because I had only agreed to purchase in future. So do you realize in my exchange position, in the buy, I must have recorded this 30,000 as the forward purchase, and it must definitely be there in my opening balance, correct? Students, today I am saying I am cancelling that purchase contract. Do you realize I'll have to take an opposite stand, and in my books of accounts I'll have to reverse it. Students, where will the reversal happen? Will it happen in the cash balance, cash position, or the exchange position? Obviously in the exchange position, because the original entry was passed in the exchange position only. There only we have to rectify it, correct? So therefore, if my forward purchase was recorded in the buy of the exchange position, to cancel it now, today I will record it in the sell of the exchange position. I hope you understand. So I'll write down here forward contract cancelled. Okay, forward contract cancelled 30,000 in the sell position. It will not impact my cash balance. Everybody following till here? Next they are saying remitted by TT 75,000. What does this mean? Students, TT means telegraphic transfer. I told you in the previous video. Telegraphic transfer, you can also in today's modern mechanism understand it to be electronic transfer. So therefore today electronically you transferred 75,000, brand new fresh spot transaction, cash transaction. Do you realize this will impact not only my exchange position but also my cash position? Students, one thing understand, had they said that the remittance of Swiss franc by TT is under some forward contract we had entered into earlier, then students, do you realize today only the cash position will get impacted, because the exchange position already we have taken an entry the day we must have taken the forward contract. But here, since they are not mentioning anything like that, it appears to be a brand new spot transaction on cash. Therefore it not only impacts my exchange position. Why will it impact my exchange position? Because today I am agreeing to sell, right? Remitted means sell. Today I am agreeing to sell Swiss francs. So today only I am agreeing, so today only in the exchange position it will get impacted. And because actually Swiss francs also I am giving to somebody by electronic transfer, by telegraphic transfer, do you understand that it will also impact my cash position? 75,000 remitted by TT. I'll write down here, remitted by TT 75,000, correct? 75,000 sell, and in the cash position it will be remitted by TT. Tell me, credit or debit? Is your bank account of Swiss francs getting credited or debited? Obviously debited. I'll write down here 75,000. Everybody follow till here. Let's now read ahead. They're saying draft on Zurich cancelled 30,000. Students, draft on Zurich cancelled means we must have issued some demand draft. Okay, that means we must have agreed to sell 30,000 Swiss francs someday in the past. But before that other party could actually present the draft, before the draft could actually mature, we cancelled it. Okay, we cancelled it. Students, if the draft on Zurich is cancelled, the day we must have issued the draft, what do you think? Exchange position or cash position must have been impacted? Obviously exchange position only must have been impacted the day we issued the draft. So in the exchange position we must have already recorded a sell entry, correct? But today, before the cash position could get affected, today we only cancelled that draft. So therefore, do you realize the exchange position sell that you have already recorded has to be reversed now? So therefore this will come in the exchange position, where in the buy, correct? So therefore I will write here in the exchange position, draft on Zurich cancelled. Okay, draft on Zurich cancelled. I'll put it in the buy 30,000. I'll put it in the buy 30,000. Yes, why we are writing in the buy, students? One more time, when we must have issued the draft, exchange position sell, we must have put the entry, correct? Now when we are cancelling that draft, do you realize we have to rectify that error? We will have to now reverse the position, take an opposite stand in my exchange position, so that the original sell in the exchange position is now eliminated by putting it in buy. Till here you understood why is it not impacting my cash balance? Because the Swiss francs never even went out of my bank account, correct? Because the draft, before it could be presented for payment by the other party, I am cancelling it. Everybody following? Some of you might feel that, sir, it could be something like this, right? That the draft that we are going to receive, that we cancelled. No, students, how can you cancel a draft that you will receive? You can only cancel a draft that you have issued. You cannot cancel a draft that you have received, correct? The draft that you have received can be cancelled by the person who has issued draft to you, correct? So when they say that you are cancelling a draft on Zurich, please understand it must be a draft that you have issued and now you are cancelling. Everybody following? Okay, let's go ahead. What steps would you take if you are required to maintain a credit balance of Swiss franc 30,000 in the Nostro account and keep overbought position on Swiss francs 10,000? Students, you know what they are saying? They are saying, okay, now close both the statements, but when you are closing, you have to ensure that Swiss francs 30,000 is there in the cash position and overbought 10,000 in the exchange position. Students, use your brains if any and tell me, which statement will you close first? Come on, think hard. Will you close the exchange position first or will you close the cash position first? Students, listen to me carefully. you will have to close the cash position first. Listen carefully, okay? To close the cash position and therefore have a desired balance of 30,000, do you realize you'll have to pass one last entry, correct? What last entry? Students, if your cash position at the end is more than 30,000, you will have to immediately sell some TT, correct? You'll have to sell some TT to bring it down to 30,000, correct? You will have to sell spot to bring it down to 30. On the other hand, let's say if your final cash balance is less than 30,000, then to bring it up to 30,000, you'll have to buy TT, correct? Buy Swiss franc at spot. Students, in these transactions, to close the cash position, whatever transaction you do to close the cash position, do you realize will impact the exchange position also? Do you realize it will impact the exchange position also? So therefore, if you close the exchange position first and then close the cash position, the entry, the transaction to close the cash position will again impact the exchange position, thereby disturbing the balance that you had set there. Therefore, students, first close the cash position. Let the exchange position get impacted. At least the cash position 30,000 is now fixed. Now go to the exchange position. In the exchange position, you are saying that you want to keep a 10,000 overbought. No problem. To balance that, students, what entry will you pass? You will not now pass an entry for cash transaction. You will pass an entry there for a forward transaction, because for a forward transaction, do you realize exchange position will get impacted, and it will get impacted exactly to the extent I want, so that its overbought is closing 10,000, but that entry will have no impact on the cash position because the Swiss franc is actually not entering or going out of my bank account. I hope you understood. So let us now close our statements. The first statement to close is the cash position, where we want a 30,000 Swiss franc as the credit closing balance. Can we start? Okay, so cash position first. So students, if you see in the cash position already 1 lakh minus 75,000, okay, 25,000 already the balance is there. I want to close it till where? I want to close it till 30,000, because they are mentioning in the question that we would want a credit balance of 30,000. Students, tell me, to bring it up from 25 to 30, I have to buy Swiss francs or sell Swiss francs. Obviously we have to buy Swiss francs, and that too at spot right now, immediate delivery, it has to enter my bank account, correct? So I'll write down here, buy TT, correct? Buy TT. How much balancing figure? 5,000. I will buy TT 5,000. Students, the moment I buy TT means I receive Swiss francs, and those Swiss francs are then deposited in my Nostro account. Obviously my Nostro account will get credited to the extent of those 5,000 Swiss francs, thereby taking the closing balance to the desired 30,000. Everybody following? But the moment you have passed this entry of buying TT 5,000, do you realize my exchange position will also get impacted? Because now we are not buying those Swiss francs under some original forward contract, but brand new buy it is, correct? So I'll write down here, buy TT 5,000. Okay, buy TT 5,000. Till here you understood? Now let's see in the exchange position, what is the situation? Students, if you see the total sell is 60,000, okay, 60,000 plus 30,000 plus 75,000. Total sell here is 1,65,000. Everybody following? On the other hand, the total buy is 50,000 plus 80,000 plus 30,000 plus 5,000, that is again 1,65,000 exact, which means as of now there is neither an overbought nor an oversold position, but they are saying you want a closing overbought position of 10,000. Students, to keep an overbought position closing, what I'll have to do? I'll have to agree today to buy Swiss francs 10,000 more. But students, if I agree today to buy 10,000 Swiss francs more, then again the cash balance will get impacted. No, then don't agree to buy today. Agree today to buy tomorrow, correct? Agree today to buy tomorrow means enter into a forward purchase, forward Swiss franc buy contract today, so that your bought position is also impacted, but cash position remains intact. So what I do is I buy forward. Everybody following? I buy forward TT. Yes, I buy forward TT to the extent of 10,000 Swiss francs. Therefore, my closing position, okay, overbought will be 10,000. Everybody following? Because originally my closing position was 0, neither overbought nor oversold. So therefore to close, if I buy TT forward, 10,000 will go in my buy position, thereby taking my closing position of the exchange position to 10,000 overbought, and it will not impact my cash position also, since my bank account, my Nostro account is not getting impacted. Okay, students, I hope you understood this question number 88. Since my bank account, my Nostro account is not getting impacted. Okay, students, I hope you understood this question number 88. Okay friends, so now we'll continue with the next chapter, that is derivatives. So I'll write here derivatives. Now within derivatives, broadly speaking, there are two parts. One is futures and one is options. So first of all, we will now focus on futures. Now students, to understand futures, please understand that in the spot market, that in the stock market, I might say, there are two segments. One is the cash market or the cash segment, and one is the derivative segment. Okay, the derivative market. The cash market is also called as spot market or delivery market. Now what happens is, let's say today is 1st of January. Okay, let's say today is 1st of Jan. Today you know that you have, let's say you already own Larsen and Toubro share. Okay, and you want to sell this share in maybe 3 months from here. Okay, you want to sell shares 3 months from here. But after 3 months, when you will go to actually sell the share, at what price you will be able to sell the share, can I say, that is unknown to you today. The share will be having some market price today. Let's say that is called as S0. Spot price today is 1000. At this price you are holding the share. But after 3 months, at what price you will be able to sell, that is something that is unknown to you, and that causes risk or stress to you. That is called as the stock market risk, uncertainty of future. So can I say, if you are already holding a share, that means if you are already long on a share, can I say the risk lies in the future selling of the share, because at what price you will be selling, you don't know. Also, if you have short sold a share today, if you are having a short position on a share today, then in future at what price you will be able to buy the share. So in future at what price you will be able to buy the share, that can I say will be unknown to you today, because if you are short today, then in future you'll have to buy back to close the position. If you are long today, in future you'll have to sell the share to close the position. So therefore students, at what price you will be able to sell or buy is unknown to you. To hedge this, we have the derivative market. So in derivative market, they give you one tool called as futures, using which you can hedge. So students, let's say on 1st of Jan itself, there is a 3-month futures, which we call as 3-month F0, trading at 1100. So students, there is a futures contract, 3 months futures contract trading at rupees 1100. Since your risk lies in the future selling of the share, what you should do is, to hedge yourselves today only, you should sell futures. Okay, you should sell futures at the rate 1100. And then let's see what to do on the due date. On the due date, by the way, I hope you realize this 1100 is your F0, futures price trading today. Then on due date, let's say that the share price touches 1300. Please know, in the corresponding derivative market, the futures price will also trade at 1300. On due date, both the spot price as well as the futures price will tally. Both of them have to be same. Okay. Now what is your job? How to do? Students, very simple. Your step 1 is sell the share in the spot market itself at S1. Okay. Sell the share in the spot market itself at S1, can I say, and you will pocket 1300. Step 2, you will have to close your futures position by taking an opposite stand. Close the futures position by taking an opposite stand. What does this mean? Your original position okay, your original position in futures, can I say, was to sell at the rate 1100, that is F0. Now to close, you'll have to take an opposite stand, that is buy at the rate 1300, that is F1. This 1300, okay. So can I say you sold at this price, you are closing at this price, and by that, can I say there is a sell at 1100, there is a buy at 1300, there is a loss of rupees 200 in the futures position. Can I say your overall net cash flow will be 1300 from the spot market minus 200 rupees loss in the derivative market. Can I say your overall net cash flow is 1100, which is, can I say, same as what you had decided today only, and that is how the hedging is completed. Right now you know that whatever price, let the spot price go anywhere, eventually your final cash flow will be F0 only, that is 1100, and that is how you are hedging yourself. Today only you know that your cash inflow on sale of shares will be 1100, that is F0. That is how you hedge using futures. Students, if you would have bought futures here, I hope you are realizing you will buy futures only if you have a short position here, because if you have a short position today in the spot market, that means tomorrow you have to go and buy shares. So to hedge your future buying of shares, today you will buy futures, and then if you have bought futures today, I hope you realize you will have to close the futures position by selling at F1, correct? Opposite stand. Today if it's buy at F0, to close you will sell at F1. That's it, okay? So now as far as futures are concerned, this was the introduction. Now there are certain terms and terminologies that you need to study, or I might say concepts that you need to study. One is theoretical valuation of futures, okay? Theoretical valuation of futures. Theoretical valuation of futures means today if the share price is 1000, then what should be the value of a 3-month futures contract? That is called as theoretical valuation. Students, as a generic rule, the theoretical value of futures is spot price plus cost of carry, okay, minus incomes or dividends if any. So I'll tell you, for a share, okay, for a share which is expected to provide no income in future, okay, let's say L&T share is there, it is not expected to provide any dividend in future, then students, the theoretical value of futures should be S0 into 1 plus R raised to n. Basic future value of S0 should be the futures price. Or students, if the question has told you that the rate of compounding is to be taken as continuous, then one should do S0 into E raised to Rn, where E stands for 2.71828, okay, E is 2.71828 raised to R into N. That is the theoretical value of a futures contract where the underlying asset, that is the share, is expected to provide no income. If the share is expected to provide income, okay, that means they are saying that in this coming 3 months L&T will give a dividend of whatever rupees, then students, the theoretical F0 will be S0 minus present value of income, the whole into 1 plus R raised to N or E raised to Rn. So S0 minus present value of income. First adjust the S0 by subtracting the present value of income. So if let's say the income is expected to come in 2 months, so you discount it for 2 months, get the present value, subtract it from S0 and then multiply by 1 plus R raised to N for compounding for 3 months if it's a 3 months futures contract, right? Students, you could also be asked to calculate the theoretical value of a futures for a commodity. Now let's say there is gold futures. Then students, if we are doing commodity futures, okay, if we are doing commodity futures, then in commodity what happens is there could be storage costs. I hope you realize that as far as commodities are concerned, there won't be any income from commodity. Gold will not give you any income, but there could be a storage cost of gold, wheat, corn, etc. So if you are considering storage cost, then the theoretical value of the futures contract would be S0 plus the present value of storage cost, the whole into 1 plus r raised to n or e raised to rn, correct? Present value of storage cost. Then students, as far as index futures are concerned, now what are index futures? So index futures is a futures contract on the Nifty or on the Sensex. Then in such case, we will write that theoretical value of a futures contract will be index, whatever is the value of the index today, into 1 plus r minus y raised to n or e raised to r minus y into n, where y stands for the yield or the dividend yield percentage expected from the index. So index of course would be in points and all these are percentages. So by this, can I say we will be able to find the theoretical value of an index future. Otherwise formulas are quite similar across. Now what I will do is, I will share with you one sum each on each one of these cases. Share providing no income, share providing income, then commodity with storage cost and index futures. Once you go through these sums, then majority of index futures, then majority of valuation of futures concepts are done, and then we'll go ahead as to what is to be done next. There are only two concepts left after that in futures, that is how to do cross hedging and second is how to alter portfolio beta. Both of that also we will discuss and then we'll go on to options. Okay, so first of all, watch these sums on these individual concepts. Let us now look at a question 4 on whatever we have studied till now in this particular module. Students, I request everyone to pause the video here and read this question very carefully. Okay students, I hope you all have read the question. Let us now start. I'm very sure you understand what to do. I'm very sure some of you have even tried the solution. Let me still do it. Students, everyone across the country, listen to me. This particular question I am doing. Next question, you know me, correct? It's a test, okay? So be very attentive in this question number 4. Ready? X Limited, a company that historically not paid any dividend and has no plans to do so in future. Typical question for our module, correct? Is currently quoting at the Bombay Stock Exchange at rupees 60. Students, rupees 60, do you understand this S0 here? You wish to enter into a futures contract on the stock maturing in 3 months time. A. If the risk-free rate of return is 8% continuously compounded, what do you expect the futures price to be? Students, one thing you should understand is that when we do arbitrage opportunity, etc., when we say that we are going to invest money somewhere, do you understand the investment rate has to be risk-free rate? You cannot take your money and invest in the stock market and say, oh, you know what, this money I invest today, this will grow to this much on due date. From this money, this has to be paid, etc. You cannot do that. You have to be sure that if you are investing your money somewhere, then confirm some maturity proceeds will be received, and to get a confirmed maturity proceeds, the investment has to be done at risk-free rate. Hence, they are talking of a risk-free rate of return here, okay? Students, so point number A basically is to calculate the theoretical value of a share where the compounding is going to happen continuous. Can we start? Okay, point number B we'll see later. Point number A, let us start. Question number 4, point number A, calculation of theoretical value of futures contract. Ready? Students, what is the formula? S0 into e raised to Rn. I hope you remember. What is S0 here? 60. So I'll write down 60 into e raised to, what is the R here? 8% and n, I am very sure you understand, is 3 by 12, correct? So I'll write down here into e raised to 0.08 into 3 by 12, correct? 0.08 is the interest rate and 3 by 12 is the n. Yes? So let's start. So it is 60 into e raised to, if I take the calci, 0.08 into 3 divided by 12 will give me 0.02. Yes, so now let's take the calci and knock it off one shot. I hope you understand it is 2.71828 raised to 0.02. So I take 2.71828 on calci and press the root 12 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 minus 1 into 0.02 plus 1 into equal to 12 times. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. That comes to 1.0202. That I'll multiply by 60, correct? I've already got 1.0202 here. I'll multiply by 60. I will get 61.2 612122. Okay, rupees 61.2122. Students, this can be rounded off to rupees 61.21, correct? So what is 61.21, students? 61.21 is the theoretical value of a 3 months futures contract if the S0 is 60, R is 8% and N is 3 by 12, correct? Now once you have got the theoretical value as 61.21, see what they are saying. If the futures contract were priced at rupees 64, what action would you take? In case it is priced at 61, will your decision change? Students, they are just asking you action. I hope you understand that at 64, considering the theoretical value to be 61.21, at 64, the futures are overvalued. The strategy will be what, children? It will obviously be buy spot and sell futures. I'm very sure you all are shouting right now, sir, first of all say sell futures and buy spot. Yes, you are right. Sell futures because it is overvalued and therefore take an opposite stand in spot, buy spot, correct? And if the futures are trading at only 61 rupees, that is 0.21 less than what it should be, undervalued, tell me what is the strategy? Buy futures and sell spot. Till here you understood. So what I will do is I'll quickly calculate the arbitrage gain for both cases and then we'll complete this question. I'll show you the solution, right? So let us start question number 4, point number B. Okay. I'll write down now point number B. Okay. Calculation of arbitrage gains. Okay. I will just show it in rough here. Eventually final output, final solution, how to present, I'm anyways going to show it to you on the screens. Quickly tell me the numbers. Okay, there are two cases now. Actual value of futures is 64 and the other case is actual value of futures is 61. Till your story is clear? Okay, come on, tell me what is the strategy here. The strategy here will obviously be sell futures and buy spot. Here the strategy will be buy futures and short sell spot, correct? So step 1 today, okay, today the step 1 will be to sell futures at the rate 64. Here the step 1 would be to buy futures at the rate 61, correct? Step 2, students, step 2 here, because we want to buy the share at spot and the spot rate is 60, I'll write down here S0 is 60. I hope you understand that we'll have to borrow. Students, borrowing will happen at what rate? R is 8% and the N is 3 by 12. I hope you understand. So I'll write down here borrow rupees 60 at the rate 8% for 3 months, correct? And then step 3 will be with that borrowed money buy S0, correct? Buy the share at spot. On the other hand, here the step 2 will be to short sell the spot, correct? So I'll write short sell at the rate S0, that is obviously rupees 60, and step 3 will be therefore to invest that rupees 60 at the rate 8% for 3 months, correct? Story is clear till here. Now tell me on due date what will happen, students. On due date, this point number 4, the share that you have, you will go and sell it in the futures contract and receive rupees 64. So I'll write down sell share at the rate rupees 64 in the futures contract. Step 5, obviously this borrowing is there, students. You have to repay the borrowing. Repay the borrowing. That borrowing obviously must have grown to 61.21, right? This is it. The same formula I will use, correct, to find the compounded value of 60 rupees borrowed at the rate 8% for 3 months, exactly 61.21. So I'll write down here repay borrowing rupees 61.21. Therefore the arbitrage gain will be 64 minus 61.21, that is 2.79 confirmed gain, correct? So when you sell the share in the futures contract, you receive 64, you have to repay the borrowing which must have grown to 61.21. There is an arbitrage gain of 2.79. On the other hand, here on due date, students, do you realize the investment of rupees here must have grown at the rate 8% for 3 months, students, at rupees 60. Do you understand it must have grown to 61.21. So I'll write down point number 4. Maturity proceeds we will receive 61.21. Come on, tell me, students, step 5, what will you do? Step 5, obviously I will now buy the share, correct? This money I have now, I will buy the share under the futures contract at rupees 61. So I'll write down buy share at the rate 61 under the futures contract. Students, what should I do with this share? Should I sell it again? No, you can't. You have to give it back to the person from whom you borrowed. So that is no other cash flow specifically. So just point number 6 is repay share okay, to the lender. As far as rupees are concerned, do you realize you received 61.21? You are now paying only rupees 61 to buy the share in the futures contract. 0.21 is your arbitrage gain. Very simple question, students. Point number B, did you understand? Yes, my decision will obviously change. If it is 64, my strategy is to sell futures and buy spot. If it is 61, my strategy will be, students, obviously at 61, because it is undervalued, my strategy will be to buy futures and short sell spot. I even proved it to you. I showed you the gains also. I hope you understood question number 4. So welcome to your first question in this module, where the share underlying asset is expected to provide a known cash income. Students, let's do it together. Spot price of Infosys is 2000. This is your S0. Interest rate prevailing is 14%. This is your R. Expected dividend after 2 months is 10. This is your dividend. That is your I. Calculate what should be the expected price of Infosys today in the 3-month future contracts. Basically, your N year is not 2, it is 3 months, correct? That is 3 by 12 years. Students, can we start now? First things first, let us calculate the present value of that income. Students, present value of income, how do I do? Income is how much here? 10 rupees is the income, correct? This 10 rupees, when are you receiving? At the end of second month from now. So when I calculate the PV, the discounting obviously I will do for 2 months. Everyone understanding? So it will be 10 divided by 1 plus, correct? 1 plus R. Now the R here is 14% per annum. So it is 0.14. But since I want to discount only for a period of 2 months, I will do into 2 by 12. Everybody following? So now let me take the numbers. 10 divided by, students, 0.14 into 2 divided by 12 will give me 0.0233. So in the denominator will come 1.0233. Basically 14% per annum means 2.33% for 2 months. So for 2 months, if I am discounting, that 10 has to be discounted at the rate 2.33%, correct? And that will give me a present value of, let's take the KLC, 10 divided by 1.0233. It will give me 9.77. So 9.77 becomes the present value of your income. Students, now that I've got the PV, let us find the theoretical value of futures. I hope you understand that the dividend is not received on due date but before due date. So if you remember the step 3 formula I will use now, it is nothing but S0 minus present value of income, the whole into 1 plus R raised to N. Students, what is your S0 here? Your S0 is 2000, correct? 2000 minus present value of income, we have already calculated it to be 9.77 into 1 plus R raised to N. Students, your rate per annum is 14%. Your period is only 3 months. So I'll write down into 1 plus R means into 1 plus 0.14. 0.14 interest rate is for per annum, correct? So I want to compound it obviously for 3 months. Don't forget, don't mismatch. Don't take 3 instead of 2 year and 2 instead of 3 year, correct? Don't make those mistakes. So 3 months here, this is obviously the futures period, right? And this 2 months is obviously the dividend period. So let's do the calculation. This is 2000 minus 9.77, that is 1990.23, okay? Into, now this, students, is 0.14 into 3 divided by 12, okay? That is 0.035. That means 14% for 1 year means 3.5% for 3 months. Plus 1 if I do, it is nothing but 1.035. So I'll multiply by 1.035. So students, 1990.23 into 1.035 will give me 2059.89. 2059.89 becomes your theoretical value of the futures 3 months futures contract. Yes, thank you very much, students. With this we complete question number 8. I am very sure you also understand now how to apply this formula. Let us now do question number 11, your first question on investment commodities futures theoretical valuation. Let's read it together and knock it off. The current price of cotton is rupees 400 per bale. Bale is some unit of cotton. Basically for us S0 is 400. Storage cost is rupees 100 per bale per year, payable in arrears. Students, payable in arrears means on due date, last date you are paying, which means you don't need to calculate the present value of the storage cost and then compound it. Straight away add the storage cost. Remember step 2 in the previous video. Assuming that the R is 10% per annum, continuously compounded risk-free interest rate, students, E raised to Rn will come. Calculate the 1 year futures price per bale of cotton, and so sweetly they have given to us the e raised to 0.1 data also. Can you knock it off? I'll write down here TVF is equal to, students tell me, it will be S0 into e raised to Rn because it is a continuously compounded, and straight away I will add the storage cost to it because the storage cost here is assumed to be being paid at the end of the due date, correct? So let's put the numbers. S0 is 400 into e raised to, students, 0.1 into 1, that is nothing but 0.1, 10% compounded for 1 year, plus the storage cost, that is nothing but 100 per bale. Can we start? So this is 400 into, students, e raised to 0.1 is given to you as 1.1051, 1.1051 plus 100 if we do. So 400 into 1.1051 plus 100 will give me rupees 542.04. This becomes your theoretical value of this futures contract of question number 11. Yes, so with this we complete question number 11, students. Let us now do one question number 15 on this particular concept of index futures. Stock index currently stands at 3,500 points, I0, S0, correct? R is 8% and the dividend yield, that is Y, is 4% per annum. Calculate the 4-month index future if the continuously compounded risk-free rate of interest is 8%. They are mentioning very seriously CCRFI means continuously compounded, and very sweetly they are giving to us the E component also. Let's put the number, students. Theoretical value of futures is equal to, come on, I0 into e raised to R minus Y into N. Yes, what is our I0 here? 3,500 into e raised to, students, your R is 8%, so I'll write 0.08, your yield is 4%, I'll write 0.04, and the N, students, I hope you understand, is 4 months, so I'll write into 4 by 12, which is equal to 3,500 into 0.08 minus 0.04 into 4 divided by 12 will give you e raised to 0.0133, and exactly that is given to us as 1.014. So 3,500 into 1.014, if we take the calcis, 3,500 into 1.014 will give us 3,549. Yes, 3,549 becomes the theoretical value of futures, index futures, in question number 15. Okay, students, I hope you all saw those videos with which you got a grip on how to do valuation, theoretical valuation of futures contracts, and also arbitrage also you must have seen. Now, students, there are two concepts left as far as derivatives futures are concerned. One is called as cross hedging and the other is called as altering portfolio beta. Now, first of all, cross hedging. Now, what is the meaning of cross hedging? Students, let's say that you have a portfolio of shares, okay? You have a portfolio of shares which you are long on and you want to sell it after 3 months. Again, can I say you will be uncertain at what price you will be able to sell. So for hedging, you would want to do sell of futures, correct? Sell futures contracts. But the problem is you will not get exactly a portfolio of futures, right? Because futures could be on L&T share, futures could be on Tata Motors shares. You will not get a futures exactly on your portfolio. So in such a case, can I say we will have to go for some other futures contract whose underlying asset is not the same as your portfolio. So generally people do what? They go for index futures, okay? So index futures underlying asset is the index. So students, that is also one kind of a portfolio only. So what we will do is to hedge our share portfolio, we will go for index futures. We will sell index futures, or maybe if we are short in the cash market, then we will buy index futures. The point being, here the problem is, see, the ones which we saw just now, in that the asset you wanted to hedge was the same asset underlying in the futures contract. But now, since the futures contract is not available on the asset that you want to hedge, you want to go for some other futures contract whose underlying asset is something else, then that is called as cross hedging. Students, in cross hedging what happens is, on due date the S1 and F1 don't tally because the assets are different. The share price at the, or the portfolio value at the end of the particular period will not tally with the futures price at the end of the particular period because both are having different assets. In such a case, we use the concept of cross hedging, where we say that number of futures contracts, okay, number of futures contracts that one should go for is, now generally we would have gone for value of asset upon value of one futures contract, which means let's say that the value of your asset is, let's say, 10 lakh and value of one futures contract is 1 lakh. Can I say you would have gone for 10 such contracts, right? But now because it's a cross hedging, here we have to simply multiply by the beta of the portfolio that you want to hedge. Once you do that, your cross hedging is completed. So basically this is the formula that one should use in order to know how many number of contracts one needs to sell or buy in case you are doing cross hedging. Cross hedging means the asset that you want to hedge in the spot market is different from the underlying asset in the futures market, because you don't have only a futures contract on the asset that you want to hedge. In such a case, one should use this formula to know how many number of contracts one needs to buy. So students, on this I will show you one question here. Once you are done with that question, then there is one more concept called as altering portfolio beta. Now altering portfolio beta means right now your portfolio will have some beta. Let's say the beta of your portfolio is 2 times. Let's say the question tells you how many index futures contracts you should go for to completely hedge your portfolio. Then students, you should use this formula and get the answer. But the question can also ask you, okay, how many number of futures contracts you should go for if you want to reduce the beta from 2 to 1.5. That is called as altering portfolio beta. Now you are not going for complete hedging, you are just altering the beta. Students, for that what you will have to do is you will have to slightly change this formula where you do beta minus beta star or beta asterisk, where the beta is of course the current beta of the portfolio and beta asterisk is the desired beta that you want. Right now your beta is 2, you want it to alter to 1.5. So to alter it from 2 to 1.5, how many number of contracts of futures you need to go for? Then for that, students, this is the formula that one needs to follow. So that's it, students. So there are 2 formulas that I taught you right now. One is normal cross hedging. For that, the number of contracts you need is VA, that is value of the asset you want to hedge upon value of one futures contract. That's it. But if they ask you to alter the portfolio beta, okay, if they ask you to alter the portfolio beta, then students, you will have to do beta minus beta asterisk into VA by VF to find the number of futures contracts. So one sum on each I will now share with you. Please watch it. With that, we will be done with derivatives futures and then we will move on to derivatives options. Please watch the videos. So let us now start our questions on this beautiful concept of cross hedging. Students, question number 18 in front of your screens. I would request everyone to pause the video and read this question carefully, please. Okay students, I hope you all read it. Let us try to solve it, okay? Very interesting question. Consider the following data relating to KM stock. KM has a beta of 0.7 with Nifty futures, okay? Each Nifty contract is equal to 200 units multiplier. KM now quotes at 150. The share is quoting at 150. This is S0. Nifty futures is 1400 index points. This is what? Come on, this is your F0, correct? You are long on 1200 shares of KM in the spot market. You are long on 1200 shares means what? Means you have already bought. You already are holding 1200 shares of KM in the spot market. I am very sure before even reading the question ahead, tell me if you are long in the spot market to hedge, you will of course sell futures, correct? How many futures contracts will you have to take? Take means basically sell. Can we start? This 2 and 3 will do later. How many futures contracts you have to take? Let us put the data now first, students. Okay, so the data we have is S0. Students, S0, what is the share price in the market today? KM now quotes at 150. So my S0 therefore becomes rupees 150. What is my F0, children? My F0 is 1400 points and the multiplier is 200, correct? So I'll write down now here, it is 1400 points, okay, and the multiplier is 200 units. Everybody clear? Next, the beta given to you of KM with the futures is 0.7 times. I'll write down here the H, that is the beta, is 0.7 times. Everybody following? Okay, so one more thing is required, students. How many shares you're holding? I hope you remember you're holding 1200 shares. So I'll write down here 1200 shares is what we are playing with. Yes, you can see here 1200 shares. So now they are saying how many futures contracts you will have to take. Since we are having a long position in cash market, spot market, in the futures we will take a short position. We will sell. So I'll write down now here number of contracts. Okay, this is your point number 1. Number of contracts to be sold. Number of contracts to be sold. Obviously the formula is beta into VA upon VF. Correct? Students, the beta given to us is 0.7 into. Students, value of the asset you hold will obviously be 150 into 1200, total value of the portfolio today. So I'll write down it is 1200 shares into 150 divided by, now this is VA. Now what is VF? VF is the value of one contract, one futures contract. Do you realize the value of one futures contract will be 1400 points into 200 units, that is the multiplier. So I'll write down here 1400 into 200. Everybody following? So if I take the calci, students, 0.7 into 1200 into 150 divided by 1400 divided by 200 will give me 0.45. Okay, so basically the number of contracts I would go for to sell here in the futures will be 0.45 contracts. Students, please understand this is not an ICEI question. Here I am keeping it as 0.45. When we do ICEI questions, we'll of course round it off to the next decimal. Okay, right now I'm keeping it as 0.45 to prove something to you. Can I now go ahead? So basically now we have understood that if you want to hedge, the number of futures contracts you'll have to take is 0.45. Now let's go to point number 2. Suppose the price in the spot market drops by 10%, how are you protected? Let's start understanding. Suppose the price in the spot market drops by 10%, how are you protected? Students, point number 2. Okay, point number 2. Please be very attentive. Okay, your S0, yeah, your S0 is how much, students? Your S0 is 150. So I'll write down here S0 equal to rupees 150. Correct? Now they are saying that the expected spot is going to be dropping by 10%, correct? It's going to drop by 10%. So I'll write down expected S1 will be 150 minus 10%, that is rupees 135, correct? 135. Now they are saying how are you protected? Students, first of all, protected means what here? They are saying is your hedging proper or not here? Is your hedging proper or not? For that I have to find the final payoff, correct? In the final payoff, do you remember our formula is what? S1 plus F0 minus F1. Can I say we have the S1, we have the F0 already. Yes, this was your F0 here we already have. What we don't have is the F1. Where is the futures going to go to on the due date? That is F1. Students, let me tell you something like this. If the futures change by X%, okay, if the futures change by X%, spot here will change by 0.7x%. Okay, if the futures changes by X%, my spot will change by 0.7x%. Students, if my spot has changed by 10%, that means futures must have changed by how much? Are you understanding? I hope you understood. So therefore, for a X% change in futures, okay, for a X% change in futures, spot changes by 0.7x. So if the spot has changed by 10%, futures must have changed by how much? It is 10 into x divided by 0.7x, which is nothing but your x and x will get cancelled. It is 10 divided by 0.7, that is nothing but 14.29%. Okay, 14.29%. Your futures have changed by 14.29. What does that mean, students? See, I'll give you a simple example. If my futures have changed by 100%, okay, if my futures have changed by 100%, do you realize spot will change by 100 into 0.7, that is 70%, correct? Now if my spot is changing by 70%, when the futures change by 100%, we say that the beta is 0.7, correct? Now students, in the question if they say that you know what, the spot has changed by 70, the beta is 0.7, so how much must have changed? It is obviously 70% divided by 0.7. correct? That is 100%. Are you there? Similarly, here in this question, they are saying the spot has changed by 10%. The beta is 0.7. So how much the futures must have changed? Obviously, the change in spot divided by the beta will give you the change in the futures. I can also write it like this in a basic simple formula manner. Delta of futures into beta is the delta of spot, correct? How much futures change, how much the spot reacts to that will be the delta of spot, correct? We know the delta of spot is 10, we know the beta is 0.7, so what must be delta futures? Obviously 10 by 0.7, that is 14.29%, correct? So therefore students, if my spot has decreased by 10%, that means considering the beta of 0.7, my futures must have decreased by 14.29%. Round off, actual number is 14.285714 etc. I am rounding it off to 14.29%. Everybody follow till here. So therefore I'll write, therefore my expected F1 will be equal to something minus 14.29%. Something means basically your F0, correct? So your F0, if you remember, was 1400 points. So I'll write down here my expected F1 will be, yes, 1400 points minus 14.29%. I'll take the calci. 1400 minus 14.29% will give me 1200, correct? 1200 points. Rounded off, correct? So what is 1200 points? This is where the futures, the index futures, the nifty futures will be growing to, basically depreciating to in this case, on the due date, that is 1200. How did I understand it is going to go down till 1200 from 1400? Because I know that these futures are dropping by 14.29%. How do I know they are dropping by 14.29%? Because I know that the spot has dropped by 10%, and considering the reaction of 0.7 times beta, if the spot has dropped by 10%, the futures must have dropped by 14.29%, okay? Now let us calculate the final payoff, okay? Let us calculate the final payoff. I'll write down here calculation of final payoff. Students, we were long on this share, correct? So on due date, yes, on due date, we will sell the share in the spot market at S1. We had agreed to sell futures at F0. We will close it by buying at F1. Students, what is S1? Your S1 is 135 rupees per share, and you're holding, students, 1200 shares. So 1200 into 135 we will do in the S1. 1200 into 135 is your S1 plus, students, F0. How many contracts you have taken? 0.45 contracts, correct? 0.45 contracts you have taken, yes, of 200 units, and 1400 was the rate. So I'll write down here 0.45 contracts of 200 units of 1400 points, correct? That is the price there, minus I will buy back again 0.45 contracts of 200 units when the F1 is, students, 1200. Now before you pick up the calci, do you understand you're doing cross hedging here? Cross hedging means you'll end up at S0, correct? S0 means what, students? The value of your asset today, that is 1200 shares into the current market price, correct? 1200 shares into the current market price. Let's take that on calci first. 1200 into 150. My final answer, students, should be 1,80,000. Let us check. Final answer should be 1,80,000 of this final payoff. Can we start? So it is 1200 into 135 M plus 0.45 into 200 into 1400 M plus 0.45 into 200 into 1200 M minus MRC will exactly give you 1,80,000, correct? Students, I hope you understood what is happening with you here, okay? And with that we complete your point number 2. Then they are saying in point number 3, suppose the price in the spot market jumps up by 5%. What happens? What happens means how are you protected? Your S1 now is going to grow up by 5% compared to S0 in this case. So students, let's do the calculations again. My expected S1 will be now 150 plus 5%, correct? Your 150 was the spot rate, and now they are saying it is expected to jump up by 5%. Okay, so now my expected S1 will be 150 plus 5%. Let's take the calci. 150 plus 5%, if I do, it comes to 157.5. Okay, my expected S1 is 157.5. Also students, I hope you understand that my percentage increase in futures will be, because the spot is increasing, that means the futures must have increased as a reaction to which the spot increased, correct? The increase, percentage increase in futures must be, tell me how to do. Yes, you are right, 5% divided by the beta, that is 0.7. So 5 divided by 0.7, if I do, I get 7.14%, rounded off, correct? 7.14%. Students, my current F0, yes, if you remember, my current F0 was 1400 points. Yes, you can see it here. F0 was 1400 points. Now this is expected to go up by 7.14%. So I'll write down now here. F0 is 1400 points. Therefore, expected F1 will be 1400 plus 7.14%. So on the calci, 1400 plus 7.14%, if we do, I get 1500. Okay, 1500 rounded off, they are the points, correct? So my expected F1 is 1500 points. My expected S1 is 157.5. F0 obviously was 1400. Contracts you had taken was 0.45 contracts. I am very sure you also understand that my final payoff will be S0, that is 1,80,000. You want to check? So let's check my final. Okay, my final payoff will be obviously S1 plus F0 minus F1. Students, I had how many shares with me today? I already am owning 1200 shares, correct? So I will be selling 1200 shares at the rate now 157.5. So I'll write into 157.5 plus F0. Students should agree to sell 0.45 contracts of 200 units of 1400 points. Now you are buying it to close 0.45 contracts of 200 units into 1500 points now, correct? Because now the futures price have grown to 1500. Let's check the calci. I'm very sure you also know the answer is 1,80,000. Still as a formality and to check whether you have done right or wrong, we will do it, correct? I have of course done it right. In the exam, you should check whether you have done it right or not, okay? So 1200 into 157.5 M plus 0.45 into 200 into 1400 M plus 0.45 into 200 into 1500 M minus MRC will exactly give me 1,80,000. I am protected. Basically this hedge ratio of 0.7 times, and therefore the calculation of these 0.45 contracts did the magic. But I'm again repeating, this magic happened because the beta worked. The beta worked. Where did the beta work? Is that when the spot was changing by 5%, we had taken that the futures must have changed by 7.14 considering this beta, right? Had the futures not changed by this, or for that matter, had the spot not changed by this, do you realize the beta would have turned false and the hedge would have been inefficient? Yes. So for the hedge to be efficient, basically for the final payoff to be equal to S0 in a cross hedging, your beta has to work. And as I told you, for the beta to work, what has to be strong? Your correlation coefficient between the asset and the futures. Okay. So students, with this we end your question number 18. So let's now look at one more question on this concept of altering portfolio beta with index futures. Very interesting question, students. This is clubbing portfolio management as well as derivatives futures. Can we start? So I request everyone to kindly pause the video and read the question carefully. Start. Okay students, I hope you all read this question. Let us now try to understand it. I am very sure you have again recollected portfolio. Yes, a portfolio manager has the following 5 stocks in his portfolio: A, B, C, D and E. Number of shares given, price per share given, beta given. Compute portfolio beta. I'm very sure you remember portfolio beta is nothing but the weighted average beta, right? Weight of A into beta of A, weight of B into beta of B, and so on. And to calculate the weights, do you remember what we used to do? Number of shares into price per share will give you the investment values of each of these particular shares, and on the basis of those investment values you can create the weights, and once the weights are calculated, then multiply them by beta, you will get the weighted average beta, that is nothing but beta P, that is the portfolio beta. Students, let us complete point 1 first. 2, 3, 4 and 5 we'll see later. Okay, right now let us complete point number 1. Can we start? So question 31, I'll write down here point number 1, calculation of beta P. Okay, calculation of beta P. What is the formula of beta P? Beta P is equal to WA beta A plus WB beta B plus WC beta C plus WD beta D plus WE beta E. Correct? Let's put the table now in place. There is this security, that is A to E. So I'll write down here security. Then I'll write number of equity shares. Then I'll write the market price per share. I will write the value, or basically the investment value. I'll get the weights. I'll multiply by beta. So weights into beta, the total will be our portfolio beta, correct? So I'll write down A, B, C, D and E. Number of equity shares are 10,000, 5,000, 8,000. I'll write down here 10,000, 5,000, 8,000. Okay. Next three are 1,500. So I'll write down 1,500. Okay, everybody following? Let's now take the MPS students. 50, 20, 25. I'll write down here 50, 20, 25. Next students is 100 and 200. I'll write down here 100 and 200. Everybody clear? So now let's calculate the investment value, students. So on the calcs, 10,000 into 50 M plus, that will give me 5 lakhs. 5,000 into 20 M plus, that will give me 1 lakh. Next is 8,000 into 25 M plus, that will give me 2 lakhs. Next is 1,000 into 100 M plus, that will give me 1 lakh. And last is 500 into 200 M plus, that will again give me 1 lakh. And I do MRC, I get 10 lakhs. Everybody following? So now the weights are very simple because the final amount is 10 lakhs. This is 0.5, this is 0.1, this is 0.2, this is 0.1 and 0.1. Total is 1. Beta value, students, let's take the beta values from the question now. 1.2, 2.0, 0.7. 1.2, 2.0, 0.7. Next students is 1.0 and 1.3. I'll write down here 1.0 and 1.3, correct? Let us now calculate the weighted average beta, weights into beta. So on the calcs, 0.5 into 1.2 M plus, that is 0.6. 0.1 into 2 M plus, that is 0.2. 0.2 into 0.7 M plus, that is 0.14. 0.1 into 1 M plus, that is 0.1. And last is 0.1 into 1.3 M plus, that is 0.13. MRC will get 1.17. Okay, 1.17 times therefore becomes the weighted average beta, and that is nothing but our portfolio beta. 1.17 times, students, we got. That is our answer to point number 1. Portfolio beta is 1.17 times. Let's go ahead now. Point number 2. Can we start? Point number 2, they are saying if the manager wants to reduce the beta from 1.17 to 0.8, how much of risk-free investment he should bring in? What will be the new portfolio? I hope you remember such type of questions we have done in portfolio management, okay? So I'll not go into too much details of what exactly the calculations are. I'll straight away show you the calculations. Portfolio management chapter you have done in that in depth. I've taught you everything, correct? So students, let's start. We want to reduce the portfolio beta down to 0.8. So what I will do is, see, students, there is your existing portfolio, okay? Your existing portfolio has a value of rupees 10 lakh, correct? We are thinking of also investing in risk-free assets. I hope you understand. And therefore, my new portfolio will appear inclusive of risk-free asset. Now, what about this new portfolio? We know that our desired beta P of this new portfolio, children, is 0.8. Everybody following? So let the existing portfolio be called as X and the risk-free asset be called as Y. Can I say beta P is therefore WX beta X plus WY beta Y, correct? So the beta P, students, we want is 0.8. WX we don't know. Beta X, the beta of your existing portfolio, 1.17 we know, correct? So into 1.17 plus, students, WY into beta Y we know. Beta Y is obviously 0. That is why it is called as risk-free, right? So into 0. So therefore, I can say 0.8 is equal to 1.17 WX. Therefore, WX is equal to 0.8 divided by 1.17 will give me 0.68. 0.68 if it is Wx, can I say Wy will be 1 minus 0.68, that is 0.32. Everybody clear with this? So therefore, I'll write down here the weights of the existing portfolio in the revised portfolio is not 1, it is 0.68 only, and the weight of Y, that is the risk-free asset, is 0.32, and therefore my total portfolio value comes to 1. So if I do the calculation, students, 10 lakh divided by 0.68 into 0.32 if I do, I will get 4,70,588 as the value of the risk-free investment I need to bring in. And of course, if I add 10 lakh to this, 14,70,588 therefore becomes the total new portfolio. If this is the new portfolio you are going for, where the existing portfolio is kept as it is, and you bring in 4,70,588 worth of risk-free asset, can I say the new portfolio 14,70,588 will have a beta of 0.8. Everybody following? Let's now go ahead. Point number 3. If the manager wants to increase the beta to 1.4, how much he should borrow? What will be the new portfolio? Everybody following? So he wants to increase the beta to now 1.4. So children, please pay attention now. See, can I say that if my existing portfolio, okay, is called as X, I'll again name it as X, that is nothing but rupees 10 lakhs. Now what my plan is, this beta is already 1.17. I want to swell it up. I want to swell up the beta to how much, children? 1.4. Now to swell up to 1.4, I'm very sure, remember, you will not be investing in risk-free assets. You will be borrowing, correct? Only by borrowing you will be able to gear up this beta to 1.4 from 1.17, obviously. So students, what to do? You will of course be borrowing, and whatever money you borrow, you will of course invest in this existing portfolio itself, correct? Once you borrow, that borrowed money you will be placing in this portfolio itself, thereby swelling up the value of your shares portfolio about 10 lakhs. Yes. So therefore, what can I do is, I'll write down shares portfolio, okay? Shares portfolio. Then there is risk-free borrowing now, okay? There is risk-free borrowing, and that will give me my existing portfolio. I hope you understood. See, what does that mean? Risk-free borrowing, I will borrow, I will invest that money I borrowed in the existing portfolio, thereby giving me my total shares portfolio now, correct? I know one thing, that my existing portfolio, children, is worth 10 lakhs. Now let us first of all find out the weights. Students, our desired beta P is how much? 1.4 times, correct? Our desired beta P is 1.4 times. So can I say beta P is equal to Wx beta X plus Wy beta Y? Everybody clear? Yes. Now students, please pay attention. My existing portfolio is named as X. Let this new shares portfolio be named as Z, and risk-free borrowing I will name as Y. So students, can I say that we already have X? I will borrow Y, correct? I will borrow Y. I will take that Y and insert it in X, and therefore what will be now available to you, the swollen up shares portfolio, is called as Z. Everybody following? Can I say the beta of Z and the beta of Y will give me my portfolio beta? Everybody following? So can I say that beta P is equal to Wz beta Z plus Wy beta Y? Can we start? We want our beta P to be 1.4. Wz into, what is the beta of Z, students? We know that the beta of Z anyways is 1.17 times, correct? So into 1.17 plus Wy into 0. Everybody following? So if we just proceed ahead, 1.4 is equal to 1.17 Wz. Can I say Wz is equal to 1.4 divided by 1.17? It comes to 1.19, correct? 1.19, to be rounding it off, it comes to 1.20. So Wz is 1.20, therefore Wy will be 1 minus 1.20, that is negative 0.20. What does this mean, children? This means that if I have already invested 1 rupee in my shares, I will borrow 0.2 additional. That 0.2 I will take and again invest in those shares only, thereby making the value of the shares grow from 1 to 1.2. Everybody following? Now what is my 1 in my example? Can I say I already have 10 lakhs? Everybody clear? So the weights, children, is nothing but 1.2, negative 0.2 and 1. I'm very sure you remember a negative weight means borrowing. Yes, I hope you remember. So children, how do I do it? If I have 10 lakh already invested in my portfolio of shares, I will borrow 2 lakh additional, and that 2 lakh also I'll invest in the shares only, thereby swelling up the value of shares portfolio to 12 lakhs, correct? Of course, I will be investing that 2 lakhs in these weights itself, okay? I will not be changing the weights, because if I change the weights, then 1.17 will change, correct? To keep the 1.17 times constant, the weights have to be same. So the 2 lakhs that I borrow in exactly these shares, exactly these proportions, I will be investing. Everybody clear with that? So students, with that we understood that if we want to swell up our portfolio beta from 1.17 to 1.4 times, we will have to do risk-free borrowing worth 2 lakh rupees, and that 2 lakhs have to invest in our shares portfolio only. Everybody clear? Students, till here everything was portfolio management, okay? Now comes this chapter, point number 4. Can we start? They are saying, suppose Nifty spot is 1200 points and Nifty futures is 1250 points, and futures have a multiplier of 200. How can he obtain the same position as in 2 above? That means this year, okay, by dealing in Nifty futures. They are saying that yes, your portfolio beta currently is 1.17 times. You want to bring it down to 0.8. How can you achieve the same result by not going for risk-free investments but by using Nifty futures? I'm very sure you know what to do, correct? Students, tell me what position I have in the cash market. My cash market position obviously is long, correct? I am holding these shares. So therefore I will write down, since my cash market position, okay, is long, number of Nifty future contracts to sell. Everybody following? If I am long in the cash market, I will short the futures. Yes, tell me what is the formula? It will be beta minus, I've taught you, right? Beta asterisk into VA upon VF, correct? Beta minus beta asterisk into VA upon VF. What is your existing beta, children? 1.17, right? You want beta asterisk. What is your desired beta, students? Desired beta is 0.8. So minus 0.8 into value of asset we know is 10 lakhs, and value of one futures contract given to you in the question. Can you see this? 1250 into 200, correct? So I'll write down here 1250 into 200. Can we start, students? So this is nothing but 1.17 minus 0.8 into 10 lakh divided by 1250 divided by 200 will give me 1.48 contracts. What is 1.48 contracts, children? If we sell 1.48 contracts, straight away our beta of the existing shares portfolio will drop from 1.17 to 0.8. Everybody clear with this? So with that, students, we complete point number 4 also, that if we want that our beta P should come down to 0.8, number of contracts to be sold are 1.48. Yes. So with that, we complete point 4. Now let's go to point 5. How can you obtain the same position as 3? Okay. Dealing in Nifty futures. That means if I want to increase my beta P to 1.4, what to do? Children, can I say I am continuing to hold a long position in the cash market? So therefore, number of Nifty future contracts to sell, correct? Number of Nifty future contracts to sell. Why am I writing sell here as of now? Because my position is long in the cash market. So in futures, I start with writing an opposite stand, that is sell. So it will be nothing but beta minus beta asterisk into VA by VF, correct? What is my beta of the existing portfolio is 1.17. Beta asterisk, students, we want to swell it up to how much? 1.4. So minus 1.4 into VA upon VF. What is VA? We know 10 lakhs. What is VF? We just saw 1250 into 200. I'll write down here 1250 into 200. Let's take the calcies. 1.17 minus 1.4 into 10 lakhs divided by 1250 divided by 200 will get me minus 0.92 contracts. So if I want to swell up my beta from 1.17 to 1.4, then the number of Nifty futures contracts to sell are negative 0.92 contracts. Therefore, we will not sell. We have to buy 0.92 contracts. Everybody following? Sell negative means I've taught you, right? You have to buy. Everybody understanding? And of course, logically speaking also, I'm already long in the cash market. My beta is 1.17. If I want to swell up this beta to 1.4, then obviously in the derivative market also I'll have to take a similar stand, that is long. I'll have to buy. Only then my portfolio beta will swell up. If I take an opposite stand in the derivatives market, my overall beta will obviously come down. Everybody clear? So therefore, in this particular case, to increase the beta from 1.17 to 1.4, I have to buy 0.92 contracts of Nifty. Everybody clear? Nifty futures. So with that, students, we complete question 31. I hope you understood this question, and I'm very sure you're getting a grip on altering portfolio beta with index futures. Okay. Okay, students. So with that, we complete the discussion or the revision of futures. Now we'll go to options. Options is another hedging tool. Now within options there are broadly speaking two. Okay, one is the call option and the other is the put option, correct? Call and put option. Call option is basically a right to buy and put option is a right to sell. Okay, right to buy and right to sell. So let's talk about a call option. Okay, so let's say there is a Larsen and Toubro 3-month call option, okay, having a strike price of 1200. Now what does this mean? K here refers to strike price. This means that if you buy this call option, you buy a right to buy L&T share after 3 months for 1200. There is no obligation to buy. You have not given any commitment to buy. You simply have a right to buy the share at 1200 after 3 months, which means after 3 months, if S1 is greater than K, that means if the spot price of L&T share is greater than 1200, let's say it is 1500, can I say your call option is in the money? In the money means it is valuable, which means you should exercise it. Everybody clear? Because you have a right to buy the share at 1200 only. The share has gone to 1500. Today if you go to buy the share from outside, it will cost you 1500, but you have a right to buy it only 1200. Can I say your call is worth 300 rupees, right? But that same thing, if S1 is less than K, let's say S1 becomes 1000, can I say your call is worthless? Because you will not exercise the call, you will lapse it. Why will you lapse it? Because why will you want to exercise a right to buy a share at 1200 when the price available outside is only 1000? Everybody clear? So students, when S1 is greater than K, we say that the call is in the money. And when S1 is less than K, we say that the call is out of money, it is useless. Now similarly for put option, now instead of call, what if this was a put option? Okay, I'll write here put option. So now if you buy a put option, basically what are you buying? You are buying a right to sell L&T share at 1200 rupees. Okay, you are buying a right to sell L&T share at 1200, no commitment, just a right, which means on due date, if S1 is greater than K, it becomes more than the strike price. The S1 becomes more than strike price. Do you realize the put here is out of money? Useless put option. Why useless? Because why would you want to exercise the right to sell the share for only 1200 whereas the price has gone to 1500? Everybody clear? Secondly students, if S1 is less than K, let's say it becomes 1000, can I say then you will be very happy because you have a right to sell the share for 1200 rupees, right? Your put will become in the money. Everybody clear? So this is as far as the basics of call and put are concerned. Now there are two parties to it. One party is the buyer of the call or the put option. They are called as call option holders or call option buyers, or put option holders or put option buyers. And then there is a counterparty which is called as the call option seller or the call option writer, or put option seller, put option writer. So students, between the two parties, I hope you are able to understand that the one who is selling the option is at risk, because the one who is buying the option is very happy. If things go in their favor, they will exercise. If they go against, they will lapse the option. But for the one who has sold the option, can I say that person is at risk, because everything happens as per the holder or the buyer. So for that risk that the writer or the seller of the option is taking on his head, the holder or the buyer of the option will have to pay a premium to the writer, to the seller, which makes options not free of cost like forward contracts or futures. Options have a cost, they have a price, and the premium is the price of the option. It is the value of the option which the holder or the buyer has to pay to the writer or the seller, because the writer or the seller is taking over the risk. Everyone clear? Now in this, one concept that comes in the exam is calculation of value of option on due date. So they say what is the value of the option on due date. So first of all, I'll explain to you from call's point of view. Students, there could be two cases, right? Either S1 is greater than K or S1 is less than K. If S1 is greater than K, tell me call is in the money or out of money? S1 greater than K. K means you have a right to buy the share at K and S1 has gone above that. That means your right is valuable, right? It is in the money option and this is out of money option. Students, if the call is in the money, then the value of the call option is S1 minus K. This is the value of the call option on the due date. It is also the gross payoff or the gross profit that the holder experiences on the due date. But if the call option is out of money, can I say the value or the gross payoff is zero. Now why do we use the words gross payoff? Because this is the profit that you will be receiving, the holder will be receiving, correct? This is the profit that the holder will be receiving gross. Why am I using the words gross? Because from this we will be subtracting the premium also that we have paid, right? The holder doesn't get this free of cost facility, he has to pay premium. So therefore this is the gross profit that the holder receives if the call goes in the money minus the premium that is paid will give him the net profit for the holder. As far as out of money is concerned, can I say the gross profit is zero, but the premium has to be paid. Premium is paid today only when you buy the option. This in the money out of money you realize on the due date, but the premium is to be paid today only, and hence since the premium is to be paid today only, the premium has to be paid whether the call is in the money or out of money, which means this will result in a slight loss for the holder. This means that the maximum loss that a call holder, correct, I'll again repeat, maximum loss the call holder can experience is restricted to the premium, right? There is no other loss. And as far as profit is concerned, can I say sky is the limit. As much as S1 keeps going up, that much profit will be there for the call holder. Similarly for the call writer, do you realize whatever is profit for the holder is loss for the writer? Whatever is loss for the holder is profit for the writer. Can I say for the writer there is a scope of unlimited loss, but as far as profit is concerned it is restricted to the premium that they receive. Everybody clear? So this is as far as call is concerned. Okay, next students, we will now go to put. Now as far as put option is concerned, again there could be two cases. One is S1 greater than K, S1 less than K. Here if S1 is greater than K, the put option is out of money. If S1 is less than K, the put option is in the money. What is the gross payoff or the value of the put option on the due date? So value of the put option on due date or gross payoff, gross profit for the put holder, do you realize will be zero here, and here it will be K minus S1. Okay, here it was S1 minus K and here it is K minus S1, and of course these are gross profits. From this you will have to subtract the premium paid to find the net profit. So this is as far as the value of the call option and put option is concerned. So four things you should remember. Call option value on due date is S1 minus K if the call option is in the money. The value of the put on due date is K minus S1 if the put is in the money. If they are out of money, whether it is call or whether it is put, the value is zero. Everyone following? So that is as far as the value of call option on due date is concerned. We will do one question on this. Okay, we will pick up one question on this, and for that let us now I'll take you to the question here. Let me now see which question I have. Yeah, we will now do one question, that is question 41. Okay, I will share with you my video on question number 41. Once that is done, then we will go ahead in this particular area of options. Please watch this video. Question number 41. We are here calculating the value of the option on the due date. Students, I request everyone to first pause the video and read the question carefully. Start. Okay students, I hope you all read the question. Let us now try to understand it. Equity share of PQR Limited is presently quoted at rupees 320. This is your S0, right? The market price of the share after 6 months, that is S1, has the following probability distribution. So this they have given to you. A put option with a strike price of 300, this is your K, is available. You are to find out the expected value of the option at maturity, that is after 6 months. Everybody following? Students, let's try understanding what they are saying. They are saying there is a share whose current stock price in the spot market S0 is rupees 320, and they are saying that after 6 months this share has a probability distribution given to you in the question as here it is seen. What does this mean? It means that they're saying, yes, see, today the share price is 320. After 6 months in the spot cash market, the price of the share S1 could touch 180. The probability is 10%. Everybody following? All of you have done a portfolio with me. So I hope you understand and remember the meaning of probability. Probability means the chance of occurrence. So they are saying there is a 10% chance that after 6 months the share price will be 180. There is a 20% chance that after 6 months the share price will be 260. There is a 50% chance that after 6 months the share price will be 280. There is a 10% chance that after 6 months the share price will be 320. There is a 10% chance that after 6 months the share price will be 400. Of course, the total of the probabilities is 100%, that is 1. Everybody follow until here. Now with that we have understood this table. Then they're saying that currently there is a put option with a strike price of 300. You are to find out the expected value of the option at maturity. Students, we all know that the put option on due date P1, what is the formula I taught you? It is K minus S1. Everybody remembers it is K minus S1. Now students, as far as this question 41 is concerned, we know we have to find the value of the put option on maturity. K minus S1 is the formula, of course, or 0, whichever is higher. I'll write down here, or 0, whichever is higher. Why, students? Because we all know that the options valuation cannot be negative. It's an option, correct? It can maximum fall down to 0 if it is out of money. Everybody following? So if it is out of money, students, we all know it is 0. If it is in the money, students, we all know it is K minus S1. Everyone knows everything till here. But the problem here is that yes, we are provided with the K, but what we are not directly provided with is the S1, correct? They have given to you 1, 2, 3, 4, 5 possible probable S1s with their probability. So tell me, students, what will you do in the exam? I'm very sure many of you who remember portfolio management will tell me, sir, let us calculate one weighted average probable S1. Everybody following? One expected S1 based on its possibilities and their respective probabilities. Students, all of those who are saying this, please pay attention. Let us first do it. So can I say that we know that P1 is K minus S1. We know that the K for this put, yes, put option at the end of maturity period, here the K given to you is 300. So I'm writing here 300 minus S1. And for S1, students, what I'm doing, I am writing calculation of, okay, calculation of expected S1. Okay, so calculation of expected S1, in that I'm writing S1 bracket X, probability and PX, and we know that the summation of PX will give us our weighted average S1. So what are the different S1s given to you? 180, 260, I'll write down here 180, 260. The next is 280, 320. I'll write down here 280, 320. And the next, students, is 400. So I'll write down here 400. The probability, students, given in the question is 0.1, 0.2, 0.5. I'll write down 0.1, 0.2, 0.5. And then they have given to you 0.1 and 0.1. This is 0.1, 0.1. Total is 1. Let's take the calcs and fix this. So it is 180 into 0.1 m plus, that is 18. Then it is 260 into 0.2 m plus, that is 52. Then it is 280 into 0.5 m plus, that is 140. Then it is 320 into 0.1 m plus, that is 32. Then it is 400 into 0.1 m plus, that is 40. And if I take MRC, it comes to 282. So students, we therefore now got what our expected S1 will be on the due date, taking into consideration the possibilities and their probabilities. We found out weighted average S1. So 282, students, we got as S1. So can I say the value of the put option on the due date is 300 minus 282. 300 minus 282. Students, on the calci, 300 minus 282, if I do, I'll get the value of the put option on due date as 18. Everybody following? Now students, what you saw here, I'm sorry, is completely wrong. Okay, what you saw here is completely wrong. I will not tell you what is the right thing. Are you ready? So let's try understanding what is the right thing. And before I teach you the right thing, I am very sure many of you want to know, sir, what is wrong here. I'll tell you what is wrong here. Please pay attention. See, you know, in the calculation you did here, okay, you got this 18. I'll tell you what it actually meant, and then when you understand what it actually meant, you will realize where you went wrong. Okay, so students, tell me S1, what are the different levels of S1 given in the question? I'll take again 180 to 60. I'll write down here 180 260. Then students, 280 320. I'll write down 280 320, and then I'll write down here 400. Okay, so it is 400 in the last one. Now children, please pay attention. Can I say that the K given to you in the question for the put is 300, correct? So I'll write down here 300 300 300 300 and 300. Now students, first of all, tell me what is the put status, whether it is in the money or out of money. We know that when S1 is less than K, the put becomes in the money, correct? So S1 less than K. Children, here can I say S1 is less than K? In first case, 180 is less than 300. Can I say this is in the money option? 260 less than 300, it is in the money option. 280 less than 300, it is in the money option. But 320 more than 300, can I say the put becomes out of money? 400 more than 300, can I say the put becomes out of money? Everybody following? They had given to you the K, right? The strike price was given to you as 300. If the S1 is below K, it is in the money. If it is above K, if S1 is above K, it is out of money. Students, now please pay attention. Put value, okay, on due date. Put value means I'm not telling you to put value. I'm saying put value on due date. Okay, now students, please pay attention. We know that the put value on due date is K minus S1 or 0, whichever is higher, correct? K minus S1 or 0, whichever is higher. Now students, tell me put value on due date K minus S1. Can I say 300 minus 180 is 120? Now what did I just write? 120. What is 120? 120, students, is the value of the put. Okay, 120 is the value of the put if S1 touches 180. Everybody following? If S1 touches 180, the value of the put on due date, correct? The P1 will be 120. Everybody following? Similarly, if S1 touches 260 on due date, can I say the value of the put P1 on due date will be K minus S1, 300 minus 260, that is 40. Everybody following? Similarly, on due date, if my S1 touches 280, the value of the put will be 300 minus 280, that is 20. Everybody following? Students, now please pay attention. If the S1 touches 320, okay, if the S1 touches 320, can I say the value of the put will be 300 minus 320, that is negative 20, right or wrong? Absolutely wrong, because we know that the value of the put on due date cannot go below 0, correct? But still, for time being, I'm writing something wrong here. 300 minus 320, K minus S1 I'm doing, and that will give me minus 20, and the last 300 minus 400 I'm writing here negative 100. Everybody following till here, except the reason why I took wrong, correct? Now students, tell me the probabilities. The probabilities given in the question are 0.1, 0.2, 0.5, 0.1, 0.1. So I'll write down here 0.1, 0.2, 0.5, 0.1, 0.1. Now children, do you have the intelligence to understand that if the probability that the S1 will be 180 on due date is 10%, can I say the value of the put being 120, the probability of that is also 10%. Everybody following? I'll repeat again. If there is a 10% chance that the S1 on due date will be 180, okay, if there is a 10% chance that the S1 on the due date will be 180, there is a 10% chance that the value of the put option on due date will be 120. Everybody following? So I'm writing 0.1 here. Next students, what can I understand for this 20%? Now please focus and understand. If there is a 20% chance that S1 on due date will be 260, there is a 20% chance that the value of the put option on due date will be 40. If there is a 50% chance that the S1 on due date will be 280, there is a 50% chance that the value of the put put option on due date will be 20. If there is a 10% chance that the S1 on due date will be 320, there is a 10% chance that the value of the put option on due date will be negative 20. I know, okay, don't worry. Then students, if there is a 10% chance that the S1 on due date will be 400, there is a 10% chance that P1 will be 100. I know, don't worry, okay. Now students, just focus on these two columns. Students, if the value of the put option I take as X and I have their probabilities, can I say I am basically saying what? I am basically saying that, okay, I am basically saying that on due date, the put value can be either 120 or 40 or 20 or negative 20 or negative 100, and these are their probabilities. Okay, so let us find out the weighted average put value. Everybody following? Let us find out the weighted average put value. So students, earlier the probabilities were given to us for the spot prices, but since we know that if these are the spot prices, these are the put values, and therefore the probabilities which were there originally for the spot prices will apply to their respective put prices also. Everybody following? Students, let us now do the summation Px and find out the weighted average P1, and that is what is our expected value of the put on the due date, right? Expected P1. So students, on the calci, what we will do now is 120 into 0.1 m plus, this comes to 12, 40 into 0.2 m plus, this comes to 8, 20 into 0.5 m plus, this comes to 10, 20 into 0.1 m minus, that is 2, because this is negative, I hope you understand, right? And 100 into 0.1 again m minus, that is 10. And students, if we do MRC, we will get 18. So we get the expected P1 as 18, and that is exactly what we had got here also, 18. But students, I hope you all understand that this 18 is a wrong answer, correct? This 18 is a wrong answer because, can I say, these two numbers we took wrong? Yes, so basically since 18 is wrong, I hope you understood why the 18 is wrong. I hope you understood why I told you that this entire calculation is wrong. Students, please understand, the moment you take expected S1 on these numbers, okay, and get that 282, and that 282 straight away you subtract from 300, do you realize you are factoring in this negative 20 and negative 100 also in the calculation? Everybody following? You are factoring that. So students, to avoid this mistake, what to do in the exam, this particular methodology you cannot follow. You will have to do this method only, but with two cosmetic changes. Which two cosmetic changes? Here students, I hope you understand, this negative 20 and negative 100 we won't take. We will be taking 0 and 0, because out of money, students, put option, the value on due date is 0. Everybody following? So what I will do is I'll just remove the unnecessary part here, and then we will again start solving it. Okay? Yes students, so what I've done is I've removed all the markings, and also instead of those negatives, I took it as the correct value of the put on the due date, that is 0, which means students, do you realize that if S1 will be 320 on due date, the value of the put on due date won't be negative 20, but it will be 0. Everybody following? Similarly, if the value of S1 on due date is 400, the value of the put here, students, won't be negative 100, but it will be 0 on the due date. Everybody following? And therefore now I can say that the put value on due date can either be 120 with a 10% chance, or 40 with a 20% chance, or 20 with a 50% chance, or 0 with a 10% chance, or 0 with a 10% chance. And here now when we do the summation Px, we can find out the expected value of put on due date. Can we start? Students, on the calcis now, everybody, 120 into 0.1 m plus, that will give me 12, 40 into 0.2 m plus, that will give me 8, 20 into 0.5 m plus, that will give me 10, and these two, students, I'm very sure you understand, will be 0. MRC if we do, we get the expected value of the put P1 on due date as rupees 30. Everybody following? So students, this is how you are supposed to do in the exam. Don't calculate the weighted average of S1 directly and then straight away apply in this formula. No, it will be wrong. This formula, P1 is equal to K minus S1, at each level you'll have to first apply. I hope you understand, put value on due date is nothing but K minus S1 formula, correct? That same formula is there in that entire column, and once you get the values, the correct values, based on whether it is ITM or OTM, OTM, then you apply the probabilities and get the weighted average expected value of put on due date. Everybody following? So students, with that we complete question 41. Okay students, so I hope you all saw that question. It was an exam question. Okay, now next in options comes a concept called as payoff table, payoff graphs, and how to calculate break-even point. Okay, payoff table, payoff graph, and break-even point. Now this particular area you need to revise through a question. I cannot just explain to you conceptually. Basically what is there is you have to calculate what is the net profit for a call holder under different levels of S1. So if S1 is this or this or this or this, then what will be my profit? That is called as payoff table. And that profits and at different levels of S1 you have to put into a graph and show a payoff graph. And then you will also have to calculate what will be that level of S1 at which for the holder there is no profit, no loss, that is break even point. Same calculations you do for call writer, same calculations you do for put holder, and same calculations you do for put writer. So through two questions I will get you through the revision of payoff tables and payoff graphs. I will immediately show those two questions to you right now. See them. So let us now do the first question in this module of payoff graphs and payoff tables. Students, I request everyone to kindly pause the video and read the question carefully. Okay students, I hope you all read the question. Let us now try to understand it and then solve it. Okay, the shares of AP Limited are selling at 104. This is your S0. Patrick wants to chip in with buying a 3 months call option at a premium of rupees 5 per option. So he's saying that there is a guy called Patrick. He wants to buy a 3-month call option by paying rupees 5 premium. The exercise price is 105. This is your K. 6 possible prices per share on the expiration date, which means they're talking of S1. Share prices on expiry date means S1. Ranging from 95 to 120 with intervals of 5 are possible, which means they're saying that S1 can be on the due date either 95 or 100, 105, 110, 115 or 120. One of these 6 are possible. Point number 1, what is Patrick's payoff as a call option holder? Draw the payoff graph for the holder. What is the call writer's payoff on expiration? Draw the payoff graph for the writer. Students, can we start? So first of all, let us knock these two and then these two. Can we start? Okay. So question 45. See what I'm doing. Point number 1. They are asking you payoff as a holder. So I'll write down here payoff table. Okay. For call holder. Payoff table for call holder. Now students, look at the table I'm doing here. This is first time for you, so please be attentive. Particulars. Now tell me S1 can be from where to where? 95 to 120, correct? From 95 to 120. So students, I'll write down here case 1, case 2, case 3, case 4, case 5 and case 6. Okay, case 6. Students, the S1 can be different S1s. We will compare the S1 with K and therefore understand the option status, okay, whether it is in the money, out of money and so on. Then we will find the gross payoff on due date, correct? Then we will subtract the premium paid, yes, and then we will get the net payoff. Everybody following? We will get the net payoff. Can we start? Now they are saying S1 can range anywhere from 95 to 120 with an interval of 5. So the 6 levels of S1 can be 95, 100, 105, 110, 115 and 120, correct? Whatever the S1 is, K is going to remain fixed at 105 exercise price, right? So therefore 105 being the exercise price, I'll write down K is 105, yes. Now tell me students, call is in the money when S1 is above K, correct? When S1 goes above K, the call becomes in the money. Do you therefore realize that here it is OTM at the money because S1 is equal to K, and from here on it is in the money. I hope you are following. Yes. Now tell me gross payoff. Students, if I am a holder of the call option, I will not exercise the option. I will lapse it. So my gross payoff obviously will be 0 when it is OTM. Also, when it is ATM, whether I exercise it or I lapse it, do you realize it doesn't make any difference to me? Students, please listen carefully. If I lapse, the payoff is zero. If I exercise, which means I will buy the share at 105k and sell it outside for 105 S1, for me there is no payoff, correct? So it doesn't make any difference. The ATM payoff is also zero. Now when it becomes ITM, students, can we say that we will exercise the call? We will buy the call at 105 and sell it outside for 110. My payoff, students, I hope you remember, is S1 minus K on the due date, or 0, whichever is higher. So here you have taken 0, but here it will be S1 minus K. So that becomes 5. Gross payoff is 5. Next is 115 minus 105, that is 10. And the last is 120 minus 105, that is 15. Everybody clear? How much premium you are paying, students, for this? You are paying a premium of 5 per option. So therefore premium paid is 5. Correct, for each case, and therefore my net payoff will be 5, 5, 5, 0, 5 and 10. Everybody following? So with this we complete the payoff table for the call holder. Isn't it very simple? Just put down the levels of S1 and then compare with K, understand the status, then gross payoff. Gross payoff for a call holder is S1 minus K or 0, whichever is higher on the due date. Premium paid, you will subtract and then you will get the net payoff. Now students, let me teach you how to do the payoff graph. Please pay attention, very simple it is. Payoff graph. Okay, now payoff graph, students, appears something like this. I'll use the scale now to draw the graph. So students, this is a graph. On the y-axis I will plot net payoff, and on the x-axis I will plot S1. Okay, this is obviously 0. Now what different levels of S1 are given to us? From 95 to 120, correct? So rounding it off, here I will put 95, then 100, then 105, then 110, then 115, and then 120, correct? Students, when the S1 is 95, do you realize that my payoff is negative 5? Everybody following? My payoff is negative 5. So I will write down, let's say this is negative 5. My first coordinate will be here. When it is 100, when the S1 is 100, my payoff is still negative 5. At 105 also it is negative 5. So what I will do is, for 100 also it is negative 5, for 105 also it is negative 5. In fact, at all levels of S1, below here also, if you take 90, 80 and so on till 0, the payoff will be negative 5 only. Why, students? Because at all levels of S1 below 105, I will be lapsing the option. Everybody following? K is 105, right? So if the S1 is 105 or below 105, I will be lapsing the option. If I as a call holder lapse the option, there is no gross payoff, but there is a loss for me because I've already paid a premium of 5. So that becomes my maximum loss. That becomes my maximum loss at all levels of S1 below K. So therefore the coordinates I have been plotted till here. Now students, when it touches 110, as it touches 110, the payoff becomes 0. So therefore at 110, my net payoff is 0. Everybody following? And at 115 and 120, students, if you see, the payoff is increasing from 5 to 10 and so on. So what I will do is, I will take this as 5, I'll take this as 10. At 115, the payoff is 5. At 120, the payoff is 10. Students, if I now plot the coordinates, do you realize it will be something like this? So students, this is your payoff graph for a call holder. Everybody clear with this? Okay. Now students, tell me, what do you conclude from this payoff graph? We conclude that as S1 goes down and down and down, the call is obviously out of money. For a call holder, the loss is restricted to the premium he pays. The loss cannot go further. Yes, it is restricted to the premium he pays. On the other hand, if the S1 goes up and up, his profit, students, are unlimited. Sky is the limit. There is no restriction here. Everybody following what I'm trying to say? So therefore, students, a call option holder will of course want to buy such a call where the share is expected to be bullish, going up, up and up. Only then he will earn profits, correct? And even if it goes down, the max loss that he will face is the premium that he's paying. Yes. So students, with this we complete the payoff graph of a call option holder. One thing you should understand here is, students, can you see that when the S1 is 110, Yes, when S1 is 110, that is the break-even point. No profit, no loss, correct? Some people mistake by saying that when S1 is equal to K, that is 105, that is break-even point. No, students, 105 at 105 students, there is a net loss of 5, correct? Yes, if the S1 goes above K, you start exercising the call, correct? If the S1 goes above K, you start exercising the call, but you will start earning profit only once the S1 crosses the break-even point. Everybody following? So I'll just explain this point again here. See, your K is 105. The premium you have paid is 5, correct? Now students, if S1 is 104, will you exercise the call? No, you will lapse it, correct? Because S1 is below K, the call is out of money, your payoff students is negative 5. If S1 is 105, whether I exercise or I lapse, it's at the money, my payoff still will be negative 5. Students, what about S1 is 106? Do you realize I will exercise? Even though break-even point is not achieved, I will still exercise. I will buy the share at 105 and sell it outside at S1 at 106. My payoff will be negative 4. Why negative 4? Because I buy at 105, I sell at 106, my gross payoff is 1, premium paid is 5, my loss is 4. What if S1 is 107? Do you realize I will exercise? I will buy at 105, sell at 107, my gross payoff is 2. Minus 5 premium paid will be negative 3 and so on. Students, when S1 touches 110, do you realize I will exercise the call? I will buy at 105, sell at 110. My gross payoff is 5. Premium paid is 5, my net payoff is 0, and at all levels of S1 above 110, my payoffs will be positive. But what I want to tell you is 105 is not the break-even point, 110 is the break-even point, correct? But on the other hand, don't make the mistake of thinking that when S1 is greater than break-even point, it is in the money call. No, when S1 is greater than K, then it is in the money. Don't think that you will exercise the call only if this happens. No, you will exercise the call the moment S1 goes above K. Are you listening? If S1 goes above K, even though you are in loss, you should exercise in the exam. Everybody following? Because logically speaking, please understand. See, focus here. If S1 goes above K, it goes to 106. It is still below the break-even point, correct? You might think, sir, 106, there is going to be a loss. Let me lapse it. Children, this is stupidity of the highest order. Because if you lapse it, the loss will be 5. You've already paid a premium of 5. By exercising, at least 1 rupee is getting recovered. I hope you're understanding. So that means here, can you see this particular line here? This line. This is the line where the S1 is above K but below break-even point. Yes. Above K but below break-even point. At this point, even though you are below the x-axis, even though you are suffering a loss, still exercise, because if you don't exercise, then the loss will be negative 5. Everybody following? So whether to exercise or not depends on the comparison of S1 and K. But when you will start earning profits, that is the comparison of break-even point with S1. Everybody following? So with this, we complete, students, your payoff table and payoff graph for call option holder. Now let us do the payoff table and payoff graph for the call option writer. Can we start? So I'll write down here point number 3. Payoff table, okay, for call writer. Payoff table for call writer. Students, same columns will make particulars, case 1, case 2, case 3, case 4, case 5 and case 6. Yes. Now what are the different levels of S1? We'll put it there. Then we'll compare it with K, obviously. Then there will be gross, payoff. But now there won't be a less premium paid. Students, I am a writer. It will be add premium received. I hope you're understanding. Add premium received. So we will get our net payoff, or basically total payoff. Everybody following? Let's now put the numbers. S1 was ranging from 95 to 120 in intervals of 5. So 100, 105, 110, 115 and 120. Everybody following? K was what, students? If you remember, your K was 105. So I'll write down here 105, 105, 105, 105, 105 and 105. Everybody following? Yes, one option status also we can put here. Option status, I'm very sure you understand that when S1 is below K, the option is out of money. When the S1 is above K, the option is in the money. Students, irrespective of whether I am the holder or the writer, that doesn't make any difference, correct? So students, do you realize when the S1 is below K, the option is out of money. So OTM, OTM, this is ATM. From here the ATM starts, yes, same as the previous table. And therefore students, now do you also understand that if it is OTM, I have written a call, I have sold a call. The call holder will not turn up only to exercise his call. So therefore OTM means for me as a writer also the gross payoff is 0. Even in ATM students, you understand whether the holder exercises or whether he lapses, the gross payoff for me is 0, correct? Now you have to understand from the ITM point of view. Children, please pay attention. Let's say you are the call writer. I am the call holder. You have to think from your point of view, okay? You have sold call to me at 105 strike price. If the S1 goes to 110, I will get excited because now I have a right to buy the share from you at 105. So I will come to you to exercise my right. Everybody following? I will come to you to exercise my right. Exercise my right means what? I will demand to buy the share from you at 105. You will have no option but to sell the share to me at 105, correct? And for selling the share to me at 105, you will have to buy the share from outside at 110, that is S1, correct? So for you, the payoff will be buy at S1 and sell at K. You are the writer, right? You will buy from S1 and then sell at K because I came to exercise my call. I wanted to buy from you. You will have to sell it to me at K. So for you students, do you understand? Your gross payoff will be K minus S1 as a writer. Yes, K minus S1 because K is the value at which you are selling. S1 is the value at which you are buying the share for selling at K. Yes. So tell me now students, we have the K, we have the S1. Your K is 105, your S1 is 110. Do you realize 105 minus 110, my gross payoff is negative 5. Next students, tell me, it will be K minus S1, that is 105 minus 115, my gross payoff is negative 10. Next students, K minus S1, 105 minus 120, my gross payoff is negative 15. Everybody following? And now students, let's see the premium received. The premium we received obviously is the premium that the holder must have paid. The premium the holder paid, if you remember, yes, was 5. So that means I am receiving 5, correct? So I'll write down here, premium received students is 5, correct? And with that, I will now get my net payoff. So 0 plus 5 is 5, 5, 5, minus 5 plus 5 is 0, minus 10 plus 5 is minus 5, that is negative 5, okay? And minus 15 minus 5 is negative 10. Everybody following? This therefore becomes the payoff table for a call writer. Students, can we now make the graph? Let's start. So as far as the graph is concerned, point number 4, we will need the graph here. Let me plot it for you. This is payoff graph for call writer. Yes, payoff graph for call writer. Okay, so this is 0, this is S1 and this is my net payoff. Students, the S1 ranges from 95 to 120, correct? So it is 95, 100, 105, 110, 115 and 120, correct? Now let's start. Students, can you see that when S1 is 95 or 100 or 105, there is a fixed gain of 5 rupees. So what I will do is, I will plot this as 5. At 95 also it is 5 gain. At 100 also it is 5 gain. At 105 also it is a gain of 5. Everybody following? But students, understand one thing. At all levels of S1 below also, whether it be 90 or 85 or whatever, students, do you realize my gain will be 5 only because students, when it is S1 below K, when S1 is below K, my call holder will not come only to exercise the call, correct? He will run away. He will lapse and run away, correct? Because he will be preferring to purchase the share from outside at S1. Why will he purchase the share from me at K when S1 is below K? So he will run away. But for me, students, therefore, do you realize there is a fixed gain of 5 because that is the premium I earned at the outset? Everybody following? So if S1 is anywhere below 95 also, the fixed gain of 5 will continue, correct? Now students, at 110 my payoff is break-even point it is 0. So what I will do is at 110 the payoff is 0, correct? And at 115 and 120, can you see the payoff is now going into loss, -5 and -10. So I'll plot it here, students. This is -5, this is -10. So at 115 this is the payoff, at 120 this is the payoff. I'm very sure you understood how to plot the coordinates. Yes, it will be something like this. This is the payoff graph for a call writer. That's it. Students, for a call writer, what do you understand? We understand that his gain is limited for the writer. As the S1 goes down, then only he will earn a gain, but his gain is restricted to the premium he has received. Yes. On the other hand, if the S1 goes up, then for him there is unlimited loss. Unlimited loss, correct? It can go to anywhere. Basically, students, because the writer has unlimited loss, that is why the holder has unlimited profit. Because the holder has a limited loss, the writer has a limited profit, correct? They both complement each other in one sense. Everybody following? So this is the payoff of a call writer. Now one thing you should notice here is, students, when the call is ITM or OTM, do you realize for writer and holder, these rules don't apply separately, correct? ITM, if it is ITM for holder, it is ITM for writer. If it is OTM for holder, it is OTM for writer. Same thing, correct? But one thing you should know here, look at the break-even point. Even here the break-even point was 110, and even for the holder, if you remember, the break-even point, students, you can see here was 110. Students, what is that 110? That 110 is nothing but the K plus the premium. Yes, because for the holder, see, please understand, for the holder, do you realize that if he exercises the call, he is paying 105, he has already paid 5, so for him his net outflow is 110. Therefore the break-even point, obviously the S1 has to cross 110, only then he will be able to earn profits. Yes, so I can just conclude here by saying the break-even point for a call, may it be a writer or may it be a holder, is K plus the premium. Everybody following? K plus premium. That's it. Yes, even from writer's point of view, you can check, students. From writer's point of view, can you see that the payoff is 0 when S1 is 110, correct? So for the writer also the break-even point is same. It is K plus premium, that is 105 plus 5, that is 110. Okay, students, so thank you very much. With this we end this particular video where I taught you the payoff tables and payoff graphs for a call, holder and writer. Okay, all 4 points are done. So let's now do one more question, that is question 46 based on this concept. Same thing we'll do, but now from the put point of view, okay, put holder and put writer. I request everyone to first pause the video and read the question carefully. Okay, students, I hope you all read the question. Now let us start solving it, okay. The shares of XYZ are selling at rupees 30 per share. Milburn buys 3 months put option at a premium of rupees 5 per option. K is 33, 6 possible prices per share on expiration date ranging from 25 to 50 with intervals of 5 are possible. Point number 1, what is Milburn's payoff as a put holder? Point number 2, draw the payoff graph. Point number 3, what is the put writer's payoff? Point number 4, draw the payoff graph. Very simple question, students. Let us start solving it, okay? So now, the first thing we'll do is to solve from whose point of view? Holder's point of view, and then the writer's point of view. 4 things quickly we'll knock off, okay? Question number 46, point number 1, payoff table, okay, for put holder. So payoff table for put holder, particulars, and then 6 cases of S1 are what, students? From 25 to 50 with intervals of 5. So I'll write down case 1, case 2, case 3, case 4, case 5 and case 6, correct? So your S1 students are 25, 30, 35, 40, 45 and 50, correct? From 25 to 50 with intervals of 5. Next, students, I am going to write K. Now K, I am very sure you understand, is 33 irrespective of S1. So 33, 33, 33, 33, 33 and 33. Students, now the status. Tell me, the put is in the money when the S1 is below K. I hope you understand. When S1 is above K, the put becomes out of money. So S1 is below K. K is what? 33. So S1 below K means ITM, ITM. But the moment the S1 goes above K, it becomes OTM, OTM, OTM and OTM. Everybody following? Your K is 33 only. The moment the S1 goes above 33, the put becomes out of money. Yes? So now for put option holder, what is the gross payoff? Tell me on the due date, if he's going to lapse the option, do you realize the gross payoff will be dash in the last 4 cases, correct? Dash, dash, dash and dash. But if he's going to exercise, that means he would want to sell. Correct, because put option holder means he has a right to sell the share at K. So he would want to exercise his option to sell the share at K, for which he will buy the share from outside at S1. So for him the payoff will be K minus S1 because he's buying at S1 and selling at K. So K minus S1, students, on due date, 33 minus 25 is 8, 33 minus 30 is 3. Everybody following? And next, students, I will subtract the premium paid. Now how much premium have we been paying now here? The premium we have been paying is 5 per option. So I'll write down here 5, 5, 5, 5, 5 and 5, and therefore my net payoff, okay, my net payoff will be 3, negative 2, negative 5, negative 5, negative 5 and negative 5. Everybody following? This is your payoff table for put holder. Let us now make the payoff graph, okay, for put holder. So point number 2, payoff graph for put holder. Payoff graph for put holder. Let's make the graph now. Net payoff and then S1. Okay, net payoff and S1. Students, come on, tell me now, what will you do? Your S1 is ranging from 25 to 50, right? So 25, 30, 35, 40, 45 and 50. Okay, students, so with this now your payoff table for put holder is ready. Students, one thing I want to tell you here. What if the S1 would have been 20? K would have still been 33, correct? The status would have been ITM. The gross payoff would have been, of course, K minus S1. So 33 minus 20, the gross payoff would have been 13. 13 minus 5, the net payoff would have been 8. Which means, students, as the S1 starts dropping down and down, my net payoff will start increasing up and up as a put option holder, because I, as a put option holder, will be happy only when the share price goes down, correct? I will get more and more profit. Why? Because then I will be able to buy at that lower S1 and sell at K. My payoff is K minus S1, and the lower the S1, the more is my gain. Everybody following? Also, can you see, if I want to find the break-even point, students, is that S1 where the net payoff is 0. Students, the premium paid will be 5, which means the gross payoff has to be 5, correct? Only when the gross payoff is 5, considering the premium paid to be 5, will my net payoff be 5. Now for gross payoff to be 5, students, considering that the K is 33, what should be the S1? Yes, you are right, the S1 should be 28. Only then can I say K minus S1. 33, this is ITM, correct? 33 minus 28. 28 S1 is below K, this is in the money put. So 33 minus S1, that is K minus S1, will give you gross payoff of 5 and therefore a net payoff of 0, and therefore my break-even point here is 28. Everybody following till here? Okay, students, so let's start plotting it. At 25, the first S1 in this question is 25. There is a gain of 3. So I'll write down here 3 and 25, correct? Then, students, we know that the break-even point is 28, correct? 28 is the point where the payoff is 0. So I'll write down here 28 must be somewhere here. This is the second coordinate. At 30, students, they are saying if the S1 is 30, yes, the payoff is negative 2. There is a loss. So therefore, I can plot it somewhere here, loss of 2 at 30. At 35, students, at 35 S1 there is a loss of 5. So therefore at 35 I will plot a loss of 5. Yes. And of course at all levels of S1 above, the loss is a fixed loss of 5. So I'll keep plotting it here only. 5, 5 and 5. Students, I'm very sure you understood how the graph looks. It is something like this. correct? What does that mean? That means that for a put option holder, as the S1 goes above, his loss is restricted to the premium he pays. As the S1 goes below, the profits are unlimited, because can you see there is no restriction here? This will go on and on and on till the time obviously S1 touches 0. Because when S1 touches 0, S1 cannot go below that. So that is the maximum loss possible. But on one sense, we can say that the profit is unlimited. Okay. So this is the payoff graph for a put holder. Everybody following? Students, what is the break-even point here? 28. You know what is 28? Here the break-even point is nothing but K minus the premium. Yes. That is 33 minus 5. 28 rupees is my break-even point. 28 is my break-even point as a put holder. If the S1 goes below 28 also, then for me there is a profit. Why is 28 taken to be the break-even point? Very simple. Students, what is the K here? The K is 33, correct? So if S1 also becomes 33, do you realize for me as a holder, it is an at the money option, correct? At the money option means whether I exercise my put or lapse my put doesn't make any difference. Students, understand one thing. Exercising the put means what? That means selling the share and getting K. K means I will receive 33 or not. Everybody following? But students, as the S1 goes below 33, do you realize my profits will start increasing because it becomes in the money? So students, if K is 33 and S1 is 32, do you realize my gross profit will be buy at 32, sell under put option by exercising at 33, my gross profit is 1. Correct? Students, if my S1 is 31, do you realize in the money I buy at 31, sell at 33, my gross profit is 2. Similarly, when my S1 is 28, I will exercise the put. I will buy it outside at 28 and sell at 33, my gross profit is 5, and the premium I am paying is also 5, right? Only then my net profit will be 0, net payoff will be 0, which means in these cases, students, my put is in the money, but my net payoff is still negative, correct? Because can you see the premium that I am paying here, the premium I am paying is more than the gross profit. But that doesn't mean we should lapse the option, correct? We should definitely exercise the option. The moment S1 goes below K, exercise the option. Don't think that, sir, S1 is 32, K is 33, we will exercise means we will buy from outside at 32 and sell at 33. The profit I am earning is only 1, but the premium I have paid is 5. Oh my God, 4 rupees lost. Don't think like that, because if you lapse the option, do you realize your loss is anyways 5? At least by exercising, your loss has come down to 4. Gross payoff of 1 minus premium paid 5, at least 4, right? 1 rupee got recovered. Everybody following? But your profit will start once the S1 crosses 28, right? So basically 33, yes, minus 5, that is 28, is my break-even point at which there will be no profit, no loss. When the S1 goes below 28, my actual net profits positive will be seen. Everybody following? This is your payoff graph for a put holder. Now let us see both calculations for a put writer. Can we start? Okay. So point number 3. Payoff table for put writer. Okay. Payoff table for put writer. Same table we will make. Particulars. Case 1, case 2, case 3, case 4 and case 5 and case 6. Correct? 6 cases are there. Tell me what are the numbers. S1 ranging from 25 to 50. So 25, 30, 35, 40, 45 and 50. Your K students is 33, 33, 33, 33, 33 and 33. Status students ITM. Yes, and from here also it is ITM. And here onwards it is OTM, OTM, OTM and OTM, correct? Because S1 is less than K, only then it is ITM, otherwise it is OTM, correct? Whether I am a writer or a holder. Now tell me students, gross payoff. First of all, tell me OTM means gross payoff is nil. Nothing much to be understood there. But if I am a put writer, do you realize ITM means what? The person to whom I have sold the put will come to exercise. He will come to exercise means what? He, the put holder, will exercise his right to sell the share to me, which means I will be obliged to buy the share from him at K and sell it outside at S1. My payoff, students, will be S1 minus K as a put writer. Why? Because I'll be obliged to buy the share at K. When the put holder exercises his right to sell the share at K to me, I will buy the share at K and sell it outside for S1. So S1 minus K is my gross payoff on due date if the put is in the money and I am a writer. I am a put writer. So S1 minus K, 25 minus 33, negative 8. 30 minus 33, negative 3 is my gross payoff. Now what will I add, students? Add. Why did I say add? Because we are a writer. We will receive premiums, right? So I'll write plus premium received. Okay, plus premium received. We have received how much premium, students? We have obviously received the premium that they have paid, that is 5. So the premium we have received is 5, 5, 5, 5, 5 and 5. So my net payoff, students, will be minus 8 plus 5, that is minus 3. Minus 3 plus 5, 2, 5, 5, 5 and 5. Everybody following? Also children, I am very sure you understand that the break-even point for me will be that S1 at which my payoff is 0. I am receiving a premium of 5, which means the gross payoff should be negative 5. Considering 33 to be the K and considering that S1 minus K is the payoff, do you realize that if the S1 is 28 and K is 33, S1 minus K, my gross payoff will be 5, plus premium received 5, my payoff will be 0, which means here also, as you saw in the call, the break-even point for the put writer is also 28. Doesn't make a difference, correct? Now students, think from the S1 point of view below 25. Let's say I take S1 as 10. What if the S1 goes to 10? Do you realize K is still 33? For me, I am the writer. The holder is going to exercise, correct? It is in the money put. Tell me what is the payoff for me if the holder exercises. My payoff as a writer is S1 minus K, correct? S1 minus K means 10 minus 33, that is minus 23. So my gross payoff is minus 23. I have received a premium of 5. My net payoff is negative 18. Can you see as a writer, as the S1 starts dropping, there is unlimited loss for me. Everybody following? There is unlimited loss. Can we go ahead? Okay. So students, let's do point number 4 now. Last point, that is the payoff graph for put writer. Okay, payoff graph for put writer. Let us plot the coordinates. This is my net payoff. This is my S1. This is 0, correct? Let's start. So from 25, 30, 35, 40, 45 and 50 is my S1. So students, let's now put the payoff. At 25, my payoff is negative 3, correct? And as the S1 is below 25, the losses are going to increase only. So negative 3, I'll plot it here. At 25, this is my payoff. At 28, students, we know this is the break-even point. At 30, they are saying at 30, yes, at 28 it's the break-even point, correct? At 30, the payoff is positive 2. So at 30, I will plot it somewhere here. Yes, 2. So this is my payoff here for the 30 strike price. Next, let's go ahead for 35. Students, for 35, can you see the payoff is 5 and then 5 for eternity. So I will plot it somewhere here. This is 5, then 5, 5 and 5. Students, how does your graph appear? It is something like this. What does it indicate? It indicates that as S1 goes down, for the writer, there is unlimited loss. Obviously, it will stop someday the moment S1 touches 0. Just as for put holder, there was unlimited gain, but that gain was unlimited, but it would have stopped one day when the S1 goes to 0. For the holder, when S1 goes down, there is profit. Similarly, for the writer, as S1 goes down, there is a loss. Yes, there is a loss. But as S1 goes up, do you realize the put will become out of money? The holder will not come only to exercise his put. For me, my payoff is restricted to the premium that I have earned. Everybody following? So this is the payoff graph for put writer. Yes, the premium he has earned is 5. That is his maximum profit. Yes. So as a conclusion, students, to both the questions, the last one and this one, what we can understand that, let's talk of call. There is a holder and there is a writer. Okay, holder and writer. Do you realize that if S1 goes above K, there is unlimited gain, and for him there is unlimited loss. Okay, unlimited gain for holder means unlimited loss for writer also. Yes, I can show it to you here only, we have done it. Yes, for writer. Yes, can you see call writer, as S1 goes above, the loss, students, is unlimited, correct? On the other hand, students, what if, okay, if S1 is less than K? If S1 is less than K, we will lapse the option, our loss is restricted. Okay, our loss is restricted to premium paid. As far as the writer is concerned, our gain therefore is restricted to premium received. Everybody following? I'll show the graphs again to you. Yes, yes, for call writer, can you see when the S1 is less than K, the gain is restricted to the premium received. On the other hand, for the call holder, yes, this is payoff graph for call holder or call buyer, as S1 goes below K, the loss is restricted to the premium paid. Everybody following till here? Great. Let's now go ahead. Okay. This was as far as the call was concerned. What about the put? We will make the table here. So I'll write down put. There will be two people here. One is holder and one is writer. Okay. If S1 is greater than K, if S1 is less than K. Students, if S1 is greater than K, then do you realize for the holder it's an option to be lapsed. The loss is restricted to premium paid. And for the writer, it will be a gain, right? Because the holder is not going to exercise. Writer will eat away the premium and vanish, correct? So basically gain is restricted, okay, to premium received. Gain is restricted to premium received. I will show it to you now in this case. If S1 is greater than K, for holder, the loss is restricted to premium paid. For writer, the gain is restricted to premium received when S1 is above K. I will show it to you. See here. When S1 is above K, S1 is above K, for the writer, gain is restricted to the premium received. And when S1 is above K, students, here, can you see for the holder of put, yes, for the holder of put, the loss is restricted to the premium paid. Everybody following? On the other hand, however, when S1 is less than K, this is unlimited, okay, unlimited gain, because it is in the money option. This is unlimited loss, correct? In the money option, for writer it will be a loss. What is gain for him is a loss for him, correct? Yes, of course, till S1 touches 0. If S1 touches 0 means S1 below K. It can go below K, down, but max it can go down is 0. At 0, their gain will stop, their loss will stop. Everybody following? I'll show it to you as S1 goes below K. Yes, you can see here, as S1 goes below K, here it goes below K. For writer, there is unlimited loss. And when S1 goes below K, yes, the holder is going to enjoy, the put holder will enjoy unlimited gains till the S1 touches 0. Everybody following? So these were the summaries I gave you for both the questions we did in this and the previous video, where we saw the payoff table and payoff graph from call holder, call writer's point of view, and now put holder and put writer's point of view. The only thing you should understand here, students, is that for a holder of option, may it be call or may it be put, the loss is restricted to the premium you are paying. Because if the tide turns against you, which means for a call, if the S1 goes down, for a put, if the S1 goes up, you can lapse the option, right? For you, the loss is restricted to the premium you paid. And therefore, for the writer on the other side, the gain is restricted to the premium they receive. And also, if the tide goes in your favor, that means if in a call option S1 goes above K, in a put option S1 goes below K, then the profits are unlimited for the holder. And therefore, the losses are unlimited for the writer. Which means here it is more of a gamble from the writer's point of view. They are gambling here. The holder has come for hedging, but the writer has come for gambling. And gambling means he's ready to suffer losses for those premiums, correct? He's thinking that the option will be lapsed. Why does the writer go into such a transaction? I told you earlier, okay? I told you in videos where I taught you the mindset of the writer. I told you writers will write only those options which they think won't be exercised on due date, so that they can eat their premium and go away. But students, do you understand they are under such a big risk? Because tomorrow, if the holder exercises, which means we'll exercise only if the tide is in their favor. For call, S1 is above K, for put, S1 is below K. If that happens, then the writer is in a big mess. Everybody following? Unlimited losses. Okay students, so I hope you all understood payoff tables, payoff graphs. Now we will go on to the next concept of this chapter of derivatives options, and the name of that concept is put call parity theorem. Okay, put call parity theorem. Now students, put call parity theorem, what is this theorem saying? It is saying value of the call today plus the present value of the strike price is equal to price of the share today plus value of the put option today. So this is a particular theorem. Now I'll tell you what type of questions will come. Out of 4 items, 1, 2, 3, 4, call price, put price, share price and present value of the strike price. Out of these 4, they will give you any 3. You have to find the 4th. Simple. Everybody clear? And another type of question can come to you. They will give you all 4. Now, if they give you all 4, then what is to be calculated? Okay, if they give you all 4, then you have to simply check whether LHS is equal to RHS. Because if LHS is not equal to RHS, that means this particular theorem is getting violated. If this theorem gets violated, basically if this is not equal to, LHS is not equal to RHS, then students, there arises an arbitrage opportunity. So now how to exploit that arbitrage opportunity? For that I will now show you a question. Actually I will show you 2 questions. I'll tell you why. In one question, the scene will be something like this. And in another question, the scene will be something like this, right? We need to study both, what to do if something like that happens. Now I'll show you 2 questions. Please immediately watch them. Then we'll go to the next concept in this chapter. Question number 52 now on this concept of lower bound of a call. Children, tell me what is the formula of lower bound of a call? C0 should be greater than equal to, tell me, S0 minus K upon E raised to Rn, correct? Students, they have given you the K, strike price is K. They have given to you the current price of the stock, that is S0. Time until expiration is 1 year, that is N, and the R given to you is 10%. Calculate the theoretical minimum price of a call option. That means this is exactly what you're supposed to calculate. And then they're saying the option is trading at rupees 30. How can an arbitrager make profits? Students, this also I hope you understand that if the call option is not equal to this, and I'm very sure students, arbitrage profit they have asked, which means this must be a value which is below this. Because if you remember, if the actual value is more than the lower bound, then there is no arbitrage. Arbitrage will happen only when the actual value is below the lower bound, correct? So therefore students, they are saying that actual value is 30, and if the lower bound is this, then how can an arbitrager make profit? Students, what you should do is, point number 1 you can do easily on your own. You can find out the theoretical minimum bound of a call, and then for point 2, students, I have taught you the steps in the previous video. I am very sure you have written it down also. I would like you to do this question as a test. Okay, children, please start doing it. And yes, when you are going to find out the arbitrage gain on due date, then on your own take any 2 levels of S1. One will be above K, one will be below K. For uniformity, everyone can take 120 as the one S1 and the other S1 can be taken as 300. Okay, so one S1 which is below the K is 120, one S1 which is above the K is 300. Students, you can try it on your own, and I'm very sure at the end you will get arbitrage gains. Okay, start your solution now, children. You can pause the video and immediately start. I will be flashing the solution directly. You can then tally your answers with mine. Start. Okay students, I hope your answers are ready. I will now flash the solution on your screens. Please tally your answers. I hope nobody has done anything wrong. Yes. Now that you have understood how to do lower bound of a put, students, one question, question 53 on a lower bound of a put. Students, tell me what is the formula. P0 should be greater than equal to K upon E raised to Rn minus S0. Okay, K upon E raised to Rn minus S0. Students, the data is given to you. This is your K, strike price, S0, that is your current spot price. Then time until expiration is 6 months, which means basically it is 6 by 12 years, that is 0.5 years, correct? And your R is 5% per annum. Calculate the theoretical minimum price of a European put option. You have to calculate this. Then they are saying if the option is trading at rupees 100, how can an arbitrager make profit? I'm again telling you, this must be an actual put value which is lower than this also, because only in that case there is an arbitrage. If it goes higher, then you also know that there is no arbitrage, we saw in the previous video. Okay, so students, here to calculate arbitrage, I've taught you how to do the steps. Yes, for the due date final payoff, you have to take two levels of S1. Any two you can take. Let's say S1. Students, let's take the higher S1 as 500 and let's take the lower S1 as 300. Okay, 500 and 300, calculate your final payoff at these two levels of S1. I'm very sure if you have seen the previous video and you have written on the notes also, you will know what steps to be followed, and you will of course get an arbitrage gain at the end. Okay, so pause the video now, students, and start the solution. I will be flashing the solution of this question anytime soon. Start. Okay students, I hope your answers are ready. I will now flash the solution. Please check your answers with mine. I hope you all have got it right. Yes. Okay students, so now that you have a grip on put call parity theorem, now students, coming to the last segment of derivatives options, that is the segment of option valuation. See, we already saw one area of valuing options, but that was on due date C1 and P1. But now we will be learning how to value a call today, that is C0. Yes, it is only about call, not about put, because once you know how to value a call, then students, valuing a put, for that we will use the put call parity theorem. In that we will put all numbers including the call, and put will be P0 will be found as a balancing figure. But for call option valuation, there are few models. One model is the binomial risk neutral model. Okay, binomial risk neutral model. Then there is something called as riskless hedging portfolio. Okay, then we have got portfolio replication model. Okay, portfolio replication model. And last we have got Black-Scholes model. Okay, binomial risk neutral, riskless hedging, portfolio replication, and Black-Scholes model. I will show you one sum of each of them, go through them how it is to be done, and I guess with that we will be done with option valuation also, and with that we should be done with this chapter of derivatives also. Okay, please now watch these four models. Start. So welcome to the first question on option valuation models. Students, this question I request you all to first pause the video and read it carefully. Start. Okay friends, I hope you all read the question, and I'm also sure you understood it is based on stock equivalent and option equivalent, the first two models if you remember. Okay, ascertain the value of the option, and option means, valuation means it has to be call option only. Okay, expiring 1 year later, so this is your N, using stock equivalent and option equivalent model. Rakesh Limited is quoted at rupees 120. This is your S0. At the end, the stock price will either be 100 or 150. Students, they are giving you the two possibilities of S1. This is S1D and this is S1U. I hope you understand. Exercise price is 130. This is K. Can you see that considering this to be a call option and considering the strike price to be K, that is the strike price to be 130, students, do you realize that the option can either land in the money or out of money? If the S1 touches 150, the call is in the money. If the S1 touches 100, the call is out of money. Correct? Which means the formula to be used, I hope you remember. Okay, risk-free rate may be assumed at 12% for continuous discounting. This is your R. Can we start? Tell me students, stock equivalent model, when the option is expected to either land in the money or out of money, tell me what is the formula? C0 is equal to, remember this, S0 minus present value of lower S1, the whole divided by number of calls to be bought per share, where number of calls to be bought per share is nothing but delta S upon delta C. I hope you remember. And also option equivalent model is C0 is equal to S0 minus present value of lower S1, the whole into number of shares to be bought per call, where number of shares to be bought per call is nothing but delta C upon delta S. I hope you remember. Okay, so students, just for data, tell me what is S0? S0 is 120. What is R? R is 12%. What is N? N is 1 year. What is K? K is 130. Can I say S1U is 150 and S1D is 100. And also students, I hope you understand that since the K is 130, okay, since the K is 130, can we also find the C1U and C1D? Students, if S1U is 150, can I say C1U will be S minus K, S1 minus K, that is 150 minus 130, that is 20. And if the S1D is 100, can I say C1D? Call option is out of money, the value will be 0. Everybody following? So we have the S1U, we have the C1U, we have the S1D, we have the C1D, all numbers we have. Let's now attack. First of all, let's calculate the value of the 1 year call option using stock equivalent model. Can we start? So students have kept these formulas in front of you. Question 67, stock equivalent model. I hope you are able to remember this formula and also about the number of calls to be bought per share. So let's put the data, students. My C0 will be equal to, what is S0? S0 given to you is 120. So I'll write down 120 minus present value of lower S1. Students, the lower S1 here, can I say is S1D, that is 100, correct? So the present value of 100 will be 100 divided by E raised to R. R given to you children is 12% and N is 1 year. So I'll write down raised to 0.12 into 1, the whole divided by number of calls to be bought per share, that is nothing but delta S upon delta C. Delta S upon delta C means S1U minus S1D upon C1U minus C1D. What is S1U minus S1D? 150 minus 100. I'll write down here 150 minus 100 divided by, students, delta C will be C1U minus C1D, that is 20 minus 0. I'll write 20 minus 0. This is 50 upon 20. 50 divided by 20 will get me 2.5, correct? So 2.5 are the number of calls to be bought per share. I'll straight away write down here 2.5. Now students, 120 minus, let us take the numbers on the calci now, E raised to 0.12. So 2.71828. Let us press the root sign 12 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Minus 1 into 0.12 plus 1 into equal to 12 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. It comes to 1.127, correct? Let us put the numbers there as 1.127. Yes, so instead of E, I'll write down now here 1.1275, okay? The whole upon 2.5. Let's now take the numbers. So it is 100 divided by 1.1275 minus 120, okay, that is 31.308 divided by 2.5. So 31.308 divided by 2.5, if I do, I get the value of the call as 12.52. Yes, value of the call as per stock equivalent model, students, comes to 12.52. Let us now go ahead and check out the next valuation model, that is the option equivalent model. Children, do you remember option equivalent model? The formula was very simple, correct? It was nothing but S0 minus PV of lower S1, the whole into number of shares to be bought per call, correct? Where the number of shares to be bought per call is nothing but delta C upon delta S. So let's take the number, students. S0 in option equivalent model, students, this is the formula. Let's take S0. What is S0 in our question? S0 is 120. So I'll write down here 120 minus present value of lower S1. Already we have got, students, that is 100 divided by 1.1275. 100 divided by 1.1275 was 88.6917, and from that if I subtract 120, we got 31.308. So I'll write down here this whole thing, can I say, students, is nothing but 31.308 into number of shares to be bought per call, that is delta C upon delta S. That is nothing but a reciprocal of this. Can I say it will be 20 upon 50, correct? So I'll write down here, students, 20 divided by 50. Students, 20 divided by 50, if we do, we get 0.4. Therefore, the number of shares to be bought per call, students, is 0.4. I'll multiply 0.4 to this bracket. Let's see what I get. 31.308 into 0.4. We will get 12.52 as the value of the call, just as we had got it earlier. Everybody following? So with that, students, we complete the option equivalent model also. Stock equivalent model we completed earlier. With that, we complete question 67. Basic questions these are, students. See, once you have gone through all these valuation models, I have taught you properly, then all this is cakewalk. Just put numbers in the formula I have already taught you and get the answers quickly. Yes. So welcome to one more question, that is question 70. Students, this question is also based on that same concept of riskless hedging portfolio model. I request everyone to please pause the video and read the question once. Please start. Okay, students, I hope you all read the question. Let us read it together. Mr. Dayal is interested in purchasing equity shares of ABC Limited, which are currently selling at rupees 600 each, S0. He expects that price of share may go up to 780 or may go down to 480 in 3 months. The chances of occurring such variations are 60% or 40% respectively, which means upside probability given as 0.6, that is 60%, and downside is 40%. A call option on the shares of ABC Limited can be exercised at the end of 3 months with a strike price of 630. This is your K. Everybody following till here? What combination of share and option should Mr. Dayal select if he wants a perfect hedge? What should be the value of the option today? Risk-free rate is 10%. Students, isn't it very similar to the immediate previous question we did? And therefore, considering the fact that you know me and you have been studying SFM from me from so long, I'm very sure you understand me by now, and you therefore should understand that I'm going to give you this question as a test. Okay, point number 1 and 2 will be a test. Point number 3 is also a test. I'll just explain to you what is to be done. They're saying what is the expected rate of return on the option. Okay, so that is what they're asking you. Students, very simple. I'll tell you what the institute has done. Point number 3 I will show you. See, can I say during the course of your solution, you will obviously be getting C1U as some value. You will obviously be getting C1D as some value, correct? And at the end, you will obviously be getting C0 also. That is the final answer of point number 2, correct? This is the value of C0 you will be getting here. Now, children, what institute has done is they are saying that we have already given to you the probabilities as 60% and 40% of up and down. Everybody following? Up and down probabilities are given as 60% and 40%. So I'll write down here PU is 0.6. PD is 0.4. This is the institute solution. Please pay attention. Can I say C1U is available, C1D is available, PU is available, PD is available? We can easily find average. Okay, average C1 can I say will be C1U into PU plus C1D into PD. I hope you understand, correct? C1U into 0.6 plus C1D into 0.4. And with this formula, students, you can easily find the weighted average C1. Now, what institute has done is, it is asking you in point number 3, what is the expected rate of return on the option? It says the rate of return on that option is nothing but C1 that we got here minus C0 we got here in point number 2, the whole upon C0 into 100. Okay, C1 minus C0, the whole upon C0 into 100 will give you the return on the option in case you buy the option at C0 and sell it off at C1. I'm very sure you understand this is the formula for a normal return on any investment, correct? So C1 minus C0, the whole upon C0 into 100 is the rate of return on this option. How do we get C1? It's a weighted average C1 of C1U and C1D with the weights given to you, the probabilities given to you as 0.6 and 0.4. C0, students, must have been calculated by you in point 2. So all numbers you have, students. I am giving point number 3 also as a test to you. Okay, so students, this is a test now. Question number 70. I am now asking you to immediately pause the video and start the test. Only and only once your solution is ready, then play the video. I will be flashing the solution on your screen, so you can pause the video and tally your answers with mine. Okay, your time for the test starts now. Pause the video and start the test. Okay, students, I'm very sure you're ready with the solution of question 70. I'll now flash the solution on your screens. You can pause the video and check your answers with mine. I am having confidence on you that your answers will be right. In case 1 or 2 mistakes you have done, please check every number, okay? In case some error you have done, please note it down and don't repeat that mistake again, okay? So let us look at one more question, question 72. Students, this question is on the basis of the binomial model, but as we know, both risk neutral and binomial are almost same only. It is just that in the binomial model, we have the binomial tree. Apart from that, nothing else is different. Students, I request everyone to please pause the video and read the question carefully. Start. Okay friends, let us start understanding the question. An equity share is currently quoted at 80. This is what? This is S0. In a year's time, this is N. 1 year is N, correct? It could either rise by 30% or fall by 15%. Ascertain the value of call option under binomial riskless option with an exercise price of 90. This is your K. The risk-free rate of return is 8%. This is your R. Let's start, students. Nothing much to discuss here. One by one, same steps we'll keep following and we'll get the final answer. Okay. So first of all, tell me, students, what is your first step to identify S1U and S1D? Can I say S1U will be, it is 80 plus 30% and S1D will be 80 minus 15%, correct? So 80 plus 30% will give me 104. 80 minus 15% will give me 68. Okay, then students, the second step is to find C1U and C1D. Now what is the strike price? 90 is the strike price. So if the S1U goes to 104, can I say 14 rupees will be the C1U, that is S1 minus K, and if the S1D goes to 68, then the C1D will be 0. It is an out of money option. Everybody following? Then students, third step is to find the probability. Tell me the formula. PU is equal to, now children, they have not given very specifically about the continuously compounding, so we will take annual compounding, that is also okay. So 1 plus R raised to n minus d, the whole upon u minus d. I hope you understood. Instead of e raised to rn, the compounding factor, I have taken a simple annual compounding factor, that is 1 plus R raised to n. Now students, first of all, tell me what is R given to in the question? 8%. And considering the fact that the n is 1 year, can I say 1 plus R raised to n will be nothing but 1.08 minus d. D, students, I hope you understand that since the share price is falling by 15%, can I say that D will be 0.85, and considering the fact that the share price is rising by 30%, the U will be 1.3 minus D, that is 0.85. Everybody following? Also, this U of 1.3 and D of 0.85 can easily be found out by doing S1U divided by S0. 104 by 80, you will get 1.3 surprisingly, and 68 divided by 80, you will get 0.85. Not so surprisingly, of course. Okay, so let's now go ahead. So students, this is 1.08 minus 0.85 will give me 0.23, and then the next is 1.3 minus 0.85 will give me 0.45. So if I take the calces, 0.23 divided by 0.45, I'll get 0.51 as the PU, and therefore the PD will be 0.49. Everybody following? So once we have the PU, we have the PD, we can easily find the value of the call using the formula we know, correct? So C0 is equal to P1U into C1U plus P1D into C1D, the whole upon 1 plus R raised to n. Instead of e raised to rn, I'm taking 1 plus R raised to n, annual compounding. What is P1U? 0.51. C1U is how much? 14. Plus P1D is 0.49 into C1D is 0, the whole upon 1.08. Everybody following? So students, on our calces, we can easily complete this off, students. Now 0.51 into 14 is 7.14 plus 0, correct? This part is entirely 0, the whole upon 1.08. So 7.14, if I divide by 1.08, I will get 6.61 as the value of the call today. Everybody following? So with this, we complete this particular calculation of valuation of a call. Students, in case they also ask us to draw a binomial tree, we can show the binomial tree also. I'll show it to you here. See how it appears is as follows. There is this year 0 and there is year 1. Year 0, the S0 given to us, students, is 80. So I'll write down here 80. In a year's time, it can either go to S1U or it can go to S1D. It can either go to 104 or it can go to 68. If it goes to 104, the C1U will be 14, considering the fact that the K is 90 and the C1D out of money will be 0, correct? Now students, once we have these numbers, we can also write down the probabilities. The probability of upside is 0.51 and the probability of downside is 0.49. Using the same, we got the C0, students, as 6.61. Everybody following? 6.61. I'll write down here 6.61. This is your one-step binomial tree. Simple, correct? So with that, students, we complete question number 72. I hope you understood this question. So welcome to another video now, where we will be again doing Black-Scholes model. Question 82. Students, in this video, only 82A I am touching. Can we start? Now, I want everyone to pause the video and just read 82A carefully. Start. Okay, students, I hope you all read the question. Let us now try understanding it, okay? I will write down here question 82 and let's start. The shares of TIC are currently priced at 415. So we know my S0 is 415. The call option exercisable in 3 months time. I know my N is 3 by 12 and of course 3 by 12 is nothing but 0.25 years, correct? Next, and an exercise rate of rupees 400. This is nothing but my K is 400. Next, risk-free interest rate is 5% per annum. So I know my R is 5%, correct? Next, standard deviation is 22%. So can I say my sigma is 0.22? Next, based on the assumption that TIC is not going to declare any dividend, we anyways assume that there is no dividend over the next 3 months. Is the option worth buying for 25? So what we'll do, we'll find out the theoretical value of C0 as per Black-Scholes and then compare with the actual value and say whether it is overvalued or not and accordingly give our decision. Okay, so let's start, students. Now we have everything from the question. Now only solution we have to do. Can we start? So tell me, what is the formula? C0 is equal to, you remember, S0 into ND1 minus K upon e raised to Rn into ND2. Yes. So what is S0 here? S0 is 415. So 415 into ND1 minus, what is your K? K is 400 divided by e raised to Rn. My R is 0.05 and my N is 0.25, correct? So into 0.25 into ND2. So this is 415 into ND1 minus, students, this is 400 divided by e raised to, students, if you take the calci, 0.05 into 0.25 will give me 0.0125 into ND2. Okay, now let's do the calculations on the calcis. That is 415 into ND1 minus 400 divided by 2.71828. Press root 12 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 minus 1 into 0.0125 plus 1 and then into equal to 12 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 and 12. I'll get 1.0125. So 1.0125 into ND2. So this is, students, 415 into ND1 minus, students, it is 400 divided by 1.0125. That will give me 395.06 into ND2. Everybody clear with this? So this is now our base equation. We have to now just find ND1 and ND2 and your question is over, correct? So students, for that, let us first focus on D1. So D1, what is the formula of D1? Natural logs of, come on, S0 by K plus R plus sigma square by 2 into T, the whole upon sigma root T. So that is ln of, students, what is S0 and K? My S0 and K is obviously 415 and 400. So I'll write down here 415 upon 400 plus my R is 5%. My sigma, students, my sigma is 0.22, correct? So I'll write down here plus 0.22 square by 2, the whole into T. T is 0.25, the whole divided by sigma root T, correct? So now let's take the calci. 415 divided by 400 will give ln 1.0375 plus, this bracket will open, 0.22 into equal to divided by 2 plus 0.05 into 0.25 is 0.01855 divided by 0.25 root into 0.22 will give me 0.11. Everybody clear with this? Let us now find ln 1.0375. That is nothing but log of 1.0375 divided by 0.4343. Everybody remembers? So log of 1.0375 must be equal to 0 point something. Everybody follows that by now, correct? So we have to see the 10th root, third column, and 75 means 8th mean difference. I'll round off the fourth term to 8. So 10 row, 3 column, 8 mean difference. Can we see it? Okay, so 10 row, okay, 10 row, next is 3 column. 10 row, 3 column means, can you see this 0, 1, 2, 8? Yes, and then the mean difference of 8. So students, if I look at the mean difference of 8 here, 10, 3, mean difference of 8 is anyways 33 only. It was already marked considering the previous question. So if you check, it is 0, 1, 2, 8 plus 33. So 128 plus 33, if we do, we will get 161, that is 0161. Everybody follows that, correct? So I'll write down here, it is 0.0161 divided by 0.4343, correct? So students, if you take the calci, 0.0161 divided by 0.4343, you will get 0.0371. 0.0371 becomes the natural log of 1.0375 plus 0.01855 divided by 0.11. Students will get the D1, 0.0371 plus 0.01855 divided by 0.11. Students, we will get 0.5059 as the D1. Now that we have got 0.5059 as D1, we can immediately find D2 also. My D2 is nothing but D1 minus sigma root T, that is 0.5059 minus sigma root T is already we know 0.11. So 0.5059 minus 0.11, if we do, we will get 0.3959. Yes, 0.3959. Everybody following till here? Great. So we have the D1 now, we have the D2 now. Let us find the ND1 and ND2. Students, calculation of ND1. What is D1? 0.5059. So Z of 0.5059 we have to first of all search, correct? Students, this Z of 0.5059 must obviously be between Z of 0.5 and Z of 0.51. Then we'll interpolate and get the value. Are you there? Students, let's start the Z value tables now. We have to search for 0.5 now, correct? So 0.5 in the Z value table, students, if you see, 0.5 and 0 is 0.1915, correct? Straight away I'll take 0.1915, and about Z 0.51, it will be 0.51, that is 0.1950. So I'll write down here 0.1950. So do you realize 0.5059 will lie between these two numbers? Let me do the interpolation. Z is 0.50, 0.51. At 0.50 the value is 0.1915. At 0.51 the value is 0.1950. I am searching for 0.5059. So students, my Z, if I increase by 0.01 from 0.50 to 0.51, my value increases from 0.1915 to 1950. So 0.1950 minus 0.1915, if we do, we will get 0.0035 increase, correct? But I want to increase my Z not by 0.01 but 0.5059 minus 0.5. I want it to be increased only by 0.0059. So if we cross multiply 0.0059 into 0.0035 divided by 0.01, we will get 0.002065, which I should add to 0.1915 to get this value. So plus 0.1915, if I do, I get 0.1936. Students, what is 0.1936? It is the Z of 0.5059. It is between these two numbers. I hope you understand. So 0.1936 I got as the Z of 0.5059. This is not ND1, okay? So for ND1, the PDC I'm drawing, there is some X bar, and I know, considering the fact that Z that we have received is positive, X must be lying to the right of X bar. The probabilities are 0.5 and 0.5, and the probability of the area between X and X bar is 0.1936, correct? This is the value. And we also know that in the Black-Scholes model, we have to check the probability of the entire area to the left of X. Left of X means, students, this entire area will come under this gambit. Yes. So tell me, what is the value of this entire shaded area to the left of X? It is obviously 0.1936 plus 0.5. Therefore, my ND1 will come to 0.6936. Everybody follow till here. So I got my ND1 as 0.6936. Let us now find the ND2 also. So I'll write down here calculation of ND2. Students, what is my D2? My D2, students, I am very sure you understand. My D2 was 0.3959, correct? My D2 was 0.3959. So I'll write down here D2 is 0.3959. And considering the fact that D2 is nothing but Z, even D1 was Z, do we realize we need to find the Z of 0.3959? Yes, and obviously it must be between Z of 0.39 and Z of 0.40. Yes, let's take the numbers, interpolate it, get the value of Z 0.3959, then get the value of ND2 and then solve the C0, right? So 0.39, Z 0.39. Students, can you see 0.3 and 0.09, that is 0.39, correct, is 0.1517. So Z of 0.39 is 0.1517. I'll write it down here. Yes, Z of 0.39 is 0.1517. Everybody following till here? And then Z of 0.40. Z of 0.40, students, will be 0.40, that is 0.1554. So I'll write down here 0.1554. Everybody clear till here? Let's now do the interpolation. So for interpolation, I'll draw this. So Z 0.39, 0.40, value is 0.1517, value is 0.1554. I want the value of 0.3959. So Z, when I increase by 0.01, correct, from 0.39 to 0.40, my value increases from 1517 to 1554. So 0.1554 minus 0.1517 will give me, so 0.0037 I'll write here, increase. So when Z increases by 0.01, the value increases by 0.0037. I want my Z to increase from 0.39 to 0.3959 only. So 0.3959 minus 0.39 if I do, I want my Z to increase only by 0.0059. So the value will increase by how much? 0.0059 into 0.0037 divided by 0.01 will give me 0.002183, which I have to add to 0.1517 to get this value here. Everybody following? So I just add 0.1517, I get 0.1539. Yes, as the Z value of 0.3959. So I'll write down here Z of 0.3959 is 0.1539. Everybody following till here? Now that we have got the Z value, let us make the imaginary PDC. This is your X bar. Z being positive, the X must be lying to the right of X. This probability is 0.5, this probability is 0.5, and the value of the probability between X and X bar we have got as 0.1539. Everybody following till here? And therefore we all know that the ND2 must be the entire shaded area to the left of X. The value must be obviously 0.1539 plus 0.5. My ND2 comes to 0.6539. My ND2 is 0.6539. Therefore, now students, we have ND2, we have the ND1. Let us now complete the question. So my ND1 is 0.6936. Where will I write 0.6936 here? So 0.6936, and my ND2, students, has come to 0.6539, correct? 0.6539. So I'll write down here 0.6539, correct? Students, now 415 minus here 395.06 will give me my C0. Let's take the calcies. 415 into 0.6936 M plus 395.06 into 0.6539 M minus MRC. The value of my call option comes to 29.5. Yes, 29.5 is the value of the call option in point A. Students, this question, entire A, B, C, D of question 82, this entire question is there in your new study material. It is also there in the old study material. As of now, not asked in the exam, correct? It's a huge question. All four, if you go to solve, it is very huge. But of course, point number A, I'm very sure you understood. Yes? Okay, students. So I hope you all saw all the videos, especially the Black-Scholes model. And with that, we finally finish the discussion on the chapter of derivatives. Now we go to the next chapter, the name of the chapter, and I would consider this to be the last chapter for your revision, that is interest rate risk management. Apart from this chapter, then there are these small theory chapters. And of course, there is one international financial management chapter, that is nothing but capital budgeting with foreign exchange currencies, which means generally in inter-CA we calculate NPV for home projects. Here we will be calculating NPV for foreign projects. Different type of questions are there. Conceptually there is nothing there to revise. You have to only practice the sums, right, where they will give you foreign currencies and you have to calculate NPV of those foreign projects. That is as far as international financial management is concerned. Now the last chapter that we need to revise is interest rate risk management. So let's start. Okay students, so we'll now start our last chapter, that is interest rate risk management. Students, I'll tell you what this chapter is all about. This chapter is about those people who experience interest rate risk. Now what is interest rate risk? Interest rate risk refers to the uncertainty concerning interest rates which impact a person who knows today that he or she wants to borrow or lend in future. So let's say there is a person, that person knows that he or she wants to borrow, but not now, in future. So in future, at what interest rate they will be able to borrow, or at what interest rate they will be able to lend or invest in future is, can I say, unknown to us today, and that is called as interest rate risk. To hedge this interest rate risk, we have few tools. One is forward rate agreements, one is interest rate futures, one is interest rate swaps, and one is interest rate options. We will go through them one by one. First of all, let's talk about forward rate agreements. Within forward rate agreements, we should first of all know what are forward rates. So students, let's say there is a 1 year bond which is giving you 5% per annum return, and there is a 2 year bond which is giving you 6% per annum return. So if I put it on a time scale, this is 0, this is 1, this is 2. If you invest in bond A, can I say you will get 5% return for 1 year? If you invest in bond B, this is like bond A, this is bond B, you will get 6% per annum for 2 years. So now the question is that if you invest in bond B, yes, you will be invested for 2 years. If you invest in bond A, you will be invested for 1 year, and then at the end of first year, let's say you again invest in that same bond, then what interest rate you should be getting for a 1 year bond after 1 year? You're understanding? 1 year bond, this 5% you are getting, that is from today till the end of year 1. But then at the end of year 1, if you again invest for another 1 year, what interest rate you should get, considering that a 2 year bond is offering you 6%. So students, the calculation is, what we are searching for is called as the 1Y 2Y forward rate. Okay, we are considering it as 1Y 2Y forward rate. So students, what happens is, I have two options. Either I invest at the rate 6% for 2 years, or I invest at the rate 5% for 1 year and then again invest at some rate for another year. For me, I should be indifferent between both options. Then what should be the rate of interest that I should get at the end of year 1 for 1 year? That is called as the 1Y 2Y forward rate. If you solve this, this is 1.06 into equal to divided by 1.05 minus 1, and that is basically 0.07, that is 7%, which means if bond A after 1 year offers us a 7% rate of return, can I say I will be indifferent between investing in bond A twice or once in bond B, total period of 2 years. That is called as a forward rate. Now you know what is a forward rate. Now let us go for forward rate agreements. Students, let's say this is 0, this is 1, this is 2. You go to a bank today and you say, bank, I want to borrow for 1 year. Let's say the bank says, okay, if you want to borrow for 1 year, 5% is the rate of interest. We say, bank, actually no, we don't want to borrow for 1 year, we want to borrow for 2 years. Bank will say, okay, then 6% per annum is the rate of interest. We say, no, bank, we actually want to borrow for 1 year only, but 1 year from year. That means after 1 year, for 1 year, this period we want to borrow. So bank will say that today I can quote these two rates only. So these rates are called as the spot rates. Whatever rates are being quoted today are called as spot rates. But I'll say, bank, no, I won't want to borrow now. I want to borrow after 1 year. So bank will say, if you want to borrow after 1 year, then you'll have to enter into a forward rate agreement where today only we decide that 1Y 2Y, right? After 1 year till the end of second year, This is the fixed rate of interest, irrespective of whatever interest rate happens after 1 year. We are not concerned with that. Fixed rate of interest, let's say 7% we decide today only, and at that rate we will be able to lend and borrow. Students, that is called as a forward rate agreement. Can I say today only you will enter into this agreement with the bank, and by that can I say you are also at peace. You now know that after 1 year when you actually go to borrow or lend, the rate of interest is fixed, that is 7%. Everybody clear? Now students, we got this 7%, right? We got this 7% by taking into consideration this 5 and 6, correct? We got this 7. But is it possible that the bank offers something else only? Calculation wise it should have been 7 theoretically, but what if the bank offers 7.3 or 6.5, something like that? So if the actual forward rate is different from the theoretical forward rate, there is an arbitrage opportunity. Okay, so what I will do now is I'll give you few questions. One question I will do, in fact in one question only we will be able to do, that is arbitrage under forward rate agreements. I will give this question to you, and then there is one typical question that comes in ICA exams, that is discounting with forward rates. Now what is the meaning of discounting with forward rates? I will tell you. Students, do you understand that let's say after 2 years we are going to get 100 rupees. What is the present value today? So if I want to find the present value of this 100, there are two ways of finding. Either I do 100 divided by 1.06 raised to 2. Correct? That means basically discounted at the rate 6% for 2 years, or I can do 100 divided by 1.05 into 1.07. It is the same thing, you know, right? 1.06 raised to 2 is equal to 1.05 into 1.07. Basically what you're doing is 100, when you're discounting, 1 year you're discounting at the rate 7%, and then 1 year you're discounting at the rate 5%. Can I say it is same as discounting at the rate 6% for 2 years? So this is like discounting using a blanket spot rate, and this is like discounting using forward rates. One question comes in institute exams based on this, so for that I will show you this. So what I will do is one question on discounting with forward rates and one question on arbitrage under forward rate agreements. These two you should see for the purpose of revising this forward rate agreement area. Okay, so I'll show you these two questions now. Please watch it. So welcome to question number 2. As I told you, we will be studying a question where we will be calculating the forward rates using some other methodology only, as I showed you the equation in the previous video where we learned the discounting of future cash flows using forward rates. Students, I request everyone to please pause the video now and just go through the data of this question carefully. Start. Okay students, I hope you all read the question. Let us now try to understand it. They are saying, consider the following data for government securities. Students, there are 4 bonds or 4 securities given to you. Let us focus on the first one itself. They are saying face value is 1 lakh, 0 coupon, 1 year maturity, and current price is 91,000. Students, if the current price is available, future cash flow is available, can we easily find out the rate at which this future cash flow must have been discounted to find this current market price? Everybody following? So let us first of all knock that off and let us find out the rate of discounting at which the future cash flow of this bond must have been discounted at. So students, I'm writing here question number 2, and what we will do is we'll give them names. This is bond A, bond B, bond C, and bond D. Let us evaluate bond A first. So I'll write down here evaluation, okay, of bond A. Please pay attention, evaluation of bond A. Students, we know that the current market price is nothing but the present value of future cash flow. As far as bond A is concerned, because the life is only 1 year, only one cash flow is there, that is the redemption value. There is no interest also here. Only the RV will be received at the end of first year. So can I say the current market price is nothing but the present value of RV alone? There is nothing else here, correct? So what is the current market price here? 91,000. I'll write down here 91,000 is equal to redemption value, children, is nothing but the face value assumed to be at par. So I'll write down here 1 lakh divided by 1 plus R raised to 1. I do not know what that R is. Can we start? So students, can I say 1 plus R is equal to 1 lakh upon 91,000? Yes, and also R is equal to 1 lakh upon 91,000 minus 1 straight away. Okay, so on the calcies, 1 lakh divided by 91,000 minus 1 will give us 0.0989. Yes, R is equal to 0.0989. That is nothing but 9.89%. Everybody followed, which means, students, do you realize that if I draw the time scale here or that number scale here, please pay attention. This is year 0 and this is year 1, end of year 1. Do you realize this period interest rate is 9.89%? Yes, so therefore this 9.89% is what, students? It is the 1 year spot rate that we got. Everybody clear? So students, we have completed the evaluation of bond A and we ended up with the first year spot rate, that is 9.89% per annum for the first year. Let us now go to bond B. Students, let us now evaluate bond B. Yes, so this is the data I have highlighted now. We have to only look out for this data here. Students, come on, tell me, what is bond B? Face value 1 lakh, coupon rate 10.5%, 2 years maturity, and 99,000 is the current price. Let us first put the data and let's see what we get out of it. So I'll write down here now, evaluation of bond B. Please pay attention. Evaluation of bond B. Students, what is the current market price of bond B? 99,000. I'll write down here. I hope you understand. 99,000. The current market price of bond B is nothing but the present value of future cash flows. Can I say this bond having a life of 2 years will have two future cash flows? First is the interest at the end of year 1. Second is the interest plus RV at the end of year 2. Students, let's start the discounting process. At the end of year 1, tell me how much interest you will get. 1 lakh into 10.5%, 10,500 interest will get at the end of year 1. I'll write down here 10,500 plus. Students, tell me the second year cash flow will be what? It will be again 10,500 plus the redemption value of 1 lakh. That is nothing but 1 lakh 10,500. I'll put it here, 1 lakh 10,500. Students, I'm very sure you understand. We have to discount these cash flows to get the present value as the current market price. Children, we all know. What do we know? We know that the first year cash flow is to be discounted at what rate, students? The rate we got is 9.89%. I hope you're able to understand. So what I will do is, I will write down here, divide by 1.0989. Everybody following, raised to 1. And as far as the second year cash flow is concerned, do you realize we can easily find out the forward rate? Students, tell me, how do I find out the forward rate? There are two ways to solve it. I will show you the first method here. Please pay attention. Can I say this 1,10,500 can be discounted like this? 1.0989 for first year and then for the second year at the rate R. That R, children, do you realize will be nothing but, if this is end of year 2, this is that R I am looking for. That is the 1Y, 2Y forward rate. Everybody following? Let us now try to solve this. Students, please pay attention. 99,000 is equal to, students, 10,500 divided by 1.0989 will give us 9555.01 plus. Now students, you'll have to write it down as it is now. 1,10,500 divided by 1.0989, yes, into 1 plus R. We'll open this denominator up in some time. This 9555.01, we place it on the LHS. So 99,000 minus 9,555.01 will give us 89,444.99 is equal to 1,10,500 divided by 1.0989 into 1 plus R. I'll write down here 1.0989, yes, into 1 plus R. Now students, can I say therefore 1.0989, yes, into 1 plus R is nothing but 1,10,500 divided by 89,444.99, correct? So therefore 1.0989 into 1 plus R is equal to, on the calci now, 1,10,500 divided by 89,444.99 will give us 1.2354. Yes, 1.2354. Therefore, students, 1 plus R will be equal to 1.2354 divided by 1.0989. 1 plus R equal to, on the calci, 1.2354 divided by 1.0989 will give us 1.1242. Yes, therefore R is equal to 0.1242. That is nothing but 12.42%. This 12.42%, can I say, is this R, and this R is nothing but, I'm very sure you understand, end of year 1 till end of year 2, we get this rate as 12.42%. This is my first forward rate that we found, 1Y, 2Y, FR. Everybody following? So I'll write down here 1Y, 2Y forward rate we got is 12.42%. Everyone clear with this concept? Great. Now students, there's another method of solving this. I will show it to you, but that's just an alternate solution. ICAI is following this solution. We'll stick to this, but just for a conceptual clarity, I'll give you another method also. Please pay attention. See, I'll write down here method 2 to find that 1Y, 2Y forward rate. Can we start? See, students, the present value of future cash flows, the current market price we know is 99,000. So I'll write down here, please pay attention, 99,000 is equal to, can I say 10,500 divided by 1.0989, as it is write down. I'll write down here 10,500 divided by 1.0989 plus, students, this particular cash flow now 1,10,500. I am writing here 1,10,500. Do you realize, students, this particular 10,500 is getting discounted for 1 year? This 1,10,500, can I say, will get discounted for 2 years. So I will do divide by 1 plus R raised to 2. Children, do you therefore realize I am putting a blanket discounting rate of R% for 2 years for discounting 1,10,500 at the rate R% per annum for 2 years. Do you therefore realize this R which I will get now by solving this equation will be nothing but the 2-year spot rate? Yes, it will be the 2-year spot rate, not the forward rate, which means it will be this rate here, this entire blanket rate for 2 years, at which this cash flow at the end of second year, I'll be discounting at a blanket rate. That rate we'll be able to find out now. Using that, later on we can find out the forward rate, that is 12.42. It's a long cut, but it's a technique I wanted to show you so that your conceptual clarity is there. In the exam, no need to do it. Exam straight away solve method 1 only, because ICAI also does it, and of course logic also says the same thing. Shorter method, immediately you will be able to solve it, correct? So students, please pay attention now. What I will do is now open up this equation. Please pay attention. 99,000 is equal to 10,500 divided by 1.0989. Students, we will get 9555.01 plus this number, of course, we had got earlier also, same thing, okay? Plus, students, I will write it down as it is, 1,10,500 divided by 1 plus R raised to 2. Everybody clear? So this 9555.01, let us push to the LHS. 99,000 minus 9,555.01 will give us 89,444.99 is equal to 1,10,500 divided by 1 plus R raised to 2, correct? So therefore 1 plus R raised to 2 is equal to 1,10,500 upon 89,444.99. Therefore 1 plus R raised to 2 is equal to 1,10,500 divided by 89,444.99. We will get 1.2354. Yes, 1.2354. Therefore 1 plus R is equal to, yes, root of 1.2354. Can we start? So 1 plus R is equal to, let's take the calcies now and solve this. I just have to press a root sign. I get 1.1115. Yes, 1.1115 rounded off, and therefore my R comes to 0.1115. That is nothing but 11.15%. What is 11.15% per annum? It is the spot rate. It's a 2-year spot rate at which blanket this particular cash flow of 1,10,500 will be discounted at. Yes, is this the forward rate? No. 11.15%, students, is this forward rate here for 2 years. Yeah, 11.15%. Now children, tell me, how do I solve to get the 1Y, 2Y forward rate? 12.42% we got using method 1. I'm asking using method 2, how do I solve? Very simple. Now go back to the original calculations of forward rate. Can I say 9.89% is 1 year spot rate, 11.15% is the 2 year spot rate. We can use these two spot rates to find the 1y, 2y forward rate. Can we start? I'll do it here only and then I'll remove it off. Okay, students, please pay attention. Can I say 1.1115 raised to 2 is equal to 1.0989 into 1 plus r? I hope you're able to understand. With this, we'll be able to easily solve this. Students, on the calci, 1.1115 into equal to will give us 1.2354 is equal to 1.0989. Yes, 1.0989 into 1 plus r. Can I say 1 plus r is equal to 1.2354 divided by 1.0989? That is nothing but 1.1242. R is equal to 0.1242. That is nothing but 12.42%. This is another way of solving. Yes. So in this method 2, what we did, students, we first of all found out the 2-year spot rate, and then using the 1-year spot rate, 2-year spot rate, we easily found out the 1y, 2y forward rate as we have been doing in the previous questions. But because I took one special video for you in the previous video itself, where I taught you discounting using forward rates, in that, students, straight away we were able to find the 1y, 2y forward rate as 12.42%. Everybody clear? In the exam also, kindly follow this methodology only, where directly we find out the forward rate. No need to go for the spot rate and then find the forward rate. This particular explanation I gave to you so that your brain connects with whatever has been happening till now. Everybody clear with this? Let us now go to the next bond. Before we go to the next bond, I will quickly first of all remove the unnecessary markings from this particular diagram. Yes? Yes, students, so with this we have cleaned up this diagram and only the necessary part has been kept in front of you. Let us now go to the next bond. Can I say bond B has been evaluated? Let us now go and evaluate bond C. Okay, students, so bond C, this is the relevant data I have highlighted. Let us now solve bond C. Students, it's a 3-year maturity. Let's see what we are able to find out of it. So I'll write down now here evaluation of bond C. Please pay attention. Evaluation of bond C. Okay, evaluation of bond C. Can we start? Students, tell me what is the current market price of bond C. The current market price of bond C is 99,500. So I'll write down 99,500 is equal to, what is the coupon rate? The coupon rate is 11% on a face value of 1 lakh, which means every year interest cash flow will be 1 lakh into 11%, that is 11,000 for first year, second year and third year. So 11,000 for first year, 11,000 for second year, and then 11,000 plus 1 lakh, that is 1 lakh 11,000 for the third year. Everybody following? Let us now do the discounting. The first year cash flow, students, we all know the first year discounting rate is 9.89%. So straight away divide by 1.0989 raised to 1 into, students, we know that the second year cash flow is to be discounted in this fashion: 9.89% for first year and 12.42% for second year. So I'll write down here, yes, 1.0989 into 12.42 means 1.1242 for the second year. Everybody clear? Now the third year cash flow. Can I say third year cash flow? For the first year, the discounting will obviously happen at 9.89%. Second year discounting will happen at 12.42%. Third year discounting will happen at what rate? We don't know. Basically, by evaluating bond C, tell me which rate we will be able to find out. We will be able to find out this rate. Yes, we know the discounting rate of first year. We know the discounting rate of second year. We do not know the discounting rate of third year. Basically, when we solve this, we will be able to find 2y, 3y forward rate. Everybody following? We'll be able to find the 2y till 3y forward rate. Can we start? So students, let us now start solving this. 99,500, that is the current market price of bond C. Students, 11,000 divided by 1.0989, we will get 10010.01 plus, students, it is 11,000. See how I'm doing it? Divided by, now this numbers divided by 1.0989 and then divide by 1.1242, we will get 8904.12 plus we will keep this 1,11,000 divided by, students, 1.0989 into 1.1242 is 1.2354. I'll write down here 1.2354 into 1 plus r. Everybody clear with this? So students, now how do I do this? Let us put these two numbers on the LHS. So 99,500 minus 10,000, 10.01 minus 8904.12 will give us 80,585.87. Yes, 80,585.87 is equal to 1,11,000 divided by 1.2354 into 1 plus r. Now what to do? Therefore, 1.2354 into 1 plus r is equal to, tell me, is equal to 1,11,000 divided by 80,585.87. Yes. So therefore, 1.2354 into 1 plus r is equal to 1,11,000 divided by 80,585.87. We get 1.3774. Yes, so therefore 1 plus r will be equal to 1.3774 divided by 1.2354. Everybody following? So we will get 1.11495. Students, 1.11495 can be also rounded off to 1150. So I'll write down here 1.1150. Can I say therefore r is equal to 0.1150? That is nothing but 11.5%. What is 11.5%? It is the third year discounting rate, forward rate, 2y, 3y. Yes. So 11.5%, I'll write it down here. Yes, we get it as 11.5%. And that is nothing but my 2y, 3y forward rate, 11.5%. Everybody clear? And now students, I'm very sure by evaluating bond D, which is a 4-year bond, we can easily find this last forward rate, that is 3y, 4y forward rate. Yes. So students, let us now focus on the last bond, that is bond D. Students, this is the data available in front of you. 4-year bond, again 11% coupon, and the face value is 1 lakh, and the current market price is 99,900, which means 11,000 is the coupon every year, and the 4th year 11,000 also you'll get plus 1 lakh redemption value. Will get 1,11,000 is the last year redemption value plus interest, terminal cash flow. Let's quickly complete this. 99,900. So students, I will write down now here. Yes, evaluation of bond D. Yes, evaluation of bond D. 99,900 is equal to first year 11,000, second year 11,000, third year 11,000, and fourth year 1,11,000. Yes, tell me students, first year is 9.89%, 1.0989 raised to 1. Second year, can I say, will be discounted first year at 9.89 and second year at 12.42. So I'll write down here 1.0989 into 1.1242. Third year students, do you realize for that 9.89 first year, 12.42% second year, and 11.5% for the third year. So I'll write down here 1.0989, 1.1242, 1.1150 for the third year. And as far as this last cash flow is concerned, do you realize 1.0989 for first year, 1.1242 for second year, 1.1150 for third year, and this is the last R that we need to calculate. Can we do it? Students, I request you all, just for the sake of practice, kindly get me this R as a test. Can you do it? Students, this answer that you will get as R, do you realize will be the R of this period here, from end of year 3 till end of year 4, which is the 3y, 4y forward rate, which I expect you all to calculate. Can you do it for me? So students, here I'm keeping this in front of your screens. Kindly pause the video and get me this R. Start. Okay students, I'm very sure you're ready with this answer. This 3y, 4y forward rate, you're ready with it. And with that, I end this question students because there is nothing much to be done here. We calculated the forward rates. We first found 1y, 2y, then 2y, 3y, and then 3y, 4y forward rates. Yes, this being a test which you solved on your own. I now will flash the solution of question 2 on your screen students. You can pause the video and copy down the notes. And as far as the 3y, 4y forward rate is concerned, everything I had done for you, only basic mathematical calculations you had to do. I hope there is no mistake there. You can tally your answers with mine as I flash the solution of question 2 on your screens. Yes. So let's look at one question, question number 4, that is arbitrage under FRA, concept based question. I request everyone to please pause the video and read the question carefully. Start. Okay friends, I hope you all read the question. Let us now try to understand this. You are given the following interest rates by a bank. Period and rates. Students, 3 months rate they have given to you as 6%. 6 months rate they have given to you as 8%. I'm very sure you people should understand these are per annum rates, and these are obviously students which rates? Spot rates. I hope you people understand these are nothing but the spot rates. So then they say another bank has quoted a 3 by 6 FRA as 6% dash 7.2%. Students, what is the meaning of 3 by 6? It is nothing but 3M, 6M FRA. 6% dash 7.2% means what? That means if you want to deposit in 3M, 6M FRA, then the deposit rate is 6%. If you want to borrow from the bank 3M, 6M, then the forward rate relevant will be 7.2%, which means the bank will lend to you. That means you can borrow from bank at 7.2%. The bank will accept your deposits at the rate 6% in the 3M, 6M FRA. What is the meaning of 3M, 6M FRA? Means what? It means after 3 months for a period of 3 months. Everybody following till here? Let's now read ahead. Required. Point number A. Calculate 3M, 6M FRA. Now you might say, sir, 3M, 6M FRA is there. What to calculate? Students, I hope you realize when they ask you to calculate, that means they're asking you to calculate the theoretical FRA, right? Theoretical FRA, do you realize we have the spot rates? We have to use the spot rates and find out the theoretical 3M, 6M FRA. Points B and C we will do later. Let us knock off A. This is something that we know very well. Correct? Let's start. Question number 4, point number A. Calculation of theoretical 3M, 6M forward rate. Can we start? So students, for that I am very sure you realize we'll require the spot rates. Spot rates are available students. Can you see 3 months spot rate is 6%. So I'll write down here spot rates. Okay, spot rates. 3 months spot rates is 6% per annum. Can I see if I go for a 3 month spot rate investment, effective spot rate will be how much? It will be 6% into 3 by 12. I hope you people understand, and this is nothing but 1.5%. Yes, 1.5% effective spot rate for a 3 month period. 6 months spot rate given to you children in the question is 8% per annum. So I'll write down here 8% per annum. So effective 6 month spot rate will be 8% into 6 by 12, that is students 4%. Yes, 8% into 6 by 12, that is 4%. So now we have the 3 month spot rate, we have the 6 month spot rate. Let us use these spot rates to find out the theoretical 3M, 6M FR. Can we start? So let's now start writing down the equation for calculating the forward rate. Students, tell me, first of all, the longer duration one, can I say 6 months one? If I invest my 1 rupee in a 6 month spot rate investment, can I say my 1 rupee will grow to 1.04 in 6 months. On the other hand, if I invest my 1 rupee in a 6% investment, that is a 3 month investment, can I say it will grow to 1.015 in 3 months, and then it will grow at the rate R. That R is the forward forward rate we have to find to equate both options. Can we start? So students, I'll write down therefore 1 plus R is equal to 1.04 divided by 1.015. This comes to 1.0246. Yes, 1 plus R equal to 1.0246. Can I say therefore R is equal to 0.0246? That is nothing but 2.46% effective for 3 months. That is end of third month till end of sixth month, correct? See, if I put it in a time scale here, do you realize this is end of month 0, this is end of third month, this is end of sixth month, correct? Students, this period interest rate effective is 1.5%. This period effective interest rate is 4% for the entire 6-month period, and using these two datas we were able to find out this forward rate, that is 2.46%. Everybody following till here? Students, one thing I would like you all to understand, that this 2.46, children, do you realize is effective for 3 months. Generally the rates are quoted on a per annum basis. So if this is for 3 months, can I say for 12 months it will be how much? Basic cross multiplication, 2.46 into 12 divided by 3, if I do, we get 9.84% per annum. Students, do you realize this is nothing but my theoretical 3-month, 6-month forward rate? Everybody following? Theoretical 3-month, 6-month forward rate is 9.84% per annum. Effectively, it is 2.46% for 3 months. 3 months starting at the end of third month from now till the end of the 6th month. Everybody clear with this? With that, we complete our point number A, calculation of 3M, 6M FRA. Everybody following till here? Let us now go to point number B. Students, in point number B, they are asking you, verify whether there is any arbitrage opportunity if the client can borrow rupees 1 lakh now. Students, what the client can borrow is irrelevant as of now. We have to only first of all check out whether there is an arbitrage opportunity or not. Can I say arbitrage opportunity will happen only when actual forward rate not equal to theoretical forward rate? Everybody following? Can I say the actual forward rate given to you in the question, the 3M, 6M forward rate given to you in the question, yes, they have given to you in 2 quotes, that is deposit quote separate and borrowing quote separate. That's okay. 6% and 7.2% they have given to you as the actual forward rate. Theoretical forward rate, children, just now we found out as 9.84%. So what I will do is I'll write down here 9.84% is the theoretical forward rate. Can I say this is the actual, this is the theoretical? Do you realize they do not equate? Correct? They do not equate. One is in the range of 6 and 7.2, other is 9.84%. Can I say they do not equate? And hence, yes, there is an arbitrage opportunity. Everybody following? Nothing much beyond this. Point number C. Also, if yes, there is a yes, correct? There is an arbitrage opportunity. Describe the actions to be taken by the arbitrager to avail arbitrage opportunity. Can we start? So students, I hope you remember in the last video I showed you that borrowing portfolio, investment portfolio, those are the steps to be done to find out the arbitrage profit. Can we start? So students, I'll write down here straight away now point number C. Okay, point number C. Now, do you realize, first of all, we have to understand whether to sell FRA or buy FRA, correct? So students, I'll write down here, since actual forward rate, that is in the range of 6 to 7.2%, yes, is less than theoretical forward rate, students, which we got as 9.84%. I'll write down here 9.84%. Can I say this forward rate agreement is undervalued, and therefore for arbitrage, do you realize we will buy FRA, right? 3M, 6M FRA we will buy. Everybody following? This is undervalued, right? If it is undervalued, we'll of course buy FRA. Now, what is the meaning of buying a 3M, 6M FRA? It means I agree today. Yes, I agree today to borrow after 3 months for 3 months at the rate 7.2% per annum. I'm very sure you understood why I didn't take 6, because 6 is the rate applicable in the forward rate in case you wanted to go and deposit. Students, but we are not depositing here, correct? We are agreeing to borrow in future because the strategy is to buy FRA. Buying FRA means we'll borrow. So therefore the relevant borrowing rate will be 7.2% per annum at the end of third month for 3 months. That is till the end of the 6th month. Everybody clear with this? So now let us create that portfolio of borrowing and lending. So I'll write down now your month. I'll write down your borrowing portfolio. Yes. Then I'll write down your investing portfolio. Can we start? Students, end of month 0, end of month 3, end of month 6, correct? Now tell me, according to the strategy, which part have we already frozen? Can I say we have already agreed to borrow at the rate 7.2% at the end of third month till the end of sixth month, which means can I say this part is already frozen at the rate 7.2% per annum. Everybody following? So if this is frozen, do you realize we will have to borrow for the first 3 months separately using the 3-month spot rate available? Students, the 3-month spot rate available to us is 6% per annum. So therefore I will borrow here at the rate 6%. Everybody clear? Now the question is telling you how much principal is to be borrowed. We have to borrow how much principal, students? We have to borrow rupees 1 lakh, correct? Rupees 1 lakh principal is to be borrowed. So here I will borrow 1 lakh principal. Everybody following? I'll borrow 1 lakh principal here. I will borrow it at the rate 6% spot rate per annum rate, but will borrow only for a period of 3 months. So students, we saw earlier that 6% per annum is effectively only 1.5% for 3 months, which means your 1 lakh will grow to 1 lakh plus 1.5%, that is 1 lakh 1,500. To repay this loan at the end of third month, we will enter into a 3M 6M FRA today only to borrow exactly this principal of 1 lakh 1,500 at the end of the third month for a period of 3 months at the rate 7.2% per annum. Everybody cleared with this? 3 months borrowing we will do under FRA. So basically this structure is clear. Students, this 1 lakh that you borrowed, that only you will invest, right? Now you will invest straight away for how many periods? For this entire 6-month period you will invest. Students, if you are investing directly for a 6-month period without any pressure, without any commitment of FRA, do you realize straight away you will go for a 6-month spot rate, that is 8% for 6 months, 8% per annum for 6 months. So this 1 lakh, students, I will straight away invest at the rate 8% per annum. Everybody clear? Let us now write down the steps and then we'll find out the arbitrage gain. Can we start? So students, I'll write down here step 1. Okay, step 1 is what? Step 1 is borrow. Okay, borrow rupees 1 lakh at the rate how much percent, students? 6% for 3 months. So I'll write down here at the rate 6% per annum for 3 months, and we know internally it will grow to 1 lakh 1,500. Step 2 will be what, students? Buy. Okay, buy a 3M 6M FRA at the rate, buy a 3M 6M FRA at what rate, students? 7.2%. So I'll write down here at the rate 7.2% per annum. And then step 3 will be what, students? Invest rupees 1 lakh today at the rate straight away 8% per annum for 6 months. We know effectively it is nothing but 4% for a 6-month period. Everybody following this? Let us now check out the maturity values and therefore the arbitrage gain. Can we start? So I'll write down here on due date. Tell me, students, on due date what will happen? So first of all, we'll take our investment portfolio. Students, our investment portfolio will give us how much? We had invested 1 lakh, students, at the rate 8% per annum for 6 months, which is effectively 4%, right? For a period of 6 months. If it is 8% per annum, for 6 months it is 4%. So children, do you realize my 1 lakh will grow at the rate 4% to 1 lakh 4,000 at the end of the 6th month, right? My due date is at the end of the 6th month. As far as my borrowing portfolio is concerned, do you realize on due date, see, please pay attention, at the end of the 3rd month, to repay the original month, you're taking another loan of 1 lakh 1,500. We take this loan of 1 lakh 1,500 and repay the original loan, and now this loan will grow at the rate 7.2%. Do you realize, for a period of 3 months. So students, I'll write down here, it will be 1 lakh 1,500 plus, this is the principal, plus on this principal 1 lakh 1,500 into 7.2% is the interest for a period of 3 months. Everybody clear with this? Yes. So here the maturity value will be what, students? This place the maturity value will be what? It will be 1 lakh 1,500 plus interest on this, right? That is nothing but 1 lakh 1,500 into 7.2% into 3 by 12. Everybody clear with this? So students, I will now take the calci and we will solve this. So 1,01,500 m plus 1,01,500 into 7.2% into 3 divided by 12 m plus 1827 we get, and MRC if we do, we get 1,03,327. Yes, 1,03,327. Or alternatively, what you could have done is, instead of doing this calculation on the calci, we could have just done this much. 7.2% is for the entire year, so into 3 by 12 if I do, 7.2 into 3 divided by 12 if I do, I get 1.8% effective interest rate for a period of 3 months. So it is 1,01,500 plus 1.8%. 1,01,500 plus 1.8% will not so surprisingly give you same answer as 1,03,327. Now children, tell me what to do. Do you realize that from my investment in 6 months period, I am getting 1,04,000 rupees as the maturity value from my deposits? On the other hand, the maturity value that I have to repay in my borrowing portfolio at the end of 6th month is 1,03,327. So clearly, can you see arbitrage? 104,000 minus this value on the calci now, 1,04,000 minus 103,327 will give us an arbitrage gain of rupees 673. Yes, arbitrage gain of rupees 673. That is what they were asking you. Describe the actions. We described the actions. We also found out the arbitrage gain if the borrowing of 1 lakh can be done today. Everybody followed this question? Yes. So with that, we complete question number 4. Okay students, so I hope you all understood how forward rate agreements function. Now we will go to the next part, that is interest rate futures. Now just as in futures we saw, there is a F0, there is a F1, correct? You have to take one position at F0 to hedge yourself. On the due date to close, you have to take an opposite stand and close yourself. So students, that particular thing is there here also. So I will tell you, if you want to borrow in future, okay, if you want to borrow in future, then you should sell futures today. Okay, you should sell futures today, and then to close you will have to, of course, to close you will have to buy futures at whatever price the futures are trading at on due date. Everybody clear? And similarly, if you want to lend in future, okay, if you want to lend in future, then today you have to take a position of buy futures at the rate F0, and to close you will sell futures at the rate F1. Everything else remains same like derivatives only, just that here the underlying asset is not a share, right? It is an interest rate, correct? An interest rate risk management that you're doing, you have to hedge your future interest rates. So here slight tricky thing is there, that if you want to borrow in future, don't buy futures, okay? If you want to borrow in future, one needs to sell interest rate futures at F0, and to close take an opposite stand, that is buy. Similarly, if you want to lend in future, then you will have to buy futures at the rate F0, and to close sell at the rate F1. Now one peculiar thing about futures contract is, they will say, for example, 3 months futures contract is trading at rupees 94, something like that they will say. Now don't get confused. You will say 94 rupees. Here we are doing interest rate risk management, right? The futures contract should be having some interest rate percentage. So yes, it will be showing as if it is 94 rupees, but please know that in it they are wanting to tell you that the interest rate in the futures contract is 6%. How did I get 6? 100 minus 94. Simple. So tomorrow if they tell you 93, then that means it is 100 minus 93, that is 7%. Everybody clear? So that's how they present an interest rate futures contract. So interest rate futures contract is not expressed as a percentage, it is expressed like 94, 93, 92.2, whatever. 100 minus that you should do to get the interest rate. Everybody clear? So students, we will do one sum on interest rate futures, and then we'll move on to next concept, that is interest rate swaps. So I'll give you a sum for the same. Hi friends, so let's look at one more question on this concept of interest rate futures. See students, I'll again tell it to you. Can I say that when we did question number 8, okay, this question number 8 we did from a person's point of view who wanted to borrow in future, and we understood interest rate futures. Then in question number 9 we understood same interest rate futures but from the point of view of a person who wanted to invest or lend in future. Then students came question number 10, which was again from a person's point of view who wanted to borrow in future, and this question you all did as a test. So now I have kept question 11 from the point of view of a person who wants to lend or invest in future, and this question also will be a test so that you get practice of both types of people's point of view, right? So I'll read out the question to you, but before I read, I want you all to pause the video and read the question carefully. Start. Okay friends, I hope you all read this question. Let us now try to understand this. In UK, X Limited has realized from its cash budget that it is likely to have a surplus of pound 100 lakhs arising in 2 months time, that is May, for a period of 3 months. So basically you know today that after 2 months you will be wanting to invest 100 lakhs, you will be wanting to lend 100 lakhs for a period of 3 months. Yes, it is concerned that interest rates in the next 2 months may fall. Anyone who wants to invest in future will fear a drop in interest rates and therefore wishes to hedge this risk using future contracts. June, 3-month sterling interest rate futures contracts are available with a contract size of 5 lakhs. I'm very sure in your head you must have seen these two numbers and you must have understood how many contracts you should go for. They are currently priced at pound 96. I'm very sure you understand the meaning of this. Interest rate currently stands at 4%. This is your spot rate today. They're saying explain how X can hedge its interest rate exposure using future contracts if in 2 months time the market interest rate has fallen to 3% and the futures price has moved to 97. So this becomes the futures price on your due date and this becomes the spot rate on your due date. Tell me children, what will you do? Can I say your step number 1? I'll write down here only. Okay, your step 1 will be to understand whether to buy or sell futures. Yeah, buy or sell futures. Once you have taken that call whether you want to buy or sell futures and also the number of contracts, etc., then students comes point number 2, as we saw in the previous question also. In point number 2 we have to just calculation of final interest. Okay, calculation of final interest that you will receive. Why calculation of final interest received? Because you are a person now who wants to invest in future. Yes, now tell me, in that how many points are there? 2 points are there, 2 steps are there. First point students obviously is to invest the money that we want to invest in the spot market and generate some interest amount there. Secondly children, do you realize as far as the futures position is concerned, you will have to close out that position and check whether there is any gain or loss, and then combined impact you have to show as the final interest that is being received. Everybody following? Final interest that is being received is nothing but the interest you receive in the spot market plus the difference, the gain or loss, plus or minus. It depends whether there is a gain or loss in the closeout of the futures position. Yes, so just get this final answer, the final interest to be received, which is therefore the answer to question number 11. I'll again repeat, as you're solving this, your first point should be to identify whether we want to buy futures or sell futures, and whatever we do, how many number of contracts. Yes, so I'll again repeat once more for solving this question number 11. Tell me, what is the first thing you will do? The first thing you will do is to identify whether you want to buy or sell interest rate futures, and whatever you want to do, how many contracts you will go for, right? Once that is done, then point number 2, calculation of final interest that you will receive. Why receive? Because you are a person who wants to lend in future. You are going to get a surplus, right? You will be wanting to lend or basically invest in future. Now children, tell me, if you're going to invest in future means, can I say after 2 months for a period of 3 months, where will you invest? You will of course invest. The delivery will happen in the spot market market only. So in the spot market, these rates are available to you. They are saying in the spot market, the interest rate has fallen to 3% per annum. And on the other hand, you will close out your futures position, which is now trading at 97 pounds. Students, therefore, the combined effect, one, interest you will receive in the spot market. Secondly, there will be some gain or loss on the closeout of futures position. Combine both and get me the final interest that is to be received. Yes, students, one thing I want you all to understand, these interest rates given in this question are all on a per annum basis. They are always on a per annum basis. Yes, therefore convert it for that effective period into 3 by 12. That is what I want to tell you. Yes, so I am now announcing this question to you as a test. I request all of you all to please pause the video right now and start the test. I am waiting for you here. Start. Okay, students, I'm very sure you all have sincerely tried this question. I'll now flash the solution of this question on your screens. You can pause the video and tally your answers with mine. I'm very sure by now, fourth question we are doing, your answer has to be correct. Yes, it will be correct. Okay, students, so I hope you all understood interest rate futures, how they work. Now we go to the second last concept of this chapter, that is interest rate swaps. Students, in interest rate swaps, I'll tell you what happens. Let's say there is a company A, there is a company B, there is a bank of A, there is a bank of B. Now students, bank offers loan to A where A has to, let's say, pay a fixed rate of interest, and B is offered loan by its bank where B has to pay a floating rate of interest. Now students, it is possible that A might not actually want a fixed rate of interest and wants to pay a floating rate of interest, whereas B might not want to pay a floating rate of interest and wants a fixed rate of interest. When is this possible? When now A is right now paying fixed. Why would A actually be wanting to pay floating? Because A would think that interest rates in future would drop, correct? And if interest rates drop and if he's still paying fixed, can I say A will feel sad about it, right? Similarly, B. Why is B wanting to pay fixed and not floating? Because B might be having an opposite view. B might be thinking that interest rates will go up, and if he's paying floating, then more and more interest he will have to pay. So students, both of these opposing viewpoint parties can come together and solve each other's problem, where A agrees to lend the same amount of money to B and B agrees to lend the same amount of money to A, where A agrees to pay a floating rate of interest to B and B agrees to pay a fixed rate of interest to A. So then by this what will happen? Can I say A has to pay fixed, it will receive fixed, but it will have to pay floating under the swap. So net, can I say fixed will eventually get cancelled. Some part will of course remain unless both of these rates are same, and effectively A is paying a floating rate. Similarly, if you see from B's point of view, it is receiving floating, it is paying floating, that can get cancelled off against each other, and net what B is paying is fixed. So students, one should remember that a swap is therefore done where two parties having opposing viewpoints can come together. And yes, when one enters into a swap, one enters to satisfy one's desire of paying interest. Basically A's desire was to pay floating, right? So it will enter into the swap to pay floating. B's desire is to pay fixed, right? So it will enter into the swap to pay fixed. Simple. Everyone clear? So on this we will have one question. I will show you that question, and then there is one more kind of question where the question might ask you to design a swap. See, generally question will be where a question will tell you that okay, this is the fixed, this is the floating that the respective banks have charged, and then you have to enter into the swap where A will pay this much, B will pay this much. Everything is clear. You have to simply create the swap and calculate the net interest, correct? But students, one more thing before I go to net interest is that how is swap settled? Now students, let's say in the floating for a particular period the interest rate is 8%, and for fixed of course the fixed rate is let's say 7%. By this can you see that A has to net pay, or I might say gross pay 8% to B, and B has to pay 7% to A for a particular period. Why am I using the term for a particular period? Is because this floating will change period to period, right? So in that particular period where floating is 8% and fixed is 7%, A will have to net pay 1% to B B will net receive 1%. So like that they will net off for every period and then decide who has to pay what. So on that one question will come. Another question that can come is where they will tell you, okay, now you decide what should be the floating and what should be the fixed rate of interest, and that decision making has to be such that is beneficial to both parties. Students, for that one needs to go through one more question where we need to learn how to create a swap. So that question also I will share with you, where we need to learn how to create a swap in such a way that both parties will stand to gain something. Now how that happens I will show it to you through a question, but please remember that both parties have to gain. In what ratio they will gain, everything will be mentioned in the question. You have to follow a few steps, follow those steps that I will show you in the question and get the answer. Okay, so I will show you both questions, one question on calculating the net interest to be paid received, and the second question on how to create a swap which is beneficial to both. Please watch these two videos. Hi friends, so welcome to one more question, question number 14. I request everyone to please pause the video and read the question carefully. Start. Okay friends, I hope you all read the question. Let us now try to understand this. Suppose a dealer quotes all-in cost for a generic swap at 8% against 6-month LIBOR flat. If the notional principal amount of swap is 5 lakhs, then calculate these points given to you. Can we start? So they are saying point number 1, calculate the semi-annual fixed payment. Students, let us first of all knock off point number 1. What they are saying, that the notional principal is how much? 5 lakh. As far as the fixed rate is concerned, they are telling you the fixed rate is 8% and they are telling you the floating rate is LIBOR, that is a 6-month LIBOR. 6-month LIBOR means, do you realize the reset period is after every 6 months? That means at the end of every 6 months, there will be an exchange of interest, basically on a net amount basis. Everybody understanding? So tell me now, for your fixed payment, they are telling you that the fixed interest payment is to be done at the rate 8% per annum. That means for a period of 6 months, do you realize it will be 4% per annum? They are asking you what is the semi-annual fixed payment. I'll do it here only. On 5 lakh, can I say 8% per annum is fixed? Into 6 by 12 if I do, I'll get my fixed interest payment. Everybody following? So on the calci, 5 lakh into 8% into 6 divided by 12, you will get your fixed interest to be paid equal to rupees 20,000. Everybody following till here? Let's now go to point number 2. In point number 2, they are saying, find the floating rate payment for one above if the 6-month period from the effective date of swap to the settlement date, that means from today is the date when we entered into the swap till the first reset date, comprises of 181 days, and that the corresponding LIBOR was 6% on the effective date of the swap. Effective date of swap means what? The date on which you actually enter into the swap, that is today. They are saying today the LIBOR is 6%. Therefore, do you realize that this is the interest rate that will be applicable for the first floating rate payment that is due 6 months from now? On that date, what will be the LIBOR payment? On the settlement date, what will be the floating rate payment? Can we start? So now students, to calculate that interest to be paid, that floating rate interest to be paid after 6 months, do you realize they are telling you that the effective period is, don't take 6 months, take 181 days. No problem. Instead of doing 6 by 12, we will do using the days given to you. 181 days is the period of borrowing there, and they are telling you in point number 4 here, it is based on 30 by 360 day basis. Basically, they are telling you that take 1 year as 360 days. So students, if 1 year is 360 days, this first period of swap is 181 days. Can I say for that 181 days at the rate 6% on 5 lakh principal, what will be the floating rate interest to be paid? I will write down here 5 lakh into 6% per annum into 181 by 360 if I do. On the calci, 5 lakh into 6% into 181 divided by 360 if I do, I get 15,083 as my floating interest to be paid. 0.33 is there. If you want, you can take it here. Yes, this is 2 decimals I took here. 15,083.33. Everybody following? Now tell me, what is 15,083.33? It is nothing but the floating interest payment to be made. Everybody following? So therefore, we all understand that the first fixed to be paid is 20,000. The first floating to be paid is 15,083.33. They are asking you in point number 3, into above, if settlement is on net basis, how much the fixed rate payer would pay to the floating rate payer? Can I say fixed rate payer has to pay 20,000. Floating rate payer has to pay only 15,083.33. Therefore, net the fixed rate payer has to pay is nothing but 20,000 minus 15,083.33 on the calci. 20,000 minus 15083.33. The net to be paid by the fixed rate payer to the floating rate payer, students, will be 4,916.67. 4,916.67. Everybody follow till here? Yes. So with that we complete question 14 also. Very simple question. Yes. Just calculate the fixed payment, the floating payment, and find out the net. Nothing much here. Okay. I'll now flash the solution. You can pause the video and copy down the notes. Question 23. So before I start this question based on this interest rate swaps comparative rate argument, I request everyone to please first pause the video and read the question carefully. Start. Okay friends, I hope you all read the question. Let us now try to understand it. Grades Limited enjoys a high credit rating and is capable of raising term funds either at a fixed rate of 10% or at a floating rate of 40 basis points over MIBOR. Levels Limited, another company, enjoys a relatively lower credit rating and is able to borrow either at 80 basis points over MIBOR or at a fixed rate of 11%. Levels Limited wants to borrow at a fixed rate, whereas Grades would like to enjoy a floating rate. Structure the swap arrangement such that Grades gains 2/3 of the total gain. I'm very sure you understood the language. So students, without any further delay, let's start the solution according to the examination point of view steps I taught you. So students, question number 23, tell me what is step 1. Step 1 is to calculate the interest rate, net interest rate differential, correct? So I will write down now. The two companies given in the question are Grades and Levels. So I'll write down here Grades and Levels. Okay, Grades Limited and Levels Limited. Students, I'm very sure you understand that one of them is the strong company, the other is the weak company. I'll write down here fixed. I'll write down here floating. Okay. Yes students, now as far as Grades Limited is concerned, it enjoys a high credit rating, which means it is the stronger company. It is comparable to A Limited in my previous video, correct? Students, Grades can raise funds at the fixed rate of 10%. So I'll write down here 10% and a floating rate of 40 basis points over MIBOR. Students, I hope you understand that 100 basis points means 1%. So children, 40 basis points means 0.4%, correct? Over MIBOR, students, here LIBOR is not there, MIBOR is there. So can I say the floating interest rate that Grades is offered by its bank is M plus 0.4%, right? 0.4% over M. So I'll write down here M plus 0.4% the floating interest rate. As far as the weaker company Levels Limited, comparable to B Limited in my question, is concerned, they say it enjoys a relatively lower credit rating and is able to borrow at either 80 basis points over MIBOR, which means it is M plus 0.8, or students, it is saying the fixed interest rate of 11%. So students, the fixed interest rate is 11%. So children, if we take the difference in fixed, can I say is 1%. The difference, students, in floating, can you see, is 0.4%. I hope you're understanding. Yes, the difference in floating is 0.4%. That is M plus 0.4 and M plus 0.8. Difference is 0.4. Students, the difference of the difference, the greater one is 1, the smaller one is 0.4. So difference comes to 0.6%. This is the net interest rate differential. In the mind, we should know this is nothing but what? It is nothing but the interest rate advantage. Yes, the advantage that the weaker company is sitting on. Everybody following till here? Let us now go ahead, students. So we have got the net interest rate differential. Step 2, students, I am very sure you understand, is to find the bifurcation. So I'll write down here step 2 bifurcation. Okay, step 2 bifurcation. What is the net interest rate differential coming to? 0.6. So I'll write down here 0.6% has to be broken up between Grades and Levels. Students, what they are saying, that structure the swap such that Grades enjoys 2/3 of total gain. So therefore Grades will enjoy 0.6 into 2 by 3, correct? 2/3 is 2 by 3, and levels will enjoy 0.6 into 1 by 3. Students, on the calc, 0.6 into 2 divided by 3 will give you 0.4 gain that grade should enjoy, and 0.6 into 1 by 3, that is 0.2 gain that levels should enjoy. Everybody following? Next step, students, is to find out the comparative advantage. I'll write down step 3 to find out the comparative advantage. Students, there is this company called as Grades, whose comparative advantage, students, must either be borrowing in fixed or floating, and then there is Levels, yes, whose comparative advantage must be borrowing either in fixed or floating. If you see here, you'll understand. Can you see that the stronger company, that is Grades, okay, gets a discount of 1% compared to Levels in fixed, whereas there is a discount of only 0.4 as far as floating is concerned. So can I say for Grades there is a comparative advantage in borrowing in fixed? As far as Levels, the weaker company is concerned, do you realize that yes, they will have to pay a premium because they are weak? But students, as far as premium is concerned, they have to pay a premium of 1% borrowing in fixed, but only 0.4%, correct, borrowing in floating, and therefore for Levels the comparative rate advantage is in floating. So students, do you realize that Grades should borrow where they have their comparative advantage, that is fixed, and Levels should borrow where they have their comparative advantage, that is floating. So students, for Grade they should borrow at the rate fixed, and Levels should borrow at the rate floating. Everybody following? Students, tell me, what is the fixed rate at which Grades can borrow? Grades can borrow at the rate 10%. So I'll write down Grades should borrow at the rate 10%. And as far as floating is concerned, for Levels they should borrow at the rate M plus 0.8%. I'll write down here M plus 0.8%. Yes, students, on the last step, that is a swap structure, I'll write down here step 4, swap structure. Okay, step 4, swap structure. There is this bank here, yes students, and then there is a company called Grades, there is a company called Levels. Grades has to pay interest to its bank, Levels has to pay interest to its bank, and then they enter into a swap. So tell me students, as far as Grades is concerned, it will be paying fixed 10% to its bank. As far as Levels is concerned, it will be paying floating M plus 0.8% to its bank. So I'll write down 10% fixed, yes, and M plus 0.8% floating, correct? Students, Grades is paying fixed, but the question says that Grades would like to enjoy a floating rate. Levels, on the other hand, would like to borrow at a fixed rate. Students, do you realize that even if this line was not given, we would have still known what to do? Because in a swap, I'm very sure I've taught you that yes, if a particular company is paying fixed to its bank, then it will take the opposite stand in the swap, correct? It will take a floating stand, which means if you are paying fixed to the bank, you will pay floating in the swap and therefore receive fixed. If you are paying floating to your bank, you will enter the swap to pay opposite, that is fixed, and receive floating. Students, let's start. Do you realize Grades, it is paying fixed to its bank, but it wishes to pay floating. Levels is paying floating to its bank, but it wishes to pay fixed. Everybody following? Now tell me students, who dictates the terms? The stronger company dictates the terms. Grades will say, I will pay my floating. Now what is the floating of Grades? The floating of Grades given in the question is M plus 0.4. So Grades says that I will pay floating of M plus 0.4% under the swap, and I wish to receive my fixed. My fixed, students, can I say is 10%? So Grades tells Levels, pay me 10%. This is the basic swap structure. And apart from this, the stronger company will tell to the weaker company that give me my share of the gain. Yes, my share of the gain. Do you realize, you know that 0.6 gain is what the weaker company Levels is already sitting on. From that it has to pay 0.4 to Grades, which it will attach to the payment Levels is doing under the swap. So can I say Levels is paying 10% fixed under the swap to Grades, in that it will attach the 0.4% also. Everybody following? So students, with that the swap structure is clear, and now we can find out the net interest paid. So students, I can just write down here Grades and Levels. Okay, Grades and Levels pays to bank, okay, pays under swap and then receives, okay, from swap. So students, let's now complete this. Tell me, as far as grades is concerned, how much is it paying to the bank? 10% fixed. I'll write down here 10% fixed. How much is it paying under the swap? Under the swap it is paying M plus 0.4. So I'll write down here M plus 0.4%. How much is it receiving from the swap? From the swap it is receiving 10.4%. So I'll write down here 10.4%. Everybody following? Which of course I'll put in a bracket because we are receiving it. And now let us calculate the net interest paid. Students, the net interest paid, do you realize, will be 10 plus M plus 0.4 minus 10.4. Students, do you realize it is nothing but M, and then I do 10 plus 0.4 minus 10.4, that gives me 0, which is M plus 0, that is nothing but M. So do you realize the net interest rate paid by Grades Limited will be a floating interest rate of M percent, that is MIBOR. And as far as levels is concerned, tell me how much is it paying to its bank? It is paying M plus 0.8. So I'll write down here M plus 0.8%. How much is it paying under the swap? 10.4%. I'll write down here 10.4%. How much is it receiving from the swap? M plus 0.4%. I'll write down here M plus 0.4%. Let us calculate the net interest paid. It will be M plus 0.8 plus 10.4 minus M minus 0.4. M and M will get cancelled. What will be left is 0.8 plus 10.4 minus 0.4. That comes to 10.8%. Yes, that comes to 10.8% fixed. Everybody following? Students, do you realize levels wanted to borrow fixed, so the swap gave levels fixed. Grades wanted to enjoy floating, the swap ends up giving grades a floating interest rate. Everybody following? Tell me, if grades would have directly gone to its bank for floating, how much floating interest rate the bank would have offered? The bank would have offered a floating interest rate of M plus 0.4%. Students, M plus 0.4% is what grades would have had to pay had it gone for floating rate direct to the bank. But can I say due to the swap it is paying only M, which means can I say grades is enjoying an advantage of 0.4%. That 0.4% I'm very sure you people understand is nothing but this advantage here that grades is enjoying. Everybody following? On the other hand, student, do you realize levels ends up paying 10.8% fixed, and you all know had it gone to its bank asking for fixed interest rate, it would have had to pay 11%, which means can you see that its bank was offering it 11% fixed, but now children, do you realize that through the swap it is paying only 10.8% fixed, which means do you realize levels is enjoying a 0.2% advantage. That 0.2% advantage, I'm very sure you understand, is this particular advantage that levels keeps with itself. Everybody clear? So students, I'm very sure you understood this question, you understood this concept of how to structure the swap through these 4 steps. So with this, students, we complete question number 23. I hope you understood this question. I will now flash the solution of this question on a screen, so you can pause the video and copy it on the notes. Okay students, so you all saw now how an interest rate swap works. I also hope you all saw the video on creating the interest rate swap. Now we go to the last concept of this chapter, that is interest rate options. And interest rate options are also called as caps, floors, and there is something called as collars. Okay. Now interest rate cap is basically a call option on an interest rate. Interest rate floors is basically a put option on an interest rate, and collars is a strategy where you buy a cap and you sell a floor. Okay, so now let's talk about call option. Let's say you buy a call option with a K of 10%. What does that mean? That means today you are buying a right to borrow at the rate 10%. Okay, I'll again repeat. If you buy a cap at the rate 10%, you are basically buying a right to borrow at the rate 10%. So if S1 on due date becomes 11, if S1 greater than K, can I say your call option becomes in the money, right? S1 greater than K, call option becomes in the money. S1 minus K is the gross profit that you will be receiving. Of course, minus the premium will be the net profit that you will receive. Why is S1 greater than K lending you in the money? Because you have a right to borrow at the rate 10%, whereas the interest rates have gone to 11%. Can I say your right is having a value, right? Similarly, of course, if S1 goes to, let's say, 8%, okay, if S1 goes to 8%, students, do you realize that you have a right to borrow at the rate 10%, but the market is giving you interest rate of only 8% to borrow? Then why will you want to exercise your right to borrow at the rate 10%? If S1 is less than K, then the call is out of money. Same rules which are there in derivatives for call, same is there here also, same product, just that there the underlying assets were shares, here the underlying assets are interest rates. Okay, now students, moving on to put option. Students, put option gives you a right to lend. So if you buy a put option, or basically if you buy a floor, then students, do you realize you have a right to lend at the rate 10%? Do you realize if the S1 goes to 8%, then your put is in the money, correct? You will get K minus S1 2% as the gross profit, because you have a right to lend at the rate 10%, whereas outside the interest rate is only 8%, your floor is in the money. But if S1, students, is greater than K, okay, if S1 is greater than K, then students, can I say your put is worthless? Because why would you want to exercise your right to lend at the rate 10% when outside you can lend at the rate 12%? When S1 is greater than K, the floor, the put is out of money. Now, why is it called as cap and floor? Because students, do you realize if you buy a call at the rate 10%, do you realize the maximum interest that you have to pay is 10? You will not need to pay anything more than 10. Correct? Because just imagine, even if the interest rates, let's say, go to 15%, outside you will have to borrow at the rate 15%, but here, can I say 5% you will be getting a profit from the cap option. So net you have to pay is 10% only. So your interest payment will never cross 10%. Everybody clear? That is the cap. And as far as floor is concerned, do you realize your lending interest rate that you will be getting on lending, can I say, will never go below 10%. That is the minimum you will get, that is 10%, right? So students, therefore we say that cap and floor. Floor is like the lower value, cap is the higher value, and collar is basically a strategy where you simultaneously buy a cap, you hold a cap basically, and you sell a floor. You become a writer on the floor, and that becomes a collar strategy if you do both things simultaneously. So both will impact you together, correct? So what we will do is we will do one question, correct, where you will be getting a grip on caps and floors. So now what we will be doing is, we will be doing one question. In that question, we will be getting a grip on call, put, as well as collar. Basically cap, floor and collar, everything you will be able to see in one question only. I'll show that to you. Please watch it. Question number 29. Based on this concept of interest rate options, students, I request you all, as usual, to first of all pause the video and read the question carefully. Start. Okay students, I hope you all read the question. Let us now try to understand it. XYZ issues a 10 million pound floating rate loan on July 1, 2016 with resetting of coupon rate every 6 months equal to LIBOR plus 50 BP. BP refers to basis points. Students, before I go ahead, I would just want to first of all explain this line. XYZ, till here all understood? Great. XYZ is a company which issues a 10 million pound floating rate loan. Stop. Basically, it is issuing a loan, means going for borrowing. Everybody following? XYZ is borrowing. Borrowing how much? 10 million pounds floating rate loan on July 1, 2016. So first things first, I'll write down here borrowing, okay, borrowing amount. The principal is how many pounds, students? It is 10 million. 10 millions means, students, do you realize it is nothing but 1 crore. So 1 crore pound, okay, is the borrowing amount. And then they say resetting of coupon rate happens every 6 months. Students, I'm very sure you understand, since it is a floating rate loan, here the reset period is 6 months. So every 6 months the floating rate will be reset, and the floating rate taken here is LIBOR plus 50 basis points. Students, we all know basis points, 100 basis points means 1%. So 50 basis points will be 0.5%. So do you realize, students, the interest rate applicable on this borrowing, okay, the interest rate applicable is LIBOR plus 0.5%. Of course, in this 0.5% is the fixed component, and the LIBOR of course is floating. Yes, we do call the whole thing to be floating, but in that 0.5%, as we all know, will be fixed, and the L, the LIBOR, will be floating, will be reset after every 6 months. Everybody clear with this? Now let's read ahead. XYZ is interested in a collar strategy. Children, as I told you in the video explaining collars, that this is generally applicable to long collars, that is for those people who want to borrow. Here, students, XYZ Limited is a company that wishes to borrow, and therefore to hedge its risk, it can either go for a cap, correct, go long on a cap, or it can go long on a collar. Going long on a collar, children, do you remember what it means? It means, yes, it means buying, okay, buying a cap at K2 and selling a floor at the rate K1. Everybody remembers buying a cap at K2 and selling a floor at K1, and that's what they're saying, by selling a floor and buying a cap. Yes, selling a floor and buying a cap. XYZ buys the 3 years cap and sells 3 years floor as per following details. Students, one thing to note here is that the period of the cap and the floor taken is 3 years. 3 years means, children, do you realize it will be 6 periods? 6 periods how? Of course, don't do 3 years plus 3 years like national idiots, okay? It is not 3 years plus 3 years. Yes, you can see here reset period is 6 months. So if reset period is 6 months, every year 2 periods will be there. 3 years means, do you realize, 6 periods. 6 periods for cap and 6 periods for floor. Everybody following till here? Then they say notional principal amount in these options will be pound 10 million. Same, basically what our hedging amount is, same amount will be the notional principal in the cap and the floor option. Then they say, students, that the reference rate will be 6 months LIBOR, which means, do you realize that strike rate being 4% for floor means, do you realize this 4%, the K will be compared with LIBOR as the S1. Everybody following? The reference rate means that rate with which we will be comparing our strike rate of the option. The K has to be compared with S1 only, correct? So therefore they are saying that the S1 will be LIBOR, whatever the LIBOR is on the respective due date. Everybody following till here? Due date, basically the reset dates. And they say 7% for cap. So children, of course, do you realize this is K2 and this is K1? So I'll write down here cap at the rate 7%, and can I say we have bought a cap, and floor, children, floor is at the rate 4%, we have sold a floor. Everybody following till here? And of course, children, this is against LIBOR, correct? The S1 to be compared with, the reference rate is LIBOR. Now please pay attention. They are saying premium is 0. Premium is 0. Why? If we go for options, premium we pay, right? But here in this question, I've explained this to you in the theory video of interest rate options, and they have very specifically told you also this. Since premium paid for cap is equal to premium received for floor. Everybody following? So when I buy cap, I have to pay premium. When I sell floor, I will receive premium. They net itself off against each other, and therefore there is no premium in this particular case. Everybody following till here? Let's now go ahead. Using the following data, you are required to determine, let us read point number 1, effective interest paid out at each reset date, which means basically they're asking you the net interest, final interest paid at each of these reset dates. Point number 2 we will see later. Let us now do point number 1. So children, there are 6 reset dates. Of course, there are 6 reset dates. Everybody following? These, of course, children, you should understand, are the payment dates. I'll tell you why it is payment dates. See, please pay attention. Do you realize you enter into a loan on 1st July 2016? Okay, 1st July 2016 you enter into a loan, and then every 6 months you'll be paying the interest, correct? So if you're entering into the loan on 1st July, children, do you realize you will not be paying your first interest on 1st July, correct? You will be paying your first interest 6 months from 1st July, that is nothing but 31st December 2016. So children, I'm very sure you understand that this LIBOR, yes, it is S1, No doubt about it. S1 means for this due date, this is the S1. But children, I'm very sure with all the explanation that I have given to you, I'm very sure you understand that this 6% is not the rate quoted on 31/12/2016. It must be the rate quoted on the date you entered the loan, that is 1st July. The rate quoted on 1st July, can I say, will be applicable for payment 6 months after. Then children, on 31st December 2016, 7.5% must be the LIBOR rate quoted, the payment for which must be happening 6 months later, and so on. I hope you understand. And we of course need not go into those details. For us, these are the 6 S1s. We have the case of both the cap and the floor. Let us knock it off and find out the final interest paid. There is no premium in this question. Can we start? So children, I'm writing down now here. Okay. Point number 1, calculation of final interest paid. Okay, calculation of final interest paid. Can we start? So students, tell me. So students, the first column I'll be writing down now here is reset date. Okay, reset date. Let us place them. 31/12/16. I'll write down here 31/12/16. The next one here is 36/17. I'll write down here 36/17. The next one is 31/12/17. I'll write down here 31/12/17. Next one is 36/18. I'll write down here 36/18. The next one is 31/12/18. Okay, I'll write down here 31/12/18. And the last one is 36/19. I'll write down here 36/19. Everybody following? Okay students, now the next column we'll be making is the LIBOR rate. Okay, the LIBOR rates are given in the question. 6%. I'll write down here 6%. The next is 7.5%. I'll write down here 7.5%. The next one is 5%. I'll write down here 5%. The next one, students, is 4%. I'll write down here 4%. The next one, students, is 3.75%. I'll write down here 3.75%. And the last is 4.25%. I'll write down here 4.25%. These are the LIBOR rates, okay? The actual LIBOR rates. These are not the estimated rates, okay? These are the actual LIBOR rates in these reset periods. Now children, do you realize that even though these are the LIBOR spot rates, for us, these will not be applicable, since for us, we have borrowed in the spot market at the rate LIBOR plus 0.5. I hope you realize, students, it is LIBOR plus 50 basis points. So whatever the L is, plus 0.5% will be our spot rates, that is the S1. Everybody following? So basically, students, whatever the LIBOR rate is, plus 0.5% will be my actual interest rate that I as a company will have to pay, irrespective of whether or not I've gone for options. I will have to pay in the spot market L plus 0.5%. So therefore, students, I will write down actual spot interest rate. Okay, actual spot interest rate for us will be LIBOR plus 0.5, correct? LIBOR plus 0.5%, that is 6.5%. 8%, that is 7.5 plus 0.5, 5 plus 0.5 will be 5.5%, 4 plus 0.5 will be 4.5%, 3.75% plus 0.5 will be 4.25%, and 4.25% plus 0.5 will be 4.75%. Everybody following till here? Can I say this is what will be our actual interest paid on the due date, considering no options as of now. Now let us go on to the options. Children, as far as the cap is concerned, tell me children, cap. You all know cap is nothing but a call option. We have gone long on the call option. Do you realize the call option, whether I've gone long or short, whether I've bought or sold, students, do you realize that when S1 is less than K, that call option becomes out of money, correct? When S1 is less than K, the call option becomes out of money. The K in the cap, children, can I say is 7%. So therefore, students, do you realize all those cases where S1 is less than 7%, do you realize that cap option will be out of money? But the tricky part here, students, is that the S1 which we will be using to compare with 7 is not this S1 but LIBOR. Because do you realize, students, in the question they very clearly told you that the reference rate for the options is not LIBOR plus 0.5. That LIBOR plus 0.5 is our actual spot interest rate. Here to compare the strike rates of the cap and floor, the interest rate, the relevant reference interest rate, the S1 taken will be only L. Everybody following? So 4 you have to compare with L, 7 you have to compare with L, not with L plus 0.5. L plus 0.5 is our actual interest borrowing rate. Everybody following till here? So therefore, students, tell me, here you have to only compare. Now as far as cap is concerned, children, do you realize cap is 7% strike rate? All those reset dates where the LIBOR, yes, where the LIBOR is below 7%, that particular cap option will be out of money, which means, can I say this is out of money considering 6%, next one is in the money considering 7.5%, next one is 5%, so out of money, next one is 4%, so out of money, next one is 3.75%, so out of money, and next one is 4.25%, so out of money. Children, therefore, do you realize the gross payoff, yes, the gross payoff for the cap option wherever it is out of money will be nil, that is 0. Everybody following? And as far as in the money is concerned, we all know it is S1 minus K. As far as cap option, we have gone long, correct, on the cap option, so S1 minus K for the holder. We are the holder of cap option, and here we have purchased a cap option, we have gone long on a cap option, we have bought a cap option, we are holding a cap option. Therefore, children, do you realize the payoff will be S1 minus K, that is 7.5% minus 7%, that is, children, 0.5% gain. Everybody following till here? Great. Next, students, let us go on to the floor. Students, as far as the floor is concerned, I hope you understand that the strike rate is now changing. The strike rate is 4%. Okay, the strike rate is 4%. Children, strike rate is 4%, but do you realize that as far as floor is concerned, if S1 is greater than K, it is out of money, else it is in the money. Everybody following? Here, children, tell me, floor is 4%. All those cases where L, again, the reference rate is L, if it is more than 4%, that particular reset date, that particular case becomes out of money. So students, please focus on the L and let's compare with 4% strike rate. If the L is more than 4%, out of money. So the first one is 6%, out of money. Next one is 7.5%, out of money. Next one, children, is 5%, out of money. Next one is 4%. Yes, this, students, do you realize will be at the money, doesn't make a difference. Next is, children, do you realize 3.75%, this will be in the money. Everybody following? So 3.75 will be in the money, and 4.25, children, of course, will be out of money since it is above 4%. Let us now find out the gross payoff. Okay, gross payoff, students, out of money, children, all will be dash, at the money also will be dash. Everybody following? Now, children, as far as floor is concerned, a person who is holding a floor, correct, a person has gone long on floor, if it is in the money, we all know the gross payoff is K minus S1. On the other hand, if a person has gone short on a floor, sold a floor, which we have sold a floor here, do you realize S1 minus K? Everybody following? S1 minus K will be the payoff for the floor seller. Everybody following till here? Now, children, tell me, S1 minus K means what here? S1 is what here, students? Can I say S1 here will be 3.75% and the K here is 4%. 3.75 minus 4, of course, is 0.25%, will be a loss here. Everybody following? 0.25% will be a loss. Students, I will not want to put it in a bracket here. I'll tell you why I'm not putting it in a bracket here. Because, children, do you realize all these interest rates are what we have to pay, correct? So if this is what you have to pay, loss also is what you have to pay, so it will of course add. Of course, here there was a gain which I'll want to put in a bracket. Everybody clear with this? So with that, we have completed the table almost. Now we can find out the final interest paid. So children, I'll write down here, okay, final interest paid. Okay, final interest paid. Let us now focus on the first reset date. Can I say 6.5% will be the final interest rate paid? Next one, children, can I say will be 8% minus 0.5, that is 7.5%. Everybody following? Next will be 5.5%. Next will be 4.5%. Everybody following? Next will be 4.25. plus 0.25. Yes, 4.25 plus 0.25, that will be 4.5%, and the last one will be 4.75%. Yes, the last one will be 4.75%. Everybody following? Yes, basically it is the actual spot rates plus any losses in the options minus any gains in the options. It is so simple. Yes, there would have been a plus premium paid on cap, less premium received on floor, but that, students, do you realize, has nullified with each other. The premium is not there in the picture. We got the final interest rates. What are they asking in the question? They are asking in the question effective interest paid. They are not asking interest rate, they are asking effective interest paid. No problem. We will just take the calci, apply that interest rates on the principal, and find out the final interest paid at each reset date. So students, I will write down here reset date. Okay, reset date. There are 6 reset dates: 1, 2, 3, 4, 5 and 6. Of course, in the exam, write down the reset dates, or just make the table where you can find a space at the end also for calculation and the amount. So I'll write down here calculation. Okay, and I'll write down the interest amount. Okay, calculation and interest amount. In fact, what you can do is, you can just here, because you're writing a separate table, I'll write down the final, okay, final interest rate, then I'll write down calculation, okay, and then the interest amount. Okay students, the first reset date, the final interest rate is 6.5%, so I'll write down here 6.5%. The next is students 7.5%, I'll write down here 7.5%. The next one, students, is 5.5%, I'll write down here 5.5%. The next one, students, is 4.5%, I'll write down here 4.5%. The next one, children, is 4.5%. Again, I'll write down here 4.5%. And the last one, children, is 4.75%. I'll write down here 4.75%. I'm very sure you understand these are per annum rates, and these reset dates are at the end of every 6 months. So for the calculations, be very attentive. Okay, let's start now, children. Tell me, what is the principal amount here? The principal amount, as we all know, is 1 crore. Correct? The principal amount is 1 crore pounds, both for the spot as well as for the options, which is why I could net off the interest rates or add them. You know, students, what would have happened had the principals of both been different? Then this, students, these interest rates would have been on the actual principal borrowed, and then these separately would have to be calculated on the notional principal in the options. But here, since the actual principal borrowed and the notional principal are same, we can easily add, subtract these interest rates. Everybody following? And the notional principal, the actual principal being same, is nothing but 1 crore pounds. So students, do you realize calculation will be 1 crore into 6.5% into 6 by 12. Everybody following? 1 crore into 7.5% into 6 by 12. 1 crore into 5.5% into 6 by 12. 1 crore into 4.5% into 6 by 12. 1 crore into 4.5% into 6 by 12. 1 crore into 4.75% into 6 by 12. Everybody following? Let's now take the calcs. 1 crore means, students, 100 lakhs obviously. So 100 lakhs into 6.5% into 6 divided by 12, or just divide by 2, we will get 3,25,000. I'll write down here 3,25,000. Next is again 100 lakhs into 7.5% into 6 divided by 12. This comes to 3,75,000. I'll write down here 3,75,000. Next is 100 lakhs into 5.5% into 6 by 12, or straight away divide by 2. I get 2,75,000. Next is 100 lakhs into 4.5% divided by 2 will give me 2,25,000. And of course the next one also being 4.5% will again be 2,25,000. And the last is, students, 1 crore, that is 100 lakhs into 4.75% into 6 divided by 12, that is nothing but 2,37,500. If we take total, this comes to 16,62,500 as the total interest paid. Everybody follow until here? 16,62,500. Therefore, students, is the total interest paid. Children, with that we complete your first point, effective interest paid out at each reset date. They are not asked such a total. But no problem, I did it for point number 2. Okay, the average overall effective rate of interest per annum. Okay, students, average effective interest rate, I'll tell you. Do you realize total you have paid this much? Okay, I'll write down here. Total interest is 1662,500, correct? This interest is paid over how many periods, students? Yes, students, so we have written down the total interest that we have paid, that is 16,62,500, which is of course paid over a period of 3 years, correct? Paid over a period of 3 years. Students, they are asking you the effective rate of interest per annum. Children, first of all, let us find out the 3-year total interest rate. Can I say that the interest rate for us will be, since we are paying 16,62,500 as the total interest on a principal of 1 crore, I'll write down here 1 crore. Yes, the effective interest rate will be 16,62,500 divided by 100 lakhs. The percentage comes to 16.625%, correct? But this 16.625%, children, do you realize is over a period of 3 years? So this is an interest rate for a 3-year period. So 1 year effective rate of interest will be what? Students, I'll again repeat, this 16,62,500 is the total interest of 3 years, correct? It is the total interest of 3 years. They are asking what is the effective interest rate per annum. So children, what we did, if this is the interest for 3 years combined on a principal of 1 crore, therefore 16.625% must be the combined 3-year interest rate, correct? So if this is the 3-year interest rate, so effective average per annum 1 year interest rate will be how much? Very simple, 16.625 into 1 divided by 3, that comes to 5.54% per annum. Okay, 5.54% per annum therefore becomes the effective interest rate per annum. Everybody clear with this? Students, one thing I want to tell you, yes, we have completed this question, no doubt about it. There is one thing I want to tell you. In the institute solution, when here at this point, can you see we have done into 6 by 12 here, correct? We've done into 6 by 12 here. Children, you know what the institute has done? They have not done into 6 by 12. They have taken the number of days divided by 365, which means here they have actually calculated that from this date of July to that date of December of that particular year, how many days were there, that divided by 365. It is of course somewhere around 181, 185 days, because of course 365 days is the total year, and of course the half of it will be ranging somewhere between 181 and 183, 184. But students, I didn't go into that details. I straight away took into 6 by 12. Half yearly means 6 by 12 for me. Everybody following? And don't worry, institute has done into 6 by 12 in many questions throughout CA final syllabus, correct? Even in this chapter of interest rate derivatives. So don't worry, there the institute has done in days calculations. We did in months calculations. That is completely fine. Secondly, children, there is another mistake in the ICAI solution, which is why the answer does not tally. Yes, there is a slight change. Children, after you go through this video of mine, I would like you all to go to the ICAI solution and check it out and find out the mistake on your own. I will not tell you. Okay, this is the correct answer. Don't worry. Okay. So with that, students, we complete this question. Question number 29. I will now flash the solution of this question on your screens. You can pause the video and copy down the notes. Okay students, so I hope you all saw the entire discussion to caps, floors and collars, that question. With that students, we end the discussion or the revision part for interest rate risk management, and that's it from my side for CA final revision. We have discussed a lot over this entire video. I hope it was helpful to you as your last minute revision. Please do see all the different questions that have been done for you during your full course lectures, because each question is important. Anytime anything can come. So I wish you all the best. Try covering as much as possible. Thank you for patient listening. All the very best for your exams.